Futures currently are pointing down 0.2%. Diageo is going to be interesting today. You've also got NatWest, but Tom has got all of the stocks that you need to be thinking about this morning. There are many.
All three of them. Yeah. Diageo. Well, the King says he's going to be raising a dram to the President, to President Trump, for giving that reprieve around the tariffs around whiskey. So Diageo could be a beneficiary, of course, of that. So watching Diageo, the ADR's jumped after President Trump said he is removing some of those whiskey tariffs. So that's really significant for that industry. Novo Nordisk in focus. We've been talking about the fact that its Wegovy has helped. It's been found to help alcoholics drink less, at least in one study. So watching that stock on the Danish market, of course. And NatWest coming through with a profit beat, guys, seeing income excluding notable items at the top end of the range, of course, heavily exposed to the mortgage market in the UK as well. To what extent is NatWest still positioned for upside? Is the growth picture here looks more challenged, but the profit was a beat, Guy.
Okay, let's talk about the market open. Smaller market open this morning. So the FTSE 100 was positive yesterday. We come through this morning. We are a little softer. We're going to soften up. It looks like a little bit more. I think we're down around 0.3%. The market across Europe is pretty much closed today. It is May Day. Most markets are closed. You've got a really long holiday coming up in Japan as well. The FTSE will be closed on Monday, so that's a factor in terms of positioning as well. How much risk do you want to carry into the weekend? You've got a few things to price in. Obviously, there is the ongoing oil move. What is happening there? The base metal story is also continuing to be interesting. You've got NatWest, which I think is interesting as well, and what it tells us about what's happening in particularly the mortgage market, which is fascinating right now. That takes you into that to the housing story. But the FTSE 100 delivering almost exactly what was anticipated, Tom, which is a move to the downside of around 0.3%. That's all the excitement I've got.
Interestingly, NatWest is down 3.4%, 3.5%, despite that profit beat, and despite pointing to a pickup in both retail and commercial borrowing. Net interest income rising to £3.4 billion. Nonetheless, it is amongst the biggest losers across the FTSE right now. So NatWest is currently down 3.6%. On the upside, the best performing across the FTSE 100 is Diageo. So we can tie that to the tariff story around whiskey. So again, President Trump saying that tariffs will be removed for whiskey into the US market. Unilever up there as well, 1.3% is the gain. You're seeing some of the builders, so the likes of Pearson is gaining 1.1%. Sorry, not in the building space, but you do have Land Securities and what else is near the top? Standard Life in terms of the financial sector and insurance is gaining 0.9%. On the downside, you've got United Utilities down 5%, and then NatWest is the second biggest drop across the FTSE 100. FTSE 250 is currently down, 0.3%.
You're doing well. Excellent. There's not much to work with this morning. That was good work. Yeah.
Appreciate that. Yeah.
In terms of points, Astra's down. NatWest is the biggest drag. In fact, Lloyds is down there as well. So the banking sector is a drag on the London market this morning. Unilever, Diageo, and Shell. So actually, some of the staples are doing relatively well. Diageo off the back of the whiskey story, but the market is rolling into some of the oil-related names as well in terms of the heavy lifting.
Novo Nordisk is down 0.6%, despite that finding around Wegovy. Let's get a broader take on these markets and bring in Leonie McCann, Head of Multi-Asset Solutions at Key Ridge Asset Management. Leonie, good morning. Thanks for joining us around the studio.
Good morning.
This Friday, a lot has happened this week for the market. Central bank action, we continue to focus on Hormuz, remains closed, of course, and earnings, which broadly are positive. I mean, particularly the tech story, top line is there were beats. Are we at a point where we have to think about equities re-rating if the Strait of Hormuz remains closed for a longer period than maybe some expect? There is continued to be this gap between the equity market performance, US stocks at record highs, and yet an energy and inflation challenge, and certainly a lot of uncertainty.
Yeah, so I think that's the big question in markets right now. And I look at markets, what they're really trying to decipher is, are we in boom or is there doom coming? And when you look at equity markets so far, really since the ceasefire, they've rallied really strongly. And a lot of that rally in markets has been on the back of a few things. Firstly, earnings. So earnings have been really strong and robust. So we're coming through Q1 earnings season. So far, about of the S&P 500 companies that have reported, around 80% have beat earnings expectations. And you're seeing average earnings growth of about 15%. So that's buoying equities. The other thing is that arguably peak uncertainty is behind us. Now, there's still a bit of cloud around that, an open question. But with the announcement of ceasefire and the indefinite ceasefire, the probability that diplomacy is the end game here has increased. So that's also given hope to markets as well. The other side of the coin is what's going on in bond markets. And bond markets, so while equity markets are leaning more towards the boom, as we've seen, supported by earnings and that AI CapEx spending boom, bond markets are a bit more worried by the fact that the Strait of Hormuz is still closed. So actually this last week, we saw UK gilts, 10-year gilts, top 5%. That's the first time they've hit that level since 2008. Similarly in Europe, 10-year German bonds hit their highest level since 2011.
Yeah.
So you're seeing that difference between now bonds, the bond market's naturally more pessimistic and equity markets will naturally be more optimistic. But our base case is that you will see a resolution and that the Strait of Hormuz will open in a number of weeks, but there is uncertainty and the fact remains that they're waiting to see those active peace talks restart.
When do those higher yields start to become a problem for equities?
Well, I think the big key piece to the higher yields right now is what is the central bank outlook. And what we saw this week was the big central banks meeting, and they're very much in a wait-and-see mode. And what you're seeing from the Bank of England and the ECB is they're looking like they're likely to raise rates in June. They're happy to wait and see because they don't want to raise rates too soon in case you do see a resolution and oil prices come back down. So monetary policy acts with a lag. So there's a risk if they raise rates this week, you could see that impact hitting after effect if you see a resolution, the Strait of Hormuz opening, that oil prices could come back down. So it's a delicate balance.
The base case is that the Strait reopens in a few weeks' time. What happens if it doesn't? What does a portfolio... What do you do? What's the advice if it doesn't open in 3 weeks' time? Do you change the advice, or do you just keep kind of pushing it forward? It'll be open in a few weeks' time.
Yeah, so this is key right now. It's really trying to assess what are the different range of outcomes that you could see, right, from a more benign to a more extreme. Our base case is that more benign, where you do see a resolution, right? It is in both sides' interest to really find an off-ramp right now. In that scenario, we would see oil coming back down if the Strait opens in, say, 4 to 6 weeks, coming back down to maybe $80 to $90 a barrel. That's still higher than the pre-war level. I think you're still going to see a premium in oil prices. In that scenario, though, those inflation and growth fears start to recede, and we think those strong growth supports we saw early in this year could re-exert themselves, and you see that supporting markets. To your point, Guy, the other side of the extreme is what if we have a more worst-case scenario? That's where you don't see a resolution, extended conflict, Strait of Hormuz remains closed, oil prices could reach those 150 to 200 levels, and that's where you do start to see inflation and growth risks coming through and the probability of recession more likely. I think in that scenario, though, the one offset could be growth risks will start to outweigh inflation risks, and I think you would see central banks cut rates, so you could see bonds. So
what do I do? So every week that it goes on, do I average into the second scenario a bit more? Or do I kind of wait for 6 weeks and go, right, I've got to change my plan here? How do you, because the longer it goes on, the more damage that is getting done and the bigger the risk there is. So how do I, as time goes on, reposition a portfolio? Do I just keep it as it is right now, or do I start to feather into that second scenario, which looks more dangerous?
So look, there's a broad range of outcomes that are there, right? So what we're doing in our multi-asset portfolios, given our base case and given that positive fundamental backdrop we saw at the start of the year, we came into this conflict overweight risk, overweight equities, and we've held that position through. But at Keyridge, we manage clients' money for the longer term, right? And we take great pride in that fiduciary responsibility bestowed upon us. So right now, naturally, the market is focused on the short term and what's happening over the next few weeks. But it's also really important to look through some of that noise and really focus as well on some of the more medium-term to longer-term drivers of markets. What we're doing in practice is we're really leaning into our core investment principles of deep diversification and risk management. What does that mean in practice, right? Is we're very diversified across different asset classes and return drivers. So in our multi-asset portfolios, we have allocations to alternatives, both liquid and illiquid, where client mandates allow that. Within our equities, we're getting a blend of exposure to more growth-orientated equities, but also some risk management strategies.
Are you going to de-risk the portfolio over the next few weeks, or do you just wait?
At the moment, we're not looking to de-risk. I think you run the risk when there is heightened uncertainty that markets could end up getting whipsawed, and you don't want to be in that situation. So given our base case and given the positive, strong fundamentals we see, the earnings support coming through, as well as fiscal stimulus globally, we are still overweight risk, but we're monitoring that very closely, and we're not using all of our risk budget.
What are the red lights that would signal that de-risking then? Is it Brent at 150? Is it the straight close for another 4 weeks? Is it a step up in military action? Is there something that you would look at and go, okay, this is the moment where we really have to re-rate and de-risk?
Yeah, so I think if you see Brent above 150 and sustained above that level, that starts to get difficult for markets. The other thing is if you were to see any earnings disappointment or that AI theme start to disappoint. Now, that was one thing that the market was really closely watching this week with the big reports we saw from the hyperscalers. Were they paring back CapEx spending, which would signal they were getting nervous about CapEx spending, or would you see earnings disappoint on that? And we didn't see that. So we're still seeing that support from earnings. If you were to see that, Wayne, I think that could be.
Is the US a safe haven?
That's a good question, right? So I think about the US in the near term, I think the US can continue to be a growth leader, because if you just think about in the context of this conflict, it's less exposed to the crisis because it's a net energy importer, and it is the AI leader. And when you think about all of that CapEx spending on AI, the majority of that is being spent in the US. However, coming back to our core investment principles and trying to look through some of that noise, on a more medium to longer term, we are starting to look beyond US exceptionalism. So when you think about it on that more medium to longer term view, there's potentially a number of headwinds which could impact the relative level of US exceptionalism versus what you saw over the last decade. That's not a negative view on the US, but just in terms of the level of exceptionalism.
Where are you looking?
So we're looking in other regions like Europe and Asia. So
looking at Europe?
Yeah, to an extent, yeah, Asia and Europe. Now, when you think about it from a US more medium to longer term, what are some of those headwinds? Well, you've got mounting fiscal pressures, just given the high debt level. Not an issue today, but it will be an issue in the future if it isn't addressed. You have increasingly isolationist policy coming out of the US. Again, over a more medium to longer term view, that could have some impact on growth. You're also potentially seeing demographic changes, just given changes in immigration policy. Now, add that in with the fact that valuations are richer in the US versus other regions. Valuations, as we know, aren't a great predictor of returns in the short term, but over a much longer term, they can be a strong predictor. So we think there is scope for other regions to potentially catch up somewhat with the US.
I don't know if I detected some skepticism in your question. Europe, question mark.
Europe feels the most challenged right now. Asia, with the tech story, looks much stronger. You've seen what's happened with Taiwan and Korea.
What draws you to, what specifically are you looking at in Europe in terms of the opportunities? Is it finding companies that are resilient to that energy shock and to that lower growth story? Is it companies that are leaning into defense spending? Is it companies that can play into the data center story? What is it that is drawing your eye?
Yeah, so it's not just a Europe story, right? We're looking at other regions outside the US, Europe and Asia, and also some EM. But when I look at Europe, near term, it definitely faces its challenges, right? It's more exposed to the conflict right now. Inflation is picking up. We saw that this week. Now you're not seeing core inflation pick up, so those dreaded second-order impacts of inflation aren't coming through yet. Growth is slow in Europe, growth coming through a little lower than expected at 0.1% for Q1. But when you look at Europe, it's not in as bad a situation as it was back in 2022 when we last saw the energy shock. If you just think about what we faced with then, there are a multitude of factors. You had a global supply chain shock from the pandemic, you had pent-up demand, a savings buffer, and then you had the energy shock of Russia invading Ukraine. Today, you're not in the same situation. You are seeing a shock, but the supply shock is just the Strait of Hormuz, and monetary policy is tighter. So if you were to see that worst case scenario that myself and Guy spoke about, you're not going to see inflation spike to the same levels we saw back in 2022, and also you won't see as a result as extreme number of hikes. So in terms of where you're looking at Europe, defence spending will be a longer-term structural support. You're seeing fiscal stimulus in Europe, which should help some growth. And then, you know, when you look at markets, two of the big dominant drivers right now are geopolitics and AI. And one of the themes coming out of geopolitics is we are seeing a bit more focus on national champions. We're seeing this in the US, but there's also potential that you'll start to see that in Europe as well. So that's something we're keeping an eye out for.
Erin, it's been great to see you. Thanks for joining us ahead of a long weekend. We really appreciate it.
Thank you very much.
Jenny McCann, Head of Multi-Asset Solutions at Keyridge Asset Management. Dollars popped a little bit off the earlier lows. We'll keep an eye on that trade for you. Let's talk as well about what is happening, some of the single stocks that we're watching this morning. Charlie, NatWest, what's going on?
I mean, that's a good question because they just had a really solid earnings report. They beat on profitability. They strengthened income guidance. They reiterated their guidance for the year ahead. This is what traders have been looking for. This is what they've been wanting to find out about. And look what's happened. We're down over 3% this morning. So again, this is repeating a pattern that we saw yesterday morning when a lot of French banks delivered pretty solid reports, but then the market didn't reward them for that. So this could be concerns, right, about the broader economy. This could be concerns about rates. This could be concerns about the consumer. But this seems to be a pattern that we're seeing in European banks. Despite solid results that we're seeing, the market is just not reacting to those. So that could be some bigger issues that we've got out there. Let's flip and take a look at Diageo because we are in the green here, up nearly 2%. Now, this appears to be on the back of that announcement from Donald Trump that he would be giving preferential treatment to whiskey from the UK. This had been a major flashpoint in trade negotiations between the two countries. It follows that state visit by King Charles and Queen Camilla to the United States. So this should give a boost to Diageo, and it certainly looks like it is because Scotch is about a quarter of their revenue. It's really important for their company. So again, traders seeming to like this. Let's flip again and talk about Unilever because I think this is a really interesting story too. They had a really solid earnings report yesterday. Again, the market seeming to be liking this in the green. Now, what was interesting about Unilever is they talked a lot about volume growth as opposed to just price growth. So this could be the market really liking that, seeing this expansion not just in developed economies, but also in emerging markets. That's a really important growth driver for this company. So still the market digesting that and seeming to like what it seems out of Unilever. I want to end on AstraZeneca because they just had some disappointing news coming from U.S. regulators, basically regulators in the United States failing to endorse a breast cancer treatment. Now, again, this had been really important for AstraZeneca. They wanted to diversify, and they want to diversify beyond vaccines. But again, failing to get that regulatory approval is hitting the stock this morning, and this had been a key drug in their pipeline. So definitely a blow to the company this morning.
Charlie Wells, thank you very much indeed, with some of the stocks on the move this Friday. Coming up, Apple delivering a juicy sales forecast, but so far investors are only taking a nibble on the shares. Congratulations, producers, for that tease. Up a touch in after-hours trade. More details next. This is Bloomberg.
This has Bloomberg Daybreak Europe. I'm Lizzie Burden in London, and these are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything. It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
At a time when policy in Washington is driving Wall Street, we draw a distinction between the rhetoric and the action, bringing you market-moving guests and original reporting. This is Bloomberg Surveillance.
At 9:30 a.m., the market tells you what it's really thinking.
We beat the drum to the opening bell.
With deep analysis of the forces driving the price action.
Focusing investors on what really matters.
Where the money flows, which markets are changing.
Conversations with players shaping the narrative.
Innovative growth companies gravitate to NASDAQ.
It's not just like, let's buy the Mag 7 or AI.
That's a really compelling story.
This is where your trading day begins.
And this is Open Interest.
Only on Bloomberg.
Astonishing day for US technology.
It's shaping the region's technology ecosystem.
Asia's biggest tech news and innovation.
Welcome to Bloomberg This Weekend. I'm David Murray.
I'm Lisa Mateo. And I'm Christina Ruffini. We're tracking breaking news today from Wall Street to Washington. Let's start overseas. The sector is really propelling this deal forward.
Yeah, the hope is this will open up new markets and provide some additional liquidity.
Of course, now they're going to have competitors. We got a big week coming up in politics.
Earnings season is underway. We're going to get some key reports.
Everything you need to know before the markets open on Monday.
Introducing Bloomberg This Weekend, bringing a little Bloomberg into your weekend routine.
Guys, buckle up.
Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate. More than what you need to know, it's what you need to think about.
Morning, welcome back. 20 minutes past the hour. Most markets in Europe are closed today. The UK is open, which puts a firm focus on NatWest. The bank is lower this morning. Its stock is lower, as you can see, by 3.5. Actually, the numbers looked all right. We beat estimates in the first quarter. Higher earnings going forward. Consumer looks okay. So why is the stock down? Let's try and find out. Tom Metcalf, our EMEA Finance Managing Editor, who's definitely put in a shift this week, joins us finally on a Friday. Why are the shares down?
Yeah, I think, well, let's try to find out, I suppose. That's something I'm also trying to work out. I think kind of there were beats like lending, also borrowing was pretty good. So there's lots of positives to take. But I think on a few things, the market, I say quiet markets, so probably the moves are a bit outsized. Also looking at, maybe it's just a little bit disappointing despite a relatively decent print. Yeah. And, you've also got the B of E, of course, yesterday coming out with some pretty gloomy, predictions perhaps about the UK economy. So I think, the sentiment's off as well a bit today.
So if the BOE hikes in June, it's still an if, of course, but markets are pricing in more than 2 hikes by the end of this year. Positive for net interest income for NatWest going forward, but a constraint maybe in other parts of the business. I mean, it's obviously heavily exposed to the mortgage market as well. How are higher rates, or at least rates above 4%? How would that factor in?
Well, I think that's the thing. Is it's always that balancing act. Higher rates, you'd think, always good for banks. No, it's just how much it impacts the economy, and it's kind of that give and take, I suppose. And look, I mean, this was the most extreme case, but the Bank of England were yesterday talking about 5.5%, which, if you manage to put that into the mortgage market, that is just going to lock up a lot of the housing market. So, for me, I think that's been the shift. Is obviously the last few years, higher rates was a great story banks could tell. But probably right now, actually, they would have welcomed what was the status quo until a couple of months ago was, lower rates, because that's kind of what everyone's been building towards. And, consumers would probably be then more optimistic and spending more.
Yeah, you got higher mortgage rates, plus also landlords are selling at the moment aggressively into a market that is looking pretty tough. So the housing market's looking quite tough right now. How does NatWest stack up against the others?
Yeah, again, it's sort of a print that doesn't look too different to, say, Lloyd's or anything like that. And you've got the CFO today, as we speak, going on there saying, look, we're not seeing signs of distress in our books.
Right, so there's no credit issue here?
No, I think it's one of those ones where they did fine, but really for the market to kind of respond a bit better today, they probably really needed to, I guess, change the dynamic or really make people think a different way.
Don't report numbers on a Friday before a long weekend, maybe, is the strategy.
I'd 100% agree with that. That should be a rule.
Okay, Tom Metcalf, thank you very much indeed. The stock's down 3.7% despite the profit beat coming through for NatWest. Tom Metcalf, who of course leads our EMEA finance team. Tom, thank you. Let's get to the tech space. Of course, talking of a beat, very strong set of numbers coming through for Apple. Shares ticking higher in late trading after the company issued a surprisingly strong revenue forecast for the third quarter. The tech giant is projecting double-digit sales growth, even as it warns of rising memory chip costs and ongoing supply constraints. Let's bring in Matt Bloxham, senior analyst at Bloomberg Intelligence. Matt, you were talking to us yesterday about how the supply chain story of Apple would be crucial, particularly the input costs. What for you stood out from a set of numbers that, at least on a headline basis, look very strong for Apple?
Yeah, obviously the continued strength in China. You know, if we go back a year, they were really struggling in China, kind of shrinking revenue, and now they're up into kind of high 20% year-on-year growth, sustaining what they did last quarter. I think there were some kind of warning signs there from them that maybe explains to some degree why the shares haven't reacted more positively. That they're starting to see some impacts from rising memory prices, but that will become a much more significant headwind in the quarters to come. So perhaps some kind of margin pressure coming. But overall, consumers can't get their hands on enough Apple products by the sounds of it. The Neo is sold out, strong demand for iPhone, and there isn't enough supply to meet that demand. So the overall picture looks pretty good.
So you're John Turner. Is this good or bad? The numbers look okay. But you're probably quite a long way through a kind of a mini sort of upgrade cycle for the iPhone. So you're going to come in off the back of that. What are you going? How do you move the ball forward?
Yeah, I mean, I think in some ways he inherits an incredibly strong business, particularly the balance sheet. I think he's got. It doesn't
sound great if you're a CEO though. If you're an incoming CEO, it look fantastic. But you've got to then make it even better.
Exactly, but there are some opportunities to make things better. Obviously, the AI strategy has been one of the kind of the weak points. Perhaps as Tim Cook's legacy rolls out, there's an opportunity there to kind of really reposition Apple there. Obviously, there's the foldable iPhone coming out, and there's the next form factor for consumer devices as AI takes hold. So there are some massive opportunities for him to create his own legacy and really take Apple from an incredibly strong position to an even stronger one. And it was interesting, I thought, how they changed the guidance on the balance sheet. They're not going to run a net cash neutral policy anymore. They're going to divide cash and debt. And they said, again, that the priority is to give the business the investment it needs, and then shareholder returns come after that. We'll see how that plays out, but potentially there's going to be some different perspectives within the company about how they invest, whether it's just organic cash flow investment. Did they start to use a balance sheet for M&A to kind of strengthen some of these areas, particularly in AI?
We also got earnings from some of the memory makers themselves, which are Western, of course, Western Digital and SanDisk. The earnings were beat, and yet the stock performance, the investors did not welcome the numbers.
No, I think, obviously, when you look at the share prices for these companies in the last month or few months, and they've gone up massively. So I think this is a bit of a, kind of...
Like hundreds of percent.
Yeah. Exactly, and it's just kind of like a journey, and I think even though there's a big beat on consensus for the quarter reported and on the forward guide, the whisper numbers were massively higher. So I think people are kind of looking at going and saying, are they just being cautious, or is there something going on here about the kind of demand supply dynamics that's not apparent now, but it's obviously going to take the edge of it. So yeah.
Okay, Matt, nice. Thank you very much indeed. Matt Bloxham joining us on the tech story. I want to take you back to the central bank story. You got a couple of speakers coming out over the last couple of minutes. Magnus Muller's out, Joachim Nagel's out from the Bundesbank. Both, to be honest, painting a pretty similar picture. Talking about the fact that we could see rate hikes. Nagel saying a June hike is appropriate if no markedly improvement on the inflation picture. Muller becoming increasingly clearer that energy prices will remain elevated. Basically, both pointing us in the direction, firming up maybe the language we got from Christine Lagarde yesterday.
Yep, euro-dollar at 117 right now. Coming up, investors and central banks, of course, watching for the trickle-through impact of the Iran war. To that point, we're going to talk to Marathon's Bruce Richards about the macro environment, private credit, and more. Stay with us for that conversation. This is Bloomberg.
Peru is maybe first country inspired to me to how can I use the different ingredients. First time I went to Peru, trying to culture food. I never had this ingredients never used in Japan. Kind of like a wow, you know, and cilantros, chili, garlic, and olive oils. It's a lot of good seafoods, complete a different way. Example, they have the fresh fish, but Japan, the fresh fish uses sashimi, but Peru use fresh fish, make the called the ceviche, cooked with the lemon juice. You know, never use the soy sauce. First time I eat this, kind of the wow. So then after this one, my open eye more, my cooking style that change, combined to Japanese style and another country food, then make novel style.
Welcome to the world of decentralized finance.
Why is it that NFTs have not recovered in the same way that, say, Bitcoin has?
Bloomberg is covering all things crypto.
It's a pretty spectacular story.
The people.
This is the future. This is the 21st century economy.
The transactions.
It snapped up nearly $1 billion of Bitcoin.
And the technology.
We need to build a digital Fort Knox.
That gives people financial freedom, and that's a wonderful thing.
That's extraordinary.
We ride the wave that is Bitcoin.
Bloomberg Crypto, only on Bloomberg. Middle East tensions are high.
Both sides willing to go back to the battlefield.
The narrative changes moment to moment.
Is there a ceasefire? Is there not a ceasefire? Markets are up, markets are down.
Count on Bloomberg for up-to-the-minute reporting.
Breaking news this morning.
Breaking news in the last few minutes.
On-the-ground perspective.
Talking to you from the bomb shelter.
This White House still pushing.
And the analysis you need to make informed decisions fast.
Clearly, nothing is final until it's well and truly final.
The really important question is whether we'll get second-round effects.
Nobody covers geopolitics like Bloomberg.
The trading day is about to start.
And you're already looking for that edge.
The opening trade brings you everything you need to know as markets open across Europe.
I'm Guy Johnson.
I'm Anna Edwards.
And I'm Tom McKenzie.
This is your opening trade.
Only on Bloomberg.
Happy Friday. This is the opening trade. We are 30 minutes into today's session. Every market apart from the Danish and the UK markets closed today. So the FTSE 100 is firmly in focus for us today. Currently down 0.4%. Of course, volumes will be light in the context of the holiday for most, of course, European investors. We're looking at an oil price still around 110, 111 dollars per barrel on Brent. We continue to digest, of course, the earnings story in NatWest coming through, but also the central bank action of earlier this week, of course, as well, Guy. But currently, you're looking at losses of around 0.4% on the FTSE 100.
Yeah, market time, waiting for a better price discovery, I would maybe argue, next week. There are some single stocks that are worth looking at. Pearson is one of them in the education space. The stock is up by 4.5%. Numbers out this morning, reiterating guidance. Market likes a little bit of clarity coming out of this business. Diageo is the fun one this morning. King Charles, going over to the United States, and Donald Trump talking about the fact that he is going to reunite Kentucky and Scotland. We're going to see the tariffs being removed on Scotch whisky, and as a result of which, we do see Diageo up on the back of that, up by 1.7%. NatWest, I'm a little confused by this morning. The numbers look all right, but maybe it's a simple fact of being kind of better to travel than arrive. NatWest is a little softer this morning. The numbers are okay, maybe not quite good enough, but the stock is being marked down. But it's a thin trade today, so maybe that's a factor in what we're seeing there, Tom.
Okay. Here's what else you need to know this Friday morning. Fitch Ratings is warning the US credit grade faces the challenges of a widening deficit that leaves its debt burden, quote, far above other nations that share its AA score. Deterioration is likely in the US fiscal position this year due to tax cuts in the One Big Beautiful Bill Act, despite offsets from tariff revenue. Fitch downgraded the US in August 2023 by one level to AA+, citing concerns about political wrangling over the debt ceiling. UK home values unexpectedly strengthened in April, according to one of the country's largest lenders. The move higher, suggesting that the housing market remained resilient even as the Iran war pushed up mortgage rates. President Trump is calling the Iran blockade, quote, incredible, adding that he's sticking with the closure of the vital Strait of Hormuz. These comments coming as pump prices across parts of the US are rising sharply, with the national average at fresh highs and retail gasoline in California soaring above $6 a gallon.
Tom, let's pick up on that theme and continue it. Oil Brent. holding on to its second weekly gain. Let's get more details on what is happening now. Anthony DePaola, our Middle East energy reporter, joining us. Anthony, the war is now entering its third month. The President of the United States indicating that the strait is going to remain closed. As time marches on, how far are we now away from shortages becoming a material risk rather than simply just elevated prices? Okay, we are having a slight technical difficulty when it comes to connecting with Dubai. So let's talk, let's chat. Here's the question, and this is what everybody's grappling with at the moment. And we heard it yesterday from Christine Lagarde, and we heard it yesterday from the Bank of England governor. Oil's in charge of this narrative. Everything else is determined on what kind of the price of crude is. But there's this other factor as well, which is the demand destruction story. Are we actually just going to see material shortages? And is that something that actually can have a much bigger growth hit than simply just the high prices that we're all beginning to factor in?
And on that demand destruction story, we were hearing from Kepler at the start of this week, the analyst there suggesting you get to 120, you get to 125, 130, that's where you start to see demand destruction. We got to around 125 yesterday before, of course, that moved lower by about 10%. Andrew Bailey was talking about this at the central bank meeting, of course, of the BOE, in terms of the volatility that we're starting to see in the oil markets now. If this is an entrenched position from the Trump administration in terms of keeping this blockade in place with no movement right now from Iran, what does that mean in terms of physical barrels on the market longer term?
Technical difficulty apparently fixed. Let's return to Anthony DePaola and try and find out exactly what is happening here. Are we going to get shortages soon, Anthony? Is that the risk that we now face?
Hi, good morning, Guy. Yeah, I mean, shortage is already in the market as the last oil that had left the Persian Gulf before these blockades started and was available to the free market has pretty much already arrived for a couple weeks now to its buyers. The only one who was really able to export out of the Gulf was Iran, and of course those barrels were restricted. And that has been completely cut off since we had the U.S. blockade imposed, which, as you just said, U.S. President Donald Trump has said is working fantastically, and he wants to keep it in place. So that's going to keep any vestiges of oil flowing out of the Strait of Hormuz, out of the Gulf, blocked. And these are really the kind of the red lines for those two parties, Iran and the U.S., when they're talking about getting back into negotiations. Iran wants the blockade lifted in order to get back to the table, and the U.S. wants Hormuz open. So we're really at a stalemate there. And according to those comments of President Donald Trump, he wants to continue to squeeze Iran by depriving it of its income, the income that it gets from oil supplies. At the same time, the global economy is being deprived of those needed oil supplies. More than 10 million barrels a day of crude that's being blocked inside the Gulf. Of course, we have the UAE and Saudi with some pipelines that run outside of Hormuz, and so they've been able to continue exporting something about 6.5 million barrels a day, but that's much less than the roughly 20 million that we would have been getting at before. So to your question, yeah, we are deprived of oil, and so that's a big issue, and that's what we're seeing in prices and in gasoline for sure coming through, Guy.
Anthony, thanks for the update. Sorry for the technical issues. Anthony DePaola joining us out of Dubai. Bruce Richards is here, folks. Let's talk to him about what's happening. CEO, chair, and founder of Marathon Asset Management. Good morning. Nice to see you.
Nice
the ECB is going to raise rates, it looks like it. Is that a mistake?
It is a mistake, and it's a policy mistake to raise rates because high inflation is a function of higher oil prices, and as long as the strait remains closed, we're going to see higher oil prices, and all we're going to see from central banks raising rates is destroy, demand and drive growth down, and at the same time, it's going to do nothing to bring supply on, and so it's not going to affect inflation, and so I don't think there's a purpose really in raising rates at this juncture right now.
We're going to see damage being done in Europe, economic damage being done.
We will, and I think, in the U.S. as well, they would be, well advised not to raise rates.
Do you think it's likely the Fed raises rates? It doesn't sound like Washington's going to go anywhere near that.
Today's, happy May Day, and so in exactly 2 weeks, we have a new Fed chair, Kevin Warsh, and I think he has two central policy focus points. Number one is, let's bring down rates, but he can't and he won't be able to, given the composition of all the governors, because they're all on hold until they see lower inflation. So with inflation at 3+% right now and trending a little higher because of oil prices. In the next couple of months, we'll see CPI and PCE go up. I think his hands are tied, but he wants to see lower rates. And so as soon as we get a break in, as soon as the Strait opens, we get a break in oil prices. I think that later this year, hopefully, if peace prevails and we can get the Strait open, that we'll see lower rates. And by the Fed and I think the ECB and Bank of England will be well served also when inflation comes under control by lowering rates.
Bruce, good morning.
Morning,
I was making this point earlier on the show that this looks like a US administration and maybe a new Fed chair as well that wants to run this economy hot. 2% growth, inflation is looking stickier, and maybe we get cuts. If not immediately, then in the longer term. Is this an economy that's being run hot in the US?
The U.S. economy is in good shape. It comes in good shape. First of all, it is a net exporter of oil and gas. It has plenty of oil and gas, although consumers will pay more at the pump. And as you pointed out, the national average right now is approaching $4.50 a gallon and over $6 a gallon for the first time in California, the highest rate for, at the pump that we've seen. And so that's going to take a little bit out of discretionary spending for consumers. But the economy is doing well. 2% growth in the first quarter. We have the big, beautiful bill, which has all these tax incentives in. Now, it's going to an earlier point, it's going to drive deficits higher, and it's essentially deficit spending by giving all these tax incentives for anyone that puts CapEx, brings industrialization and manufacturing back to the United States, and there's a lot of that. There's big data center spend, which is hundreds of billions a year. It's a $31 trillion economy, the U.S. economy. So 2% growth is around $600 billion per year. You may have $200 to $500 billion a year in just data center spending, in addition to the spending that happens from bringing the supply chain back to the United States. And so the U.S. economy is driven by the consumer. It's 65 to 75% consumer consumption. And that looks rock solid to me because employment is running full in relative terms, 4%, low 4%. And so I think the U.S. economy is in fine shape. But oil prices is the key.
Yeah.
And it's not a spike in oil to 120 for a day or a week. That doesn't bother me at all, although that's unsettling. It's duration. You keep it there for a year, and I believe it takes about 1% off of growth, and you have higher inflation, and that looks like stagflation. As opposed to 2% growth, maybe you have 1, and you have a 3 to 4% inflation rate. You take oil prices to 140, and it's within shouting distance, 140, and you keep that there for a year, that's when we're talking about a much different scenario in terms of potential for recession.
But that's a potential worst-case scenario, 140.
I'm not so sure it's a worst-case scenario right now with the Strait closed.
What's the worst-case scenario?
Well, look at 2008.
Okay.
In 2008, oil prices in, I believe it was July 11th, hit $147 a barrel, Brent and WTI. But the good news is 5 months later, in December of the same year, 5 months later, it hit $32 a barrel, 147 to 32. Venezuela's coming on board.
Yeah.
The OPEC is, with UAE deciding to, take a different vantage point on their participation, with Iran coming on potentially if we can get the Strait open and we can bring Iran into, back into the economy of exports. There's going to be an overabundance of oil and gas. So I see the backside of this much lower than the short-term spike. I'm hopeful, but if we keep oil prices high, and look, there's 9 weeks in, and there's about 10 to 12 weeks of supply. As you take supply, the reserves, and you exhaust it all, that's when you get your spike. And so we haven't seen the real spike that could happen yet if the Strait stays closed for the next 4 to 8 weeks.
Oil prices, AI. At the moment, that's the tussle. AI spending is epic. Oil prices are a problem. You believe in AI. Is that the longer-term sort of bigger upside? Is the upside bigger because of AI than what you're seeing in terms of the
oil prices are temporary, I believe. I don't believe it's structurally going to be here based upon the abundance of oil and gas in the world. AI is the greatest technological change of our lifetime.
Sure.
And so you look at the value creation, Anthropic, OpenAI, each trillion-dollar companies, roughly. And so that's $2 trillion in value creation there, and there's many other companies.
Yep.
Think about the chips, the semiconductors. Last month, they were up 40%. 40%. That's the biggest monthly rally, I believe, this century, at least since the year 2000, up 40%. And then you have all the data set spending, and then you have all the companies that are going to be beneficiaries of AI, all the productivity gains. And that's true of the public markets. It's true of private equity. It's a tremendous boon to productivity, and that's why we're starting to see the early signs of earnings being so strong, despite what is higher inflation.
Having to spend so much money. Do we need to go through, does AI need to be cheaper, basically? Do we need to go through this kind of normal big spending kind of story? You get it with railways, you get it with everything else. The price then comes down. Then it becomes the miracle that we all hope it's going to become, that it delivers that productivity stuff. But can it deliver the productivity bonus that we're expecting if prices remain elevated? Do we need to commoditize this stuff, make it cheaper? Do we need to go through some sort of boom and bust cycle so that actually AI can deliver at a price that most people, most businesses can benefit from?
The boom and bust will come, and the boom will be the big hyperscalers that have the capital, that have the capital structure, that have the ability to raise money in order to make the investment. But there's a whole neo-cloud of upstarts that won't make it through, what this next cycle is going to be, because there's going to be winners and losers in this space, guys, you all know. And so rather being a boom and a bust per se, I think we're in the early innings of it. It's a lot of CapEx spending. It's going to bring enormous productivity gains, and I think that's a net very much a positive for the economy and GDP.
So, Bruce, how do you want to invest around that scenario then? How do you want to invest to get exposure to the boom part of that scenario, but protect against the downside of the bust? How are you thinking about positioning around that theme longer term?
Yeah, look at software, for instance. That's a good way to segue to software. Software, I've been quite bullish, and we've bearish in the sector, and we've taken a vantage point as a lender to not participate, to not expose our clients to that exposure, and it served us very, very well because I made that call with our CIO and our investment staff when they started to play around with ChatGPT when OpenAI dropped that years and years ago, understanding, connecting the dots, what it meant for the software industry.
So you saw that back towards the end of 2022, early 2023?
I've been watching this for years and been making this call internally at Marathon and been speaking vocally about this for some time. So we're way ahead of the curve. But now let's make the bull case a little bit for software. And the bull case is software. You look at Salesforce, ServiceNow, Intuit, Adobe, they're trading 8 times forward earnings. Those are very cheap valuations based upon big margins, strong earnings, and so some companies in that sector are way undervalued, and I think there's tremendous upside when they make the AI conversion to be an AI-first software company. Now, not every software company is going to make that conversion, and there's going to be the haves and the have-nots, and they're going to be the winners and the losers, and you don't know who makes it through that Rubicon at this point in time, so valuations are relatively cheap. Okay. There's a big distinction in Europe from the U.S. The U.S. has been very heavily focused on software investing in the private credit and private equity markets. Europe has been much, much less exposure to software, much less leverage, much less exposure, and very good straight from a private credit and private equity standpoint. And so it's been principally a U.S. risk factor there. As it relates to AI, it's going to be enormously productive for the U.S. and global economy to have this resource. It's hugely transformative.
Bruce Richards, fantastic to say you are staying with us, we're staying with you, you're staying with us. So more from Bruce coming up. Next, we're going to focus on the outlook for private credit. This is a new report from Fitch reveals record first quarter defaults from new private credit borrowers. Stay with us. This is Bloomberg.
As an exchange, what can you do to make it more attractive to be a publicly traded company?
Talk to our customers. We spent a lot of time with our listed companies, listening to their concerns, particularly the offices of the CFO, head of IR, listening to their pain points, general counsels as well, and then act as an advocacy group for those companies to really focus on structured reform to allow a company to tell their story in the most efficient way possible and reward them for the good disclosures that they are making in the market.
Is there any sort of financial innovation that you could drive to get more companies to list? Tokenization has come up.
Well, we did announce our tokenization initiative earlier this year. We already built the technology, we've already done a variety of proof of concepts. It allows for instantaneous settlement, 24/7 trading. It importantly allows for the rights associated with a share to move into that electronic form, but is going to be a platform that runs in parallel to our more traditional exchanges.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Bringing you up-to-the-minute global news whenever and wherever it happens. I'm Jemana Bersecci in Davos, Switzerland, and this is Bloomberg.
Welcome back. 50 minutes into the session. Bruce Richards is still here. So let's talk about private credit, private lending. A fresh report from Fitch Ratings has revealed a record number of new private credit borrowers defaulted in Q1. This as 3 of the biggest names in private credit space moved to reassure investors this week about the AI risks facing their software borrowers. We've just been talking about this with Bruce. He's still with us. Bruce, let's continue the conversation we left a few moments ago talking about software and talk about kind of the phase that we've just been through and the opportunities that are being thrown up. The vintages of the last few years in terms of investments must be starting to smell like rotten fish a little bit. How does what comes next take advantage of what the last few years have looked like?
Beginning 2020 to 2025, those 2 vintages of fundraisers for private credit will underperform relative to expectations, no doubt because of the overexposure in software. That's the bad news. Again, that's true of U.S., much less true of Europe. I think Europe is just fine. Leveling set that, when you look forward, as you point out, Guy, there's some really fascinating things. Number one, everyone now understands the impact to software from AI and how transformative that is and how much risk some of these private credit managers have in software. Everyone now understands that. And so this next vintage, private credit managers will not be allocating much, if anything at all, to software, given the risk of what that company looks like in 5 years. Huge swing. And that's a good thing. Spreads now in the U.S. are 50 to 75 basis points wider in private credit. Meanwhile, high-yield bonds tightened last month from 350 into 300, which is a relatively tight level. So you have really nice dynamic of private credit looks very cheap and is a great allocation for investors relative to the public credit markets. So that's the first thing. Spreads are probably around 25 to 40 basis points wider here in Europe in private credit. Covenants, they've tightened up, as has documentation. So I think the next vintage for private credit is going to be a very strong vintage. And capital allocators are going to allocate to their best private credit managers. And we're seeing this. You know, this week I've been in 4 countries. And I'm glad to be here on May Day here in London. But I've been in 4 countries. I've met with about 50 investors. These investors are institutional investors, some leading insurance companies, and some leaders in the wealth management sector. And the investors across the board are very excited about the credit markets because they understand this next credit vintage for direct lending is going to be a strong one. Based upon what I just said, they get that, and they're allocating. Again, it's going to be a big dispersion between the winners in the private credit market and those that took too much risk. And we're going to see that play out. The second thing is when you see turbulence in the direct lending business, when you have volatility and uncertainty and this higher level of defaults that you're referencing, then you see opportunity for opportunistic credit. It will probably be the best opportunistic credit vintage, dislocation, distress, but mostly capital solutions for company. It will be the best vintage, I believe, since the GFC. Maybe not as good as the GFC, but a really strong vintage. And then what people are very excited about is asset-based lending, because asset-based lending is your offset to direct lending. Direct lending is based upon a company's cash flow, their ability to generate earnings, and your debt-to-EBITDA ratios. And asset-based lending is all about, here's hard assets. We prefer HALO, which is hard assets, low obsolescence. Here's your asset value, $100 million of property, plant, and equipment, whether it's an Airbus 320neo, whether it's turbines or engines or cranes. Here's your collateral pool, and I have a perfected interest in that collateral pool. And I have $65 million loan against that $100 million property. I'm at 65% LTV. The balance between ABL and DL is what a lot of investment allocators are looking to allocate to. And there's nothing better, I think, than your 60-40 portfolio. The 60% is equities, that's public equities and private equity, and your 40% is fixed income and credit, that's both the public markets and the private markets. And that's how investors are thinking.
How big is that shift to asset-backed lending then? And how big does that market become, do you think, on the back of this?
Well, the market is as big as $40 trillion in terms of the TAM of asset-based marketplace. Now, a lot of that is what I call nons. No assets, no security. Talk about buy now, pay later that people call asset-based finance, or credit card loan, or a student loan. So those loans, when there's a loss, you have a default, you have a 90% loss. It's a 5% recovery or 25% recovery. And so that's 40 trillion. When you talk about hard assets, that's a marketplace of around 10 to 15 trillion in size. How big is the asset-based lending market today? Around 500 billion.
Yep.
The direct lending marketplace is 1.8 trillion. And so asset-based lending has a long way to capture in terms of market share relative to the TAM, as well as the balance with direct lending in terms of its size. And I believe it will catch direct lending and be equally important to a capital allocator's wallet. Direct lending, of course, is here to stay, will be bigger than ever, and ABL will catch direct lending.
Bruce, it's been great to catch up. Thank you very much indeed for joining us here on set. Bruce Richards, the CEO and Chair of Marathon Asset Management. You're going home, right? You're heading home. Okay. So we got a whole weekend coming up here for most.
Great weekend.
Yep.
Great May Day weekend. I hope you dance around that maypole and have a joyous time.
Now that's an image, Bruce.
I'm not going to be doing that. But it sounds like quite a nice idea.
There's a Grand Prix, potentially, if thunderstorms don't derail it.
Is there a weather concern? Miami is the Miami Grand Prix, isn't it?
Thunderstorm concerns, apparently, about the Miami Grand Prix.
Bath Exeter is the game I'm going to be paying attention to.
You'll focus on Bath Exeter.
Yeah. Anyway, Met Gala apparently on Monday. We'll talk about that Monday. We're closed here over the weekend and into Monday in the UK. Have a great weekend, folks.
Know how the market day started.
Find out how it finishes.
Public markets to private markets.
From the micro to the macro.
Covering retail, entertainment, the business of sports.
The supply chains, trade policy, how it all is impacting the U.S. equity market as we drive to the closing bell at 4 p.m.
A holistic approach to covering financial markets.
If it matters to your life, we're covering it. I'm Katie Greifeld.
And I'm Romaine Bostic, and this is The Close.
Live every weekday.
Only on Bloomberg. Context changes everything.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Amin, only on Bloomberg.
Good morning. This is Bloomberg Daybreak Europe. I'm Lizzie Burden in London, and these are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
At 9:30 a.m., the market tells you what it's really thinking.
We beat the drum to the opening bell.
With deep analysis of the forces driving the price action.
Focusing investors on what really matters.
Where the money flows, which markets are changing.
Conversations with players shaping the narrative.
Innovative growth companies gravitate to NASDAQ.
It's not just like, let's buy the Mag 7 or AI.
That's a really compelling story.
This is where your trading day begins.
And this is Open Interest.
Only on Bloomberg.
Oil prices head for a second week of gains, but President Trump defends his policy in the Middle East, saying the Iranian economy is a disaster. Apple tops estimates a boost for incoming chief executive John Ternus, but the company warns about higher costs for memory chips and shortages of Mac computers. And Japan intervenes in the currency market for the first time since 2024. Some traders say more action could actually be needed. So there is quite a lot going on in the markets, but happy Friday, everyone. We've made it to Friday after what was a very intense week, not only for the geopolitics, markets, but of course what we heard from central banks. Now today, U.S. equity futures seem to be edging a little bit higher again, signaling that a rally may have a little bit further to run. I'm also looking at the yen rising as much as 0.7% against the dollar, again extending some of the gains beyond the level struck following the intervention from Japanese authorities yesterday, late yesterday on Friday. And then finally, oil actually holding on to the second weekly gains. Look, if you look at Brent, it's above $111 a barrel. WTI nearing 106, as Donald Trump says he was sticking with the naval blockade of Iranian ports. The way this is all playing out in European markets, the CAC, the DAX, and for example, the IBEX and the FTSE may be a little bit higher, but the FTSE here in the UK down 0.5%. So for the conversations that matter and the insights you need, let's get started.
Newsmakers and market movers. This is The Pulse with Francine Lacqua.
Well, good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London. Now, pump prices keep rising, but President Trump is defending his strategy in the Middle East. Now, we discuss what it means for inflation and monetary policy with Yari Sten from Goldman Sachs in just a moment. But first, Apple posted a surprisingly strong revenue forecast for the third quarter. The tech giant projecting double-digit sales growth, even as it warns of rising memory chip costs and ongoing supply pressures. Well, joining us now is Matt Bloxham, senior analyst at Bloomberg Intelligence. Matt, always good to speak to you, especially on a Friday morning. So what stood out to you in these results and the guidance that they also issued?
Yes, I mean, also that guidance in itself is pretty robust, of 14 to 17% year-on-year sales growth for the fourth quarter. The market was looking for about 9%, and that's on the back of a strong quarter they just reported of 17%. So I think what we're seeing is very resilient demand for Apple products, even though the iPhone sales were only in line with expectations. It was a pretty full expectation. So the iPhone remains incredibly popular with the 17e just launched, and huge success on the Neo. Obviously, there is this kind of slight cloud on the horizon about rising memory costs, which didn't really hit the March quarter numbers so much, but they did clearly signal that it would become a bigger impact going forward, but probably only going to really impact certain parts of the product line. For example, the Mac Mini, which is being hugely popular for AI workflows.
So, Matt, I mean, overall, the outlook appears, pretty encouraging for John Turnus, the incoming chief executive. What are your expectations in terms of leadership transition, or just leadership in general as the transition approaches?
Yeah, so I mean, he obviously inherits an incredibly strong company, but there are a number of issues that do need his attention, most notably being their AI strategy and the overhaul of the Siri platform, which is, being dragging on. So that's one big thing. They've also got some big product launches coming in September, with most likely the first foldable iPhone, the iPhone Ultra. And then he has to think about, the kind of the longer term view about what is the next form factor for consumer devices as AI takes hold, and how is Apple going to take a leading role in that innovation. I think arguably they've been a little bit kind of a follower rather than a leader in some ways recently.
Matt, thank you so much for the terrific briefing. Matt Bloxham there, and of course we continue watching all tech stocks. Matt is our senior analyst at Bloomberg Intelligence. Now, President Trump says the U.S. blockade of Iranian ports is, quote, incredible. But the stalemate in the Strait of Hormuz continues to shape global energy markets. Well, let's bring in Bloomberg's Charlie Wells with the latest. Charlie, I mean, this is a problem for prices at the pump.
That's exactly right, Francine. These geopolitical tensions are really hitting that oil market. We can see the price of oil is up some 25% over the past 2 weeks. So that is a significant jump as it continues to hold these gains. And again, this has been a market story. It's turning into a corporate story. And now it really is starting to turn into a consumer story as well. So let's flip and look to see where this pain at the pump is hitting across the United States. Because you can see divergence here, right? What we had this week is in California, prices at the pump heading north of $6 a gallon for the first time since 2023. So a big jump there. You see divergence across the country, but you see increases. Now, what's really interesting, if you want to think about the consumer and you want to think about politics, look at the states where we see this strong red, where you see these big jumps. Those are typically blue states. These are states that voted for Kamala Harris in the 2024 election. If you look at some of these blue, some of the kind of weaker jumps in gas prices, these are states that voted for Trump. You might start to think that this might not have such negative implications for the midterms that are coming up in just a few months. But let's flip the board and take a look at some analysis coming from Bloomberg Intelligence, talking about how actually it's these red states, these states that voted for Trump, that get hit hardest on a percentage basis, because when you look at how household expenditure evens out, you see more spending in these states on gasoline at the pump. So again, a hit in those states of as much as 70% there. So again, serious implications for the consumer and also politics as we head towards these midterms.
Charlie, thanks so much for the terrific briefing. Charlie Wells there with the very latest, of course, on these rising oil prices, what it means for voters in the U.S. Now, the Fed, the ECB, and the Bank of England all holding rates over the past few days. Let's get the thoughts of Yari Sten. He's Chief European Economist at Goldman Sachs. Yari, as always, thank you so much for joining us. Okay, so three big central banks, but actually the message was quite different. They're in different cycles, and they're also vulnerable in different ways to higher oil prices.
Yeah, I think that's right, and that was to be expected, of course. The Fed is still more in the camp of seeing whether holding or cutting is appropriate. Yeah. There was obviously quite a debate around whether to keep an easing bias or not, with a large number of dissents. I would say the ECB on the opposite side of that spectrum, I think signaling pretty clearly that higher rates are coming. So I think a June hike now looks really quite likely. And then the Bank of England, we would say somewhere in between, with some indications that rates might rise, but then also Governor Bailey saying that the options remain open. And so I think a healthy range of communication this week.
Yari, I think we mentioned this before. I mean, does the Bank of England have a problem because actually interest rates are just so much higher than the ECB? And so I understand there are different economies, but at the same time, it just puts naturally, at this moment in time, the BOE at a disadvantage.
Yeah, I think it matters where you start. And we think rates in the UK are still restrictive. Bank rate is at 3.75%. Our estimate would be for the neutral rate of around 3%. So you're coming into this with a restrictive stance. You also have a weakening labor market. The unemployment rate, of course, has gone up. Long-term interest rates have gone up quite a bit. Financial conditions have tightened. And so I do think the hurdle for them to hike further on top of that is higher than, for example, for the ECB, where we think you're going into this with a much more neutral setting for interest rates.
I mean, at some point, I mean, the number of hikes that the market was expecting was it out of control? I mean, at some point, it was like 3 or 4 hikes this year, which would really put the economy on its knees.
I think 3 or 4 hikes would be excessive as an expectation at this point. So our baseline actually is that the bank holds through this. Yeah. Now, I think that's a close call whether they hold or they do a couple of hikes during the summer. But that doesn't get you to 3 or 4 hikes. So I think that would really require a combination of more intense pressures from the energy markets. Of course, it's possible, but wouldn't be our base case. And then I think also signs of strong pass-through, not just into headline inflation, but also into wage setting, into services inflation. And all of that is possible, but that doesn't seem to us like the most likely outcome because the labor market has weakened. Rates, as I said, are restrictive. And so I think we'll get some inflation pressure, and possible they lean against it a little bit, but I don't really think it requires a proper tightening cycle from the Bank of England.
I mean, everybody remembers 2022 and what happened there with a lot of central banks being a little bit late to the game. I mean, this also feels like a different situation because it's a much bigger energy crisis than what happened in 22, which was Russia-Ukraine. Is it right that central banks wait a little bit to see more data before they decide? Like, what would a real policy mistake look like today?
Yeah, I think it's right to wait longer, and the differences you mentioned to 22 are important. Central banks are going into this with a more normal level of interest rates. They don't have to do that sort of catch-up that they had to do in 22. Labor markets are not nearly as overheated as they were in 22. If you think about the post-COVID bottlenecks in the labor market, the reopening, I think that's very different. Fiscal policy is not nearly as expansionary as it was in 22. And then I would also say the shock itself, the energy shock is big, but it's not as broad as it was in 22. It's energy, it's not food, and we're not seeing the same type of supply chain disruptions in goods markets, for example. And so I think it's right to go into this and say we want to see a bit more data, and that's really what all of them have said. It's just that we think the ECB is closest to actually pulling the trigger because they're starting neutral, and I think for them to go a bit restrictive here is defensible. Yeah. At the same time, we don't think that these higher rates will be sustained for very long. Right. So we have the ECB cutting a couple of times, but we actually have them, hiking a couple of times this summer, but we have them cutting back next summer because you are hiking into what is a pretty weak growth environment. So I don't really think it needs the sustained level of restriction that we saw in 22. And that aspect is not priced by financial markets. We're pricing these hikes, but they're not unwound. And I think at some point, I think markets will come to that view.
I mean, is it too alarmist to say that we could be seeing the first, green shoots of stagflation? Because stagflation is the one thing that nobody wants to be dealing with.
I mean, we will certainly see weaker growth, higher inflation. Yeah. I mean, whether you want to call it stagflation or not. I mean, President Lagarde said that's a term for the 70s. But it's certainly what we're seeing in the data, even over the last couple of weeks. The surveys are weakening. We're also seeing, both in Europe and the US, that the Q1 GDP data, so the pre-conflict data, was actually also a bit softer. So we have cut our growth forecast quite significantly, especially in Europe. And at the same time, the inflation indicators are going up. Yeah. I think on the headline inflation side, it's really not a surprise at all. This is pretty mechanical by energy prices. But the key question really is the feed through into core inflation, into supply chains, ultimately into wages. And here we don't have a lot of evidence yet. We think there'll be some pass-through, but a more limited pass-through than in 22. But that will be the key issue for central banks to watch.
Yeah. Do you worry that actually markets, especially equity markets, are focusing so much on tech and some of the tech valuation and the CapEx spending that have been above expectations that they're not pricing in correctly a possible downturn in the economy? If you look at all of the geopolitics that we're living through, I mean, there's no real good outcome where there's a permanent ceasefire in the next couple of weeks that would allow these oil prices to go down.
Yeah, it is an interesting comparison and to some extent disconnect that you have all-time high equity prices in the US, and then you have significant concerns around energy supply and still upside risk, we think, on energy prices. And our equity strategists do think that the tail, the sort of left tail on equities at this point is underpriced. You can make a very reasonable argument that these valuations are justified given the AI story, given still pretty solid growth in the US, and then also the fact that some of the valuations had come down. But to us, it's a little bit more about the distribution. Yeah. And as you said, there isn't clarity in terms of how the energy situation will evolve. And I think until then, we do need to keep, a bit of an open mind about the downside here as well.
Jari, just very quickly, I mean, after the communication from the ECB and the BOE yesterday, do you expect a hike in the summer?
So we do expect a hike from the ECB. We expect 2 in June, September. I think that's been pretty well flagged. Risks around that, I think at this stage, go in both directions. If energy prices fall significantly, then they could still hike. If energy prices rise more, if you get more pass-through effects, they could do more than 2 hikes. So I think that's relatively clear. For the Bank of England, I think it's a little more uncertain. We read the communication yesterday, particularly from Governor Bailey, as really leaving options open at this point. Our base case is that they hold for the reasons we talked about, restrictive rates, weak labor market. But I think that's a pretty close call versus delivering a couple of hikes. And so I think we really need to see for the bank how the energy price pressures evolve, how the inflation indicators evolve, how the labor market evolves. I think it's a little bit up in the air still.
Yeah, and hopefully we'll have a little bit more data from now until then. Right. Jari, thank you so much for joining us. Jari Sten, nice to see you. Chief European Economist at Goldman Sachs. Now, coming up, we'll also discuss the pressure building on both the U.S. and Iran as the war enters its 3rd month. Phillips O'Brien from St. Andrews University joins us next, and this is Bloomberg.
Bringing you up-to-the-minute political news whenever and wherever it happens. I'm Tyler Kendall in Washington, and this is Bloomberg.
Welcome to Bloomberg This Weekend. I'm David Gura.
I'm Lisa Mateo. And I'm Christina Ruffini. We're tracking breaking news today from Wall Street to Washington. Let's start overseas. The sector is really propelling this yield forward.
Yeah, the hope is this will open up new markets and provide some additional liquidity.
Of course, now they're going to have competitors. We got a big week coming up in politics.
Earnings season is underway. We're going to get some key reports.
Everything you need to know before the markets open on Monday.
Introducing Bloomberg This Weekend, bringing a little Bloomberg into your weekend routine.
Guys, buckle up.
Welcome to the world of decentralized finance.
Why is it that NFTs have not recovered in the same way that, say, Bitcoin has?
Bloomberg is covering all things crypto.
It's a pretty spectacular story.
The people.
This is the future. This is the 21st century economy.
The transactions.
It snapped up nearly $1 billion of Bitcoin.
And the technology.
We need to build a digital Fort Knox.
That gives people financial freedom, and that's a wonderful thing.
That's extraordinary.
We ride the wave that is Bitcoin.
Bloomberg Crypto, only on Bloomberg.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
Watch Bloomberg Tech.
This is the Asia Trade.
This is Wall Street Week. Welcome to Balance of Power.
You're watching Bloomberg Deals. Welcome to Bloomberg This Weekend.
This is Bloomberg Television.
Well, President Donald Trump says he's sticking with the naval blockade of Iranian ports amid concerns that the vital Strait of Hormuz will not reopen anytime soon. Let's bring in Bloomberg's managing editor for the Middle East, Onur Axios, reporting that President Trump has been briefed on new plans for possible military action against Iran. With language hardening on both sides, where do we stand this morning?
Well, the impasse as of this morning continues. On the one hand, we have President Donald Trump, as you said, reiterating his intention to keep the blockade in place. He said that the restrictions are preventing the Islamic Republic from exporting oil, and that's depriving Tehran of much-needed revenue. On the other hand, we are seeing no indication from Tehran that they are ready to reopen the Strait of Hormuz, which they think should be preceded by the U.S. lifting its own naval blockade. That basically leaves us where we were pretty much about 3 weeks ago when the ceasefire was first announced. Both sides want the other one to act first, and as the impasse continues, we're seeing signs from Washington that Trump is again considering, or at least looking at, military options, which according to Axios may be aimed at breaking the deadlock with a possible sudden and short but intense wave of attacks on the Islamic Republic.
Honor, OPEC meets on Sunday without the UAE. How much attention will the market pay if there's another symbolic production hike?
Well, when it comes to OPEC and the UAE's recent decision to quit the oil-producing group of countries, it really is hard to see what kind of action from OPEC or from UAE from here on can make an immediate impact. At the end of the day, all we're talking about when it comes to production and UAE's decision is kind of hypothetical at this point. Without the reopening of Hormuz, anything that OPEC member countries are going to say about production remains hypothetical and can only have an impact on oil markets once there is an eventual possible reopening of the waterway, Francine.
Honor, thank you so much. As always, our managing editor for the Middle East, Honor Aunt. Now let's bring in Philip O'Brien, professor of strategic studies at the University of St. Andrews. Professor, thank you so much for joining us this morning. There's no clean way out. It seems that both sides are becoming more entrenched. Iran yesterday was saying, or at least the leader was saying, that they absolutely need to not get rid of some of the nuclear options of enrichment, and the U.S. will continue to blockade. What is the way that we de-escalate this?
Actually, I do wonder if Trump's needs for victory conditions have narrowed a lot, and there is more of a way out, but the Iranians right now don't seem to be wanting to go down that road. That if you listen to the administration closely over the last week, all their victory conditions have gone except one. They want a major nuclear concession by Iran, and that might even not be that much in terms of substance. It could just be a stylistic concession. But they need a nuclear concession. That's all Trump is talking about. That's what Rubio and what Hegseth are talking about. If Iran is willing to give the administration some kind of, it might even, as I said, just be a loose concession on nuclear power, which make it look like Iran won't have a nuclear bomb, it could be settled. So in many ways, it's a bit up to Iran right now what happens, and the Iranian regime, from what it looks like, doesn't want to make that concession, but that's not to say that it won't.
But, Professor, what I hear from all sides is that actually there is no trust. So I don't understand what would bring Iran actually to negotiate seriously if they don't trust the president not to go back on his words.
Then they would never negotiate. I mean, in some ways, negotiations are happening between two powers. I mean, the Iranian regime has been hit. It right now doesn't seem to want a deal, but we don't actually know its real condition. And if they could get, for a fig leaf concession to Trump, if they could get a breathing space to consolidate power and start getting more income in, they might take. I mean, this is all subjective, but it's just to say that there will have to be a deal at some point. It's whether now there could be a deal before going back to escalation or before waiting many months or weeks for a blockade to hit. I'm not saying this is likely. I'm just saying we are now to the point where there is only really one victory condition left for the United States because they've failed in this war. And if Iran is willing to give the Trump administration that victory condition, even as a fig leaf, the Trump administration might take it because they want out of this war.
Professor, what happens to the Strait of Hormuz? Who would control it? Is this still on the table? There's no clear way out today, but also once there is a negotiation, what happens to it in 3-4 months?
Well, that's what's interesting is that the Trump administration has talked less about control of the Strait of Hormuz in the last few days than they've talked about a nuclear concession. So it might be that the Trump administration would allow Iran to maintain some control over the Strait of Hormuz as long as Iran reopens trade. Because that's a real problem for the Trump administration. They can't open the Strait of Hormuz by sort of clicking their heels and saying open up, because really the Iranians control it. And they can control it with very simple weapons and cheap weapons. So it might be that this is the kind of thing where the Trump administration doesn't make a concession to Iran, but leaves it quiet, accepts a nuclear kind of deal, and Iran remains in control of the strait on the assumption that trade opens up.
Professor, how crucial is the next couple of weeks? I don't know whether there's someone that you would watch from the Trump administration side to look to whether there are any signs of progress.
Well, it would be actually watching the Iranian side, because they're the ones who are in control of this right now. The Trump administration, as I said, they want out. The president wants to get out of this. He just needs to be able to declare victory. So the Trump administration has been actually in some ways quite clear in the last week about what they want. What we don't know really is what the real condition is for the Iranian government. So I would watch what the Iranians do and see if there is any wiggle room on their side to see if this is going to end relatively soon or whether it's going to stretch on. If Iran doesn't want it to end, it's not going to end because they control the strait. So it doesn't matter what the U.S. government wants as long as the Iranians want to keep this going.
Who has the best intelligence on Iran right now? How much do we understand about the strength of this new regime?
That's a great question. I don't think American intelligence has been very good on Iran to this point. They really did seem to think that if they killed the government, that they would get a government in place with which they could deal. They don't seem to even have now a great deal of knowledge about the internal condition of the Iranian government. My guess is the people who have a better idea about this are the Russians and the Chinese, who are closer to the Iranian government and actually, from what we can tell, are increasing their support for the Iranian government. So they might have a better idea about the true condition of what's going on in Tehran. And it is notable that the Iranians have reached out recently and made a very public showing of support, received a public showing of support from Russia. Trade from China is up. So I think that actually is probably where a lot of the power in this lies.
Yeah. Should we worry, very quickly, Professor, should we worry about China potentially giving more support to Iran?
Well, I think that's what the Iranians want. I mean, the Chinese are probably going to do what they consider in their best interest. They certainly don't want the Iranian government to be overthrown by a pro-Western government. So we should worry about it. But actually, there's not a lot that we can do about it. The United States it's gone to bombing. It's tried to destroy the Iranian government, and as of now, it's failed. So it can try and intimidate the Chinese. But by the way, the United States has lost its military levers over China. That the United States has shown it cannot fight a war in the Western Pacific, that it doesn't represent that kind of military threat to China that people perhaps thought it did represent.
Thank you so much for joining us. That was Phillips O'Brien, Professor of Strategic Studies at the University of St. Andrews. Coming up, President Trump says he plans to remove some tariffs on Scotch whiskey following the visit of King Charles. More on that next.
exploring the frontiers of science and technology to help explain the difference between the next gold rush and whatever this thing is. And in season 2, we're upping the stakes. More danger.
Now that is some high-grade uranium mineralization.
We used to have a stable climate on this Earth. Right now, we do not.
More science.
We're pushing the envelope of technology in multiple directions. Software, hardware, chemistry, physics.
The cable is like very cold.
And more CEOs that can nail the photo shoot.
Hundreds and hundreds of billions of dollars are at stake.
While the problems are economic, the solutions are too.
And yes, we will be talking about AI.
There is a lot of humanoid hype out there.
But our future doesn't run on hype. It runs on innovation. Watch season 2 on all these lovely channels.
Middle East tensions are high.
Both sides willing to go back to the battlefield.
The narrative changes moment to moment.
Is there a ceasefire? Is there not a ceasefire? Markets are up, markets are down.
Count on Bloomberg for up-to-the-minute reporting.
Breaking news this morning.
Breaking news in the last few minutes.
On-the-ground perspective.
Talking to you from the bomb shelter.
This White House still pushing.
And the analysis you need to make informed decisions fast.
Clearly, nothing is final until it's well and truly final.
The really important question is whether we'll get second-round effects.
Nobody covers geopolitics like Bloomberg. When news breaks,
a redhead across the Bloomberg terminal.
Bloomberg has you covered.
Trump's global tariffs are struck down by the U.S. Supreme Court.
For all the context and clarity you need.
There's going to be now tons of tariff headlines until midterm elections.
Hear it first on Bloomberg.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm Jennifer Zabasaja in the Lesotho Highlands, and this is Bloomberg.
Good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London, and these are your top stories. Oil prices head for a second week of gains, but President Trump defends his policy in the Middle East, saying the Iranian economy is a disaster. Apple tops estimates, a boost for incoming chief executive John Turnus, but the company warns about higher costs of memory chips and shortages of Mac computers. And Japan intervened in the currency market for the first time since 2024, but some traders say more action could be needed. So President Christine Lagarde signaled the European Central Bank will consider a possible interest rate hike in June after policymakers debated and rejected the idea on Thursday. Well, Lagarde says the euro area is moving away from its baseline.
Directionally, I know where we're heading, okay? But we shall see. There might be massive changes taking place. There's one element that is going to have a real impact, and that is the duration of the conflict.
That is, of course, the ECB President Christine Lagarde. Now, the Bank of England has voted 8-1 to keep rates unchanged, with the chief economist, Hugh Pill, the single dissenter, calling for a quarter-point hike. Now, the governor of the Bank of England says that was perfectly understandable and played down the differences in opinion. Now, Andrew Bailey also told us the central bank is concerned about the impact of inflation on consumers.
Well, inflation expectations have picked up. Now, of course, they do tend to follow the shorter end. 1 year ahead inflation expectations tend to sort of follow what inflation is today. But look, we're also obviously sensitive to the fact that people's memories are important here. They remember the fact that we had high inflation 4 years ago. So that also has a part to play in this. And we do take it into consideration, obviously.
Governor, I mean, overall, the markets largely see today as dovish, yet your own chief economist was pushing quite hard for a hike. So is it odd having a dissenter coming from the BOE's own office?
Well, I wouldn't particularly say it's dovish, but obviously that judgment has to be relative to what what people thought we were going to do. So I respect that point. And we have been somewhat pushing against, I was pushing against the curve, as you know, 5 or 6 weeks ago, probably now. Look, I think Hugh Pill's position is perfectly understandable. I didn't vote with him. I didn't agree with him on the end decision, but I understand the point he's making. I would also say, and Hugh wrote this in his paragraph, that he used the word modest, and I think he used the word modest very deliberately. I mean, he'll speak for himself, but I think that word is deliberately in there. So the differences between us are not that big.
What would it take for you to actually to vote for a hike next time?
Well, I think we sit down and go through all the evidence, and I think what it will take is, and we laid out sort of some of the things we'd be looking at is both quantitative and qualitative. I mean, I think what we get on the qualitative side is going to be important because, we'll be talking to a lot of businesses saying, how are you approaching passing these cost increases through? What are you seeing in terms of demand for your, whatever you produce or provide? It's going to be some time before we get a real read on wage settlements because there's quite a seasonality to wage settlements in this country. And we've passed through peak season, which is earlier in the spring. So it's going to be a while before we get a really probably any big read on wage settlements. But we will be looking very carefully at what people are planning for, those settlements that are coming through. That will be important as well.
How big is the risk of a technical recession at this point?
Well, most of the scenarios we have actually, and against most of the interest rate paths, actually suggested this is a story of slower growth. In the more extreme sort of difficult scenario, with some policy rule, you can have a variety of policy responses. There are some quarters of negative growth, but this is actually interestingly not, as we see it today, at least, a story of dominating. It's going to be a recession. That's not the dominating story at all.
But Governor, so far you're happy with the market reaction, and also, next week is a big deal in terms of the elections in parts of the UK. Could that be a market event?
I think the market's reaction so far today is very sensible. Look, on the UK side, I don't comment on UK politics, obviously, but what I would say is this. The things that I think what we've seen in the interest rate curve has been dominated by the Gulf. The things I look for in terms of when I try to sort of break down what's influencing this, has the exchange rate moved? No, not much at all, actually. Have we seen much movement in short-run sterling swap spreads? No, not much at all. In fact, it's a bit tighter than it was before the budget last autumn. So that suggests it's really actually it's a Gulf story, I think.
Governor, the final question is the NISR warned this week that rates could go 150 basis points higher if the Middle East crisis worsened. Can you see any scenario where that would happen?
Well, look, there are really bad scenarios in this. If we get cut off of energy supplies going on for a very long period of time, bad things can happen. But it's not in our. It's not in our central decision today at all.
But this is what, a 10% chance? So
I'm going to avoid it because I think look, the world is so unpredictable at the moment. So we've seen it today, let alone over longer periods of time. The world is so unpredictable that I think putting sort of precise, percentage probabilities on things is put it politely, hazardous business.
Well, that was the governor of the Bank of England, Andrew Bailey, speaking to me yesterday after the press conference. Now, President Trump says he plans to remove some tariffs on whiskey following the visit of King Charles. Well, Trump says he would remove the restrictions so that Scotland and Kentucky can start dealing again. The U.S. bourbon industry exports used casks to Scotch producers. Now, for more, I'm joined by Bloomberg's James Wolcock. James, this was a visit that had to go well for King Charles, and it went very well. Did he charm the president?
Clearly. Everyone has, in my inbox at least, been talking about a big golden bell that the king dug up from a 1940s warship called HMS Trump, which still has the Trump name on it, which is a British ship that he gave to the US president. Now, the deal is big news. It's roughly $1 billion of UK exports to the US. The UK is also the US's second largest export market for bourbon. So look, it's good money, but more importantly, the president is playing favourites. The UK Prime Minister has been frequently attacked in the past few months by Donald Trump, but it just goes to show that UK has another asset, soft power, and you can send the royal family with pageantry and pomp and great speeches, and you can get something from this US president.
Do we have any idea of how long, I guess, this friendship or likeness lasts? Because, and you're right, King Charles, he was funny. He was, he kind of weighed into politics very subtly, but some of the speeches that he made were very powerful.
Well, it's kind of also Charles who was responsible for the initial US-UK trade deal. If you remember, Keir Starmer went to the Oval Office with a letter from the King. So, in many ways, Trump's love for the royals is very long and enduring. I think, to your point, the difficulty is his hostility towards UK Prime Minister Keir Starmer is also now quite well documented. And as soon as next week, there could be problems there because we look to UK's plans to try and reopen the Strait of Hormuz internationally without helping the US. We're looking at the US president talking about withdrawing troops from NATO in parts of Europe. There are all sorts of issues on the horizon that I think the king will have very little ability to play into. And meanwhile, for the UK Prime Minister Keir Starmer, he's got very difficult local elections coming up as well.
I mean, reading between the lines, there were points where the king did, almost seem to suggest, look, Mr. President, back off my prime minister. Is that fair?
I mean, he's also, by the way, as the head of the Commonwealth, the head of Canada as well. So there are also parts of that there too. I mean, Charles, before becoming king, has long had very big environmental credentials. He's been a very sort of fan of green technology. And so the word we're using is it's punches with a velvet glove. So it's all sort of very hidden behind sort of charm and charisma. But I think the questions will always be, when will this trade deal happen? There are still questions about the details of these Scotch tariffs. There's a lot more behind the pomp in sort of the hard economics that we sort of are still tracking and is yet to be seen.
And James, I mean, on these local elections, is it likely that they go badly for Labour, and how do they regroup and rethink?
I think you're being very kind with likely. We had a poll this week, a landmark poll that says of the sort of 2,500 seats Labour are defending, they could lose 1,800 of them. That would be the worst loss in sort of the midterm elections of any UK government in modern history. Yeah. I mean, so that's the definition of badly, frankly. Yeah. That could spark all sorts of problems for Keir Starmer, because what happens is every MP has their councillors. If you use your councillors, they ring you up and go, what are you doing? I've just lost my job, I've lost my salary, I've lost my sort of career. What are you going to do about that? And so that's when the MPs who back Starmer and keep his seat in Parliament start ringing him up and saying, what are we going to do?
James, thank you so much, as ever, for the terrific briefing. James Woolcock there with the very latest on the UK. Now, the yen retreating after its biggest gain in almost 2 years as investors assess the impact of Japan's market intervention. Our markets reporter, Justina Lee, joins us now. Justina, it's so good to see you. How significant was this latest intervention, and are we likely to see, more than one round?
Yeah, we did see a pretty stark reaction earlier today in Japan, with the yen surging 3%, the most in almost 2 years. Now, it's probably worth remembering here that the BOJ really is fighting against the fundamental tide. Because on the one hand, we've had a hawkish hold from the Federal Reserve this week, which is supporting the dollar. And kind of on the other hand, I mean, the BOJ has seemed like reluctant to signal that another rate hike is coming. And so when all the fundamentals are kind of pointing to a weaker yen here, I think if we really want to see some sustained resistance to further yen depreciation, you probably do need more intervention here.
Justina, can they do something on oil markets? Because that's also, I mean, this is a huge problem for a lot of Asian economies, especially Japan.
Yeah, exactly. And that would be a very novel way of dealing with currency weakness. But it does seem like Japan is considering that move right now. I mean, we've had kind of officials signaling that they think that speculative trading in crude oil is something that they're watching when it comes to the currency. And that's because Japan is very dependent on oil imports. And so when oil is higher, the currency naturally weakens. And it does seem like they are considering intervening in the oil derivatives market as well.
So this would, I mean, so this would be in the markets. I mean, there's no cap or anything like that they could do. I mean, that would be really dramatic. Are you hearing anything of, the more innovative ways of maybe trying to keep a handle on this?
Yeah, exactly. I mean, my colleagues in Japan have reported that the BOJ has spoken to market participants about the possibility of intervening in oil. And I think if we look at like the past patterns of intervention, it usually does take, quite a few rounds for that move to really stick. And some people are talking about how, whether the U.S. is going to kind of take part as well. Of course, that would be a way stronger signal to the markets, but that is generally kind of extraordinary, very rare. And so I think people are really kind of watching how Japan is going to fight those fundamental tides here.
Justina, thank you so much, as ever. Justina Lee there with the very latest on the markets, especially on yen. Now, Wall Street's trading desks just capped off a record-breaking first quarter as clients scrambled to hedge against global volatility. Now, while UBS rode that same wave to bumper profits, the celebrations may be short-lived. Well, Paul Davies from Bloomberg Opinion argues these massive gains could actually complicate the bank's ongoing regulatory battles. And Paul joins us now. Paul, thank you for coming. I mean, I love it. You wrote from like UBS yesterday, and then it was US with Jamie Dimon, Barclays, and UniCredit. So we can really go around the world and talk about all the banks. Look, I loved your column on UBS because the general idea is that if you're negotiating with the government that want to, for you to put money to one side, you don't want to be that profitable, especially if shareholders expect a lot of money back.
Yeah, exactly. I mean, their problem this week is that, they did very, very well, and some of the short-term or smaller concessions that the government has given them on some of the capital rule changes that are coming have made it very apparent to a lot of the analysts that actually they could afford another big buyback in the second half of this year. They've already done or nearly completed about $3 billion worth of share buybacks so far. And lots of people are now expecting another $3 billion more. But this is going to be announced, if they announce it, in July, right in the middle of when the Parliament is starting to debate whether they need to hit them with much bigger capital charges to protect taxpayers against the risk of a possible failure of what's now their last very large, globally important bank in Switzerland. So it's a bit awkward.
But it is a little bit awkward. When you look at some of the business models, does this set of earnings actually show you what works and what doesn't? Or is it also a bit of luck of the draw if you're just doing really well on the trading front, given all the volatility because of what's happening in the Middle East?
Everyone's done well on trading this quarter. Unsurprisingly, there's been a lot of volatility in markets. The US banks did better in general, I think, and on average than the Europeans. Some of that is business mix. Some of that is because the US banks do a lot more in commodities than most of the Europeans do. Some of that is to do with just being much more in US markets, which are bigger and there's more activity been going on. And on the investment banking side, they definitely did a lot better in the US. And again, that's to do with where the deal activity is happening to some degree, I think. But it was still very good in all. I guess the issue the thing I realized about European banks this week is a lot of them, in fact, all of the significant investment banks are actually really capping their ambitions in investment banking and markets now.
Why is that? Is that because of the US?
It's to do with their own individual strategies. They've been recovering and rebuilding their balance sheets for years, and some of us expected them to start maybe gaining share again, especially in trading. But most of them have now some kind of informal or formal cap on just how much capital they want to put into banking. So at Barclays, it's got to be less than half the balance sheet. At UBS, it's a quarter. And most interestingly, this week, Deutsche Bank, their new CFO, Raja Akram, who's just joined from Morgan Stanley, he put their private bank and asset management businesses first in his presentation, which is like a cosmetic shift in some ways, but it sends a signal. And they now want to build. They had a first quarter where the investment bank provided less than half of profits, and they want to build on that, and they want the rest of the bank to provide more of the earnings in the future.
But are we going to be in a situation where it's the Goldman Sachs's, the JP Morgans, Morgan Stanleys that will come more to Europe and actually try and get that market share in terms of investment bank? And is that not risky actually for European banks if they want to ever build it up again?
I think absolutely. And don't forget they're being helped, or they're going to be increasingly helped by the following wind of a Trump White House that is very keen on deregulation. There is some capital easing going through. JP Morgan, they still think it's going to hurt them more than help them, but then they always do. So there is definitely going to be more expansion. And Goldman Sachs itself was very expansive with its balance sheet in trading in the first quarter of this year. And yes, you're right. Longer term, this risks leaving European companies, completely dependent on US banks for access to capital markets. And that's a lot of the decisions make sense individually for the European banks, but collectively for Europe as a whole, maybe it's not such a good thing.
Yeah, it's never good news. Paul, thank you so much. Paul Davies there from Bloomberg Opinion. Now, coming up, we'll also talk to Tim Richards, the founder and chief executive of View Entertainment, about the impact of Paramount's Warner deal on the cinema industry. But let's face it, we'll also talk about Devil Wears Prada 2. We'll talk about cinema next. This is Bloomberg.
know how the market day started.
Find out how it finishes.
Public markets to private markets.
From the micro to the macro.
Covering retail, entertainment, the business of sports.
The supply chains, trade policy, how it all is impacting the U.S. equity market as we drive to the closing bell at 4 p.m.
A holistic approach to covering financial markets.
If it matters to your life, we're covering it. I'm Katie Greifeld.
And I'm Romaine Bostic, and this is The Close.
Live every weekday.
Only on Bloomberg. Context changes everything.
At a time when policy in Washington is driving Wall Street, we draw a distinction between the rhetoric and the action, bringing you market-moving guests and original reporting. This is Bloomberg Surveillance.
Good morning. This is Bloomberg Daybreak Europe. I'm Lizzie Burden in London, and these are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
The conversations that matter, the insights you need. This is The Pulse, and I'm Francine Lacroix here in London. Now, the $111 billion Paramount Skydance merger with Warner Brothers Discovery could reshape the cinema industry. While David Ellison, the Paramount chief executive, has pledged 30 theatrical releases per year, industry groups remain skeptical. Now, they point to the 2019 Disney-Fox merger, where consolidation ultimately led to fewer films and less variety for theaters. Well, joining us now is Timothy Richards, founder and chief executive of View, the largest privately held cinema operator in Europe. Tim, thank you so much for joining us. I mean, first of all, when you look at all of this M&A background, I mean, does the cinema business just remain too fragmented in Europe or globally?
Well, I mean, the good news is business is back, and the demand, our customers never left us. But business is back right now, and if you look at what happened with Michael opening weekend, $217 million. Devil Wears Prada is going to be very, very similar. In terms of how for consolidation, it is fragmented, and it has been fragmented for quite a while, and I think everyone's been waiting for business to return before they actually took that first step. The contrarian investors are too late. We're back.
But Tim, I mean, you need content first and foremost. So we'll talk about ticket pricing and, you know, AI and how you manage queues and stuff. But you need content. Do you worry there's going to be less content out there, less films being made because of the merger? Yeah, look, I think my biggest concern is demand. And I think we've proven certainly in the last few years that there is a massive demand for all movies of all genres, for all demographics. We've broken records for all kinds of movies, and if you look at Hamlet's going to do 20 million pounds in the UK. Wow. So I worry about demand. Where there's a demand, there's normally a supply will follow. If you look at what's happened, and I'm fresh back from Las Vegas and CinemaCon, and from meeting with studios in Los Angeles after that, and the commitment to feature filmmaking right now with the legacy studios is unprecedented. Then when you actually look at the three biggest names in tech, Tim Cook, Jeff Bezos, and David and Larry Ellison, they've all now embraced theatrical releases and film production. They're coming into our industry. Tim, at CinemaCon, I mean, ticket prices and premium formats, I know was a lot of the talk. Sony executive Tom Rothman was saying, like, movie tickets are just too expensive. Is he right? I would agree domestically in the U.S. I think that there's a lack of creativity in pricing, and we, about 10 years ago, brought on pricing experts. And I think if you look at what's going on in Europe, particularly in the UK, it's a completely different pricing model. The industry was in the dark ages forever, and we've kind of brought it forward with dynamic pricing models. And we have entry-level prices for our customers who are perhaps suffering financially a little bit. We want to make it accessible for everyone. And it's a big difference. I mean, as you probably have seen, it hit $50 in the U.S. And, you know, for most families, that's simply not achievable, not attainable. Are you expecting tastes of cinema goers to change a little bit? I mean, there's a, you know, will you see more European productions being shown in movie theaters, Japanese anime, Indian films?
In Europe, absolutely. I mean, we have the luxury here of having kind of domestic filmmakers, and in our markets in Europe, every single year, a handful of movies break into the top 5 or top 10. So we have a much broader audience and tastes in Europe than domestically in the U.S., where it's predominantly 85-95% Hollywood. And if you look at what happened in Italy this year, Buen Camino, Cecco Zaloni's new movie, it passed C'è ancora domani, the last biggest movie in Italy, and then it passed Avatar, the highest grossing movie in Italian history. And what that actually does for European filmmaking, it's one of those classic success breeds success. It has shown other filmmakers and financiers of film that there is a market out there, and it's a great market, especially an emerging market now.
What have you seen as biggest change, actually, in your world in the last 10 to 15 years? I know, if you go back to The Devil Wears Prada, I couldn't open anything on social media without being bombarded, actually, with, you see this, with publicity and tours. Is that what makes a movie successful?
Well, when you consider that Devil Wears Prada, the first one, was 20 years ago this October, it's extraordinary, and there's still this huge demand. There's a demand for great stories, and I think really the success of movies generally is starting with a great story. And Devil Wears Prada is a great story, and that has been well executed with great talent. But, 2019 was the 3rd consecutive record-breaking box office year. This was not an industry that was broken. We got hit by a pandemic. We got body slammed by a pandemic, and now we're back.
Talk to me a little bit about whether there's, enough demand for alternative content, like concerts or sports.
Well, we did the very first kind of live concert with Genesis in 2007, and there is absolutely a demand. And we worked with Bernie Ecclestone, and when he was running F1, we ran F1 races right through. We've done Wimbledon. We did Wimbledon in 3D, and we learned about camera placement because a lot of our audience got sick because the cameras were too close to the net. Back and forth. But there is a growing demand now, and certainly for Asian films, Bollywood produces 20 times more movies than Hollywood does. There's a huge demand, and you're going to see some very, very big international successes with Bollywood movies this year.
Okay, what's your favorite film that I wouldn't have heard of that everyone should go and see at the moment? Do you have one? I'm putting you on the spot, aren't I?
I see so many movies. It is, I think looking forward, there's going to be some really interesting movies coming up that I'm really looking forward to. There's reboot and there's franchises, and even with Billie Eilish's concert movie coming out as well, James Cameron.
Tim, do you feel like you're a competitor to Netflix? I know it's a different experience, but again, because the content is king and it's everything.
Yeah, I started my career in home entertainment with a studio, so I've kind of seen all sides of it, and I've never looked at what happens in home as being competition with out of home. I worry more about theme parks and sporting fixtures than I do what happens in home.
So fun. Tim, thank you so much for joining us. Tim Richards there, founder and chief executive of View. Now, a couple of things we need to watch out for because it is a very big market today, and we've had a pretty big week, not only when it comes to central banks, but of course everything that's happening in the Strait of Hormuz. So quickly, U.S. equity futures pretty much steady. Maybe there's a bit of a pause in the rally that's put, Wall Street gauges to record highs. The other thing I'm looking for is yen resuming gains triggered by Japan's intervention, and then oil holding its second weekly gain as Donald Trump says he was sticking with a naval blockade of Iranian ports. Up next, it's Bloomberg Brief, and this is Bloomberg. Have a great weekend, everyone.
Astonishing day for US technology.
It's shaping the region's technology ecosystem.
Asia's biggest tech news and innovation.
A cidade estava sitiada.
Nisso eu começo, eu não sabia o que fazer.
Foi a mais terrível que eu passei na minha vida.
Eu temo, que o Brasil se torne, num futuro próximo, um narco-estado.
Porque no final, tudo é dinheiro.
people back home, they are suffering. And someone is driving a Range Rover with their money.
Where is my money?
I think she's a scam up to now.
It's some of the world's most desperate people who are getting ripped off.
Repeat after me. I am a winner.
I didn't know how big it was. I didn't really understand what I was getting myself into.
If you tell me you have a vision of being a billion-dollar business, then you're going to have to do what it takes. And if you're not going to do that, everybody's going to suffer.
Una batalla a muerte.
Money can do a lot of good. It can really transform people's lives, but it can also hurt them.
At 9:30 a.m., the market tells you what it's really thinking.
We beat the drum to the opening bell.
With deep analysis of the forces driving the price action.
Focusing investors on what really matters.
Where the money flows, which markets are changing.
Conversations with players shaping the narrative.
Innovative growth companies gravitate to NASDAQ.
It's not just like, let's buy the Mag 7 or AI.
That's a really compelling story.
This is where your trading day begins.
And this is Open Interest.
Only on Bloomberg.
The trading day is about to start.
And you're already looking for that edge.
The Opening Trade brings you everything you need to know as markets open across Europe.
I'm Guy Johnson.
I'm Anna Edwards.
And I'm Tom McKenzie.
This is your Opening Trade.
Only on Bloomberg.
It's 5 a.m. in New York City, 10 a.m. in London. Good morning, I'm Bonnie Quinn with your Bloomberg Brief. Let's get you set up for the day. Futures wavering after U.S. stocks notched their best month since 2020. Oil holding on to a second week of gains. Apple out with a strong forecast, but warns of surging costs. More earnings on deck with Chevron and Exxon before the bell. And President Trump said to be mulling further military options against Iran while keeping that naval blockade. Let's get a check on markets around the world now and back to Tokyo for the latest from Asia, particularly at this extraordinary time for the yen. Let's get to Alice French. Alice.
Morning. Yes, the yen very much in focus today, which I will get to in a second. But for stocks, we have eked out some modest gains in Japan and also Australia. Earnings definitely helping. We had some strong readings from trading houses. Also, amazing gains from Toto, the toilet maker, after they came out and said they will invest more in their chip parts business due to AI demand. But as I said, the yen is really what everyone's talking about. We saw some sharp strengthening after intervention yesterday. And also another kind of brief strengthening again, just in the past hour or so, which is fueling more speculation of potential intervention, now around the kind of 156 to the dollar mark. Of course, we're heading into Golden Week. There may be more moves from authorities if we head back down to that 160 level. Let's see what happens next week.
Alice, it's a fascinating story. Thank you. That's Alice French there. We're 2 hours into the European Open. Here is Justina Lee in London. Justina.
Good morning, Vani. Now, it's a Labor Day holiday throughout Europe today, so I have an all-UK market update for you. Now, if we look at the FTSE 100, it's trading down a little bit with kind of poor results from NatWest. Now, looking at kind of the currency market, I mean, the pound is a little bit stronger. You know, the euro is also a little bit stronger. Now, looking at the UK bond yields here, we're seeing further gains with kind of oil still holding on to another week of increases. Now, if you look back at the BOE decision yesterday, what was interesting is that, of course, everyone was expecting the spotlight to be on inflation. Now, Andrew Bailey kind of said that, you know, maybe monetary policy isn't the best tool for fighting an kind of an exogenous shock like that. And so we actually saw kind of the bond yield dip a little bit, but as we can see today, I mean, it's still going up because at the end of the day, it's all about what those oil prices are doing. And the problem for the BOE is they don't know either, right?
I guess not. Justina, thank you so much and happy May Day. London, of course, will be on holiday on Monday. Let's take a look at where we're starting off May, because it is the 1st of May. Believe it or not, we had a record in April for stocks. We finished at a record yesterday, and it was the best month in totality since 2020. That's a 6-year run. The good news is that it also didn't completely depend on Nvidia. Nvidia was down 4.6% yesterday. The other good news is that the rally does seem to be broadening just a little bit. We might have more room to run today, with the S&P futures at least pointing to gains. NASDAQ 100 futures down just a little bit. The 30-year yield hanging out just around the 498 mark. We still haven't closed above 5%, but we do have that Fitch warning out as well today, so that could be putting pressure on things later in the session. Now, Brent crude, this has moved to the July contract. It's trading almost at 112. Ed Yardeni asking the question, why hasn't Brent completely soared since President Trump said he's not standing down on the blockade? One of Ed's answers is that, well, there are multiple emergency sources coming into this market of oil. We are still seeing WTI, though, and that's the June contract, at 106 a barrel, so very definite continuous pressure here, and the dollar index basically unchanged right now. All right, let's get to some individual movers with Chloe Melly in London. Chloe.
Good morning, Bonnie. Apple is up this morning after a stronger than expected revenue forecast. It did warn that it was facing some higher prices for memory chips, but it seems that investors are a lot more focused on this positive outlook and the resilient margins for Apple despite those higher costs. We're up almost 3% this morning. Moving on to Atlassian, and the software company is also up very strongly this morning, more than 23% after beating expectations that was driven by the cloud segment in particular. And so this reassured investors that were worried about this AI disruption for software, for the software sector. And this is really something that we've already seen from SAP, for example, here in Europe, also reassuring investors after that huge software sell-off from earlier in the year. And finally, Roblox is down very significantly this morning after lowering its forecast and reporting slower user growth as well. It's due to the implementation of new safety measures for kids. And so this is something that, at least in the near term, is going to really slow down engagement and bookings for that company. And we're down almost 23% in pre-market.
Chloe, thank you so much. Chloe Melly there will be back later in the hour. And coming up in this hour, more on this earnings season with Seema Shah of Principal Asset Management. Later, we'll also be previewing big oil results with Jason Gableman of TD Cowen. Apple higher in pre-market trading after wildly beating the street's estimates on a strong revenue forecast for the third quarter. But the outlook came with some warnings, with CEO Tim Cook saying, quote, "We expect significantly higher memory costs. Beyond the June quarter, we believe memory costs will drive an increasing impact on our business." Matt Bloxham of Bloomberg Intelligence joins us now. How serious is this, Matt? Because everything else about the Apple report seemed to be really quite positive.
Yeah, I mean, it's obviously something that we need to pay close attention to, but I think the fact that there's really strong demand across their range of products and that they are supply constrained, I think protects their pricing power to a degree, and I think they'll be able to manage, the supply of product into the market so they can balance that against costs. And also just maybe push pricing up at strategic points in the year, for example, with the product refresh in September. Yeah, overall, a kind of really robust position for them. And I think, a surprising amount of strength in the China market, which is about 18% of their sales, up 28% year on year. The second quarter in a row of really strong growth, which comes after a number of quarters of real pressure in that market. So that's kind of helping to balance out a kind of broad range of demand across products and regions.
Matt, thank you so much. Matt will be back later in the hour. That's Matt Bloxham of Bloomberg Intelligence. Turning to geopolitics now, President Trump vowing to keep the pressure on Iran.
Their economy is crashing. The blockade is incredible. The power of the blockade is incredible. They're not getting any money from oil. And hopefully it can be worked out very soon.
Iran responding that the blockade will further push up oil prices and it must be lifted for new talks to occur. Joining us now from Dubai is Bloomberg's Onur Ant. So, Onur, we've had several responses really from Iran, including a statement from Iran's new supreme leader. What's the general drift of all of these statements?
Well, the impasse continues, as we've just seen from President Donald Trump, that the U.S. wants to stick with its naval blockade of Iran, which it says is depriving the Islamic Republic of much needed revenue at this point. And Trump also suggested that this could force Tehran back to the negotiating table after a first round of direct talks failed to reach a peace agreement last month in Islamabad. The problem right now we have is that both sides want the other one to yield first. Tehran has made it clear that it does not want to reopen Hormuz before the U.S. lifts its naval blockade, and the same logic holds in Washington about who should act first. Under the current stalemate, we have seen that President Donald Trump got a briefing from his top commanders, including the head of the U.S. Central Command, on Thursday, and that briefing was reportedly about a possible brief but intense wave of attacks and warning that underlines how fragile the ceasefire, now in its fourth week, remains in the region.
And so we head into the weekend. Owner, thank you so much for joining. That's Bloomberg's Owner and in Dubai. Now to other top stories trending on the terminal this morning. OpenAI CFO Sarah Friar pushes back on concerns about missing internal targets. She says the company is meeting objectives and sees a, quote, vertical wall of demand for its products. OpenAI came under scrutiny this week after a report said it fell short of internal targets for revenue and user growth. A day after the ECB announced it's keeping rates unchanged, a few officials are saying they will need to hike rates in June if there isn't a significant change in the economic outlook. Bundesbank President Joachim Nagel and Governing Council member Mattes Muller citing energy costs from the Iran war. Council member Martin Kocher is saying, though, that it is still too early to tell and the decision to hold rates will give policymakers more time to assess long-term inflation. Japan's top currency official says authorities are ready to intervene in the crude oil futures market, where speculative moves have been affecting the yen. The comment comes a day after Japan stepped into the currency market to buy yen. The currency market faces increased volatility as Japan prepares to observe Golden Week holidays next week. Coming up, we speak to Seema Shah of Principal Asset Management on earnings momentum supporting the strength in this market. This is Bloomberg.
I'm David Weston. Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate. We go on the road for a look at what lies behind the headlines of today and what will likely be the headlines tomorrow.
We need more transparency.
Oil and gas is still important.
They said every citizen should be investing in the market.
Accelerate progress in all fields of science.
Watch Wall Street Week right here on Bloomberg.
More than what you need to know, it's what you need to think about.
Making money isn't about drowning in emotions. It's about understanding what's actually happening. Markets are the best way to glean signal from noise, and that is what we try to do every morning. This is Bloomberg Surveillance.
Bringing you up-to-the-minute global news whenever and wherever it happens. I'm Jemana Bersecci in Davos, Switzerland, and this is Bloomberg.
Welcome to Bloomberg This Weekend. I'm David Burr.
I'm Lisa Mateo.
And I'm Christina Raffini. We're tracking breaking news today from Wall Street to Washington.
Let's start overseas. The sector is really propelling this deal forward.
Yeah, the hope is this will open up new markets and provide some additional liquidity.
Of course, now they're going to have competitors. We got a big week coming up in politics.
Earnings season is underway. We're going to get some key reports.
Everything you need to know before the markets open on Monday.
Introducing Bloomberg This Weekend, bringing a little Bloomberg into your weekend routine.
Guys, buckle up.
Sorry.
This is Bloomberg Brief. I'm Bonnie Quinn in New York. Principal Seema Shah weighing in on this earnings season, writing, quote, earnings growth expectations are accelerating to levels last seen in the immediate post-COVID recovery. This optimism suggests analysts expect companies to absorb the recent energy shock with little lasting damage to fundamentals. Seema is Chief Global Strategist at Principal Asset Management, and she joins us now. Well, Seema, so far this earnings season, 81% of companies that have reported have beaten estimates. Now, two views, obviously. One saying, look, the rally should and could broaden out, which could create a virtuous cycle and continue this rally even further. The other saying, look, there's lots of risks out there and these markets are way too sanguine. What resonates more this Friday?
Hi, Bonnie. Good to be with you. Well, I think there has to be some caution involved. There are a number of different volatilities, and I think one of the things that we have seen is there does seem to be some complacency with regards to the conflict, how long it could extend for. Now, that, of course, if it were to continue and oil prices stay very elevated, the global economy is not immune to this, so we have to be on the lookout for that. But at the same time, what we've been learning from the earnings season so far is that there is real resilience, and forward guidance is suggesting that there isn't as much exposure to the conflict as had been expected, and that's particularly the case in the US. So it's really a case of how long does this go on for, but we do feel quite confident that even if there is a bit of a drawback, a pullback in the market, US markets certainly are very well positioned with economic strength to ensure that that is quite contained.
At the same time, there are red flags, as you say. Seema, Paul Donovan pointing out today that the household savings rate has dropped from 5.1% to 3.6% of disposable income during the lifetime of this administration. We saw that in the data yesterday. That's how customers have been funding, let's say, this difficult patch, and that can't continue, can it?
Well, I mean, actually, household balance sheets are incredibly strong. So although savings rate has fallen, there is so much of a cushion to fall back on that we do feel quite confident that actually consumer spending can stay quite strong. And remember, the one big beautiful bill, the tax refunds are hitting at just the crucial moment to offset some of the pain from higher gasoline prices. Of course, that can't go on forever. But certainly with regards to the conflict and how long this extends for, that should essentially mean that households can navigate this without too much difficulty. And actually, interestingly, you see the same thing with corporate balance sheets. The estimates that we're looking at suggest that they're strongest that they've been since the late 60s. So this is a really, really well-positioned US economy at this stage.
And there's also all sorts of buybacks being increased and so on. So what does give you pause about this rally, Seema? Because you're not completely all in, I can sense.
Well, certainly we do have some concerns, as I said, about how long the conflict is going to be. And it's positioned internationally. So, you know, as I said, the US is looking very strong, but we do see more vulnerability in Europe and in Asia. Now, it's not a terrible story, but they don't have the same kind of cushions that we've got in the US. And of course, as energy importers, they are more exposed. That doesn't take us off the international trade entirely, because there are important secular drivers such as defense spending, building out AI infrastructure, that all continue to be really key. But it does mean that you have to be very focused, very disciplined on focusing on what is that dispersion and where are the opportunities, even as the conflict goes on.
How much of a risk, particularly for international markets, as you say, are rate hikes that very likely are coming in the near future?
Yeah, that's a really good point. And again, I think that's one of the other things that you're seeing why there is so much divergence in the global performance is that with the US, for example, we're not anticipating hikes this year and actually still have one rate cut in our forecast. By comparison, for Europe, we're anticipating a rate hike in June and potentially another one this year. And potentially for the Bank of England, there could be one hike in this year. And we have seen that historically in geopolitical crises, it's really when central banks hike, that's when the economy really deteriorates, that's when markets start to underperform. So that is a risk. But keep in mind that we're only talking about one or two hikes in Europe. We're not expecting a significant move. And certainly for the ECB, that would just take rates to the upper end of the neutral range. So interest rates would not be in restrictive territory. They shouldn't be weighing particularly on activity. It's just a case of containing inflation expectations.
So, Seema, back to the US then, you said you're still expecting one cut this year. We obviously saw a little bit of a move off the easing bias this week, at least the language part of it. What would it take in the data for the rest of the members to perhaps become a little bit, less sanguine, and even yourself to take out that quarter point cut potentially that you see this year?
Yeah, well, the key things that we have to be watching out for is going to be inflation expectations to see, are they becoming unanchored, de-anchored? At the moment, we don't see any signs of that, but that certainly is a risk that we have to keep a watch out for. Core inflation, of course, as well. Are the energy prices leaking into other segments of the inflation basket, which then could raise a risk of this inflation move becoming a little bit more ingrained? So those are the key things that we'd be watching out for. Powell specifically mentioned about tariffs, making the assumption that within the next 2 quarters that will essentially be out of the inflation numbers. But that's still a question mark. So we have to strengthen the economy, because if the economy is doing really, really well, the labour market is looking very strong, then there's very little reason to have another cut. But that would be considered as a positive move for markets rather than a negative that the Fed isn't cutting.
Seema, this Fitch warning that the US's debt burden is far above other nations that share its AA rating, is that something to be very concerned about right now, or has the bond market just way too much to be considering?
So it's one of those cautions that those concerns that we always have at the back of our mind. It is not healthy, and I'm sure that long term there will be some implications of this. But at this stage, the bond market is it's looking away. It has got some worries, and certainly we do expect it to be one of the reasons why bond yields do not come down very significantly. But at this stage, it's not really a crisis point. It's just something to keep an eye on.
Yeah, Seema, thank you so much, and happy May. Seema Shah of Principal Asset Management joining us there. Coming up, we're going to dig into the world of vibe coding in your Wall Street Week preview. That's next. This is Bloomberg.
About 80% of projects will find it difficult to secure financing. And this is really all because of the level of readiness or preparation. As you know, for investment to occur, you need well-prepared, technically prepared projects, but they must also demonstrate economic and financial impact. So one of the major challenges is the stock or availability of bankable projects in countries. Almost all countries have got good plans and ideas, but when you look at the readiness of those projects, that's a major obstacle. And that is why the African Development Bank, through the African Water Facility, invests heavily in upstream preparation of projects to enable countries to have a large pool of investable projects. The second element that is an obstacle is the institutional and regulatory environment in most countries, which make it difficult for investment to happen.
The countdown is on. Everything you need to get the edge at the end of the market day. Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
The Middle East and Africa regions are home to some of the biggest deals and fastest growth in the world. Vibrant resources and high-yield investment opportunities abound. I'm Jumana Versace. Join me on Bloomberg Horizon's Middle East and Africa for the stories, newsmakers, and insights shaping the decisions of traders across this exciting region.
You had heightened levels of volatility.
There's still room to maneuver.
We do see opportunities.
It allows you to increase significantly your net income.
Every trading day, only on Bloomberg.
This This is Bloomberg Brief. I'm Bonnie Quinn in New York. AI investment dominating big tech earnings this week, and with much debate over the best use cases for AI, Wall Street Week takes a look at one area it's excelling at, and that's coding.
In Upper Tract, West Virginia, Jamie Grove owns a boutique warehouse, helping clients ship out anything from dinosaur bones to board games. Last year, he built software that automates shipping out packages with help from AI.
Where's the order that you're looking at there?
There's absolutely no way I could have done any of this without AI.
And although vibe coding has helped small businesses and hobbyists create their own software, it's the professionals who are leading the way.
At Google, when we talk about autonomy and agentic engineering, we have systems that allow you to kind of have almost a virtual software engineer.
Hold on. If all these brilliant engineers are using AI in this way, what is it that they're doing all day long in beautiful buildings like this one?
Excellent question.
Adi Osmani is the director of Google Cloud AI.
So if you are vibe coding, you're pretty much just giving into the vibes. You don't necessarily have a clear, full idea of your vision. You're just working with the LLM. You're trying to get somewhere with it.
Wall Street Week's Simon Hampton joins us now at the desk for more. So, Simon, the engineer there basically saying, so if you're vibe coding, you're giving into the vibe. What is vibe coding?
Yeah, it all sounds a little bit meditative, isn't it?
Yep.
Like giving into the vibes. But I think, this week we're talking about big tech earnings, a lot of focus on AI investment. Coding really is one of the best use cases so far for it. And what vibe coding really is it almost cutting out the middleman. And what you're seeing is a lot of these small and medium businesses, they can do the coding themselves, and they don't need any technical expertise in coding. We spoke to a couple of examples. You heard from one there, Jamie Grove, a warehouse operator in West Virginia. We spoke to another one, Cynthia Chin, a creative designer out in Oakland, California. Two people in vastly different fields, and they'd taken on the coding themselves, the vibe coding, I guess. And basically, they built their apps, they built their warehouse operations, in the case of Jamie Grove, themselves, and for far less cost as well. Jamie Grove talked about that. He said that typically software development would cost him tens of thousands of dollars, doing it himself, $20 a month.
Oh, insane. So vibe coding then, it's not based around any particular coding language, is that? I mean, you don't need to know COBOL or whatever.
No, I don't think it's based around a particular language. It's really just, as they say, based around the vibes and following the vibes of the product you're making. There are some concerns with it, I guess, and that is that, if you're doing it yourself and you're giving into the vibes and coding yourself, and you don't have the expert there, that when something goes wrong, you have to figure out how to fix that. But it certainly seems to be popular amongst these small and medium businesses in particular.
And does it work across every industry? And how do you buy it? You just buy a package of vibe coding tools?
Well, I think they're just using the AI tools that are out there right now, and using some of the, certainly the cheaper models that are there, and they're coding their websites, they're coding their systems, and they're doing it all from the comfort of their home.
All right, well, I cannot wait to watch this week's episode of Wall Street Week and find out more about this and how we can make use of it in our daily lives. That is Simon Hampton there, and you can see more on that story on tonight's episode of Wall Street Week, 6 p.m. Eastern. It also plays across the weekend on Bloomberg Television. Coming up, Apple shares higher in pre-market trading after delivering a surprisingly strong revenue forecast. We'll dig into the results next. This is Bloomberg.
as an exchange, what can you do to make it more attractive to be a publicly traded company?
Talk to our customers. We spend a lot of time with our listed companies, listening to their concerns, particularly the offices of the CFO, head of IR, listening to their pain points, general counsels as well, and then act as an advocacy group for those companies to really focus on structured reform to allow a company to tell their story in the most efficient way possible and reward them for the good disclosures that they are making in the market.
Is there any sort of financial innovation that you could drive to get more companies to list? Tokenization has come up.
Well, we did announce our tokenization initiative earlier this year. We've already built the technology, we've already done a variety of proof of concepts. It allows for instantaneous settlement, 24/7 trading. It importantly allows for the rights associated with a share to move into that electronic form, but is going to be a platform that runs in parallel to our more traditional exchanges.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
Watch
Bloomberg 10. This is the Asia trade.
This is Wall Street Week. Welcome to Balance of Power.
You're watching Bloomberg Deals.
Welcome to Bloomberg This Weekend.
This is Bloomberg Television. It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
It's 5:30 a.m. in New York City, 10:30 a.m. in London. Good morning, I'm Bonnie Quinn with your Bloomberg Brief. Let's get you set up for the day. Futures wavering after U.S. stocks notched their best month since 2020. Oil holds on to a second week of gains. Apple out with a strong forecast, but warns of rising costs. More earnings with Chevron and Exxon on deck. And President Trump said to be mulling further military options against Iran while keeping that naval blockade. So let's look at those markets then, starting with U.S. equity index futures, which, as you can see, are a little bifurcated. S&P futures pointing to more gains after we hit a record at the end of April trading yesterday. 5 straight weeks of gains for the S&P, even as NVIDIA was falling. That's a little bit why you're seeing a bit of a divergence, but really we're talking minuscule here with NASDAQ futures pointing to a very slight decline. The VIX, by the way, is around 17. And semiconductor stocks, for their part, they're up 38% in the month of April. That 30-year yield creeping ever so slightly back up at 4.98, but we have yet to close above 5%, so that's a line in the sand. And then oil. We have moved to the July contract for Brent, and we are elevated still, 112 a barrel, 106 almost on New York crude. You know, a second week of gains, but that makes it sound positive. It's really unfortunately, a second week of gains. And then we have a slight gain for the US dollar now that we have some more clarity on central bank moves. Let's get to some individual pre-market movers. Here's Chloe Melly in London.
Good morning, Bonnie. Apple is up about 3% in pre-market this morning after a stronger than expected revenue forecast. It did warn that it was facing higher prices for memory chips, but what investors are really focused on is how resilient Apple's margins have been despite those higher costs. And this really positive outlook is translating in this boost in the share price this morning. Moving on to Atlassian, which is also up, really rallying this morning, more than 24% now after beating expectations. That performance was really driven by the cloud segment. And so this eased some fears that AI is going to disrupt that software sector. This, of course, comes after the huge software sell-off that we had earlier in the year. But the likes of Atlassian and then SAP in Europe are now reassuring investors. And finally, Roblox is down this morning after cutting its forecast and reporting slower user growth. This is because it's implemented a few new safety features for the kids using the platform. But this is something that in the near term, at least, is going to be impacting those bookings and that engagement on that platform, but perhaps setting it up for recovery a little bit later. But in the meantime, we're down more than 23%.
Chloe, thank you so much. Chloe Melly there in London. In Washington, President Trump keeping the pressure on Iran.
Their economy is crashing. The blockade is incredible. The power of the blockade is incredible. They're not getting any money from oil. And hopefully it can be worked out very soon.
Iran's Speaker of the Parliament posting on X, quote, "Good luck blockading a country with those borders," referring to Iran's size. He also believes the blockade will push oil prices up to $140 a barrel and says that it must be lifted for new talks to occur. Jonathan Tamari of Bloomberg Government joins us now from Washington. Jonathan, it's not working, at least so far. Is President Trump hoping to wake up one morning and see Iran running back to some negotiating table somewhere?
That seems to be the goal, and the theory, I believe, is that Iran could potentially run out of storage for the oil that they're not able to ship, and that if they have to shut their wells, that could cause long-term damage, and that will bring kind of pressure on Iran to come back to the table in a way that the military bombing had not. But Iran is betting exactly the opposite, that the economic pressure will weigh on President Trump and cause him to back down eventually. So we're in kind of a test of wills and who can endure more pain, and everybody's just basically watching these two in a standoff at the moment.
Yeah, wait and see approach. Now, domestically, Trump has now signed legislation ending that shutdown at Homeland Security, a relief for many, I imagine.
Yeah, absolutely. I mean, this has gone on for more than 70 days. The most visible impact was at airports because TSA workers who check folks into the airport or handle security at the airport were not getting paid, or they were eventually getting paid, but only through an executive order. It was unclear how long that would last. So this does bring relief to nearly all of DHS. Still no funding yet for ICE and Border Patrol, but that is working its way through Congress. Republicans should be able to pass that in the coming weeks.
All right, and then we also saw some movement on tariffs, very particular tariffs after the King's visit, some Scotch tariffs being removed. What was this in aid of? I mean, I guess as Scottish ancestry, right?
Yeah, and it's in honor of the King's visit. We know the president is, feels very strongly about the royal family. He loves meeting with the royal family, even though he doesn't feel great about Keir Starmer. He was very gracious and welcoming to the King, and this was meant as a gesture of goodwill, and it just shows how important personal relationships are with the president, sometimes more than policy considerations. If he likes a person, he feels valued by a person, he will make a policy decision that favors them in a way he won't someone else, and this works out for the King and for Scotch makers.
You have to wonder how many emissaries will be sent from other countries around the world in the hopes of gaining an exemption or two, right, on tariffs. Now, the executive order to expand access to retirement plans, it's been in the works. Talk a little bit about what it means for the general public.
Yeah, so the president's expanding access to retirement plans through the federal government for people who don't have those retirement plans at their private employer. It's right now starting through executive order only for people at low incomes, $35,000 or less a year. The government would match up to $1,000 of retirement contributions. This is a part of him trying to refocus on the affordability question that is really the top issue in the midterm elections. A lot of Democrats and some Republicans privately said the president's been too focused on his ballroom, on wars overseas, on things like Greenland, and they really want him to focus, at least Republicans do, on the cost of living. This is one effort to do that. The challenge for an election year, it won't kick in until next year, so people won't be feeling it by the time they go to the polls in November.
No, and what they are feeling is gas prices rising day by day. Jonathan, thank you so much for joining this Friday. That is Bloomberg Government's Jonathan Tamari. Let's turn to tech now, and Apple pushing higher after the firm beat analyst estimates with a strong revenue forecast, offsetting a warning from CEO Tim Cook, saying on the earnings call, quote, "We expect significantly higher memory costs beyond the June quarter. We believe memory costs will drive an increasing impact on our business." Cook also noting a persistent shortage of Mac computers. Matt Bloxham of Bloomberg Intelligence joins us now. What do we all miss, Matt? How come we're seeing such stunning growth in revenue forecasts?
Yeah, I mean, it's a testament to the enduring consumer appeal of the Apple product lineup, and particularly some of these new products like the MacBook Neo, which has sold out, and even the kind of the iPhone 17e, and actually things like the MacBook Mini and the Studio, which are turning out to be incredibly popular for AI, and they're seeing an unexpected ramp in demand there. So I think that surplus of demand over supply helps them to some degree on this potential margin squeeze coming because they do have a huge amount of pricing power. The other thing which helps them a bit is the continued success of their services business, which has a much higher gross margin. And so even though there might be some headwinds on the product margin, as services becomes a bigger part of the mix, that starts to kind of compensate. So that may well kind of dampen any squeeze we see in the coming quarters.
In terms of the memory costs going higher, I mean, I guess it's a silver lining for the memory companies potentially, but is there a point at which companies just won't buy memory? Is there a level at which they'll try and substitute? Is there even substitution for
I just don't, there just isn't really an option, I think. And I think that the kind of the options you've got as a company like Apple are either, if you think this is a structural issue, you start to rethink your supply chain, but that doesn't help you in the short term. Ultimately, you look to kind of see how much of it you can pass on to your customers, which isn't easy for lots of companies, but for a company with brand strength like Apple, they're in a strong position. And it's not a company-specific issue, it's an industry-wide issue, and that maybe kind of helps because you know that if you're having to think about putting prices up, probably your biggest rivals are making the same considerations too.
Well, interestingly, we're seeing memory chip companies down this morning, but that's after a blistering rally, and just remains to be seen how sustained it can be. OpenAI CFO Sarah Fryer saying the company is meeting objectives. She's talking about a vertical wall of demand. I mean, is she doing damage control at this point, Matt, to the story that we saw earlier in the week from the Wall Street Journal?
Yeah, I think to a degree she is. I think clearly, anecdotally, you hear so much talk about the success of Anthropic and its Claude business right now, and even Gemini. So I think there's definitely a perception out there amongst the investment community that the momentum has gone away from OpenAI. So I think given their kind of aspirations to float the business, they definitely need to kind of reposition things. I think she was quite careful to kind of point out that a lot of the issues, to the extent they're facing issues, are due to supply constraints too. So that they're kind of like everybody else struggling to get enough compute power to deliver on the demand that they have for their products. But I think as we kind of move through this year, there's definitely going to be a lot of scrutiny and focus on whether this kind of shift in pecking order that's pushed towards Anthropic is just a kind of short-term thing, or that there is an opportunity for OpenAI to kind of regain the leadership position as they launch new models into the marketplace.
All right, Matt Bloxham of Bloomberg Intelligence, thank you so much. Now to other top stories trending on the terminal this morning. Bloomberg analysis of Bank of Japan accounts indicates FX intervention of about $34.5 billion to support the yen. It's the first currency intervention by the BOJ since July of 2024. The yen appreciated dramatically Thursday evening after Japan's finance minister warned that bold action was imminent. S&P Dow Jones Indices has launched a consultation that could speed up the entry of mega-cap companies into its indexes. Under the rule change, companies would only need to be public for 6 months before entering its indexes. That's versus the previous rule for 12 months. It would include admission into the S&P 500. If approved, the changes would mean Elon Musk's SpaceX could enter the S&P obviously faster. More on the richest person in the world. Based on a regulatory filing, Musk's total compensation from Tesla in 2025 was $158 billion. Tesla did say there could be significant disconnect between the reported compensation and what Musk actually got. Since Tesla didn't reach any of the market value or operational targets set last year, Musk's total realized compensation was zero. Coming up, Exxon and Chevron set to report before the bell. We'll push ahead with Jason Gableman of TD Cowen next. This is Bloomberg.
Welcome to the world of decentralized finance.
Why is it that NFTs have not recovered in the same way that, say, Bitcoin has?
Bloomberg is covering all things crypto.
It's a pretty spectacular story.
The people.
This is the future. This is the 21st century economy.
The transactions.
It snapped up nearly $1 billion of Bitcoin.
And the technology.
We need to build a digital Fort Knox.
That gives people financial freedom, and that's a wonderful thing.
That's extraordinary.
We ride the wave that is Bitcoin.
Bloomberg Crypto, only on Bloomberg.
Oh, hello there. Just wanted to say, Primer is back. We've been scouring the frontiers of science and technology to help explain the difference between the next gold rush and whatever this thing is. And in season 2, we're upping the stakes. More danger.
Now that is some high-grade uranium mineralization.
We used to have a stable climate on this Earth. Right now, we do not.
More science.
We're pushing the envelope of technology in multiple directions. Software, hardware, chemistry, physics.
The cable is like very cold.
And more CEOs that can nail the photo shoot.
Hundreds and hundreds of billions of dollars are at stake.
While the problems are economic, the solutions are too.
And yes, we will be talking about AI.
There is a lot of humanoid hype out there.
But our future doesn't run on hype. It runs on innovation. Watch season 2 on all these lovely channels.
World's most powerful investors don't ring a bell. They quietly reshape entire industries. This is the money shaping the world. The Dealmaker Playbook, where power and billions of dollars change hands every day. From private equity and credit to venture capital and M&A, we bring you the inside scoop on the biggest deals and debates, plus exclusive conversations with finance's ultimate insiders. I'm Danny Berger, and this is Bloomberg Deals. Every week, only on Bloomberg Television.
This is Bloomberg Brief. I'm Bonnie Quinn in New York. Earnings rolling in once again today. Exxon and Chevron, they're higher in the pre-market ahead of earnings before the bell. Joining us now is Jason Gabelman, Managing Director of Energy Equity Research at TD Cowen. Now, he's maintaining a buy rating on Exxon, but has a slightly reduced price target at this point of $172, maintaining a hold on Chevron with, again, a reduced price target of $204. Why the reduced price targets broadly, Jason?
Well, we look at the stocks over the medium term. Obviously, the equities are inflated right now due to what's going on in the Middle East. We expect over time commodities will normalize to some extent, and that's what's reflected in our price targets.
Now, we have a Bloomberg Intelligence Outlook that suggests that energy firms broadly are going to see an 8.6% drop in their first quarter profit. Energy equipment and services providers obviously expected to take a larger hit thanks to the Middle East. Let's get to Exxon and Chevron. Will it be really bad for both of those companies? Are we expecting dire headlines year over year?
No, we certainly don't expect that. And in fact, we expect investors to focus more on the outlook moving forward, given the Middle East conflict really ramped up during March and you didn't see the full commodity impact until late in the month. So we expect commentary on future guidance will be more important than what gets printed for the quarter.
So both of them have said they expect production to slump. Let's take Exxon first. Where could we see some bright spots for Exxon?
Yeah, so Exxon, we think there's a couple of focal points for them. Of course, they have more exposure to the Middle East than Chevron. They've said 20% of their production has been impacted due to the Middle East conflict. So certainly being able to manage that downtime is going to be an important point for earnings. They additionally have had some damage at a Qatari LNG plant. The time to get that coming back online and the cost of that will be important. And then the medium-term benefits from the UAE exiting OPEC. The UAE has spare capacity and they could ramp that up. And we'll see if Exxon thinks that'll benefit them at all. Moving to, yeah, sorry.
Go ahead, Chevron, yeah.
Yeah, no, I was going to move to Chevron. They have less Middle East exposure, so they're better positioned in the near term to capitalize from the higher prices we're seeing in the market. One area we're looking for is their desire to increase investments in Venezuela. They've been a bit more hesitant to do so, given a lack of confidence, what we're seeing on the ground there, will be sustained in the medium term. So we wonder if they have gained confidence, given it's been pretty stable there. And then the other thing for Chevron we're watching for is if they increase their buybacks. They cut that last year, but given commodity prices have increased, we see capacity for them to increase that this quarter.
Yeah, it's kind of incredible to think that last earnings season, the war in the Middle East hadn't started, right? I mean, it feels like it's been going on for forever, but the big concern back then was, well, what happens in Venezuela? Will Chevron, be giving us a big update on Venezuela? Is it very serious about taking its projects forward there? And will we hear of any major development in the last 3 months?
They said last quarter that they wouldn't put more capital to work in the country for about 18 to 24 months as they wanted to see how the situation unfolded there. Given what's going on in the Middle East, it does increase the value of increasing production in non-Middle East countries. So we do suspect that what's going on outside of Venezuela could impact Chevron's decisions within the country.
Now, we have seen blistering rallies for both of these companies just since the beginning of the year and since the whole Venezuela chatter started, up 27 and 28%. Can that continue, Jason? Or are we sort of, obviously you have price targets, but are we pretty fully valued here?
So one of the more interesting things to note is neither of the stocks have really rallied since the Middle East conflict began. You mentioned the strength in the equities year to date, but that mainly predated the Middle East conflict. So we haven't actually seen a reflection of these higher commodity prices reflected in the stocks. As such, we do see upside to the stocks in the near term.
What base assumptions are you making for the price of a barrel of oil over the near future? And will Chevron and Exxon give us their estimates?
The companies in the past have been hesitant to throw out commodity price assumptions in the near term, so we'd be surprised if we get any discrete numbers from them. We're using strip in the near term, which has gone up to $100 a barrel, and if you look at the futures curve over the next 12 months, it's actually the highest level it's been since the conflict started. So I think we're seeing perhaps a longer duration for this conflict and the closure of the Strait of Hormuz being priced in to the commodity strip. So we're assuming about $100 a barrel for the rest of this year, falling to $75 a barrel next year and $70 a barrel thereafter.
If oil prices stay elevated like this, is it generally a boon to these companies though, Jason? Or is there a point at which it starts to become a headwind even for them?
There's no doubt that higher commodity prices are beneficial for this group. There could, of course, be some offsets. The higher oil prices go, you start to risk demand destruction, which largely we have not seen yet, according to companies that have reported thus far. That does become a risk. Some industry estimates suggest that at about $200 a barrel of product prices, so not crude, but things like diesel and gas, that you do start to see demand destruction. We haven't seen it yet in this market, but higher prices should be a positive for these stocks.
We appreciate your time so much, especially on this day, Jason. Thank you. Jason Gableman of TD Cowen. Coming up, those earnings and more economic data on deck in your day ahead. This is Bloomberg.
to Bloomberg This Weekend. I'm David Gura.
I'm Lisa Mateo.
And I'm Christina Raffini. We're tracking breaking news today from Wall Street to Washington.
Let's start overseas. The sector is really propelling this deal forward.
Yeah, the hope is this will open up new markets and provide some additional liquidity.
Of course, now they're going to have competitors. We got a big week coming up in politics.
Earnings season is underway. We're going to get some key reports.
Everything you need to know before the markets open on Monday.
Introducing Bloomberg This Weekend, bringing a little Bloomberg into your weekend routine.
Guys, buckle up.
Bringing you the world's business and financial news whenever and wherever it happens. I'm Michael McKee at Mount Everest, and this is Bloomberg.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Amin, only on Bloomberg.
Every weekday, Bloomberg puts the spotlight on a different aspect of global finance. Flows, funds, and the forces shaping markets on ETF IQ. The future of money with Bloomberg Crypto. The players behind major transactions on Bloomberg Deals. The stories informing finance with Bloomberg Markets. And rates, risk, and the cost of capital on Bloomberg Real Yield. A different topic every weekday, only on Bloomberg Television.
Bringing you up-to-the-minute space news whenever and wherever it happens. I'm Ed Ludlow at NASA's Kennedy Space Center in Florida, and this is Bloomberg.
Bloomberg Brief. I'm Bonnie Quinn in New York. Now a look at what's ahead today, May 1st, the first trading day of the month. Earnings from Exxon, Chevron and Moderna all coming out before the bell. Then we get some manufacturing PMIs at 9:45 and also 10 a.m. Eastern. And then Berkshire Hathaway earnings coming Saturday morning. Now this is going to be Greg Abel's first annual meeting as CEO. Let's take a look at some pre-market movers. Obviously, Apple is going to be one of them. It's leading Mag 7 stocks higher this morning after its forecast well-topped street estimates. A little bit of a surprise there. Now, SanDisk, one of the memory makers, a big beat on earnings and guidance. Not enough to meet lofty expectations, or maybe not enough to continue this blistering rally that we've seen in SanDisk, but you know, we'll see how the session rolls out, right? Clorox down 5.5%. It cut its fiscal year 2026 outlook due to weakening consumer sentiment and higher energy costs. That could be a red flag for the next earnings season. Let's take a look at your macro environment this Friday. So we're coming into the first trading day of the month. A little uncertain. S&P futures pointed higher after hitting a record yesterday and having April be the best month for equities since 2020. Which is a long time. NASDAQ 100 futures pointing to a lower open. The 30-year yield seems to be relatively calm there and stable under 498. Let's take a look at Brent. We've moved to the July contract and we're still elevated. 111 and change. Crude, WTI 105 and change. And then the dollar index is relatively unchanged. The yen, by the way, still around the 156 mark. And the VIX hanging out at 17. Well, that is it for Bloomberg Brief. Surveillance is ahead. This is Bloomberg.
The women's semi-finals in Madrid. A day after her 19th birthday, Mira Andreeva punched her ticket into the championship match with a hard-fought win over Hailey Baptiste. Mira becomes the first teen in history to reach 3 finals at WTA 1000 events. And don't forget, you can watch all the action live daily and head on over to tennischannel.com to download the app.
Everybody has a moment where they put into action all they've practiced, where they step up to a challenge and either succeed or fail. But what are those moments for some of the world's most influential leaders?
It was a rough and tumble world, and I thought, okay, I can rise up, I can play this game, and I did play the game.
It was great, and it was depressing, and it was disappointing.
My chair at the time sat down with me and said, succession starts now.
I'm Francine Lacroix, an award-winning journalist. For the last 25 years, I've interviewed world leaders, bank bosses, even fashion icons. I'm often asking about the news of the moment. But I've always been curious, who are these people as leaders? Join me for the podcast version of Leaders with Francine Lacroix. I'll start your week with conversations that explore what drives the world's most influential people, how today's leaders got to where they are, where they're going next, and how they've transformed their organization in the process.
Make decisions. A poor decision is always better than no decision.
You have to have truth tellers around you, and you have to be willing to listen.
You don't want to be setting strategy in the middle of a transaction, that's for sure.
Do it for the right reasons. Don't do it because of FOMO.
We'll also learn lessons which we can apply to our work and daily lives. Tune into the podcast version of Leaders with Francine Lacroix. Listen and watch on Bloomberg Television or wherever you get your podcasts.
What is going to be the consequence for U.S. markets?
We are seeing modest gains across European equity markets.
Take a look at how we're faring when it comes to Asian markets.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg.
If there's a war, nobody told earnings.
What's really driving the market higher has been extremely strong earnings.
If you look at the earnings we've gotten, they've been incredible.
The earnings story is overpowering.
As far as kind of the main driver here, it will continue to be AI.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, Bloomberg Surveillance starts right now. Coming into Friday, entering May at all-time highs. The S&P 500 looking to build on the biggest monthly advance since 2020 as Apple is wrapping up mega-cap tech earnings topping forecasts. Investors are shaking off elevated oil prices as the president maintains the naval blockade.
I love this. People said that this market would not be able to keep rallying if you saw this blockade continue, or if you saw the Strait of Hormuz continue to be shut. Not only have we rallied, as you just said, we saw the biggest rally for a month going back to the height of the pandemic when we first were coming back. We were learning about vaccines in 2020. If you take a look at semis, we're talking about the best monthly rally going back to 2000. The why cannot be found in the bond market. The why cannot be found in the oil market. The why cannot be found in the currency market. It is squarely in the earnings, and it is a multifaceted bunch of earnings that have come in better than expected.
10% move on the S&P 500, 16% move on the Nasdaq 100. Phenomenal gains. The message from the market is pretty simple. Developments in tech are far more important to this market than developments in the Middle East.
Yeah, the fiscal stimulus of CapEx from the biggest tech companies is pretty tremendous. And it's not just those companies. It's also the ecosystem around them, whether it's Caterpillar, whether it's some of the other discretionary spending that is hinged off of some of the stock gains that we've seen that are tied to those tech companies. Just putting this out there, only 12% of companies reported have missed. That is the lowest share going back to 2021. That is so far in this earnings season. So it is broad-based, even amid this concern about the oil machine.
And the names you'd expect to do well haven't done well at all. Exxon, Chevron have done nothing for 2 months. Both of those companies report earnings later on this hour. Throughout this morning, look out for that. I want to start with this move in crude. Still elevated here, and the president committed to a naval blockade. In the president's own words, their economy is crashing. The blockade is incredible. Their economy is a disaster. We'll see how long they hold out.
And interesting to see that we're so far off some of the recent highs in crude. I mean, I just want to point out that we've reached 125 on Brent crude, and we've come back to 111, even as this blockade shows no sign of going anywhere. And frankly, people are still having the same conversation of who blinks first. What is the optimism baked into that? I know this is a strange thing to say, but what is the optimism baked into that we're going to reach a resolution sooner, especially as there are discussions and reports of potential strikes by the U.S. in Iran to expedite some of this coming to the table?
The president appears to have three options on the table right now: maintain the blockade, resume hostilities, or walk away. And based on the communication we've received from the administration throughout this week, he seems far more comfortable with option number one: maintain the blockade, keep the squeeze on, and see what happens next.
And frankly, a lot of analysts are saying it really is putting the squeeze economically on Iran. There are a number of stories about how the currency is completely tumbling, about how hyperinflation is really pressuring the political environment. That said, if you're dealing with an actor that doesn't necessarily have political goals in mind, how do you negotiate and use tools of leverage? How political are the decisions being made by the IRGC?
Equity futures on the S&P 500 just about positive to kick off the month of May. Where did April go? Said this a few times over the past few days. The first quarter felt like a lifetime. April, blink of an eye, gone.
Part of it is that in the beginning, we were talking about headline roulette, and we were talking about focusing on different things. And this, it was just a fire hose. I mean, it was just an absolute fire hose, and people felt pretty good because they were making money. So if you have a fire hose of information that you could digest and people feeling pretty good, well, time flies.
Coming up this hour, we'll catch up with one of those equity market bulls throughout all of this. Ajay Rajadaksha of Barclays, with stocks coming off the biggest monthly gain since 2020. We'll speak to Tom Forday of Maxim Group as Apple sees impressive sales growth, and Abigail Watt of UBS as the US economy shows some real signs of strength. We begin this hour with stocks looking to build on fresh record highs. Ajay Rajadaksha of Barclays writing, we were overweight risk assets last week on the belief that momentum would carry markets further, but we now turn more neutral. Ajay joins us now for more. Ajay, good morning. It's good to see you.
Good morning.
I want to give you some credit first, because the person who's not here today is Anne-Marie, and that's unfortunate because she gave you so much criticism last time for maintaining this bull case, despite the fact that we had the Strait of Hormuz closed. Can we start there? Why you were bullish, before we get to the turn to neutral, why you were bullish and why that worked out?
Right, so that was March 27th. I looked the data up, looked up how much stocks are up since then before I came back on. but better lucky than smart, John. So in this particular case, I think two or three things the markets were not factoring in then. The first is the economies that matter, the United States and China in particular, just had a much bigger buffer. China has 1.2 billion barrels in SPR. The United States is an energy superpower. The second thing, and we keep missing this crisis is not 8 weeks old, it is 5 weeks old. For the first 3 weeks, you still had tankers that had left Hormuz that were landing on shores, so people tend to forget that. And the third is that the starting point collectively for the world oil markets was looser than people realized. Last year, we had nearly 700 million barrels of inventory built up. Hormuz matters, but it's a much slower moving story than markets just got ahead of themselves, and then the power of earnings remind them that, well, let's not get carried away.
So we had a big cushion, bigger than people thought.
That's right.
We've worked through some of that. You've now turned neutral. Walk us through why you've developed a more slightly negative view on this market.
And the reason is because the pace at which inventories are now coming down, the first 3 week cushion is gone, right? The outage is about 10, 11, 12 million barrels a day. We are drawing down global inventories at 80 to 90 million barrels. It seems like a week. It seems like you said that the president is going to continue with this tactic. That means in another 2 to 4 weeks, if we continue here, no hostilities.
Sure.
But at the same time, no oil flowing through Hormuz. It is going to start to matter. That's what I'm, trying.
This is slightly different, Bramo, to what we were talking about. The consensus right now in the street is it doesn't matter. The only thing that matters is tech, and that's what's got us here. What I'm hearing right now is that's about to change.
And frankly, that it has mattered. It just didn't matter in the same kind of way that people had expected. And you're starting to see that a little bit in some of the earnings coming through, where people are saying, well, component parts are getting more expensive, and that's the reason why they have to raise more money. And that is going to pressure some of the capex that we keep hearing about.
How did the dominoes fall? You clearly think we're close to a tipping point. Where do you expect to see it show up first?
I think tipping point is still overstating it. I would not be outright short risk. Like I said, the weight of earnings is still too strong. But I do think that momentum's carried us in the last week, 2 weeks. No one wanted to be short earnings going into Wednesday for good reason. I mean, the earnings were blowout strong. People are not questioning AI capex the way they were 3 months ago. It's viability. I think we just trade around these ranges and probably stay like that until we have clarity on Iran. Then we take another leg upwards. It's not as clear-cut a message as a month ago, Jonathan, but here we are.
How much tension is built in the fact that we just saw the best monthly gain for the S&P 500 since 2020, and we reached cycle highs on benchmark yields around the world at a time when people are really worried about inflation and they're really worried about the central bank response to it.
There is a little bit of tension in equities, but I think it's more a bond story in itself, just an outright bond story. There is not a part of the duration market globally in the 10 to 15-year sector that I would touch with a barge pole, genuinely. Because the United States, the United Kingdom, Japan, France, it's not just the US. In every economy, fiscal profiles are worsening quickly. Inflation profiles, at least for 2026, will worsen. And there's no political will anywhere to do anything about it. We used to have this debt clock outside Times Square, remember?
Yeah.
We just ran out of numbers and we no longer, it's not like our debt profile improved.
Okay, so this is the reason why Fitch raised some concerns yesterday about the U.S. and its rating, especially given the fact that we have debt profiles right up there with, say, Senegal and Mozambique, but actually they are better than us. But I'm just wondering, from your perspective, at what point that challenges just how much further some of the equity valuations can run, just simply because we are going to be entering a new regime if other people also don't want to touch this with a 10-foot pole.
I think for the next month, Iran, and I know I come from a place where I downplayed Iran a month ago, but at this point, for the next month, what happens in Iran will matter more for the equity markets. But if you have a decisive breakout, if 10s in the US go to, say, 4.75 to 5%, that, I think, is the level at which the equity markets will pay attention, and not in a positive fashion. We still have some time. If you get a bond story here, it is much more likely to come out of Japan or France or the United Kingdom right now than the US.
Japan intervening in the FX market. What was your reaction to that yesterday?
I was not surprised. They have said that 160 is their line in the sand. But you speak about tensions. There's a fundamental tension here, which is that the Central Bank of Japan, by every metric except history, except the fact that they're coming out of 30 years of deflation, right, is much further behind the inflation curve than any other major central bank. And they still are incremental in their process. The Ministry of Finance can do as much as it can, but ultimately there's an economic underlying tension here, which is not going.
It begs the question, you're fighting a terms of trade shock right now. Why aren't you hiking interest rates if you're worried about the currency?
Not immediately. I don't think enough that you and I are here discussing why markets are down 10% because of a terms of trade shock. But it is a slow-moving thing, and it's not possible.
Well, they're about to do something in crude as well. Have you seen this headline from Japan overnight? Oh, this is crazy. We are always ready to act regarding crude oil futures transactions. That from a Japanese official overnight.
Well, they're used to, absolutely owning the market, so why not try it again? I do want to just finish up with not just the manipulation of markets, but why the dollar hasn't strengthened more. Because we keep seeing that the U.S. economy surprises to the upside. The central bank is getting a bit more hawkish on the margins than people had expected, even as you see a little bit more of a dovish read in some of the other places, whether it's Japan or Europe. Why is the dollar doing nothing?
So for dollar bulls, this crisis has been humbling. There's no question, right? This crisis was tailor-made for the dollar. We are a gigantic energy superpower. The two big markets that form the dollar basket, the renminbi and the euro, are not. They're giant energy importers. And as you said, the dollar struggled. And I think the reason is not because the world is shunning dollar assets at all, remotely. Not treasuries. Last year, US treasuries were the best performing long bond in the developed world. If you want AI exposure, you have to be in the US, or you can take your chances in China. So that's not it. It's just that people are increasing their dollar hedges. They're no longer willing to take a flyer on the dollar. That's the thing that has changed over the last year to 2 years from a 20-year journey. I think that's it.
So you don't really like the bond market. You're cautious on equities. What do you like right now?
All right. So I would still hide in Max 6, if you ask me.
Max 6, which was the one that's not in the Max 7 anymore? Who gets chopped off?
I cannot believe you're putting me on the spot like this.
Well, you said Max 6,
I would put Tesla a little bit behind that.
Tesla's to one side.
Right.
Any particular reason for that?
I'm never going to be able to make it out of this room. I'm looking at forward valuations. I'm looking at free cash flows. I'm looking at all of the things that that are fundamental.
Okay.
And the other 6 just make a lot more money. That's literally the biggest reason. But I think, despite everything I've said, I think for now the European equity markets have gotten ahead of themselves. The US is not. The front end of the US bond curve is still reasonable. I don't think the bank of the Federal Reserve is going to hike no matter what. So
by the front end, you mean twos?
Twos.
Okay.
Right. But there's slim pickings out there after a 14% rally, after the best April in a long time.
Pretty phenomenal stuff, and well called by you and the team, sir. Thanks for being here. We appreciate it. Thank you.
Thank you.
Ajay Rajadaksha there of Barclays, following a 10% gain on the S&P 500 through the month of April.
Follow the earnings. He was the one saying it. And ultimately, the most important thing that he said that I thought really a lot of people haven't talked about, we have had a delayed crisis. It's really only been 5 weeks, not 8 weeks. So maybe the real pain starts about now.
You know when we have one of those conversations, you go home, you listen back to it?
Yep.
Just had one of those conversations.
I feel like that's every time with him.
Yeah. Fantastic work, as always. Let's get you an update on stories elsewhere this morning with your Bloomberg brief. Yahara Anand has more. Hey, Yahara.
Good morning, John. President Donald Trump says he's sticking with a naval blockade of Iranian ports. His comments coming after oil hit a wartime high. Iran's new supreme leader casting doubt on the likelihood of a deal, vowing not to give up the country's nuclear or missile technologies. The president says he'll remove some tariffs on whiskey following King Charles's visit. Trump saying he'll remove the restrictions so Scotland and Kentucky can start dealing again. Tariffs on Scotch have been a point of contention between the U.S. and the U.K. And the longest partial government shutdown ever is now over. President Trump signing a bill to fund most of the Department of Homeland Security except for immigration enforcement. Republicans plan to pass those funds separately in a budget bill that will not require Democratic votes. That's your Bloomberg Brief, John.
Yahara, thank you. A diplomatic breakthrough down in Washington, D.C. Well worth the trip. By King Charles.
I mean, it's like, why, of all things that we're talking about the fire hose of news, whether it's one person invading in a mark, whatever, it's like Scotch.
Scotch, done.
Anyway.
Okay, need a few of those. I think everyone does. Up next on the program, Apple's strong quarter.
The quarter looks really good, above expectations in almost every metric. They're buying up all the memory they can to ensure that they don't run out, and that's going to put a lot of pressure on their competitors.
Up next, we'll catch up with Tom Forte of Maxim Group from New York City this morning. Good morning.
Asia is at the forefront of some of the world's biggest stories.
And we're here, where the action starts in Sydney.
And in Tokyo, get ahead as the global trading day begins.
The Asia Trade, weekdays only on Bloomberg.
Middle East tensions are high.
Both sides willing to go back to the battlefield.
The narrative changes moment to moment.
Is there a ceasefire? Is there not a ceasefire? Markets are up, markets are down.
Count on Bloomberg for up-to-the-minute reporting.
Breaking news this morning.
Breaking news in the last few minutes.
On-the-ground perspective.
Talking to you from the bomb shelter.
This White House still pushing.
And the analysis you need to make informed decisions fast.
Clearly, nothing is final until it's well and truly final.
The really important question is whether we'll get second-round effects.
Nobody covers geopolitics like Bloomberg. From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
We've got a big hour of energy earnings coming up. Exxon in about 15 minutes' time. Just heard from Chevron, upside surprise. Adjusted EPS for the first quarter, 141. The estimate 90 cents. That stock doing nicely in the pre-market. Exxon coming later. After that, ISM data, manufacturing for the month of April. Look out for that at 10 a.m. Eastern time. Just a read, another read on an economy that so far is doing pretty well. The equity market doing better than good. Stocks through April. We went through some of the numbers. The S&P up 10%, the Nasdaq up 16%. Bramo talked about chips. It's been a big story for us over the last month or so. The semi-index just had a 38% monthly gain in April, the biggest month since the year 2000.
And earnings still outperformed, and that's what people keep pointing to, the idea that demand is just insatiable and existential. Key point, though, a lot of different tech companies pointed to component costs going up. With the ISM manufacturing, with some of the earnings from the oil giants, how much does CapEx start increasing as everybody races for the same thing?
That's something to look forward to a little bit later. That conversation is going to pick up ahead of that data point at 10 a.m. Eastern time. Let's turn to crude. Brent and WTI still elevated here. Brent crude at 111, WTI around 105. We're higher by about 0.9% on Brent crude this morning. That's keeping yields elevated too. Your 10-year around 440 still, up a single basis point. Twos at 388, also up a single basis point. We asked Ajay of Barclays, what do you like right now? Don't seem to like bonds, don't seem to like the equity market as much. Front end of the yield curve. Don't believe the Fed's going to hike. Twos offer value here.
We hear that a lot. Ultimately, if you don't have conviction on anything else, have conviction in almost 4% coupon that you can clip for the next couple of years with the expectation that most likely it won't go all that much higher.
Let's talk about another central bank, the BOJ and the finance ministry in Japan. Why isn't the BOJ hiking? Why is it all about the finance ministry intervening? This move, this drop-off that you saw in yesterday's session from 160 down to about 156, it holds at 156.54. Nikkei the first to report that there was some real intervention here, not just the threat of it. We followed that up here at Bloomberg as well. It's the final advisory if you want to escape, and they didn't give people very long to get out, did they?
They gave them about 12 hours, then they spent $34.5 billion to intervene in this market. For what, I think? Number one, it gives us a sense that 160 truly is the line in the sand, and so people are saying, okay, I better get not that far away from that because you don't want to fight the Japanese authorities. What is their goal, though? And to your point, the Bank of Japan could have just hiked rates. Instead, they're forced intervening to try to prevent inflation from imported goods like fuel and other commodities. So a question here, what's their limit from basically putting up their money in flames?
You're fighting a terms of trade shock. Can you do that with one-off intervention in 24 hours? Maybe that keeps some people on the other side of the trade, just stepping back a little bit because they don't want to touch this right now. But ultimately, if you want a sustainable, prolonged move, you've got to do something with rates now, or something corrects with energy and you get bailed out on that side of things.
The interesting footnote, and I would love to hear more information, is that Japan was doing this in tandem with communications with the United States. So trying to understand exactly what could be behind all of this, I would like a roadmap. Maybe someone could come up with a Claude model.
Just want it all spelt out for you.
100%.
I don't blame you. In the United States, of course, a focus on other things, and it's technology, a massive week of tech earnings. Under surveillance this morning, Apple's strong quarter.
The quarter looks really good, above expectations in almost every metric. Every company that's not doing something with AI, so it's consumer, enterprise, electronics, are facing severe margin pressure because of the surge in memory prices. I think they're being strategically very smart what they're doing. They're buying up all the memory they can to ensure that they don't run out, and that's going to put a lot of pressure on their competitors.
So here's the latest this morning. Apple's rising after posting double-digit sales growth and delivering a better-than-expected revenue forecast. Tom Forty of Maxim Group with a buy rating and a $300 price target on the stock joins us now for more. Tom, welcome to the program. What did you like about what you saw yesterday afternoon?
Yeah, so Jonathan, I think there was a lot to like, although there was a lot of kind of everything in that Apple report, and the special guest, John Turnus, on the call was a bonus and a surprise. So what I really liked was that consolidated net sales exceeded expectations, despite the fact that iPhone sales slightly missed, and sales in China slightly missed. But I'm willing to give a pass on the iPhone in China when considering you've had 2 consecutive quarters of north of 20% revenue growth for the iPhone and nearly 30% revenue growth for 2 quarters ago in China. So I think that those are some good numbers, despite things I think you could point at with some small level of concern.
So, Tom, we'll get to that in a moment because I know Lisa's got questions about costs and what's happening with supply chains. Just on leadership, you mentioned Turnus. Is it new leadership, same approach, or do you expect some changes?
So, Jonathan, I thought it was interesting. The other thing they had in the quarter is that they're abandoning net cash neutral while at the same time announcing a new incremental $100 billion of buyback. So I know you've talked about Tim Cook as being the king of buybacks. So John Turnus will still have a lot of dry powder to buy back shares. So I think the story here is still quite good. And, I think that they'll still be returning a lot of money to shareholders despite the changing the guard on September 1st.
Tom, there's some contradictory messages within these earnings. On one hand, they built up their R&D spending about 34% in the quarter. This is a departure since they've maintained a pretty subdued spending profile in this area, but they also are building cash. Do you think they're preparing to buy something, to pick up assets in a downturn? Do you think that they're trying to build something on their own? Are you getting any tea leaves?
So, Lisa, I absolutely think that Apple historically is almost always build versus buy. If they're buying, they're usually buying talent. So I think that it's clearly to build. John Turnus, again, as the next CEO, suggests they're still a hardware-first company, given that he was SVP of hardware engineering before being named apparent heir to Tim. So I would say that they're more interested in building. And then the other side of net cash neutral, abandoning that, is that they said they want to make sure that they have the ability to invest as much as they believe is necessary while still returning money to shareholders. So I think they're clearly investing.
Tom, about the component costs, as John was mentioning, this is something that keeps coming up on earnings calls from all the big tech players. They're going to increase their spend in part because everything is just getting more expensive. Is that still the same kind of spending, or does it become less beneficial in the eyes of investors?
Well, I think for Apple, there's a couple things that are working in its favor. When you have this strong of performance from the iPhone 17, I think they're able to generate better margins given the strong unit sales. When you look at that guidance for gross margin of 47.5 to 48.5, that's really good given the higher memory costs. And I think the other thing working in its favor now versus, say, 10 years ago is 18%, give or take, of their sales comes from higher margin services. So I think they are more buffeted when you have a material increase in component costs like we're seeing right now with memory.
Tom, just finally, the buybacks. Over the course of Tim Cook's tenure leading this company, what are we at now? $700, $800 billion in buybacks?
I still like to think of it as $350 billion market cap that turned into a $4 trillion market cap. Yes, buybacks played a role. Tim did an amazing job. So I think that the thing I'll be looking for in John's tenure is, like Tim, will he be able to sustain the life cycle of the iPhone? 5 years from now, will we still talk about the iPhone as 33 to 50% of revenue? And I think that's an important, benchmark for John and something I'll be following closely.
I'm not playing down the achievements. Don't worry, Tom. They're phenomenal achievements. Tom, thank you.
They
Tom
are.
Forday.
Poster child of the CEO after the founder of Jonathan.
Tom, very true. Appreciate it. Thank you very much. They've done great work. The stock is up again this morning by close to 3%.
Yeah, and they're running out of product, right? This cheaper than expected nano, micro, whatever computer that costs $500. They can't get them in stores quickly enough, and this is becoming a problem.
So they're Mac Minis.
Mac Minis? Is that what they're called?
Isn't that what they're called?
There's another one, too, that's like Neo Mac. I'm really up on my stuff.
Likewise.
This is really great.
Based on this conversation. So we'll move on to other things. We'll talk about energy. Bloomberg's Vincent Piessa with energy giants reporting earnings. Great numbers from Chevron just moments ago, at least on EPS beating expectations. Exxon coming up in just a moment. Plus, Yahira's got your morning movers. Memory stocks slide following an April surge. We'll get into that in just a moment. From New York City, you're watching Bloomberg TV.
phone is, what's great about it is it's a well-developed gaming ecosystem, right? So it, folks know to find games there, but it's also a highly competitive gaming ecosystem. So it's developed, this gives you both that upside and that downside. But what's exciting is that now we are moving beyond the phone to the TV. So I mentioned like one of the big gaming areas we're going after. One of the big gaming areas we're going after now is, social gaming experiences that will show up on your TV. So we are now announcing, we're going to announce here actually, that we're going to have these social party games that you can play on your TV with your phone as the controller. And it's things like, recognizable games like Boggle, you got Pictionary, we've got a Lego party game. We, basically are gonna like unleash this with a bunch of creators, and they're gonna go figure out stuff that we didn't even imagine that they can do with that interactivity.
I'm David Weston. Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate. We go on the road for a look at what lies behind the headlines of today and what will likely be the headlines tomorrow.
We need more transparency.
Oil and gas is still important.
They said every citizen should be investing in the market.
Accelerate progress in all fields of science.
Watch Wall Street Week right here on Bloomberg. More than what you need to know, it's what you need to think about.
Full time for the month of April, the final score, check it out, up 10% on the S&P 500, biggest monthly gain since November 2020. On the NASDAQ 100, up 16%, biggest monthly advance since October 2002. NASDAQ futures this morning, just slightly softer, down 0.1%. On the S&P 500, slightly positive, up 0.1%. That's the price action for stock markets. Let's get you some single names, some morning movers. Yahara has more. Hey, Yahara.
Hi, John. We start with Apple. Those shares are rising nearly 3% in the pre-market on a forecast that blew past estimates. And make no mistake, Apple making it clear that its last quarter would have been even stronger if it weren't for those supply constraints, especially around memory. And this is interesting. Bloomberg Intelligence saying that dynamic could be what's driving Apple's gains in China as higher memory costs force its competitors there to raise their prices. And sticking with that memory theme, we are seeing the likes of Western Digital and SanDisk down after earnings, even after they delivered a beat and a raise. But the bar was high because Western Digital is up some 130% year to date, and SanDisk up 300%. Year to date. And we end on Chevron. A surge in oil prices tied to the war helped power earnings there, so shares are up nearly 1.8%. The company blowing past estimates as stronger crude prices helped offset production hits it experienced from the war. Plus, it was helped by that Hess deal and that fast-growing Guyana asset. John.
Yahara, thank you. Thanks for the update. Similar story just from Exxon right now. Similar price action to Exxon. First quarter adjusted EPS 116, the estimate 96 cents. That's another upside surprise.
When you take a look at the numbers here, higher energy prices added $1.7 billion to earnings during the quarter. That's compared to $400 million of a decline from war-related production outages. They estimate that about 15% of their production is offline as a result of some of the conflicts in the Persian Gulf. A question here about how much this market has discounted the boom for a lot of the oil companies in the United States from higher oil prices. We're seeing it in real time right now.
These stocks had great first few months of 2026, then faded pretty quickly. Once this naval blockade started and once the Iranians blocked the Strait of Hormuz, they've done nothing for the last 2 months or so. We'll talk about that in just a moment. The stock is up at a pre-market by close to 2% this morning. Upside surprise on Chevron, similar story on Exxon. On our radar this morning, Apple delivering a stronger than expected revenue forecast for the third quarter. The company warning of increasing memory chip costs and months-long shortages of Mac computers. Elsewhere, the president vowing to maintain pressure on Iran with the naval blockade near the Strait of Hormuz.
Their economy is crashing. The blockade is incredible. The power of the blockade is incredible. They're not getting any money from oil. And hopefully it can be worked out very soon.
Tehran facing threat of exhausting its crude storage space and being forced to cut production. And the president saying he's unbothered by Jay Powell's decision to stay on the FOMC after his term as chair ends.
No, I don't care. If he stays on, he stays on. That doesn't... I just wanted to make sure that Kevin became the head. It's very unusual that they stay on. You know, I predicted he would because, you know, who's going to hire him? He's a negative. I think he's a negative force.
Kevin Walsh is on track for Senate confirmation as the next Fed chair, something we've talked about just in the last 24 hours since this announcement from Chairman Powell in that news conference. The administration is not looking for a fight here. In fact, based on the comments we've had, not just from the president, but also from the NEC director, Kevin Hassett, they're backing away and turning down the temperature as much as they can.
So the question really is why? Is this because they want this to go away, they have enough on their hands, and they want to deal with that? Is it because they're concerned about the market's response to some sort of prolonged fight that nobody really wins? Or is this just Operation Get Kevin Walsh in there and then we'll reassess? And ultimately, the decision to that will give people a sense of whether this is a pause or whether this is truly a change in tone. And maybe we'll give Jerome Powell the confidence that this might be actually some full and complete transparent end to the conflict.
I can't get in their minds, so I don't know, but it was a mistake. It was a mistake to go after the institution in the way they did when they had the opportunity to reshape it in the way they wanted to. And they've made sure now that someone in the institution is going to make it harder for them to do that, because this is not the situation they had to be in. They could have had a situation where Kevin Walsh was confirmed, respectable candidate, would have been on the FOMC, still going to be on the FOMC by the time we get to June, plus they would have had another seat they could have filled with someone they wanted to fill it with.
There were a lot of logical off-ramps where they could have exited stage left earlier in this tit-for-tat between the Fed and this administration. They haven't. That's why, even though you are completely correct, it was a mistake to go after them. It was a mistake to really engage in some sort of illegal battle that a lot of people wonder how much merit it actually has, and to stick with it even after there are some discussions around that. That's why this is surprising. Why now?
On the margin, they've made it harder to cut interest rates. That's the ridiculous thing about all of this. Let's turn back to the war in Iran. The president vowing to keep up the blockade, even as the average cost of a gallon of regular gasoline is well over $4 and more than $6 in some states, including California. Bloomberg's Tyler Kendall has the latest from Washington. Hey, Tyler.
Hey, John, good morning. Well, higher gas prices are definitely proving a political liability as we head into the midterms, though this White House maintains that they are highly confident it will only be a short-term disruption, in their words, when it comes to the energy markets. The NEC director, Kevin Hassett, said as much on this program yesterday, but I have to say I was pretty struck by the fact that when Anne-Marie was pressing him on whether or not the administration is considering any additional tactics to help bring down the price of retail gasoline, he only touted things that have already been done, including that extension to the Jones Act waiver, because at this point we haven't gotten any indication that the standoff over the Strait of Hormuz is easing. In fact, overnight there was this post from Iran's president reiterating what has been a consistent demand, that the U.S. must lift its naval blockade before talks resume, calling it, quote, intolerable. But as you mentioned, President Trump touted it just yesterday, saying that the blockade is incredible and that the U.S. will continue to try to squeeze Iranian oil exports amid real questions about just how much excess crude storage capacity the country has. Now, there is this new reporting from the Wall Street Journal that the U.S. is renewing its pitch to allied countries about deploying and joining a joint force naval force to help secure the Strait of Hormuz, but it appears that the sentiment is still the same, that these countries don't want to deploy any additional assets until there is a stronger ceasefire in place. Though, John, when asked yesterday by a reporter about whether he is getting, quote, antsy about ending the ceasefire, maybe resuming the fighting, President Trump says that nobody really knows where the talks stand except himself and a couple of other people.
Tyler Kendall down in Washington. Tyler, thank you. The squeeze continues. 111 on Brent, WTI at 105. Shares of Exxon and Chevron rising in the pre-market. Both companies reporting earnings that beat Wall Street estimates. Joining us now to discuss, Vincent Piazza, Senior Equity Analyst for Oil and Gas at Bloomberg Intelligence. Vince, welcome to the program. Where have the beats come from? Because the price of crude was higher, but production in some places obviously has been cut.
Good morning. Yeah, thank you for having me, John. So, when you think about the quarter, two things come to mind. Price trumps volume. Volume was down for both, but the consistency of the upstream price appreciation during the end of the quarter definitely had the benefit. But also, the second important thing is the resiliency of the model. Where have Exxon and Chevron invested over the last several years, and that's in North American upstream, and that also is in Guyana. Both of those assets are in more stable, less geopolitical risk in those regions, and so therefore those were an actual benefit to them, despite the turmoil out there in the Middle East. Exxon and Chevron's business models actually shining through, despite the timing differences, the impacts on the upstream side because of the Middle East, the results speak to that resiliency of the overall model.
Vince, one curious aspect of this is some people have been calling for oil companies to increase their production to offset any of the lost barrels in the Middle East. The Financial Times reporting this morning that Exxon and Chevron both have shunned those kinds of calls, saying we're already operating at a pretty high volume, and right now we're in a good place. Do you think that there is going to be increasing pressure for the oil majors in the United States to increase production, or do you think that they're in a good place to really have a good balance going forward?
Yeah, thank you. That's a great question. So when we talk to the companies, whether it's the integrateds or the other independent upstream companies, what we're hearing is that the investor base wants capital discipline, because if you look at the prices farther out along the curve, it is well below the prices that we're seeing today. And so capital discipline, controlled production, free cash flow that goes to the investors in the form of base dividends and buybacks, those are the keys. The investor base does not desire any incremental production growth just for the sake of production growth, because there is still clouds in the air in terms of the demand cadence for the legacy fuels.
What are you looking for, Vince, in terms of assessing the actual damage to assets near Iran, given some of the costs that have been put out there? Do you think that we're going to get a better sense of how long it will take, should the conflict and should the fighting, the kinetic war stop, how long it will take to rebuild and bring these assets online?
So when we think about it, we put it in three buckets: what's been delayed, what's been disturbed, and what's been destroyed. I think the first two buckets have been pretty obvious, that we have had significant delays and disruptions. But from the destruction standpoint, outside of Qatar gas, there hasn't been significant destruction of the actual underlying assets. So we think that in order to ramp up, it probably won't take as long as some of the dire estimates are out there. So I think so far what we have here is a pretty controlled environment. Here for the U.S., the U.S. operators are obviously going to see a net benefit because it's a much more stable environment here. And also, for the most part, we have a much more stable operating scheme for the upstream operators.
Hey, Vince, thanks for breaking it down. We appreciate it. Vincent Piazza there of Bloomberg Intelligence, following the numbers from Exxon and Chevron, better than expected this morning. What did he say? Price trumps volume.
Yeah.
Seems to be the story so far. Looking at Exxon and the way it closed at the end of February, we've talked about this theme a few times. Closed at the end of February at 150, 250. Some of these names in the energy sector had massive starts at the very beginning of the year. But through March and April, in total, haven't done much at all. We closed yesterday at 154.33.
Does this launch a change where people realize that price trumps volume and think about the fact that these companies are not boosting production? What's the offset? Some people were speculating, analysts were speculating, that if longer-term oil prices remained above a certain level, say $90, into December, into next year, then all of a sudden there could be an incentive to increase production. We're not hearing that because ultimately they don't want to spend more of their capital. That is the message from shareholders, and that's the message from some of these executives.
Anne-Marie not with us this morning. You might have noticed that. She'll be back a little bit later. She's having a lie-in. Good for her. She's going to be back later on this afternoon. She'll be catching up with the CFO of Chevron. Look out for that around 4 p.m. Eastern Time. Let's give you an update on stories elsewhere this morning with your Bloomberg Brief. Yahira has more. Hey, Yahira.
Hi, John. Nissan is scrapping plans to produce 2 fully electric SUVs at a U.S. factory. The move is part of a broader rethink of its product strategy as it looks to conserve cash. It also comes as EV sales in the U.S. have been slower than expected, especially after President Trump eliminated tax credits. Meta selling $25 billion of investment-grade bonds as shares plunged yesterday on rising concerns about its AI spending spree. Almost all the 6 tranches were priced at higher risk premiums than at a sale last October. The stock, though, as you can see, is down more than 7% year to date. And as you all were discussing, we are seeing Exxon and Chevron shares trading higher in the pre-market. Both companies reporting earnings that topped Wall Street estimates in the first quarter. Chevron saying higher oil prices helped offset production outages. Exxon saying something similar. That's your Bloomberg Brief. John?
Yahira, thank you. Thank you very much. I would have taken the extra few hours in bed this morning, wouldn't you?
No, I
Have we had it confirmed as to whether that was cleared? She was allowed to do that, or just fancied an extra few hours in bed this morning?
I'm working on a full investigative look-through.
Okay, you find out.
Yeah, and then we
Let
can
us
all,
know.
you know.
I'm told that Anne-Marie will be here a little bit later on this afternoon to conduct that interview, so
I mean, what kind of
looking
questions
forward
is
to that appearance.
We could have all, like, would you have wanted that? Well, I mean, would you like candy and rainbows?
Yeah, absolutely.
Correct.
I wanted what I wanted to do. Not that it really matters what I wanted to do. I wanted one of those things behind the bed, like just a massive TV with this, right? And then just have a camera there just to sit up in bed.
I would pay for that. Would
Just
you wear
do
your
the
tie?
show down the barrel for 60 minutes.
Okay.
I sleep in this, Bramo. Ready to go, obviously.
Clearly.
Up next on the program, supercharging the U.S. economy.
It's really strong data. We got initial claims, the lowest they've been since the 1960s. We got government employment, the lowest it's been since the Second World War. We've got all these positive movements. Getting interest rates down could really supercharge the economy.
Up next, we'll catch up with Abigail Watt of UBS from New York City. You're watching Bloomberg TV.
My old mentor, Roger Staubach, who told me when I transitioned, football will never leave you, but you need to leave it.
Wow.
Everyone has a dream, and a lot of dreams are, you know, my dream is to play football and play professional football, and you get the dream comes true, but it is going to end. And the day it ends, the day before it ends, you're one of the best in the world. Great. The next day you wake up, that's gone. What are you great at? And the truth is nothing, right? I'm not great at anything else.
I talk about it all the time, Steve, is this whole idea of it's not from penthouse to penthouse. And what I mean by that is you played for 15, 20 years and you're in the penthouse. It doesn't mean that you come to the business world and you're going to be in the penthouse. Now, you don't start on the third floor or the lobby. You actually have to start in the basement.
Welcome to Bloomberg This Weekend. I'm David Gura.
I'm Lisa Mateo. And I'm Christina Raffini. We're tracking breaking news today from Wall Street to Washington. Let's start overseas. The sector is really propelling this deal forward.
Yeah, the hope is this will open up new markets and provide some additional liquidity.
Of course, now they're going to have competitors. We got a big week coming up in politics.
Earnings season is underway. We're going to get some key reports.
Everything you need to know before the markets open on Monday.
Introducing Bloomberg This Weekend, bringing a little Bloomberg into your weekend routine.
Guys, buckle up.
Welcome to Bloomberg This Weekend. I'm David Gura.
I'm Lisa Mateo. And I'm Christina Raffini. We're tracking breaking news today from Wall Street to Washington. Let's
Introducing Bloomberg This Weekend, bringing a little Bloomberg into your weekend routine. Watch, listen, stream. Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
Welcome to May. Equity futures positive by 1/10% on the S&P 500, on the Nasdaq down by a similar amount. In the bond market, want to turn to fixed income. Bring up 2s, 10s and 30s and just look at 2s. 388 on 2s this morning, up a single basis point. So that's above where Fed funds is. This market has decided this Fed is going nowhere and there's a small risk that might have to hike. This is the view from Mike Gapel and Morgan Stanley. We now expect the Fed to maintain a hold for the rest of 26. Deutsche Bank's Matt Lazzetti, the policy rate is likely to stay unchanged this year. BNP Paribas agrees. We expect the Fed to stay on hold into 27. But James Egelhoff over at BNP says this: we see a growing tail risk that policymakers could hike this year if the unemployment rate declines and the Strait of Hormuz remains closed.
We've had him on before and asked him about this and said, what about the political pressure to cut rates? And he said, well, yeah, this is stripping that out. So, the one thing that the market is baking in is a dovish predisposition of the Fed chair coming in because of the administration that will shun any thought of a rate hike, even if there are a couple of economic conditions that make it through.
If you go through the year and you've got Brent at 111, WTI at 105, and let's say that stays with us into the fall, into the back end of 26, and you've got jobless claims like the ones we saw yesterday, and an unemployment rate that stays closer to 4 than it does 4.5%. You wonder where that would leave inflation in this country and how this Fed might respond to it.
I'm watching the back end of the yield curve. This is the answer to that conundrum. If you see a yield curve steepening that starts to really exert itself over this economy, do you get a Fed willing to hike rates? Or, to Kevin Hassett's point yesterday, do they start looking at things like the balance sheet to really work with some sort of Treasury Fed accord to change the dynamic a little bit?
Under Savanas this morning, supercharging the U.S. economy.
It's really strong data. We got initial claims the lowest they've been since the 1960s. We got government employment the lowest it's been since the Second World War. We've got all these positive movements in terms of fiscal responsibility and economic growth moving forward. And so then, but we do have this temporary disruption with energy markets. Getting interest rates down could really supercharge the economy from where we are, but not be super inflationary.
So here's the latest this morning. The U.S. economy showing signs of strength despite surging energy costs. Abigail Watt of UBS writing, we expect that spending should still be a little stronger in the second quarter, but will depend on the offset between higher gasoline prices and tax refunds. Abigail joins us now for more. Abby, welcome to the program. Is this economy in a position to support higher prices?
Good morning. Thank you for having me. Yeah, so I think it's a really interesting point to raise, right? I think when we look at the data that we got yesterday, I think it's totally fair to say that we had a relatively strong nominal increase in spending in March. But if you looked at kind of real spending, it was actually down 0.1% over the month when you consider that strong inflation impulse through the March period. And I think when you look at the kind of fundamentals for the consumer, I think they look relatively different depending on where you're sitting in the income distribution. One of the things we've seen in that kind of, personal income and outlays report kind of consistently is you've essentially seen kind of slowing real disposable income, kind of okay pace of real spending in kind of annual terms. But what you've seen is the saving rate dipping lower, right? So yesterday, the savings rate dipped back down to 3.6%, the lowest it's been since October 2022. And so I think with inflation pressures, I think the distribution of that's going to be different across the income spectrum. And I would say that what we're seeing at the minute is kind of a wealth effect, potentially keeping consumption going, despite some of the slowing we did see in the numbers yesterday.
So what does that mean for the second half of this year, Abby, with that in mind?
So I think, one of the key things coming into this year, obviously, was that you could potentially have a little bit more support for the consumer from tax policy, right? I mean, we've seen a relatively significant rise in terms of tax refunds flowing to households are up kind of 15 to 20% versus kind of where they were at this point last year. And I think that's something that helps kind of that buffer, right? I think that buffers a little bit some of this kind of energy price shock that we're seeing through the second quarter. And so with that, we've basically got kind of the strongest quarter of consumption growth happening in this quarter, and then I think a little bit of slowing into the second half of the year when you see kind of some of that kind of some of the energy price kind of feeding through, and you also see some of those tax refunds essentially being spent away by the lower income households essentially.
Abigail, do you think that this is a labor market that's in stasis or shows signs of reaccelerating based on some of the initial data from the likes of ADP and the initial jobless claims?
Yeah, so I think it's really challenging at this juncture to get a really good sense of the labour market. Obviously, the kind of establishment survey data have been incredibly volatile through the first couple of months of the year, just given the kind of change in the methodology that's being used by the BLS. We've also seen in the unemployment rate, it's a little bit hard to get a read because, you've seen some shifts in terms of the labour force participation rate. With that shift in participation, if you were to hold that stable, the unemployment rate would have actually risen to 4.5% rather than kind of fallen back to 4.3. So I think it's a little bit challenging to get a good read just now. now. But I think it's fair to say that, we haven't seen necessarily a shift higher in initial claims or continuing claims. You've seen relative stability. Obviously the print this week in initial claims, there was quite a drop within the week, but these can be quite noisy from week to week. And so when you smooth through, I would say they're signaling a labor market that's showing relative signs of stability, not necessarily weakening at this juncture or not necessarily significantly improving at this juncture is how I would read those data.
Taking a step back to tie it all together, Abigail, there's a real debate right now about how much people are starting to see the nodes of some sort of cyclical recovery in the underlying economy and how much we're just seeing AI spend overwhelming absolutely everything and distorting all signals. Which do you think it is?
Yeah, so I mean, the data that we got yesterday, the Q1 GDP data, I think the composition was really interesting. Obviously, we're continuing to see that slowing in consumption, a 1.6% pace of consumption in Q1 versus 1.9% in the fourth quarter. And I think the real standout yesterday, as you're noting there, was the equipment side of the accounts, the investment side. And when you look at the investment that we're seeing in the US, it is relatively narrowly driven in terms of that tech, AI, CapEx spend out. And I think, the data that we got this week in terms of the core durable goods report, that would be consistent with that potentially continuing. We had expected that you would see a little bit of a broadening out, I guess, in that investment dynamic this year because of the expensing provisions in the Big Beautiful Bill Act, potentially meaning you see a little bit more traditional CapEx coming through as well as that kind of ongoing tech CapEx. And I think you have seen a little bit of a broadening out in terms of those durable goods orders, but I think that's something that we'll be watching just to get a sense of whether we see kind of a broadening versus kind of this just ongoing AI tech theme, which really, was the standout in yesterday's GDP report.
Abby, thanks for being with us. It's good to see you, as always. Abigail Watt there of UBS. That's been the story coming into 26. Rate cuts in the pipeline. CapEx from some of the biggest companies on the planet. Tax refunds too. That's insulating this economy from the stress in the commodity market.
We keep going back to at what point is it then inflationary? We had Kevin Hassett saying that it wasn't going to be inflationary because of productivity from sort of the artificial intelligence. Are we hearing that though, or is this the idea that potentially people can absorb higher prices because of the wealth effect, because they're earning more money, and because they are getting tax refunds, and that ultimately maybe is what you're seeing in some of the underlying data?
We played this game in 24, in 25. What's happening with inflation is the Fed on hold. What's happening with inflation is the Fed on hold. Then unemployment bit, and then at the end of 24 they cut rates. At the end of 25 they cut interest rates. There's a sense, and you can feel it building just in the consensus right now, that this feels different for a lot of people.
In terms of the sustainability of this inflationary push, there has been a game change. And when you start to talk to analysts, I was thinking about Bob Michael, who came in, buy bonds, there's a shortage of bonds. And then you start asking, do you buy long bonds here? And he said things have changed a little bit with respect to what's going on with the oil prices, the Strait of Hormuz. Wait and see is the mode that everybody is in. Who is the forward indicator for that? Maybe the Truth Social feed coming from President Trump.
Bob Michael has changed his view a little bit. Neil Dutta has changed his view a little bit. Governor Waller has changed his view a little bit as well. It's notable. The names are building.
Yeah, when you have a fifth of the world's oil shut in and other supplies, well, things change.
Up next on the program, Victoria Fernandez of Crossmark, Ed Mills of Raymond James, Shamir Khalik of Citi, and Amanda Lynham of Goldman Sachs. The second hour of Bloomberg Surveillance. Up next.
The Middle East and Africa regions are home to some of the biggest deals and fastest growth in the world. Vibrant resources and high-yield investment opportunities abound. I'm Jumana Versace. Join me on Bloomberg Horizon's Middle East and Africa for the stories, newsmakers, and insights shaping the decisions of traders across this exciting region.
You had heightened levels of volatility. There's still room to maneuver. Reduce the opportunities. It allows you to increase significantly your net income.
Every trading day, only on Bloomberg.
You don't think the court was hurt by the perception that it was a political decision?
The court's always hurt, it seems to me, if we look political. One of my concerns, my present-day concerns, is there's too much partisanship. It's true historically that most presidents have appointed justices to the Supreme Court who are members of their own party. The partisanship should not be an overriding factor. What you look at is temperament, learning, background, reputation, whether or not you have those qualities of independence and caution that make for a good judge.
Increasingly, you see dissenting opinions in the Supreme Court aren't quite as civil as maybe you might prefer. And is that of concern to you?
Yes, it's of great concern to me that our civil discourse, our civic discourse, is not civil enough. Aristotle said that a democracy depends on an open debate where you respect the dignity of those with whom you disagree. He said democracies only live if they are sustained over a period of time by a thoughtful, rational discourse, a discourse in which you respect the dignity of those with whom you disagree.
Welcome to the world of decentralized finance.
Why is it that NFTs have not recovered in the same way that, say, Bitcoin has?
Bloomberg is covering all things crypto.
It's a pretty spectacular story.
The people.
This is the future. This is the 21st century economy.
The transactions.
It snapped up nearly $1 billion of Bitcoin.
And the technology.
We need to build a digital Fort Knox.
That gives people financial freedom, and that's a wonderful thing.
That's extraordinary.
We ride the wave that is Bitcoin.
Bloomberg Crypto, only on Bloomberg.
Making money isn't about drowning in emotions. It's about understanding what's actually happening. Markets are the best way to glean signal from noise, and that is what we try to do every morning. This is Bloomberg Surveillance.
World's most powerful investors don't ring a bell. They quietly reshape entire industries. This is the money shaping the world, the dealmaker playbook where power and billions of dollars change hands every day. From private equity and credit to venture capital and M&A, we bring you the inside scoop on the biggest deals and debates, plus exclusive conversations with finance's ultimate insiders. I'm Danny Berger, and this is Bloomberg Deals. Every week, only on Bloomberg Television.
For the most part, the economy is in a very strong trajectory.
The U.S. still has the most dynamic, most sort of innovative economy.
People continue to underestimate that.
We really have reoriented this economy towards very strong capex.
For right now, you have to kind of tip your hat to the economy and say things are stable.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
It's a quiet start to May. Let's hope it stays that way. Live from New York City this morning. Good morning, good morning. For our audience worldwide, the second hour of Bloomberg Surveillance starts right now. Your price action of scores look like this. Equity futures this morning, muted gains up by about 0.1%. What a run through the month of April, higher by 10%. The biggest monthly gain since 2020 on the S&P 500. You've got to go back 20 years plus for the NASDAQ 100. The biggest monthly gain on the NASDAQ 100 going back to 2002, a 16% advance on the NASDAQ through April. That's the scores in the equity market. This is how things are shaping up in the commodity market this morning. Brent crude, front end of the futures curve. We're now talking about July. Just bear that in mind. 111 for WTI. We're still talking about the month of June at 105 this morning. Brent crude up by about 0.7%. And with crude still being elevated, this is the move in the bond market. Yields are as well, near the highs of the year, close to 440 at 438 on 10s.
You can't underestimate the strength in earnings and the strength in corporate America, given the fact that we just saw the best monthly rally since 2020, as you mentioned, even with yields going higher, even with oil prices going significantly higher. It just shows a resilience that really underpins the lack of attention that people have paid to it. Ajay Rajadaksha of Barclays really summed it up well. Is this the market just shrugging things off? Is it the earnings being so great? Or is it also that the oil ramifications really haven't hit yet, that ultimately the first 3 weeks were not necessarily felt in the physical world in the same kind of way because of the floating oil and because of the supply glut that people hadn't taken into consideration? How much does that change in every consecutive week going forward?
The tankers were still arriving. The inventories were large. There was a cushion there. So in Ajay's mind, it's not that the situation in the Middle East didn't matter. It just didn't matter yet. And first and foremost, what did matter to him was the earnings profile in the United States. And earnings have been fantastic in certain places. Now he thinks that maybe it will start to matter. So this is an interesting call coming from the team at Barclays, because they've been bullish off the low of late March, upgrading their price target on the S&P 500. And now they turn a little bit more neutral, because the longer this blockade goes on, in their minds, they believe it starts to bite.
A number of analysts say that they're going to start to worry a little bit more when the oil majors start performing more successfully in markets. They haven't been really doing anything. You've pointed this out many times. And yet Chevron and Exxon reporting earnings today highlighted how we were just hearing the price trumps volume. And when you look at the likes of Exxon, with a $1.7 billion increase to their budget as a result of higher oil prices, despite the $400 million hit, you see how much some of the losses are offset. If they do better, is that problematic for the rest of the index?
Mike Worth over at Chevron is the guy I always listen to. The global energy system is under extreme stress. His words this morning: demand must come down if supply is not re-established, and right now supply is not being re-established. So where does it leave the central banks? So this week we heard from the Fed, the BOE and the ECB. The Federal Reserve, very close to dropping its easing bias, is getting closer. The Bank of England open to hiking interest rates sometime soon, just not quite there yet. The ECB, out of the three, arguably closest. There feels like there's a real consideration, listening to the guard through that news conference yesterday, that June is very much on the table.
Yeah, it just seems like there needs to be a reason not to, for them to ultimately make that move. June right now very much priced in for the ECB, despite the fact that analysts here say it'll be a policy error, considering the fact that growth is slowing. Nonetheless, highest yields in the Eurozone since 2011, the UK since 2008, Japan since 1997. You put this all together, you know, at what point does that crimp some of the dynamism that we're seeing in the earnings and corporate story?
Futures right now positive by 1/10% on the S&P 500. Coming up this hour, we'll catch up with Victoria Fernandez of Crossmark Global, with equities hitting fresh all-time highs. Ed Mills of Raymond James on the standoff in the Strait of Hormuz, and Amanda Lynham of Goldman Sachs as hyperscalers unleash record debt. We begin this hour with stocks holding steady, closing out a week of strong tech earnings. Victoria Fernandez of Crossmark Global writing, our theme for the year is high-risk bull market, and earnings seem to be telling us that the bull component of that statement is holding true. Victoria joins us now for more. Victoria, welcome to the program. Decent earnings in many cases. Does that insulate this stock market from additional pressure from elsewhere?
I think it does, at least for the time being, but you're still seeing a market that's a little jittery. I mean, look at SanDisk, right? Great earnings, knocked the cover off the ball, and the stock is down this morning. So the market isn't necessarily going in and rewarding everyone because they have good earnings, but it's the fact that the earnings are good, that people are meeting expectations and even exceeding them in some cases, that continues to give a little bit of momentum to this market. And I think your conversation is spot on when you're talking about some of the elements that just haven't hit the market yet. When you look at the buffer of the tax situation, higher gas prices have taken out about 12 to 15% of that tax buffer right now. So the longevity of how long this Strait of Hormuz is closed could eat away at that pretty quickly. And then I think you start to see sentiment turn. But for now, earnings and capex are really driving this market.
Average gasoline prices in this country now pushing $4.40 a gallon. Victoria, do you believe that's a growth story or an inflation story?
Yeah, I think for now we see it as an inflation story. Consumers are only going to be able to pay higher prices for so long. And again, they have a little bit of a buffer right now that will get them further along. We saw spending up 0.9%, but incomes were only up 0.3%. So how long are they willing to do that? When you look at the companies, the oil and gas companies saying they need demand to come down, it wouldn't take long for demand to come down if we continue to see those prices move higher and we don't see incomes move at the same pace. And obviously, if we get central banks starting to raise rates like you were talking about, I think the ECB whisper talk is maybe 2 hikes through the rest of this year. Then you definitely get that demand coming down, and that will bring inflation down with it. But for now, I think you're going to have stickier inflation.
John started the show saying that we're about 7 hours into May, and it seems pretty calm, and so hopefully it'll stay that way. And I almost laughed. I did laugh, because ultimately it's been such a tumultuous ride. And one thing that people keep saying is you don't get a full read on anything. There's no way to get an edge on the news flow. What is the canary in the coal mine for a shift in the tone where earnings can be independent of some of these macro trends?
Yeah, so earnings in itself, like I said, are not really feeding through in terms of just because a company does well, the stock is going to do well. We have examples of that. What I think is really feeding through is the capex component. So capex has been huge. When you look at the GDP number, you're seeing analysts say about 1.5% of the 2% growth for GDP came from capex. It came from that industrial complex, the non-residential investment component. That's where we're seeing a lot of things grow. And I think that's going to be what drives us forward. So we're going to be watching those elements very closely. It's one of the reasons I think that you're seeing things like agriculture break out. You're seeing industrial metals outperform outperform precious metals because the discretionary part of the market really is not doing that great. There's certain elements of it, but discretionary itself is back to kind of where we saw in the beginning of the year where it's not doing wonderfully. So I don't think we can make a blanket statement about the market. I think we have to look at very specific components, what's driving the momentum right now, and those are the areas that you want to look at investing in.
If the Chevrons and Exxons start outperforming again, is that a warning sign for the rest of the non-tech market?
It's difficult to say, and obviously sitting here in Houston, I love to see these companies do well. I like to see their cash flows increase, but you also don't see these companies going out and doing drilling and doing new projects. They're really just kind of sitting on hold because, as you've heard the CEOs some this morning even say, this can change pretty quickly. So they're not going to make big decisions and do things that will affect their balance sheets without knowing how long some of these elements are going to be in place. So I don't think it's necessarily a growth story here. I think we're looking at a market that is weighing a lot on earnings and CapEx. They're concerned about what's going on in energy, but they're in a wait and see mode, not ready to make decisions based on that yet.
Let's stay with CapEx and let's pick out two names, two very different stories this week, Meta and Alphabet. Meta down yesterday by close to 9%, Alphabet up 10%. Both of them are spending a lot of money. What's the difference between the two right now? And are we reaching the limits of this CapEx boom?
Yeah, you know, I'm not sure we are reaching the limits. Unfortunately, it makes me very nervous when I see these numbers continue to go higher. But I think the reason we had a difference between those two companies, there's concern around Meta's revenue and the monetization of the CapEx that they're putting to work. Whereas when you look at Alphabet, you're already seeing some of that come to fruition. Plus, Alphabet has their cloud business up 60%. I mean, I think that was one of the strongest components that you saw for Alphabet. Plus, you saw paid subscribers go up. You saw their backlog double. So there were a lot of elements there at Alphabet that continue to have it as one of the leaders. It's the area where we're overweight in the Mag 7 along with Apple, where we're underweight when it comes to Meta. And I think it comes down to that monetization and do they have the revenue in order to do the CapEx they're talking about. We saw Meta come to market with what, a $25 billion bond deal this week. So that makes people nervous.
Yeah, and a big order book too of about 96 billion. We'll talk about that order book a little bit later this hour. Victoria Fernandez there of Crossmark Global. Victoria, thank you. The performance, the spread of the performance through April across some of these names. Apple up 7%, Meta up 7%, Microsoft up 10%, Amazon up 27%, Alphabet up 34%. Last month.
Yeah, you see who's gaining share and who's actually exceeding expectations when it comes to growth rates. Google had been left for dead, and people said OpenAI would eat its lunch. All of a sudden, not so fast. We've got Gemini taking over, and frankly, they're keening to on the cloud computing side as well. Amazon, meanwhile, turning to become a chip producer. People are getting very excited. Meta, a question mark. What are they spending on? Do they have a clear vision? They're cutting staff. They're seeing demand go down for their advertising. People feel a little more sketchy. Still, $96 billion order book for a $25 billion deal. I'm not exactly crying for them.
It's just not 125, which was what the order book was last time for the 30 billion offering.
Right, so it's actually waning demand, and so maybe this is a warning sign that, you know.
It's fatigue building.
Yeah, that's correct.
We'll ask Amanda Lynham later this hour. She joins us from Goldman. She'll have her own views on that situation in the credit market. Let's get you an update on stories elsewhere this morning with your Bloomberg brief. Yahira has more. Hey, Yahira.
Hi, John. President Trump says he's sticking with a naval blockade of Iranian ports. His comments coming after oil hit a wartime high. Iran's new supreme leader also casting doubt on the likelihood of a deal, vowing not to give up the country's nuclear or missile technologies. NVIDIA and Microsoft are signing deals with the U.S. Department of Defense to expand the use of AI on classified military networks, sources telling us here at Bloomberg. The Pentagon is also looking to strike a similar agreement with Amazon Web Services. And Jane Street's pay pool more than doubling to $9.4 billion in 2025. Sources telling us here at Bloomberg that the market maker brought in about $40 billion in trading revenue last year, putting it ahead of Wall Street banks and many of its peers. That's your Bloomberg brief. John?
Have we lost Anne-Marie to Jane Street?
How do I get a job at Jane Street?
Application. You ready to go?
Please write my application.
They can't afford you, Bramo.
Oh, right. Oh, yeah.
No way.
Oh, thank you.
No way.
That's so sweet. That's
No
your pitch.
Up next on the program, keeping the pressure on Iran.
There economy is crashing. The blockade is incredible. The power of the blockade is incredible. They're not getting any money from oil. And hopefully it can be worked out very soon.
Up next, we'll catch up with Ed Mills of Raymond James, live from New York City this morning. Good morning.
The countdown is on. Everything you need to get the edge at the end of the market day. Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
Welcome to Bloomberg This Weekend. I'm David Gura.
I'm Lisa Mateo. And I'm Christina Raffiti. We're tracking breaking news today from Wall Street to Washington. Let's start overseas. The sector is really propelling this deal forward.
Yeah, the hope is this will open up new markets and provide some additional liquidity.
Of course, now they're going to have competitors. We got a big week coming up in politics.
Earnings season is underway. We're going to get some key reports.
Everything you need to know before the markets open on Monday.
Introducing Bloomberg This Weekend, bringing a little Bloomberg into your weekend routine.
Guys, buckle up.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
Watch Bloomberg Tech.
This is the Asia trade.
This is Wall Street Week. Welcome to Balance of Power.
You're watching Bloomberg Deals.
Welcome to Bloomberg This Weekend. This is Bloomberg Television.
Stocks, a bit snoozy this morning, firmer by 0.1% on the S&P, on the Nasdaq down by 0.2. Breaking down the month of April, energy stocks trading lower on the month, discretionary on the S&P, up by double digits. Decent gain there, despite this move in crude. Brent WTI, Brent crude, still triple digits here across the board, 111 on Brent crude, and up by 0.8% so far this morning. And the longer dated prices, say the December contract, they've been making new highs throughout this week.
There are two theories. On one hand, that the actual pain hasn't really hit. The second one is that the U.S. economy is resilient enough and strong enough, and the consumer wants to spend enough, that this just isn't a problem. And which is it? And ultimately, the answer to that will decide the fate of some of these consumer discretionaries and, frankly, the optimism in U.S. economic strength despite the increase in oil prices.
And more verbal intervention from the Japanese. This time not the FX market, but the commodity market. And if you're just joining us and you missed this is the quote from the Vice Finance Minister for International Affairs. Generally speaking, we are always ready to act regarding crude oil futures transactions.
That feels like somebody standing in front of an oil tanker and trying to push it back. I mean, at what point do you not want to just burn money, given the fact that you can't really fight the groundswell of concern about higher oil prices, and at some point you are going to get wiped out? So I understand that Japan is a big economy. I just wonder, for all the people who say this is a manipulated market, it could be, and people were thinking about that. It's a pretty big market to be manipulated for that long, and it's pretty expensive.
I respect the threat, the willingness of Japanese authorities to manipulate markets.
Do you? Do you
To
now?
the point that they are no longer markets anymore.
Are you buying an ETF in Japan?
In certain cases, we saw that in the JGB market over the last decade.
Yeah,
Which is why people take threats like this seriously, because they've shown a willingness and ability to follow through on some of these things.
Arguably, JGBs are a bit more of a closed market than, say, oil.
I would agree with that.
So potentially that might be a little bit more problematic. Nonetheless, I'm glad that you
know that
appreciate
for lots of people, I know we've got to move on. There are some people that think some funky stuff has been happening in the futures market
every single
over
person,
the last 2 months.
Every single person who's come on, when I've asked them, they say, well, yeah, look at the trades. I mean, there definitely has been. At the same time, it hasn't been enough to push prices lower the longer this grinds on. And at a certain point, it does become a freight trade. And that maybe is what we're seeing in the December contract.
111 on Brent this morning in the July contract. Under surveillance this morning, keeping the pressure on Iran.
There economy is crashing. The blockade is incredible. The power of the blockade is incredible. They're not getting any money from oil. And hopefully it can be worked out very soon. The gas will go down. As soon as the war's over, it'll drop like a rock. Despite the fact that we are in what some people would call a war, we just hit a new high today on the stock market.
So here's the latest this morning. President Trump vowing to maintain the blockade on Iranian ports. Tehran insisting it must be lifted before new talks can occur. Bloomberg's Tyler Kendall has more. Morning, Tyler.
Hey, John, good morning. Well, President Trump maintains that it's fractured leadership in Iran that is making the negotiations so difficult, and he says that the U.S. still wants to pursue the diplomatic options. But at this point, and as you mentioned, the sticking point seems to be that Iranian officials have been pretty consistent that they don't want to resume talks until the U.S. lifts its naval blockade. And in the latest sign that that's not happening, a senior administration official tells us that the U.S. Department of Justice has initiated the forfeiture process for 2 Iranian-linked oil tankers that were seized by U.S. naval forces just the other week. Now, it's unclear what this will entail, but it's something to watch because it could signal intent to seize the oil cargoes on board in what would be considered an escalation. Because at this point, Axios is reporting that President Trump has been briefed on an array of potential options, including maybe even a short wave of strikes to help try to break the deadlock that we're currently in, because Iran is still maintaining its hardline position. In fact, we got a statement from Iran's president overnight calling the U.S. blockade, quote, intolerable. But John, when asked yesterday about whether or not President Trump is getting what the reporter called, quote, antsy about ending the ceasefire if we could see a resumption when it comes to the fighting, the president maintained that no one really knows where these talks stand except for himself and a couple of other advisors.
Tyler Kendall with the latest in the nation's capital down in Washington, D.C. Tyler, thank you. Ed Mills of Raymond James writing this. Any diplomatic path forward will likely be rocky and have to take the form of a near-term framework that allows both sides to claim victory. Ed joins us now for more. Ed, welcome to the programme. At times, this has been messy. That's inevitable. We've asked the question whether this is strategic ambiguity or just the lack of a strategy. Do you think we have a decent idea of what the strategy is now?
Well, John, I think the biggest concern that I have is right now both sides feel the other one wants to get this over quicker, and both the United States and Iran think that they have the upper hand. And so unless someone feels this pressure, the Straits of Hormuz are not reopening. In the kind of back and forth here, is it the oil price? Is it the price at the gas pump here in the United States? Is it political pressure on Trump? Or is it the fact that the Iranian economy needs to move things through the Straits? They have more than 150 million barrels of oil on the water. They have oil wells that are about to get shut in. Who moves first is really the question that I'm getting the most here at Raymond James.
Ed, how would targeted strikes accelerate the process by the U.S.?
I think, the hope there, Lisa, is that it is going to just force it, that there is going to be that threat, that something has to move. And I think from a market perspective, I think the debate here is, are targeted strikes a signal that the kinetic activity is about to really ramp up? Or is that the push that finally reopens and gets us back to the negotiating table? My bet is the immediate market reaction would be the kind of fact that they think that this could reopen things and this could be the catalyst to those talks restarting. So the hope I have is that even with additional kinetic activity, the market holds in there. The kind of risk there is that it actually kind of goes further south before we get any sort of solution.
Ed, how does the deadline of 60 days calculate in this whole equation, given the fact that ostensibly the administration would need to seek congressional approval to continue the conflict beyond that?
Yeah, so there's two things there. Under the War Powers Act of 1973, there is this 60-day deadline. What we heard from Secretary Hegseth yesterday is that the Trump administration doesn't think that they are hitting that 60-day deadline because of the ceasefire. And under this, there's also a 30-day ability to kind of withdraw troops. However, we have seen presidents in the past violate this deadline. After 60 days, you are supposed to get the congressional authorization, but you go back to the Obama administration. You actually had the House of Representatives vote to end activity in Libya because they were well beyond that 60 and 90-day period. The Senate never took that up. They tried to go to the courts. The court said, you know what? It's Congress's job. So right now, it is a political issue for the Trump administration, and unless you have a veto-proof majority in the House and the Senate, this law does not get enforced.
In 2 weeks' time, there's a meeting with the Chinese leader. And initially, when that date was set, when the original date was pushed out to the middle of May, people looked at the calendar and said, it will be over by then. Is that date important anymore?
It's very important because you have the number one economy sitting down with the number two economy. We don't have a huge expectation that there's going to be big deals that come out of the Trump and Xi meeting. There is a view that that could be some pressure, but there is growing questions that I'm getting here at Raymond James is, does this get pushed off again? We have not seen the staff level negotiations. Besson and Greer have not met with their counterparts. And unless you have that fleshed out activity before the meeting, you're not going to get real deals into this meeting. The other big question I've gotten here at Raymond James is Xi, who said that this war is upsetting the world order, come in and try to be a bit more aggressive with President Trump. But the risk there is that President Trump never stays on the defensive. He goes on the offensive. And if we have an escalation in the trade war with China, if we are questioning what's happening with tech restrictions on semiconductors, if we're questioning what's happening on critical minerals, those are not positive headlines. I don't think we get there, but that risk is absolutely present over this next 2 weeks.
Ed, are there any signs of that so far? I've been struck by some of the commentary on corporate calls. I'm thinking of Apple in particular, and Tim Cook talking about how things are actually getting better in China, and they actually reported a better than expected sales in China. Do you get any sense that the relationship is becoming more tense, or do you think that we're entering a period of both sides wanting calm?
Yeah, so after the October meeting between Trump and Xi, he gave an order, President Trump gave an order to the administration, stand down. Do not do anything that pokes China, which has given this opportunity to de-escalate. There's been conversations with companies like Apple. Can they work with a couple of Chinese companies to develop deals on memory, because those have been very expensive products. Those are openings. Tim Cook has had a great relationship with President Trump since the beginning of this second term. But if you see this kind of shift, and if she wants to make this change because they hold a number of things that we need to run our economy, he could get a little bit more aggressive. Now, the United States holds plenty of things that China needs to run their economy. It's just more of that personality-driven decision-making as we go into this discussion here kind of 2 weeks from now that can dictate that. And I guess the one warning I'd have is that we've seen in the past, China will escalate right before the meeting to be able to de-escalate during the meeting. Trump's able to come out of the meeting and say, I won these concessions that China had threatened. That's what we did in October. Will we do it again here in May?
Looking forward to that dance if it happens later on. And thank you, sir. Ed Mills there of Raymond James, wonderfully framed for a meeting that takes place in a few weeks' time. Remember, it was going to be a diplomatic embarrassment? Language like that, right? Which is why it was delayed originally?
Yeah, and if it gets delayed again, how terrible. And now it's sort of like, yeah, what's the point? Let's just move it all around.
Coming up on the program, Shamir Khalik of Citi, as the Iran war reshapes global trade, plus Danny's got your morning movers. Moderna flying in the pre-market, higher by 7%.
weekday, Bloomberg puts the spotlight on a different aspect of global finance. Flows, funds, and the forces shaping markets on ETF IQ. The future of money with Bloomberg Crypto. The players behind major transactions on Bloomberg Deals. The stories informing finance with Bloomberg Markets. And rates, risk, and the cost of capital on Bloomberg Real Yield. A different topic every weekday, only on Bloomberg Television.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Amin, only on Bloomberg.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm Stephen Engel at Japan's Akasaka Palace in Tokyo, and this is Bloomberg.
Middle East tensions are high.
Both sides willing to go back to the battlefield.
The narrative changes moment to moment.
Is there a ceasefire? Is there not a ceasefire? Markets are up, markets are down.
Count on Bloomberg for up-to-the-minute reporting.
Breaking news this morning.
Breaking news in the last few minutes.
On-the-ground perspective.
Talking to you from the bomb shelter.
This White House still pushing.
And the analysis you need to make informed decisions fast.
Clearly, nothing is final until it's well and truly final.
The really important question is whether we'll get second-round effects.
Nobody covers geopolitics like Bloomberg.
Equity futures shaping up as follows this morning on the S&P 500, positive by 0.1%. What a run of gains through the month of April. Let's go through the scores once again because they're absolutely phenomenal. Before we move on too quickly, up 10% in April on the S&P, biggest monthly gain since November 2020. On the Nasdaq, up 16, biggest monthly gain since October 2002. And for the semi-index, the Philadelphia Semiconductor Index up by 38% in April, and the biggest monthly gain we've seen going back to 2000, the year 2000.
Given the fact that we've seen gains like that, it is shocking to know that bonds didn't cooperate, oil didn't cooperate, the downside surprise and economic growth didn't cooperate. A lot of things didn't cooperate to make this happen. One thing cooperated, and it was big tech earnings and broader earnings in general. And at what point does that get crimped by some of these other aspects? That's the debate heading into May. You're hoping it'll be a really non-momentous May, quiet, we'll all relax.
I'm hoping today's quiet, just into the weekend. I don't mind if the rest of the month is crazy. I welcome that.
You welcome that?
I've got a bias for volatility.
You're going to get hate mail because people are like, listen, I just want Sunday nights to be nice.
Any journalist in our world that says they're not long volatility
I know.
is a liar, okay? That's what they want. It makes it interesting.
Or
they don't want it boring all the time.
Or fear, and then, they feel like they just have to...
Fear I don't need, just excitement. Whether you find scary things exciting or not is,
your own bag.
I'm the beholder of all
Anyway,
of
I think
stuff.
it's going to be a really interesting month. I'm excited for this month.
I agree with you. Okay, let's turn to crude. Brent and WTI shaping up as follows this morning. On Brent, just bear in mind, the front month of the futures contract is now the month of July, so we're not really comparing apples to apples here. WTI is still June. WTI is at 105, Brent crude's at 110. Still elevated really across the board and across the curve, and I think that's how the story's changed. Never mind the front month. We've talked lots about how things would really kick in at the back end of the year. Crude prices would drop, deep backwardation, all that stuff. Really, the opposite has started to happen. We're talking about the long end of the futures curve, the longer end, making new highs throughout this week, and that gets your attention.
The December contract for Brent is almost $90. The December contract for WTI is about $80, a little bit north of that. We're looking at this sort of steady creeping higher. So even if the Bank of Japan or the Japanese authorities want to come in and try to manipulate the long-dated curve of oil, good luck, because a lot of people are taking a look at some of the physical shortages and saying it's just a matter of when. And ultimately, it is a slow-moving train wreck that a lot of people have their eye on.
This is keeping bond yields elevated throughout this morning. 2s, 10s, 30s. 30-year yields up by a single basis point. 10s up by 1 as well. 438 on 10s. So 440-ish is like the high of the year right now. We're right there on 10s. And to your point, you said it earlier, over in Japan, yield close to the highest yields we've seen since the 90s. The UK 2008, Germany 2011. Pretty elevated stuff in the bond market.
You have inflationary pressures. You have questions about fiscal spend to offset the consumer pain as a result of higher oil prices. And you have a real concern about investing in the physical world and where that money is going to come from. All those three things come together. A lot of people are saying, as Ajay Rajadaksha said, I wouldn't touch it with a 10-foot pole.
He's not alone.
I know.
Which is why yields have been drifting higher. 10s right now at 438. It's funny, isn't it? People were lining up at the end of the month of May, saying that we'd created value in the bond market and they wanted to buy yield. this was a great opportunity to lock in some income. I don't hear that quite as much as we did a month ago.
The situation with the Strait of Hormuz has been a game changer. We've heard that time and time again from people. Neil Dutta is the perfect litmus test. He was so gung-ho about how weak the labor market actually was and the need to cut rates, and now we're talking about him saying that this is a Fed that should remain on hold. So go figure.
Neil Dutta's changed, Governor Wallace changed, went through those names this morning. There's been a shift. There's been a shift. 10s this morning, 438 up a single basis point. On our radar this morning, Chevron and Exxon rising in the pre-market after reporting earnings that beat estimates. Chevron saying higher oil prices helped offset production outages. We'll catch up with the Chevron CFO later on this afternoon at 3:30 Eastern Time. Anne-Marie will finally get into the office a little bit later. Just didn't make it this morning.
Yeah, well, I won't make it Monday, so.
You're going to be here Monday?
No, I'm going to lie in.
Oh, you're going to have a long weekend?
I'm going to have a long lie in.
Good for you.
Okay, let's move on.
You've earned it, Brownline.
Thank you. Oh,
all
that's
right.
so sweet.
Let's turn to OpenAI. The CFO, Sarah Fryer, pushing back on concerns about missing internal targets. Fryer saying the company is meeting objectives and seeing a, quote, vertical wall of demand for its products. And finally, Meta, planning to shrink its teams and develop new apps as AI shifts the company's workflows. The Wall Street Journal reporting the CEO, Mark Zuckerberg, saying the move won't necessarily mean more layoffs. Meta falling 8% on Thursday after raising its capex for the year. And the story this morning is not really improving too much.
No, because on one hand, there's a question of what exactly its strategy is, whether it potentially could have layoffs. It's saying anything remains on the table, but also saying that recently the trajectory for our business is still very strong, but what you have seen is a real shift downward in terms of the flow in advertising as a result, and he blamed what's going on in the Middle East. So people are looking at this and maybe getting a little bit skeptical.
Well, let's talk about what's happening in the Middle East right now. The stalemate in the Strait of Hormuz is reshaping global supply chains. Shamir Khalik, the city head of services, writing for corporates, the challenge is cumulative. Predictability has declined and more capital is required upfront simply to move goods reliably. Shamir joins us now for more. Shamir, good morning.
Thank you so much. Thank you for having me.
Welcome to the studio. Thank you for being here. Yeah. Just in time used to be the way business was done.
That's right.
We've been doing that for decades. Globalization really helped encourage all of that. Things have changed, haven't they?
Things have changed materially. And I would say, if you just step back and think about not just what's happening in the Strait of Hormuz, but also what's been happening since the start of the year, last year, with tariffs coming through, having an impact on company supply chains and how they go out and sell products across the globe. Secondly, as you think about what's happened to rates, rates have generally stayed elevated. We were expecting to see more cuts in the, particularly in the US, come through. We haven't seen that yet. And generally inflation. So as you think about this triple whammy of effects, we're seeing companies really basically stepping back and saying, how do I think about my supply chain? How do I think about my working capital cycle, my cash flow, and make sure I'm running an optimal business cycle? And therefore, at least from where we're sitting, we're seeing a lot of the companies move from just-in-time to thinking about production resiliency. When you go there and you talk about production resiliency, that by definition means you're going to run a far more expensive and a far more diversified supply chain and a far more resilient supply chain. So what that means is higher expenses. And companies have to therefore think about what that incremental cost, how that factors in, and by definition has an effect as they sell their products or services.
Let's spend some time on that. When you shift from one to the other, how do financing needs change?
Yeah, I think very clearly, right? So if you think about, first and foremost, you think about your suppliers and the goods that you put into your production process. First and foremost, are you going to use the same suppliers? Do you have to onboard new suppliers? Think about new production facilities. You have to go out there and basically assess the strength and resiliency of the new supply chain that you're building out. So that takes time, that takes assessment, and that obviously needs CapEx on both sides of the house, both on the supplier side and on the company side. And then separately, as you think about how that supply chain then moves through your production processes, you have to potentially retool production, think about moving your production and moving potentially near-shoring it to where your actual client demand lies. So all of that disruption is causing some of these significant moves that we're seeing. And by definition, higher oil prices, that is another higher cost of input. So we're seeing a lot of major change happen in a very, very short period of time.
Before 2020, people said it took a long time to change supply chains. Yeah. And that was one reason why there was a stickiness to some of the suppliers. Yeah. How much has that process sped up?
I'd say significantly. I think companies have become far more resilient and far more agile in how they think. Clearly, technology has helped. But I would also say companies have been on this journey for quite some time now. And that's why what we're seeing, if you look at global trade flows are up about $2.5 trillion on a year-over-year basis. Trade flows are holding up really well. But I would say within that, I think there are pockets. You think about the AI boom and what's happening in the world of AI and all of the data centers and the supply chains building up to actually cater to that need. Couple that with also, I could give you a few more sectors, the automotive sector, the tech sector, the consumer sector, the healthcare sector, all have seen varying disruptions. And I would say a real focus on building out a supply chain, which is far more resilient to helping execute the production agenda that those companies have.
There are frictions traditionally in the banking industry.
Yes.
It takes time to
Yes.
transfer money. It takes time to change some of these flows. It takes time to identify all of the vendors involved. How has that changed, and in pretty dramatic fashion, over the past couple of years to meet the changing demands?
Well, it's a journey that I would say the entire banking industry is on, but Citi in particular, the business that I run in managed services, we've been on a mission to actually think about 24/7 as our mission. So as you think about our payments platform, our liquidity platform, and trade platform, the one principle we've lived by is saying, how do we make this payment execute much faster? How do we make liquidity and financing available to support that payment, whether it's intraday lines or working capital financing lines? We've seen a significant take-up across the board. You think about our instant payments book of work, our cross-border volumes. We're seeing double-digit growth in cross-border volumes. We've seen a significant double-digit growth in instant payments around the world. Those payments arrive within seconds. So we've built out a new platform called Citi Payments Express. We've built out a new trade platform called Nirvana, which allows suppliers to be onboarded much, much faster. It's in the name.
It's a great name.
You wouldn't think it would be a payment system, but carry on.
But what it does is it allows suppliers, as companies change, it allows us to onboard suppliers. Previously, it would take a couple of months to onboard a supplier. Now we can do it in less than a week.
Can I ask you this question?
Sure.
Something to give some thought to. If I was going to start a new company today, the answer to where I'm going to start it, is it changed? The answer from 10 years ago versus now, is the answer different?
I would say yes, because I would say if you step back and think about that, you would say the world's gone far more digital. You can be sitting in Kansas and you could be running a global operation, because if you think about marketplaces and how they operate, you could actually set up a company and have clients across the globe. You could have a supply chain across the globe. You could run it pretty much from anywhere in the world. And I think technology today is very different to the technology from 5 or 10 years ago, with instant payment platforms having been built out, with us having invested in trade finance as well. But most importantly, I would say the next 5 to 10 years looks even more exciting, because with blockchain coming online, along with AI, as you think about smart contracts and the ability to inject that into an e-commerce, either an e-commerce platform or into your supply chain, that is going to be a key driver for how we see commerce and activity picking up across the globe.
Real quick here, are you seeing supply chains move away from the Middle East yet? Have you seen any material shift directly tied to the Middle East region?
I would say it's too short a time period for us to say that we're seeing any movement away from the Middle East. I would still say Middle East is obviously one of the largest, as a region, one of the largest producers of oil, of course, across the globe. I would also say, given our presence in the Middle East and what we see and hear from clients, all of those clients are driving their agendas around the globe as we speak. We're actually helping them immunize their business from some of these, what I would call short-term shocks. But I actually expect to see significant growth in the Middle East. We continue to invest in that region. We continue to see potential beyond what we're seeing in the very short term.
Shamir, appreciate your time.
Thank you so
sir.
much.
Thanks for breaking it down. Really interesting stuff. Shamir Khalid there of Citi on the supply chain shift we've seen, not just over the last few months, but the last decade or so. And these supply chains have faced shock after shock after shock ever since 2016.
Yeah, just in time going to just in case, and the extra cost that builds into the system as well. How does technology offset that? I think increasingly, I think about what some people at my house are doing with Claude. You just think about what you could do in terms of planning your supply chain. It would be a very different story.
Is that where all the Mac Minis are?
Yeah.
As a Bramo.
Honestly, I don't even know what goes on in there.
Don't want to know either. Let's get you an update on stories elsewhere this morning. With your Bloomberg brief, Yahara has more. Hey, Yahara.
Hi, John. The Pentagon is expanding its use of AI on classified networks, signing new deals with NVIDIA, Microsoft, Amazon Web Services, and Reflection AI. The effort comes as the Pentagon races for AI alternatives to Anthropic's Claude amid ongoing disagreements with the company. Elon Musk's total compensation for 2025 topping $150 billion, according to a regulatory filing. However, that pay is tied to stock and operational milestones that have not been met yet, meaning his realized compensation for the year was actually zero. And Wall Street executives in New York City's ultra-wealthy are uniting against Mayor Zohran Mamdani after he criticized a home owned by Citadel's Ken Griffin. Business leaders like Dan Loeb, Lloyd Blankfein, and Mike Novogratz criticizing the tone of the mayor's statement as he tries to add a tax on second homes in the city. That's your Bloomberg Brief. John?
Yahara, thank you. Thank you very much. I don't like the framing. I don't want this to become a story of Mamdani, the socialist, versus the ultra-wealthy, and a battle between the two. This should be about business leaders, wealth creators, employers in this city, and what they think we need to do to make sure that New York City stays an attractive destination for all of those things. If we reduce this in the media to a battle about wealth and the haves and the people who don't have, you're going to end up with a very different fight politically. This needs to be about what's good for the economy so that people actually want to come here, live here, have a job here, be employed here, and pay taxes here. Because right now, that's not the debate that I'm hearing play out.
When you look at the amount of revenue that we brought up from the pied-à-terre tax, it is negligible relative to the potential wealth you could lose. And this is what a lot of people are pointing to, and it should be the economic discussion of how you attract capital, because ultimately, this is a capitalist city, and it's run in, you know, that's sort of the point, you know?
You know what the media wants, right?
What does the media want?
Billionaires versus the socialists, you know, they want that fight on the front page. The people who cover this story, look how it's written.
Yeah, no, it's true. You're right, you're not wrong. You're not wrong. It makes a good story, but the reality is that dollars and cents make a city go.
Precisely. Up next on the program, funding, AI ambitions.
If they were to issue $30 billion, you'd hardly notice it. That's how big they are. That's how little leverage they've carried. These guys have the demand. They'll show you the demand. And I think these guys are right to borrow.
Up next, we'll catch up with Amanda Lynham of Goldman Sachs, live from New York City. You're watching Bloomberg TV.
About 80% of projects will find it difficult to secure financing. And this is really all because of the level of readiness or preparation. As you know, for investment to occur, you need well-prepared, technically prepared projects, but they must also demonstrate economic and financial impact. So one of the major challenges is the stock or availability of bankable projects in countries. Almost all countries have got good plans and ideas, but when you look at the readiness of those projects, that's a major obstacle. And that is why the African Development Bank, through the African Water Facility, invests heavily in upstream preparation of projects to enable countries to have a large pool of investable projects. The second element that is an obstacle is the institutional and regulatory environment in most countries, which make it difficult for investment to happen.
I'm David Weston. Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate. we go on the road for a look at what lies behind the headlines of today and what will likely be the headlines tomorrow.
We need more transparency.
Oil and gas is still important.
They said every citizen should be investing in the market.
Accelerate progress in all fields of science.
Watch Wall Street Week right here on Bloomberg. More than what you need to know, it's what you need to think about.
What is going to be the consequence for U.S. markets?
We are seeing modest gains across European equity markets.
Take a look at how we're faring when it comes to Asian markets. Bringing you up to them in the news whenever and wherever it happens. I'm Chevrian in Seoul, and this is Bloomberg.
Equity futures this morning positive by 0.1% on the S&P 500. On the Nasdaq, slightly lowered. We're down by 0.15%. Meta yesterday hammered, down by almost 9%. Under surveillance this morning, funding AI ambitions.
If they were to issue $30 billion, you'd hardly notice it. That's how big they are. That's how little leverage they've carried. And in our conversations with a lot of big borrowers, we want to know, do they see the demand? These guys have the demand, they'll show you the demand, and they can't monetize it until they put in place the capacity. So there is a big build to go. And I think these guys are right to borrow and get that bill going.
So here's the latest this morning. Meta selling $25 billion of investment-grade bonds after raising its CapEx guidance to fund its AI build-out. Amanda Lynham, the chief credit strategist at Goldman Sachs, writing, we see scope for additional issuance, but not nearly as much as the hyperscaler balance sheet debt capacity suggests. Amanda joins us now for more. Amanda, good morning.
Good morning. Thank you for having me.
And congratulations on the new seat.
Thank you so much.
Which is kind of like the old seat, but it's good to see you back.
Thank you.
Welcome back to the studio. Let's talk about the issue we got yesterday from Meta. Some people have talked up demand fatigue for this debt coming from these particular players. What was your view of things?
Yeah, it's a great point. I wouldn't characterize it as fatigue for the issuers. What I think is it's investors very carefully navigating market saturation constraints. We've actually used the U.S. banks as a really good case study. The U.S. banks are the largest issuer in the U.S. IG market. None of them are more than 2.3% of the index, and none of them have more than $175 billion of index-eligible debt. So when you think about what Bob mentioned, he's absolutely right. Their balance sheets are so low leveraged that they have capacity to add a significant amount of debt. The point we're making is not all of that will happen in the traditional U.S. IG market because investors will need to manage those issuer concentration constraints. So what does that mean? We've already seen issuers issue in euro, Swiss francs, sterling. Actually, if you look at the euro AA market, more than half of them are U.S. companies, and 2 of the hyperscalers are in the top 5. We've seen private infrastructure, private real estate, and we wrote last night a deep dive on kind of this new structure that's being used, these JV type deals that are kind of off index, off balance sheet, very different. We've emphasized the importance of construction risk coverage and claim to tenant, but this is a paradigm shift for the corporate debt markets because there's a significant amount of financing such that none of these markets in isolation will be able to handle it on their own, so it will need participation.
It's also happening very quickly.
Yes.
That's the big change as well, that a number of years ago, these companies weren't doing any of this.
Right.
And now a few years later, they're doing tons of it. Right. You talked about maybe falling short of capacity. What kind of size are you expecting in issuance just from these big names?
So we've seen $400 billion in total of AI-related issuance, not just hyperscalers, but across IG and high yield, most of it in IG, since mid-2025. Our equity analysts are expecting $4.5 trillion of spending from the 4 large hyperscalers from 2025 to 2030. If you drill that down just to this year, that puts CapEx spending around $700 to $725 billion. That was actually the estimate coming into earnings. When you think about the capacity that these companies could issue, again, we would go back to those kind of market saturation limits, the case study of the U.S. banks. There's a significant amount of debt capacity on paper that these companies have, but do they use all of that in the U.S. IG market in 2026? We don't think so. This reminds me very much of some of the structural shifts that we saw earlier, even in the 2010 period when pharmaceuticals did a lot of debt-funded M&A. They issued debt into the market. This is obviously a much, much larger scale. But I think what it shows you is that these companies are using their balance sheet capacity thoughtfully, strategically, not all at once, and they'll be tapping tapping a variety of different markets. We already have an above consensus forecast for U.S. IG issuance of $2.1 trillion. That would be a new record. And it's pretty clear based on this development that the risks are skewed to the upside.
Companies might be smart about how they issue, and definitely investors are being smart about concentration risks. But what about holistically? Concentration risk tied to AI injected into the investment grade bond market, does it make it inherently more concentrated and frankly riskier as a result?
So U.S. banks are still the dominant sector, anywhere between 20 and 30%, depending on how wide your financials net is in your classification. I think there's plenty of room to go before that happens. I think really this is a longer term trend that we think has momentum. These tweaks around the margins on CapEx spending aren't enough to move the needle on how they will approach the financing, at least through the medium term. And again, as was cited earlier, these companies have such incredible balance sheet capacity that they can almost afford to kind of overspend in some areas. As we get, 4 or 5 years from now, I think there will be a more nuanced discussion about were the early investors the winners? How are we thinking about that? I would say our software analysts are already kind of digging into that. We stay in very close touch with them, but I don't think it's shifting the risk. I think what it is doing though is it's changing the makeup of the market such that actually some of this debt is occurring outside of the index, and so it's causing investors to be a little bit more creative about where they're looking.
Are you seeing any reluctance by investors to invest in lower grade debt, particularly tied to some of these issuers, not necessarily the hyperscalers, but given the fact that private credit seems to have retrenched a bit too?
Well, I think private credit, is an interesting use case because there's a lot of noise around retail redemptions. But if you look at retail vehicles as a percentage of the market, it's actually only 15%, and those institutional vehicles don't have the drawdown. So I think if anything, if there's a disruption, private credit probably deploys on the back of that, especially from the institutional community, because there's a lot of dry powder. To answer your question, no, we're not seeing people shy away from risk. And in fact, within the IG market, we actually prefer the BBB pocket of the market, because if you take a step back and you say, where is there the scope for the most balance sheet deterioration? It's actually at the high end of the rating spectrum. So that's a view that we have, and I think a lot of investors kind of recognize that as well. They're just positioning, they're not taking it as a spot credit fundamental metric. They're saying, okay, what is the go forward and what is the supply?
Is there concentration in tech at the high end of the rating spectrum? Are they the companies you're thinking about?
It is. They're mainly AA or AAA. Again, very similar to what happened in pharma. I mean, at one point when I was covering pharma, some of these companies were AAA rated, right? And they did debt-funded M&A, and they slowly moved down. That's fine. There's still great credit risks. It's just baking that into your forward expectation is important.
Incentivized by the market to issue more debt, ultimately.
I mean, right now people can't get enough, and they are being careful about how they do that. I love what Amanda said about how that's the reason why they're going to Europe, not because they think that necessarily can finance better or that they want euros, but ultimately they need to be respectful of some of these constraints in the index.
Amanda, it's good to see you. Welcome back.
Thank you so much.
Amanda Lyman, back at Goldman Sachs. It's good to see. Breaking down the credit market and the issuance we saw earlier this week from Meta.
Yeah, and people saying that, they only got $96 billion of offers to buy their $25 billion offering. It was $125 to $30 billion. Oh, your Lord.
96, small violins and all that, yeah? All right. Up next, Abby Yoder of JP Morgan Private Bank, Dan Ives of Wedbush, Alejandro Grindal of Ned Davis Research, and the NASA administrator, Jared Isaacman. All of that in the third hour of Bloomberg Surveillance.
When I visited Fernandez at IMAX's headquarters outside Toronto, we went to the facility where IMAX designs and maintains its cameras. The latest next-gen equipment was out with directors on filmed for IMAX sets, but there was still plenty of cool gear on view.
As the head of the finance department, do you look at all the things in this room and think, this costs that amount of money, this costs that amount of money?
Thankfully, no, I don't. When I think about cameras in general and what we, when we first, I'll give you a really prime example, the film cameras. When you thought about it, okay, are we building 2? Are we building 4? Are you building 8, right? And that's where I start to think about, well, what makes the most sense from a return perspective? Because yes, Nolan wants the cameras, but how many other filmmakers out there use the film cameras? The lens that I look at it through is essentially, how many do we build and in what way? Because the one thing is we are going to invest to build it right and to build it for longevity. But do you need 10 of them? No. Building 4, that was the right number. And do we potentially want to build a couple more? Maybe a couple more, but I don't think we need 10 because they won't always be in use all the time.
I imagine that at different points you need to tell people no. What's that process like for you?
Oh yeah, it's a key role in the CFO position. It is a word that most people are used to, and yet they still think you're not going to say it.
Welcome to Bloomberg This Weekend. I'm David Verrett.
I'm Lisa Mateo. And I'm Christina Raffini. We're tracking breaking news today from Wall Street to Washington. Let's start overseas. The sector is really propelling this deal forward.
Yeah, the hope is this will open up new markets and provide some additional liquidity.
Of course, now they're going to have competitors. We got a big week coming up in politics.
Earnings season is underway. We're going to get some key reports.
Everything you need to know before the markets open on Monday.
Introducing Bloomberg This Weekend, bringing a little Bloomberg into your weekend routine.
Guys, buckle up.
Oh, hello there. Just wanted to say, Primer is back. We've been scouring the frontiers of science and technology to help explain the difference between the next gold rush and whatever this thing is. And in season 2, we're upping the stakes. More danger.
Now that is some high-grade uranium mineralization.
We used to have a stable climate on this Earth. Right now, we do not.
More science.
We're pushing the envelope of technology in multiple directions. Software, hardware, chemistry, physics.
The cable is like very cold.
And more CEOs that can nail the photo shoot.
Hundreds and hundreds of billions of dollars are at stake.
While the problems are economic, the solutions are too.
And yes, we will be talking about AI.
There is a lot of humanoid hype out there.
But our future doesn't run on hype. It runs on innovation. Watch season 2 on all these lovely channels.
The Middle East and Africa regions are home to some of the biggest deals and fastest growth in the world. Vibrant resources and high-yield investment opportunities abound. I'm Jumana Versace. Join me on Bloomberg Horizon's Middle East and Africa for the stories, newsmakers, and insights shaping the decisions of traders across this exciting region.
You had heightened levels of volatility.
There's still room to maneuver.
We do see opportunities.
It allows you to increase significantly your net income.
Every trading day, only on Bloomberg.
Bringing you up-to-the-minute global news whenever and wherever it happens. I'm Jumana Versace in Davos, Switzerland, and this is Bloomberg.
If there's a war, nobody told earnings.
What's really driving the market higher has been extremely strong earnings.
If you look at the earnings we've gotten, they've been incredible.
The earnings story is overpowering.
As far as kind of the main driver here, it will continue to be AI.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, the third hour of Bloomberg Surveillance starts right now, and your scores look like this. Following a 10% gain on the S&P 500 last month, we look to add to it this month, up 0.2% on the S&P 500, down 0.1% on the Nasdaq 100, which is nothing compared to the 16% advance we saw through the month of April, the biggest monthly gain since 2002. In a bond market, we're shaping up as follows for fixed income. 2s, 10s, 30s, yields higher by a single basis point on the 2-year at 388, 10s at 438, dragged higher by elevated crude prices. Brent, WTI, Brent crude 111, WTI 104 so far this morning.
We heard a bit of a hawkish tone over in Europe in particular. We seem to be expecting now a June rate hike from the European Central Bank. A question about whether the U.S. Federal Reserve will actually shift to more of a neutral stance when it comes to symmetric risk. Is the next move going to be a hike or a cut? There has been a sea change, though, given that now we're looking at higher for longer, and people are gaming this out and saying that the resilience in the U.S. economy will allow the second-order inflationary effects to remain stickier.
Pricing in this market was super hawkish, and I think we fell just short of that, the ECB and the Bank of England earlier this week. But still, on their own, they were quite hawkish decisions. Bank of England is considering rate hikes. I don't think they're there yet, but they're considering it. The ECB, to your point, is getting super close. June's very much on the table. For the Federal Reserve, we're talking about removing the easing bias, articulating a more symmetrical reaction function over at the Federal Reserve. And for BNP Paribas, it's not the consensus view, but for BNP Paribas, they believe there is a risk of a rate hike this year, and it depends on two things. One, you have a continued closure of the Strait of Hormuz and energy prices remain elevated, and two, unemployment declines, which puts a lot of weight on next week's labour market report. Does this labour market support higher prices? That's the question we keep going back to over the last 2 months. Next week, the payrolls report, the estimate's 60K. The range is super wide, the low is 0, the high is 140. The unemployment rate's key, 4.3% at the moment. If you start to see that drift lower, because we actually are seeing an underlying pickup in the US economy. The conversation around broad-based inflation pressure is going to change pretty quickly.
Especially when you put it together with the lowest jobless claims figure going back to 1969, with an ECI figure that crept up the employment cost index in yesterday's GDP report, signaling a little bit of strengthening there. And we heard from Neela Richardson of ADP saying she's actually starting to see recoveries in the underlying labor market. You put all these things together, that was what allowed inflation to take hold in 2022. Is that a bit more of a factor than some people had expected in 2026?
I'm not talking about 8, 9, 10% inflation, of course, but something closer to 4 to 5 versus, say, 2 to 3. Conversation shifts quickly.
The issue that a lot of people have in this market is they believe that Kevin Warsh is going to be dovish, period, full stop. He is not going to hike rates because ultimately he has an obligation to at least keep rates here, given some of the, not an obligation, but he clearly has a desire to do that. So the question is, how do they control the yield curve, considering that you might get a different reaction in the long end?
Got to keep digging. Let's get to the weekend. Coming up this hour, Abby Yoder of JP Morgan Private Bank with stocks entering May at record highs. Dan Ives of Wedbush recapping a busy week for big tech. And Alejandro Grandal of Ned Davis Research saying there's still a chance of a rate cut this year. We begin this hour on the Federal Reserve. Bloomberg's Mike McKee has some headlines for us. Good morning, Mike.
Good morning, John. Well, Lisa was talking about the dissenters and what they might do down the road. It has become a tradition for dissenters to put out statements, and we have a couple of them this morning from 3 members of the Open Market Committee who voted against the Fed's decision because of what they say is an easing bias they don't support. What is that easing bias? Had a lot of questions about that after the Fed meeting, and this is the phrase they don't like. In considering the extent and timing of additional adjustments to the target range for the federal funds rate. That, according to Neil Kashkari, is the wrong thing to say at this point. He sees 2 scenarios ahead, neither one particularly great for the Fed. One is a fairly quick reopening of the strait, which means rates will be on hold for an extended period, or an extended closure, which would mean rate hikes and potentially a series of them. In his statement out this morning, fairly long one, he says, given the uncertainty about the path of the conflict and the resulting effects on inflation, employment, and economic growth, I believe the FOMC should offer a policy outlook that signals the next rate change could be either a cut or a hike. This could tighten financial conditions somewhat today, pushing back against a high inflation scenario that could require an even stronger monetary policy response in the future. We are also getting a comment from Beth Hammack, who voted against the Fed decision as well. The Cleveland Fed president saying, this forward guidance was put into the statement to signal a pause rather than an end to the easing cycle. I see this clear easing bias as no longer appropriate given the outlook. Inflation pressures continue to be broad-based, and rising oil prices present an additional source of inflationary pressure. Uncertainty around the economic outlook is elevated, with upside risks to inflation and downside risks to growth and employment. Lori Logan of Dallas is the 3rd person to vote against the statement because of the easing bias. So far, we have not heard from her, but if we get a statement, we will bring that to you as soon as we can.
Mike McKee, thank you, sir. Appreciate the breakdown. Thank you very much. The easing bias is no longer appropriate. The Cleveland Fed president this morning, echoed by the Minneapolis Fed president as well.
With this idea that potentially having this sort of more symmetric reaction function could tighten financial conditions enough to not have to make them hike rates. So this is sort of some mental jiu-jitsu for markets. Can we get our desired goal without having to inflict higher borrowing costs?
Slightly more hawkish Federal Reserve this week. Crude prices still elevated, yet we enter May at all-time highs on the S&P 500, kicking off a fresh trading month. Abby Yoder of JP Morgan Private Bank writing, despite no end to the conflict in Iran in sight, earnings didn't blink. Companies are beating expectations at a pace we haven't seen in years. Abby joins us now for more. Abby, good morning.
Good morning.
Does this mean the situation in the Middle East doesn't matter, or just doesn't matter yet?
I think doesn't matter yet, right? Like you're not going to really, we tried to lay out 3 scenarios when this conflict originated, thinking about, what would it take for it to matter, right? And there is a period of time, like a length that is a duration that is important to keep in mind. And for us, that's 3 to 6 months at these elevated prices, particularly north of $100 or $120 on oil. And so that's really where we're more concerned if we continue to see this extended through the summer, particularly given, the heavy driving season. And you've already seen that percent of disposable income for the median consumer go up from around 3.5% to 4% on gasoline. So if that continues to move higher, then that could weigh on economic growth and sentiment more broadly. I think the sentiment channel is very important.
Started to see it in sentiment already.
Yes.
Consumer sentiment is really, really depressed.
Has been the case for the past 4 or 5 years.
Well, this is the question.
It's very,
the question I was going to ask you. Why is that relevant? Because it hasn't been.
Well, it's relevant because, it's stark in the sense that it's the lowest it's ever been, and it's at odds with what's going on from an economic standpoint and from a stock market standpoint, earnings standpoint, because at the end of the day, what ends up happening is we look at all these confidence measures, we want to have some read-through there, but then when you look at the spending figures, right, the banks all reported in the first couple of weeks of earnings, and nominal and spending growth is really, really solid. Like, a lot of these CEOs were like, you know what, you can't ask us this anymore, because at the end of the day, like, consumers are still spending, whether they feel poorly or not, they continue to spend. And the makeup of that spend, I think, has shifted, right? It's much more services oriented in our view, but it's still very elevated relative to history.
Has there been a shift over the past couple of weeks? And I ask this because Mark Zuckerberg, in this letter that he sent out at Meta, said that there was a trajectory change in Meta's ad business after the start of the U.S. war, saying if oil prices go up, then consumers spend more of their money on oil, on gas, and less on things that they would just buy that are just kind of discretionary things that the advertising might serve. Do you see this in any kind of way, or is this an excuse?
Well, you haven't seen it in the results in terms of ad spend growth and the actual usage of these apps in terms of what they're spending on. I think what we're worried about, again, is if this stays higher for longer and it creeps more into the confidence levels of consumers, that you start to see that spend shift. But for the most part, we just really haven't seen it in terms of the ad spend and the growth from a lot of these mega cap names.
What's the argument to go more into equities right now after the rally that we've seen, as oil prices continue to go higher and as yields continue to rise? Why not just cash out and kind of have a more conservative portfolio and just sort of sit tight and wait for the next leg?
Well, so first, if inflation is in fact going higher, then you are losing purchasing power from anything that's like short-term cash-related investments. I think the other thing to keep in mind is we're at all-time highs in an equity market, but the valuation is actually lower than when we started the year. And that's because we've seen earnings revisions that are in excess of what we've seen from a price reaction standpoint. So, for example, for 1Q earnings, we started this quarter with the expectation that earnings would grow 12%. Now, with a little bit over 50% of market cap having reported, we're at close to 20%. That is enormous. And that's the 6th consecutive quarter of double-digit earnings growth, right? So if you think about it, these aren't easy comps, right? We're already growing off of a very high base. And I think, obviously, technology and the tech-related sectors are what's driving that. And the margin profile of the S&P 500 is just very different than it used to be, 10, 15 years ago. So when you're looking at, the elevated PE of 21 to 22 times, but the makeup of this is just very different and is worthy of that higher multiple.
Can we finish on one of your sector favorites, something you know tons about, chips? Yeah. The rally we saw in semis, 40% move in April. What do you tell people they should do in that sector now after a rally like that?
It's buying on strength. I think when you really, and I think this is part of the hard, reconciling this. Like, we're 3.5 years into this AI cycle. And I don't think that anyone would have thought that 3.5 years in, the infrastructure players would have been still the beneficiaries of this trade, right? You would have thought it would be the adopters, and you're seeing all of these, the margin expansion story happen and play out. But because we're so supply constrained and energy constrained, it really is that you're still seeing the nuts and bolts of this build out. Those are still the winners. And we don't foresee that changing in the next, 2-3 years, really.
I've tracked the industry for so long, though. That's why it's often so cyclical. That initially supply constrained, they build it out, the opposite happens, bust.
Particularly on the memory side, right?
So why is this different? Why does this have a longer timeline?
Well, because I think when you think about the starting line, we just didn't have the industrial capacity to really build out what we need now, right? This all happened and accelerated very quickly, and we just didn't have the industrial base. Now there's obviously a lot of incentives to build that out, but we're still very far behind. And I think you know, it's really been over the last like 8 to 10 months, call it, where you've also seen it's just been this trade around all of these different components that go into this, right? Whether it's optical, whether it's memory, where those weren't really, it was, at first it was just GPUs and it was just, you know, the compute, but now it's just this broader set of inputs that are all needed that we don't have enough of.
And you think people should stick with that trade?
Yes. Within tech, we're, you know, semis over hardware over software.
Okay. Abby, appreciate it. It's good to see you. Thanks for breaking it down. Abby Yoder there of JP Morgan Private Bank. The equity market coming into May at all-time highs, looking to add some weight to it. The S&P higher by 0.2% with an update on stories worldwide with your Bloomberg brief. Yahira has more. Hey, Yahira.
Hi, John. We are seeing both Chevron and Exxon shares rising in the pre-market, both oil majors exceeding profit expectations as higher oil and natural gas prices outweighed production outages from the war in Iran. Exxon is sticking with aggressive buybacks, while Chevron's smaller repurchase pace is disappointing some investors. OpenAI CFO Sarah Friar pushing back on concerns about missing internal targets after that Wall Street Journal report. Friar saying the company is meeting objectives and that OpenAI is seeing a, quote, vertical wall of demand for its products. And President Donald Trump says he doesn't care if Fed Chair Jay Powell stays on as a governor after his tenure as chair ends. The president saying he just wants to make sure Kevin Warsh gets confirmed as the next head of the Federal Reserve. That's your Bloomberg brief. John?
Just turning down the heat just a little bit over at the White House with regards to the Federal Reserve.
Honestly,
story of the week, no?
I saw that and I was just like, who dis? I mean, honestly.
They don't want the fight.
Okay, but this, to me, they don't want the fight because they're taking the high road? Well, or is there some other reason? Are they just waiting for Kevin Warsh to get in and then they're going to go harder? Like, I don't really understand.
I can only sort of observe what's happening right now. I can't predict a thing. The president can change, of course. He can change his mind and write a social media post in about 2 minutes' time saying completely the opposite. But the trend so far seems to be turn down the temperature just a little bit.
There's a peace pipeline being built between the Fed and the administration.
We've got something from Axios once again, so here we go. It's bullish. Iran delivered on Thursday to the US through the Pakistani mediators its response to the latest US amendments on the agreement to end the war, according to a regional source. That crossing just now from Axios. As those headlines cross, futures at session highs on the equity market, up by a third of 1% on the S&P.
Yeah, I immediately go to crude to see exactly what kind of reaction there is. And you do see a little bit of a decline. You see almost now a 2% decline on WTI. That said, how much can people put credence in this and how long will that move last, given the fact that we've been subjected to this headline roulette for quite a while and people have learned that it can be a time to lose money?
And the president appears to be committed to the naval blockade at the moment. We'll get some more headlines for you in just a moment. We'll break that down in about 2 minutes' time. Up next on the programme, the morning's calls, plus Dan Ives of Wedbush recapping a busy week for big tech. That conversation up next.
Asia is at the forefront of some of the world's biggest stories.
And we're here, where the action starts in Sydney.
And in Tokyo, get ahead as the global trading day begins.
The Asia Trade, weekdays only on Bloomberg.
Welcome to the world of decentralized finance.
Why is it that NFTs have not recovered in the same way that, say, Bitcoin has?
Bloomberg is covering all things crypto.
It's a pretty spectacular story.
The people.
This is the future. This is the 21st century economy.
The transactions.
It snapped up nearly $1 billion of Bitcoin.
And the technology.
We need to build a digital Fort Knox.
That gives people financial freedom, and that's a wonderful thing.
That's extraordinary.
We ride the wave that is Bitcoin.
Bloomberg Crypto, only on Bloomberg. From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Equity futures near session highs up by 0.3% on the S&P 500. This from Axios just moments ago. Iran delivering on Thursday to the US through the Pakistani mediators its response to the latest US amendments on the agreement to end the war, according to a regional source. Things just picking up just a bit.
Yeah, although what we have seen is an initial knee-jerk reaction in markets when you take a look at crude and then that reset, because people were looking at what this means, and there isn't necessarily a clear sense, at least in crude, in Brent crude. In WTI, that's holding. And so, you know, maybe people are just optimistic this morning. Maybe it's just an issue of people wanting to move on.
Look, the negotiations happening in real time. The president said yesterday only a few people know what's going on with the talks, and he clearly knew something that we didn't and didn't want to share it. The one constant, and I'm always thinking about the one constant and what are people comfortable with. The one constant is the naval blockade. And based on the comments we've heard from administration officials just this week, they seem pretty comfortable with maintaining that blockade.
That said, most people seem to think that there's some sort of deadline because of the economic damage being done, whether it's the midterm elections for President Trump, whether it's political unrest for the Iranian leadership amid hyperinflation and an economy that's really struggling. That's what's giving people hope that there will be a near-term end. It's a near-term shock. It's not a long-term reality that's going to increase the price of crude.
Things can change really quickly, so that's the latest reporting, and we'll see if we hear from the president going into the opening balance. We often do sometimes. Equity futures close to session highs, up by 0.25% on the S&P. Crude declining. Brent down by 0.2. WTI down by a little more than 2%. That's the price action. Let's get you some morning calls. One stock in focus, Apple. Barclays raising its price target while remaining underway, viewing third quarter revenue guidance as, quote, very strong. Elsewhere, Wells Fargo raising its target to 310, expecting focus to remain on the management of memory and storage inflation into the second half of this year. And finally, Morgan Stanley boosting its price target and staying overweight, calling Apple a, quote, thematic mega-cap winner. Bloomberg's Ed Ludlow joins us now for more. Ed, are they the winner overnight?
Yeah, but it was an in-the-moment change of fortunes, all on the guidance. Third quarter or June quarter revenue to grow 14% to 17% in an environment where Apple is very clear that demand is greater than their ability to supply. Chips are the constraint, particularly impacting iPhone and Mac. Memory costs are rising. They've managed it. The margin numbers were very strong. And, you know, Tim Cook held his cards close to his chest on how that rising memory environment is going to be managed by Apple. They are the master of pulling the levers, John, aren't they? So we didn't learn as much as perhaps we wanted, but it was amazing to see how quickly the sentiment of markets changed towards Apple. And then China, a standout, you know, really growing beyond expectations. The surprise was that incoming CEO John Ternus briefly appeared on the call and said, there's a great product roadmap ahead. I'm not going to tell you anything about it, but it was a kind of interesting moment for the market too, because either he was going to show up or he wasn't.
Just a warm-up act for later this year. I think we're going to hear more from him, no doubt. Ed, thank you, sir. Looking forward to the program. Bloomberg Technology, about 3 hours away on Bloomberg TV. Dan Ives of Wedbush maintaining an outperform rating and a 350 price target on Apple, writing, it's all about the AI strategy. Dan joins us now for more. Dan, welcome to the program. Tell me more. What is the AI strategy at Apple?
Look, I think that's what we're going to find out at WWDC, but I think with Gemini as a partner, it's going to really start what's going to be a subscription service when it comes to the AI strategy for Apple. The consumer AI revolution is going to go through Cupertino. We think this could ultimately be an incremental 10, 15 billion per year of services. They're firing on all cylinders right now. In terms of iPhone growth, services, Ternus obviously taking the baton. A lot of focus on WWDC. I think it's going to be a golden age for Apple as they finally monetize the consumer AI revolution.
What's going to be a positive use of CapEx, Dan, given the fact that we did see a big increase in R&D and this pledge to potentially have the optionality to use their cash for some sort of investment in the future?
Yeah, look, in terms of investments, like, you know, they've almost been light on CapEx. And you could say that's actually been a positive for them. I continue to think with Ternus at the helm, they're going to be more acquisitive. That's another thing that's important. It's been missing as part of that DNA in Cupertino. when you look at the AI strategy and you look at the install base, they have things that no other company has. 2.5 billion iOS devices, 1.5 billion iPhones. Now it's about ultimately from acquisitions to starting to build out CapEx, partners, and will ultimately be an AI-enabled iPhone as we go into 2027.
Dan, is it a problem that all of the tech players are paying more for less? Essentially, they have to pay more money for all the components that are getting more expensive, that potentially will get more commoditized down the road, but they're in an existential race to keep up?
Yeah, look, it's an arms race, and these companies cannot all of a sudden take foot off the gas, because otherwise they'll be on the outside looking in. I mean, I saw it in Asia, being there, for the last few weeks. You see demand to supplies 10 to 1 for chips. So it's what they need to do in terms of GPUs, in terms of capacity. Now, Apple, they're in a different position because it's on the consumer side. And obviously for Apple, they have the install base. But when it comes to CapEx, you look at big tech this week, this is about as bullish as you could have gotten in terms of news for big tech.
Well, Dan, with the exception of one story, and it's the doubts around OpenAI. So can we finish on that? What's your read, your understanding of what's happening inside that company at the moment?
Look, if you look at Anthropic, it's been a historic run that they've had, going from 9 billion run rate to 30 billion. I think that definitely caught many by surprise. And I think at OpenAI, they were top of the mountain. They got bullseye in the back. And now they have to really focus on the enterprise. But in my opinion, they will be one of the core stalwarts over the coming years. It's not just going to be about Anthropic. They're just going through some perceived speed bumps. But I think now they'll navigate. And I think getting this trial over will be important, too, in terms of the soap operas between Musk and Altman.
What do you call that game, Bramo? Tic-tac-toe?
I guess so.
In the UK, we call it noughts and crosses.
Yeah, it's tic-tac-toe.
Is that what that is?
Well, I don't know. I think we need to do a special segment. Where in the world is Dan Ives?
Dan, is that what you're wearing? Is that tic-tac-toe?
It is. It's tic-tac-toe. It's a bullish tic-tac-toe.
All right. Thought so. Dan, thank you. Dan Ives there of Wedbush Securities, distracted by the new outfit.
Yeah.
Do you not notice the get-up?
I've always noticed the get-up. I mean, it's probably his own personal brand, right? Doesn't he have his own brand that he designs himself?
Yes, he does.
Well, no, I was distracted by the headlines because I was
actual
seeing,
news?
Yeah, I was actually. I'm so sorry. I was actually reading the news. I apologize. But we are getting from the state-run Iranian media that they did give Pakistan its latest proposal for U.S. talks, and that the text of the proposal was delivered Thursday. So some real meat behind this, saying at least potentially talks are on the table. Both sides in the room is a positive for a lot of people in the market.
The talks continue.
Yeah.
The diplomatic effort moves on, and let's see if they make some actual progress here.
Yeah, I was also distracted by this headline. The call with Exxon is going on. Darren Woods, the CEO there, saying it will take 1 to 2 months for flows to reestablish after the Strait reopens. So we're trying to kind of game out a time frame here. Even if the talks are successful, how long would it take for A, flows through the Strait of Hormuz to restart, and B, how long would it take for the oil prices to really come down as a result of supply picking up? All of these things are going to be gamed out. The physical world versus the paper world, really, in contrast.
Just a bit of pushback against the potential for an export ban as well. Exxon saying this, that export bans and price caps will result in less supply. The latest from Exxon so far this morning. Up next, we'll catch up with Alejandro Grindel of Ned Davis Research, saying there's still a chance for a rate cut later this year.
World's most powerful investors don't ring a bell. They quietly reshape entire industries. This is the money shaping the world, the dealmaker playbook where power and billions of dollars change hands every day. From private equity and credit to venture capital and M&A, we bring you the inside scoop on the biggest deals and debates, plus exclusive conversations with finance's ultimate insiders. I'm Danny Berger, and this is Bloomberg Deals. Every week, only on Bloomberg Television.
Welcome to Bloomberg This Weekend. I'm David Gura.
I'm Lisa Mateo. And I'm Christina Raffini. We're tracking breaking news today from Wall Street to Washington.
Introducing Bloomberg This Weekend, bringing a little Bloomberg into your weekend routine. Watch, listen, stream. It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
Welcome to Bloomberg This Weekend. I'm David Gura.
I'm Lisa Mateo. And I'm Christina Raffini. We're tracking breaking news today from Wall Street to Washington. Let's start overseas. The sector is really propelling this deal forward.
Yeah, the hope is this will open up new markets and provide some additional liquidity.
Of course, now they're going to have competitors. We got a big week coming up in politics.
Earnings season is underway. We're going to get some key reports.
Everything you need to know before the markets open on Monday.
Introducing Bloomberg This Weekend, bringing a little Bloomberg into your weekend routine.
Guys, buckle up.
The opening bell about 60 minutes away. Equities looking to add some pretty stellar gains through the month of April. Welcome to May. Equity futures up by 1/3 of 1% on the S&P. On the Nasdaq up by 1/10 of 1%. On the Russell higher by 0.2. In the commodity market, pulling back down by 2% on WTI. Brent crude just a little bit softer as well. Some movement in this market, supportive of risk appetite in the last 10-15 minutes. Let's get you an update on the latest in the Middle East. Tyler Kendall joins us from Washington with more. Hey, Tyler.
Hey, John, good morning. Well, some potential progress here as Iranian state media confirms that the country has sent an updated proposal to the U.S. through Pakistani mediators. Now, we don't have information on exactly what changes were made, but it is our understanding that earlier this week, the plan that Iran had put on the table was deemed unacceptable by the U.S. As you well know, Iran has floated the idea that we could see a reopening of the Strait of Hormuz in exchange for the U.S. lifting its naval blockade. Iran also wanted some other concessions, according to Iranian state media, including assurances that the U.S. won't attack again, compensation for damages, and a legal framework for the Strait of Hormuz, many of which are considered to be non-starters for U.S. negotiators. But perhaps the biggest lingering non-starter that was put out there earlier this week was that Iran wanted to see dialogue postponed when it came to its nuclear program. So we'll be watching to see if maybe there's been any sort of progress in that regard, considering the White House made it pretty clear that they don't want to agree to a deal without some sort of curbs being put forward when it comes to Iran's nuclear capabilities. Because, John, as you well know, at this point, this White House is maintaining that that naval blockade is not going anywhere. Just yesterday, President Trump called it, quote, incredible, and said that the U.S. maintains that it will continue to squeeze Iranian oil exports.
Tyler Kendall with the latest. Tyler, thank you. Appreciate the update. A story to watch as we approach the opening bell to see what kind of response we get from the U.S. side. Not sure what time the president received that particular proposal either from the Iranians.
Yeah, and whether he has signed off or whether he wants talks to continue. At what point do they think they have sufficient leverage to really go into a discussion, especially considering the both sides view each other as unreliable, and a lot of negotiators have complained about this issue.
Let's turn to the U.S. economy. The data so far this week has been pretty decent. Next week, we'll get payrolls data. This week, the Federal Reserve coming this close to dropping its easing bias. With the latest, Mike McKee is back with us for more. Good morning, Mike.
Good morning, John. Not close enough, according to those Fed officials who voted against this week's decision. We brought you that at 8 o'clock. We will see if we get any more dissenters out there or people talking in the weeks ahead. But this week did move us forward a little bit because Kevin Warsh's hearing was held, and the Senate Banking Committee voted to advance his nomination to the floor. Now it's just a question of when they can get floor time. They're off next week, so it may be the week after. The Fed stayed on hold, as you were talking about. In terms of the economy, we got a little stronger GDP than we did in the fourth quarter, led by AI business spending. If that keeps up, it keeps the economy afloat. Consumer spending falling back a little bit, and inflation at 4-year highs, especially gasoline prices. Is that going to cut consumer spending even more? We'll get some ideas next week. We have a lot of data. It's the first week of the month, and that's when we get jobs jobs. That's the #1 story, and that'll be Friday. But we also get ADP on Wednesday, JOLTS on Tuesday. So some jobs numbers scattered throughout the week. ISM Manufacturing's coming up at 10 o'clock this morning, but ISM Services next week. We'll see what the employment sections and prices sections of those reports are. Then we turn to the Fed. They are back next week. The blackout period is over, and we've heard, as I said, from Neil Kashkari and Beth Hammock this morning. Next week, we get a lot of them. John Williams on Monday, and we get Mickey Bowman and Michael Barr Tuesday, Musallam Goolsbee Wednesday, Hammock, John Williams again on Thursday, and then Friday out at the Hoover Institution's annual conference, Chris Waller, Mickey Bowman, Mary Daly, and Austin Goolsbee, and we will be out there to bring you all the news from that conference.
Looking forward to your coverage, Mike. Looking forward to it. Thank you, buddy. As always, great work this week. When Mike was speaking, I was sitting here thinking, was that hearing really this week with Kevin Walsh? Is that earlier this week on Tuesday? It was like a lifetime ago.
I don't think we can characterize these weeks as weeks. I think each week can be its own year, and we should really treat it as such, considering the news. But you're right. It's a very fast-moving timeline, and it's a very fast-moving cycle. And I wonder what those speeches are going to be like of Fed officials, given the fact that the Kevin Walsh influence is looming very large, paired with the influence of a Governor Powell, who potentially could be on that committee, taking a super low profile, but has the potential to be a dissenter.
I've joked all this year so far that the week has felt one long trading day that starts on Sunday evening and ends on Friday, and you get one day off. It's Saturday. Just one exceptionally long trading day. In fact, the month's felt the same way as well, hasn't it?
It's been a wild ride, and everyone who walks into this studio has said, what an exhausting week, what an exhausting year. The nonstop barrage of information and having to respond to it, and frankly, the changing market structure in response to all of this has been mind-numbing.
If we can we bring up that calendar again of all the Fed speak next week? Now the quiet period is finished. There's tons of it. I'm just going to pick out one. The one guy I'm looking forward to hearing from, not that I don't like everyone else on the board, but just the one person, Governor Waller. I want to hear from the people that aren't married to a particular policy. I want to cut rates, I don't want to cut rates, and it doesn't matter what happens, I want to cut rates, I don't want to cut rates. I want to hear from Governor Waller because his views seem to have changed recently about this economy. He was very close to voting for a rate cut not so long ago because of what was happening with the labour market. Something changed, and we know what that something is. It's the Middle East. How comfortable is he with current policy, with the easing bias? Is that changing for him as well?
Does he reflect what we heard from Neil Dutta and from others who also seem to be shifting toward a Fed that should not be cutting rates? Does he have a similar kind of feeling? Maybe not a rate hike, but this idea that maybe the easing bias needs to go away. Also, he might have really good tips on weightlifting because I've heard he is quite the heavyweight.
The deadlift.
I mean,
he can lift a lot of weight. I think, is it 370 pounds or something like that?
And he posted it on his social media post. So if you want to take a look, it is out there for a while.
Happy birthday to Governor Waller, by the way, whose birthday was earlier this week. Alejandro Grindel of Ned Davis Research writing, we expect the Fed to stay on hold in the near term, but there still is a chance for a rate cut later in 2026. Alejandro joins us now for more. Alejandro, welcome to the program. What has to happen to get that rate cut?
Well, thank you for having me again. So a lot of, I would say perfect things have to happen. As I said, neutral is where we are at this point in time, no change. The economy, it's, hanging in there, not booming, but hanging in there. Labor market is reasonably balanced. Long-term inflation expectations appear to be anchored. So just sort of that wait and see mode makes sense. But yeah, that there is actually a potential pocket for a rate cut maybe in Q4, so later in the year. So a few things have to happen. One is one that I don't think any of us have a solution to, but it's the war needs to end relatively soon. In other words, we can't have these high oil prices for a long period of time, these supply chain disruptions, because it can have knock-on effects and sort of start getting into core prices. So that's one thing, and we don't have a clear answer on that. The other thing is we need to see that long-term inflation expectations do remain anchored. They are so far, so that needs to maintain in place. Remember also, most of us were looking for, before the war, for inflation to ease in the second half of the year, partly because of the base effect from tariffs. So we should be able to see some of that. And then that's from the inflation story. But from the labor market story, this is something we'll be watching pretty closely. Right now, labor market looks pretty good. We expect just sort of a normal payrolls gain to be around 50,000. That's kind of the new normal, the Goldilocks we talked about last time. But come summer, there's a possibility that we have a lot of grads coming out of university, whether it's undergrad or graduate school, and with some of the uncertainty associated with the war, also AI perhaps taking over some of these entry-level jobs, we could see quite a few months of labor market softness. So I don't think 1 month will make the change, but if you see quite a bit of it, and all those other factors from the inflation story kick in, there is a path for rate cutting, I would say, toward the end of the year. But again, not guaranteed.
Well, that's the path. What's the likelihood? And that's the more important question. Is it just as likely we could see a rate hike? Because some people on the Fed want to communicate that.
So I think it's more likely to see a cut than a hike. And with the hike to happen, again, it's all predicated on the war, right? So if the war lasts for a long period of time and we start seeing those long-term inflation expectations, particularly the market-based ones, I think have done a good job. If those really start breaking out, then I think, hike. And again, the economy kind of holds in there. I think the hike would potentially happen. But kind of the scenario that I laid out, maybe I'm optimistic about the war maybe ending somewhat on the sooner side, then I think the cut's the more likely scenario.
Alejandro, there's a tension, and it keeps emerging as we talk with people on Wall Street who discuss the incredible earnings by corporate America, the incredible resilience, the incredible growth in the prospects for profitability, at the same time that people talk about the lackluster growth in the underlying economy and the labor market. At what point do you listen to the corporates as a guide for what's going to happen to the economy? And at what point are these things on two tracks, or even companies profiting at the behest of the labor market, at the behest of some of the profits by employees?
Well, I mean, I think this is a lot of the trend that we've been seeing even last year, is where you have companies doing well, they're spending a lot, maybe not hiring as much, but not firing either. And then the knock-on effect on equity markets is boosting that wealth effect, and you have that high-end consumer. I think that's been a constant theme, sort of supporting the economy. I think it just argues for a continuation of that K-shape that we talked about before, and even more so now with these affordability concerns. Ultimately, this means that this is an economy, using a technical term, that has weak breath. It's not necessarily a bad thing. I would say another period where we had a very long extended K-shaped recovery was actually the post-GFC pre-pandemic period. It lasted for a long period of time. But the problem is when you have an economy that's led by such weak breath, if that indicator, in this case, it's CapEx and AI spend, if that breaks apart, then everything comes down with it. So it just makes it more vulnerable to downside risk if it's hanging its hat on that one area of growth.
How much are people entertaining the idea that the reverse happens, that suddenly a lot of companies that haven't hired for a long time start rehiring or hiring more people, and people are more productive and they start earning more, and you start to see the individuals who do get hired, and you start to see a much better than expected economic backdrop going forward at the same time that there's an inflationary shock? I mean, how high is the bar to potentially hike rates in a scenario like that?
Maybe not until, say, next year, but I love your optimism, because we actually kind of went into the year viewing things that way. We expected actually a broadening of CapEx. Maybe some of the tariff uncertainty would subside a little bit. The OBA would help a little bit. The Fed, remember, was expected to ease for sure, and that would lower interest rates and allow investment spending to go to a broader degree. So there's still possibly a path toward that, but I don't think the Fed's going to move to hiking if inflation sort of ends up in a good position, because your argument was that you see an expansion and a rise in productivity. And if we see faster productivity growth, then, holding all else constant, we shouldn't have higher inflation pressures. And then we're just sort of, back to this ideal Goldilocks scenario.
Lisa, optimistic. Hey, what an accusation.
I just sent you a message. I love your optimism. Words I'll never hear again.
Alejandra, thank you. Just for the record, she's taken a long weekend. Taking Monday off. Alejandra Grindel there of Ned Davis Research.
Yeah, take my mom out for her birthday. Look,
I love that. Happy birthday, Mum.
Yes, thank you. I appreciate it. It's sometimes important to reset, amid all the crazy. But I will say, I want to be optimistic. I have some people at home telling me that they're long technology over humans. I see the flow of things. So, I'd like to see
This is what people don't know. In the family, on a relative basis,
I'm the optimistic one.
You are the optimist.
100%. Although they are optimistic about technology, so that's great. But, negative on humans.
Let's get you an update on news elsewhere. Unreal. With your Bloomberg brief, Yahara Hasmar. Hey, Yahara.
Hi, John. Axios reporting that Iran has delivered its response to the latest U.S. proposal to end the war. Iran state media confirming it delivered the text of the response to Pakistani mediators. No details yet on the response have been made public. Novo Nordisk is rebranding its diabetes pill as Ozempic in the U.S., leaning on the brand recognition of its blockbuster drug. Novo will make the pills in the U.S. and sell them to patients through its direct-to-consumer platform and select telehealth providers. And in sports, the Minnesota Timberwolves are moving on to the second round of the NBA playoffs after beating the Denver Nuggets in 6 games. The Philadelphia 76ers are heading back to Boston for a decisive Game 7, and the New York Knicks eliminating the Atlanta Hawks after winning Game 6 by 51 points. That's your Bloomberg Brief. John?
Yahara, thank you. Thank you very much. Up next, we'll catch up with the NASA Administrator, Jared Isaacman, following a successful Artemis II mission. Plus, Yahara's back with your morning movers. Another check on Apple rising after earnings impressed. That stock is up by 3.6%.
What's great about it is it's a well-developed gaming ecosystem, right? So, folks know to find games there, but it's also a highly competitive gaming ecosystem. So it's developed, this gives you both that upside and that downside. But what's exciting is that now we are moving beyond the phone to the TV. So I mentioned like one of the big gaming areas we're going after. One of the big gaming areas we're going after now is social gaming experiences that will show up on your TV. So we are now announcing, we're going to announce here actually, that we're going to have these social party games that you can play on your TV with your phone as the controller. And it's things like, recognizable games like Boggle, you got Pictionary, we've got a Lego party game. We, basically are going to unleash this with a bunch of creators, and they're going to go figure out stuff that we didn't even imagine that they can do with that interactivity.
Every weekday, Bloomberg puts the spotlight on a different aspect of global finance. Flows, funds, and the forces shaping markets on ETF IQ. The future of money with Bloomberg Crypto. The players behind major transactions on Bloomberg Deals. The stories informing finance with Bloomberg Markets. And rates, risk, and the cost of capital on Bloomberg Real Yield. A different topic every weekday, only on Bloomberg Television.
Making money isn't about drowning in emotions. It's about understanding what's actually happening. Markets are the best way to glean signal from noise, and that is what we try to do every morning. This is Bloomberg Surveillance.
Bringing you the world's business and financial news whenever and wherever it happens. I'm Michael McKee at Mount Everest, and this is Bloomberg.
We're seeing companies really basically stepping back and saying, how do I think about my supply chain? We're seeing a lot of the companies move from just in time to thinking about production resiliency. That by definition means you're going to run a far more expensive and a far more diversified supply chain and a far more resilient supply chain.
That was Shamir Khalik of Citi weighing in on the situation in the Middle East and the shift we've seen for global businesses to just in time. to something very, very different and slightly more costly.
Just in time to just in case, which costs more money and needs a different type of technology. You can't send your money over and wait 3 days for them to receive it if you're dealing with rapid-fire supply chains that are shifting in real time.
Equity futures this morning shifting in real time, positive by 0.2% on the S&P 500, following the biggest monthly gain going back to 2020 on the S&P 500. On the Nasdaq 100, you've got to go back to 2002 for a gain as big or bigger than the 16% gain we got on the Nasdaq 100 just last month. This morning, down 0.1%. Let's get you some single names, some morning movers. Yahira has more. Hey, Yahira.
Hi, John. Apple really blowing it out of the water as the last tech name to report. Shares are up 3.5% in the pre-market, but Apple making it clear that its results would have been even stronger if it weren't for those supply constraints around memory. But Bloomberg Intelligence points out that may be the reason it's making strides in China, since its competitors have had to raise prices due to those higher memory costs. And for that same reason, it is surprising to see these names down in the pre-market. SanDisk and Western Digital both falling, even after delivering a beat and a raise, but the bar was just too high, with SanDisk up 300% year to date, Western Digital up 130%. And we end on shares of Estee Lauder soaring at 11.5% in the pre-market after the beauty giant raised its profit outlook, helped in part by job cuts, announcing another 3,000 today, bringing the total to up to 10,000. John.
Yahira, thank you. Thanks for this morning. President Donald Trump hosting the Artemis II astronauts at the White House this week, the visit coming nearly a month after their historic trip around the moon. I'm really pleased to say that in the studio here in New York City, the NASA Administrator, Jared Isaacman. Jared, good morning. Good to see you.
Good morning. It's great to be here.
The pictures are amazing. I understand it costs a lot of money. Can you explain to all of us what we actually achieved in the last month?
Well, I would consider that Artemis II is part of a much bigger plan. So President Trump, during his first term, created the Artemis program, America's commitment to return to the moon. My first day on the job, he signs a national space policy that says, pick up where Apollo 17 left off, return to the moon, but go back to stay this time, build an enduring presence.
Good luck.
Build a moon base, which, I mean, it's going to be a hub for scientific discovery, economic potential. Maybe we have a lunar economy someday, but it will be the technological proving ground for where we go next, which is Mars. So all part of a bigger plan. Artemis II is just the opening act.
In the period of time, we have changed space exploration a lot. We've introduced commercial space exploration. What does that mean for the role of NASA as we try and achieve these things?
It's interesting. I get that question all the time because there are some new names. You have your SpaceX's and Blue Origins that get everyone's attention. It's like, where does NASA fit in? I remind folks, you go back to the 1960s. You had Boeing, you had McDonnell Douglas built the Gemini spacecraft. You had Grumman that built the lander that put the astronauts on the moon. Many of those players still exist today, but we have some new ones, SpaceX, Blue Origin. NASA's at its best when we are doing the near impossible, what no other agency, company, nation in the world is capable of accomplishing. And when we figure it out, if NASA can be one customer of many, we hand it off to industry and let competitive dynamics make it better, cost less. Launch is a great example right now. Dozens of companies brought down the cost, put mass in orbit materially. NASA recalibrates, like that picture you had on the screen, which was a nuclear-powered spaceship. That's not something industry should be playing with. They don't need to mess around with highly enriched uranium launch, reactors over Earth. That's something that NASA is capable of doing. So we recalibrate again back to the near impossible. The capabilities allow us to explore the outer solar system.
I think about the space race down back in the 50s and 60s and how much that put grants in all sorts of academic centers to try to get up new scientists, to get them into exactly that kind of thing. Is this kind of what we're replicating here?
Well, I'd like to think, and I just told this to Congress this past week, is every dollar you give us, inherent in it is inspiration. So, of course, the rockets, the astronauts walking on the moon, the X-planes, the images that come back from James Webb Space Telescope or our rovers on Mars. But that's not enough, right? That's enough to spark the interest, more kids dressing up as astronauts for Halloween. But we still have a huge grant portfolio that goes out to university. We have a top internship program right now. We take the top 1% of internship applications. And what I like about our moon-based program right now, we're going to have landers on the moon on a near monthly cadence starting in early 2027. We could raid the pantry at every NASA Center for Science Instruments. There won't be enough. So what does that mean? There's kids in universities right now in the United States and across the world that are working on hardware that's going to be on the moon in the years ahead.
There's an argument, why focus on space when we have a lot of problems here on Earth to fix? Can you give us a sense of some of the scientific progress that's coming from some of these programs that has real-world application beyond just necessarily hyperscalers on the moon?
Sure. Well, I mean, first, we've been hearing, this since the 1960s, too. And what I would say, it's a different budgetary environment now versus then. So 1960s, NASA was about 4.5% of the discretionary budget. We're about 0.25% now. So I would argue we can do both. We can make investments into a brighter future for the world we want our children to grow up in, and try and address some of the hardships, the affordability, the challenges of the world we live in today. And does it matter? For sure. Inspiration is a price worth paying for the next generation to take us even farther. Scientific, economic potential. I mean, we go to the moon. What could a lunar economy look like someday? I mean, whether we are 3D printing satellites like you described, or maybe we're mining helium-3 that could have quantum implications, or future fusion power, a source of future fusion power. Not to mention just like knowledge. I mean, what do we stand to learn and gain? We've only just begun this great adventure.
Can you achieve these goals with budget cuts? They're the questions you've faced all through the last few weeks.
Well, I guess, and I'll tell you the same thing I told Congress on that, is you can't just look at the president's FY27 budget request without taking it in combination with the historic $10 billion investment that came from the Working Family Tax Cut Act, that one big, beautiful bill, President Trump's signature legislation. You take that $10 billion plus 26 appropriations plus 27, pond. Like, that is where we are at in this great adventure. It is so early. You've no idea where this is going to take us in the years ahead. And then how do we get there? Well, a space economy sure would be great, because I don't think we're going to have that sci-fi future we imagine with lots of space stations and orbital outposts into Mars base if it's entirely paid for by the taxpayers. So I want data centers in space to work. Why not take advantage of a giant fusion reactor that's already out there? I want, I want us 3D printing organs. I want us making cancer-curing drugs in microgravity. I want all that to come to fruition. We can't force it into existence at NASA, but we can do all we can to ignite it.
You know, when Jared walked into the studio, one of my first questions to him was, you've made lots of money, you've had this great successful life in private business, why do you want to go into government? I've never heard someone so excited in their job in government.
He feels like he can make a difference. I don't know. It's very exciting to hear. I wish I could hear you talk for the rest of the hour, frankly, because to me, this is really the exciting stuff where we can actually innovate and find new places. Do we want to find aliens, though? Do we actually want to find other life? I don't think so.
Personally, I don't.
I mean, why would they be?
No. This is the heart of what we do at NASA, is to answer the question, are we alone?
Okay,
are we?
Are we?
I don't know how across 2 trillion galaxies that we are not. When I have this conversation with a lot of folks, and we have missions out there, right? We launched a probe to Europa called Europa Clipper looking for biosignatures. We're launching a nuclear-powered octocopter to Saturn's moon of Titan to look for biosignatures. And we have samples and tubes on Mars. And if we bring those back, we put it at a better 90%
We're about
chance
to
of
hit the break.
life.
And you know what the conspiracy theorists are going to say? They pulled the plug. They pulled the plug in the late speech.
He was about to say they're out there.
He was about to say it. Jared, thank you, sir.
Absolutely.
Appreciate it.
Thank you very much.
Jared
Great to
Isaacman there, the NASA administrator.
Middle East tensions are high.
Both sides willing to go back to the battlefield.
The narrative changes moment to moment.
Is there a ceasefire? Is there not a ceasefire? Markets are up, markets are down.
Count on Bloomberg for up-to-the-minute reporting.
Breaking news this morning.
Breaking news in the last few minutes.
On-the-ground perspective.
Talking to you from the bomb shelter.
This White House still pushing.
And the analysis you need to make informed decisions fast.
Clearly, nothing is final until it's well and truly final.
The really important question is whether we'll get second-round effects.
Nobody covers geopolitics like Bloomberg.
As an exchange, what can you do to make it more attractive to be a publicly traded company?
Talk to our customers. We spend a lot of time with our listed companies, listening to their concerns, particularly the offices of the CFO, head of IR, listening to their pain points, general counsels as well, and then act as an advocacy group for those companies to really focus on structured reform to allow a company to tell their story in the most efficient way possible and reward them for the good disclosures that they are making in the market.
Is there any sort of financial innovation that you could drive to get more companies to list? Tokenization has come up.
Well, we did announce our tokenization initiative earlier this year. We already built the technology, we've already done a variety of proof of concepts. It allows for instantaneous settlement, 24/7 trading. It importantly allows for the rights associated with a share to move into that electronic form. but is going to be a platform that runs in parallel to our more traditional exchanges.
Yes, we can. So it's a good morning.
My old mentor, Roger Staubach, who told me when I transitioned, football will never leave you, but you need to leave it.
Wow.
Everyone has a dream, and a lot of dreams are, you know, my dream is to play football and play professional football, and you get the dream comes true, but it is going to end. And the day it ends, the day before it ends, you're one of the best in the world. Great. The next day you wake up, that's gone. What are you great at? And the truth is nothing, right? I'm not great at anything else.
I talk about it all the time, Steve, is this whole idea of it's not from penthouse to penthouse. And what I mean by that is you played for 15, 20 years and you're in the penthouse. That doesn't mean that you come to the business world and you're going to be in the penthouse. You don't start in the third floor or the lobby. You actually have to start in the basement.
Bringing you up-to-the-minute space news whenever and wherever it happens. I'm Ed Ludlow at NASA's Kennedy Space Center in Florida, and this is Bloomberg.
All right, we are hovering around all-time highs for stocks on this Friday. 30 minutes till the start of the cash trade. I'm Matt Miller.
I'm Danny Berger. Bloomberg Open Interest starts right now.
Coming up, Apple caps off a massive week for earnings, delivering a surprisingly strong outlook.
At the same time, oil wavers on a report that Iran replied to U.S. amendments on a potential peace agreement.
And Jane Street's pay pool more than doubled, topping its biggest Wall Street rival. We're swimming in cash. But we need it because gas is $4.40 a gallon on average.
Yeah, correct. But people are spending. Earnings are great. People are still buying Apple products, even though it's more expensive for Apple to make those products. That's what I'm looking at the pre-market, Matt. I have Apple shares up just about 3.2%, posting double-digit sales growth, better than expected revenue forecast. And again, Matt, the concern for them was that the cost of hardware, the cost of memory was going up. They have a shortage of Macs. Didn't matter. Sales were really strong.
Yeah, I mean, it's more expensive, but the supply is constrained, so they could arguably still keep pricing power. Chevron and Exxon earnings also beating, actually blowing past estimates as oil prices and production increases helped offset supply concerns due to the war in the Middle East, which, by the way, is entering now its third month, and no one in equity markets cares, right? I mean, 7,200 plus on the S&P 500. The VIX, Danny, is at 16.
It's wild. The VIX at 16, PCE accelerating 70 basis points in just a single month. But a lot of people just point to earnings and just how robust this earnings season has been. Again, Apple adds to that. Let's discuss it more. Bloomberg Tech co-host Ed Ludlow joins us now. Ed, blowing past expectations.
Yeah, but it was such an in-the-moment thing where when they gave the outlook for the June quarter, sales growing 14%, 17%, not just the stock change trajectory, but the entire sentiment towards how Apple's managing. So it's a very clear situation from Apple's point of view. They would say that demand is greater than their ability to supply. It is chips generally that's the constraint, and Tim Cook talked about the lack of appropriate capacity for lead-edge chip manufacturing, and the memory pricing issue is going to continue. And like Apple's always been able to pull levers, right? They're the masters of the bottom line. Margins really held up. But Tim Cook didn't really actually say that much about what they could do to insulate from memory. The main point being that there is a lack of supply on Mac and iPhone in particular, but otherwise strength, right? China was really strong, very interesting, and services continues to compound and add to that growth story.
Did we hear anything on the call, Ed, from the new guy beyond Tim was such a great boss, thank you so much, and we're doing incredibly well?
Yeah, it's like, 4:59 Eastern and everyone's there at the keyboard like, will he or won't he turn up? And he turns up and he goes, I just want to say very briefly that there's a great product roadmap. This is John Turnus, the incoming CEO, September 1st. And then said, but I'm not going to tell you anything about it. And the takeaway, if you read Mark Gurman's writing and the sell-side notes, the main thing he was trying to get across apart from the product roadmap was continuity, really praising of how Tim Cook has been a really disciplined leader, one of the greatest greatest CEOs of all time, he said. So that was kind of the will he, won't he moment, and he did.
And also for all these tech companies, it's remarkable how a private company has been bowling around their share price. We started the week with fear over OpenAI that it maybe wasn't hitting its internal targets. The team speaking to Sarah Fryer, what did we learn?
Yeah, Bloomberg News interviewed Sarah Fryer last night, and she's basically pushing back on that reporting from the Wall Street Journal that OpenAI is not meeting its internal targets. We feel like we're beating our plan at the highest level is the opening of what Sarah Fryer said. And she talks about how in her career as a CFO, and she's been a CEO of other companies, it's really important to have stretch goals. OpenAI has stretch goals. And the metric at the center of that this week, which roiled public markets, was ChatGPT not getting to 1 billion active weekly ChatGPT users. Sarah Fryer did not address that metric specifically in the interview with Bloomberg News, but she said they're running ahead of their highest expectations, right? Codex, the coding agent, is now up to 4 million weekly users as an example. But similar story, right, on the supply-demand equation. She's talking about a vertical wall of demand. And OpenAI has been saying for quite a long time, if they had more compute capacity, and the anxiety is about how much they're spending to secure that capacity, they would be able to offer more features and they would see faster growth. So she stuck to her guns on that one in what's an interesting interview with Bloomberg's Shireen Ghaffari. I really recommend the audience go and read the full thing on the terminal or on .com.
Yeah, definitely a good read. They want to spend still $600 billion through 2030, and they're looking at annual revenue of like 25. So they've got to fund that. Ed, look forward to your program, considering how much is going on, as it is the case every day in tech, but really especially today. Ed Ludlow co-hosts Bloomberg Tech, that kicks off at 11 a.m. weekdays. Now, let's get to the oil patch. Chevron and Exxon also beat earnings estimates as, obviously, higher oil and gas prices outweighed production outages from the Iran war. And in fact, they're bringing more online in the Permian. Joining us now to talk about that is Bloomberg oil reporter David Wethy. So, David, this has been, okay, the shares are down a little bit today, but they have been up year to date, and really a bright spot, I guess a strong result from the war in Iran.
Yeah, exactly. The higher oil prices are definitely going to lift both of these companies. Just a matter of fact, it adds to their revenue. A little bit more tricky for Exxon than Chevron because Exxon has more of its output affected by the Strait of Hormuz closure. Right now, Exxon says about 15% of its global oil production is offline because of the Strait closure. Chevron less impacted, but still they have some impact from the Strait closure as well. So look for both companies to try to use their global footprint to maneuver and reposition other barrels from around the world to try to fill some of the gap. Still not a lot, though. We're going to wait to listen to hear on both calls on how they talk about sort of what the ultimate impacts will be and sort of what this is going to mean for the global market.
Do you think there might be any politics at play, David? Any of these executives basically calling on the Trump administration to try to move to reopen the Strait of Hormuz? Do they have that sort of ear of the president, just given the concern on affordability and gas prices in this country?
Certainly, we know that they have the line into the Trump administration, and even Chevron has said recently that they speak with the Trump administration almost regularly. So you have to know that they're speaking their mind, that they're getting their point across. Whether they're specifically saying open the Strait of Hormuz or other policy things such as do not ban exports. We don't want to limit supplies. They may be sort of saying it in other ways. They may also, be trying to say that we need to open up other areas like Venezuela and try to get other oil barrels out through other parts of the world. So they may be sort of doing a mixture of different ways to try to get to the Trump administration.
David, thank you so much for joining us. That is Bloomberg's David Wethy. And later on Bloomberg The Close, Chevron CFO Amir Bonner will be joining the team. Elsewhere in earnings, Ares reported that it's on track to beat its fundraising record for the year as assets under management jumped 18% year over year. Earnings did, though, miss estimates otherwise, but shares are up 2.2%. Bloomberg Finance editor Catherine Chiglinski joins us now. It's been a tough start to the year for Ares, and I just wonder what we make of the fact that they are still able to bring in so much cash despite all of the headlines.
Well, I think that's a really good sign because we have been so concerned about private credit. There's the lingering woes in private equity, which that was a sore spot for Ares in the quarter. But I do think it's a good sign that investors aren't shying away. And I think that'll be key as we head into next week with Milken on board. You know, I think we'll be hearing from a lot of these executives on like exactly how is it looking now? You know, are investors still willing to come into these funds? Are they still willing to put money behind some of these private strategies? And so far, it looks like from Ares, yes.
Speaking of pulling in cash, Jane Street pulled in like $40 billion in trading revenue last year, and obviously they're paying their employees for doing such a great job, right? What, like $10 billion in pay, bonus?
Yeah, and it was more than double than 2024. You know, I think it's a real sign. Jane Street has risen to the top of Wall Street. I mean, they're outranking their competitors. That pay, if you were to equate it, you know, evenly, which obviously it's not totally divided up evenly, if you were to, that's more than 7 times what Goldman workers get. And I think that's just a shocking reminder of where some of the power, the shifting influence and the shifting power in Wall Street, really.
I love formerly of Jane Street and unrelated to this, Sam Bankman-Fried's investments have been on fire. Like if that guy weren't in prison and hadn't, you know, built investors out of billions of dollars, he would be a king on Wall Street.
Yeah, because he has like all like the OpenAI and Anthropic and all that too, right?
Anthropic, yes, and I mean, it's just incredible to watch. Catherine, thanks so much for joining us. Catherine Chiglinski there covers these finance titans for us. Check on what's going on in the markets after we closed at an all-time high. Yesterday, we're looking at gains in futures. So S&P futures up almost 0.3%. NASDAQ futures not doing quite as well, but that index has been on fire as well. You can see the 10-year yield. It floats higher, another 1.5 basis points today, and now we're getting closer to 440 on the 10-year, incidentally right where we are on the national average for gas. Brent crude right now under $110, but holding right around there, 109.88. So those prices are still elevated, but it doesn't seem to be affecting earnings expectations or S&P valuations. Let's get a look at some of the single stocks on our radar this morning. Roblox shares are down after implementing safety features that ended up slowing user growth.
Estee Lauder, they're planning to cut up to 3,000 more jobs to help boost its turnaround plans, and think, God, they didn't say it was to do some weird AI thing or something like that.
I'm sure there's AI involved. More Moderna shares more than tripled from a year ago, fueled by deals with governments outside the U.S. You can see Moderna up 3% in the pre-market. Tune in, by the way, to the close at 3 p.m. today to hear from the CEO of that company, Stefan Bonsell.
Coming up on this show, day 60 of the Iran war, a key legal deadline hits with Trump's war powers on the line. That's coming up next right here on Open Interest.
This has been Bloomberg Daybreak Europe. I'm Lizzie Burden in London, and these are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
We should not deny that change is coming.
And change is not coming just in data centers and AI. As a world, we are building infrastructure, we're building energy, we're doing energy transmission, we're building next-gen manufacturing, we're ramping defense, and we're doing this thing called AI and data.
Yes.
We will see the largest need for capital ever. And that's what we've seen so far this year. And so now to your specific question, it's about underwriting. There are a number of very strong US tech companies who run diversified businesses, Amazon, Google, Microsoft, who are interested in seeing these centers built and are interested in not consolidating the debt on their balance sheet. And to the extent they are prepared to lend their credit, one can lend against those types of things and make sensible underwriting decisions.
Bringing you up-to-the-minute political news whenever and wherever it happens. I'm Tyler Kendall in Washington, and this is Bloomberg.
Investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Amin, only on Bloomberg.
Get a look at high interest, what's moving headlines around the world. Tesla tallied up Elon Musk's annual compensation for the first time since shareholders approved his moonshot pay package. And it's a doozy, $158 billion on paper. But there's a catch here, and $0 in actual pay because Tesla missed key targets, and the massive pay package depends on stock growth and performance goals. New York City's proposed pied-à-terre tax is sparking a billionaire backlash. Mayor Zoran Mamdani called out Ken Griffin's $238 million penthouse, drawing criticism from Wall Street elites who say the tone, not the tax, is the problem. Griffin is now weighing investment pullbacks as the city aims to raise $500 million amid a budget gap. Griffin met with New York Governor Kathy Hochul yesterday to discuss the tax proposal. Farmers are increasingly refusing to answer USDA surveys, with response rates dropping from about 60% 8 years ago to just over 1/3 this year. Growers say the reports are based on rushed or unreliable data. The USDA warns the decline will weaken accuracy, fueling even more distrust. Officials are exploring ways to simplify reporting and rebuild confidence as shaky data begins to ripple through global crop markets.
Elsewhere, Matt, Axios reporting that Iran replied to U.S. amendments on the agreement to end the war. Joining us now is Bloomberg Washington correspondent Tyler Kendall. So, Tyler, does this get us closer to talks, to more ceasefire, to peace, to anything?
Well, Danny, perhaps some potential progress here, though we should say at this point we don't have any further information beyond that Iran sent this amended proposal to the U.S.'s requests through Pakistani mediators. What we do know is that the U.S. was not happy with the plan that Iran had previously put on the table, which would postpone any dialogue about its nuclear program in exchange for perhaps an interim deal where we could see a reopening of the Strait of Hormuz in exchange for the U.S. lifting its naval blockade. But White House officials made it very clear that any agreement needs to include curbs on Iran's nuclear capabilities, and the leverage when it comes to the blockade isn't going anywhere. Yesterday, we heard President Trump call the blockade, quote, incredible. And in the latest sign that the U.S. is doubling down, a senior administration official tells us that the Department of Justice has initiated the forfeiture process for 2 Iranian-linked oil tankers that were seized by U.S. naval forces the other week. It's not totally clear what this will entail, but it is something to watch because it could signal intent to seize the oil cargoes on board, which would be considered an escalation. Now, that's not the only escalation. There is always the risk for more escalation, as Axios had reported yesterday that President Trump was briefed by senior military commanders about an array of options, including the potential for a short wave of strikes that could maybe help break what has been a deadlock in the discussions. But Matt and Danny, we should say that when he was asked yesterday if he was getting antsy and if he wanted to end the ceasefire, resume those military operations, President Trump said that at this point, nobody really knows where these negotiations stand beyond him and a few key advisors, adding that he has really blamed what has been a lack of progress in the talks on fractured leadership in Iran.
It's interesting that Pete Hegseth would argue we're not still in a war because of the ceasefire. He is a man who I think prides himself on his knowledge of military tradition, and traditionally, a blockade is an act of war, also considered so under international law. Why doesn't the administration want Congress, the representatives of the American people, to be able to weigh in on such an important event, a war in the Middle East that's doubled the price of oil?
Well, Matt, it's a really good point, considering we are at that 60-day mark, which under the War Powers Act would mean that the president needs to seek authorization from Congress to continue the hostilities, or at least request a 30-day extension to safely withdraw the troops. There is some chatter here in Washington and speculation that maybe the administration is going to ask for that 30-day extension. But as you alluded to, it doesn't seem like they're going to do that anytime soon, because Secretary Pete Hegseth is arguing that essentially the 60-day countdown clock has been stalled or halted amid this ceasefire. Now, Democrats on Capitol Hill would argue that we are still, of course, very much engaged in hostilities, and they want to see some sort of curbs put on this war by members of the U.S. Congress. But just yesterday, we saw what I believe is the 10th measure failed that would do just that. Though we can say that for the first time, we saw Republicans one Republican cross party lines and change their vote when it comes to supporting this war. That was Republican Senator Susan Collins. So perhaps we will see some future pressure when it does come to this, because, Matt, we can say, at least at this point, that there has been some murmurings from other Republican lawmakers that for now they are, of course, in support of President Trump's military operation. But when it comes to the administration asking for more funding, when we see that supplemental request for the Pentagon, specifically when it comes to the war in Iran, not the separate $1.5 trillion fiscal year budget request, that is where I would expect to see more Republicans speak up, that they would like to have Congress have a say in how this war is going to go forward.
Tyler, thank you very much for joining us. That's Tyler Kendall in Washington. Coming up, Anastasia Amoroso says that AI monetization is finally taking shape after companies bet trillions on growth. She's going to join us next. This is Bloomberg Open Interest. World's most powerful investors don't ring a bell. They quietly reshape entire industries. This is the money shaping the world, the dealmaker playbook where power and billions of dollars change hands every day. From private equity and credit to venture capital and M&A, we bring you the inside scoop on the biggest deals and debates, plus exclusive conversations with finance's ultimate insiders. I'm Danny Berger, and this is Bloomberg Deals. Every week, only on Bloomberg Television.
Bringing you up to them in the news whenever and wherever it happens. I'm Chevrian in Seoul, and this is Bloomberg.
We're at the epicenter of a global realignment on a scale not seen for decades. At the intersection between markets, economics, and geopolitics, a forum for sophisticated conversation. This is Bloomberg Surveillance.
Welcome to Bloomberg This Weekend. I'm David Burr.
I'm Lisa Mateo. And I'm Christina Raffiti. We're tracking breaking news today from Wall Street to Washington. Let's start overseas. The sector is really propelling this deal forward.
Yeah, the hope is this will open up new markets and provide some additional liquidity.
Of course, now they're going to have competitors. We got a big week coming up in politics.
Earnings season is underway. We're going to get some key reports.
Everything you need to know before the markets open on Monday.
Introducing Bloomberg This Weekend, bringing a little Bloomberg into your weekend routine.
Guys, buckle up.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Anastasia Amoroso of Partners Group says one earnings statement this week summed up recent AI momentum in markets. In its earnings release, Amazon CEO Andy Jassy said, quote, 3 years after AWS launched, it had $58 million revenue run rate. In the first 3 years of this AI wave, AWS AI revenue run rate is over $15 billion. That's nearly 260 times larger. I'm pleased to say that Partners Group Private Wealth Chief Investment Strategist Anastasia Amoroso joins us now. And I guess this just kind of fights back against this idea that the proof of AI isn't here, but it is here. But still we see companies like Meta sell off after their earnings and some shakiness as to just how much they're spending.
It is here. I think there's some differentiation going on between who is actually really benefiting from artificial intelligence and who is at the forefront of being the beneficiary are those cloud computing companies. Those are selling cloud capacity to the Gen AI companies that are really also seeing monetization as well. So, you know, if you look at those cloud revenues, they first of all are expected to grow by 23% this year. I think we need to upsize that number after the reporting season. But what I find stunning is that fast forward to 2029, and if you look at some of the estimates for cloud revenues from the big four then, it steps up to something like $700 billion from 300 or 400 today. So it is meaningful. So, you know, maybe investors have been waiting for the payoff, but I do think it is going to come over a sequence of years.
You know, I read through your notes, and the big number to me is 1.5 trillion. That's the amount of basically AI backlog that you've calculated from basically the four big hyperscalers. It's a massive amount. Tell us about the number, like how you got to it and what it means to you.
Yeah, that's right. Well, the companies themselves reported or stated that, you know, here are the cloud revenues today, but at the same time, there's a number of contracted revenues that are not yet recognized in the current numbers. And that goes back to the point that, you know, investors often ask, well, isn't all of this priced in? And the reality is what's priced in is the next quarter, maybe the next couple of quarters, but typically what's not priced in is the next couple of years. I think that's what the backlog speaks to. And again, that's why we see that 2029 upside.
Is it hard to price in, though, just because these are huge numbers we're talking about and there's a lot of uncertainty? I guess how much conviction can you have around these when these things are changing so rapidly?
Yeah, they are changing so rapidly, but maybe that's the whole point, is that AI is accelerating, as Amazon CEO put it, at unprecedented potential and pace, I should say. And, you know, let me put some numbers around it. Today, we're at about 55% adoption of AI, meaning 55% of U.S. adults use some sort of AI application. And if you compare and contrast that to, let's say, the internet adoption or the personal computer adoption, this time, 3 years into the adoption curve, we're at about 19% adoption for personal computers and about 30% for the internet. So case in point, this is accelerating really, really pretty significantly. And, you know, I think, Danny, to your point is how do we know this is truly going to come through? First of all, we see an increased number of AI tools that are being launched. But the second thing is, if you look at the revenues of some of the Gen AI companies, this year, I believe they're forecasting something like $54 billion in revenues. By 2030, they're forecasting $307 billion in revenues.
Anastasia, we're going to keep you with us. Anastasia Amoroso sticking around. The opening bell next. After an all-time record high on stocks yesterday, this is Bloomberg.
Tariffs, I think, are probably the first time in my career I've had to deal with like a fundamental change in government policy in terms of how we think about how markets work.
The challenge, especially within my supply chain, is now how do you have enough productivity initiatives to offset the increased cost of all the product?
Can you just move your supply chain out of China and into the US or out of Mexico and up to Canada? Is it that easy?
It's not that easy, but we do have flexibility. And we had been, prior to tariffs, prior to any of this, we had been on a journey to diversify our footprint out of China. So probably 2-ish years ago, roughly 65% of our toy and game volume was coming from China. Today, as we entered into 2025, that was around 50%. All we've done is really accelerate the path to get down to roughly, call it 30% by the time we enter into 2027. For us, I mean, if tariffs stay, if tariffs go, it's never good to have so much of your manufacturing base centered on one geography. We think the diversification is good, but it does take a bit of time to get vendors and suppliers up to speed. Quality is a big deal, especially when you're dealing with toys and kids. It's not an instantaneous thing, but it's not also a 5-year, have to build a new plant from scratch.
Middle East and Africa, vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
We are moments away from the start of trading. This is Bloomberg Open Interest. I'm Matt Miller. We're looking at futures that are higher after crossing up above and closing over 7,200 on the S&P 500 yesterday. So right now, this market, you can see futures up 0.3% on the S&P, 0.1 on the NASDAQ, is completely undeterred and really not interested in a war that's extending into a third month, crude prices that have doubled, PCE that at the core is 3.2%, so 60% above the Fed's target and climbing. Doesn't matter because we have low jobless claims right now. We have great earnings, and we have, as Anastasia Amoroso is saying, $1.5 trillion backlog in terms of AI. The CapEx is blowing everybody away. KKR ringing the bell at the New York Stock Exchange. There's Henry Kravis and the team. George Roberts, his cousin, celebrating 50 years, I guess.
Joe Bay, Scott Nuttall, the CEOs, absolute legends.
Yeah,
all gathered.
I mean, absolute titans of Wall Street. I mean, these are the barbarians at the gate. So
Yes.
Very cool. And then Seaport Therapeutics at the NASDAQ. I was looking at KKR stock, and obviously...
this year's been tough.
This year's been tough, not so bad, down 20%, but it's doubled over the last 5 years. So anytime I can get a return like that, I would be happy.
Yeah, and maybe sentiment is starting to change. We'll see. It's the whole private credit thing that's really been weighing on a lot of their shares. They're going to be reporting earnings next week, by the way. In the meantime, we had Apple reporting yesterday after the bell. It's up 4%. It posted double-digit sales growth, a better-than-expected revenue forecast. All of that despite rising memory costs for hardware. And they have just limited output of their Macs, so they're supply constrained too, but there's plenty of demand, Matt, so those shares still moving higher this morning.
Yeah, really fascinating earnings. We also saw, you know, less, I guess, unexpected, Chevron and Exxon doing very well. They did go past estimates, blew past the estimates because of oil prices, obviously, and production increases that are offsetting the supply concerns out of the Middle East. You can see investors, looks like investors taking profit here in Chevron and Exxon because the oil patch has gained about 25% year to date. Let's bring back Partners Group Private Wealth Chief Investment Strategist Anastasia Amoroso. And I'm always curious to know, Anastasia, what your view is on higher energy prices. It's helped, obviously, a big sector of the market. Not a hugely weighted, sector on the S&P, but it's big for like the FTSE and other indexes. What do you think about higher oil prices?
That's right. I mean, I think higher oil prices for now are manageable. And our base case is, yes, this will impact growth on the margin with some global divergences, but the U.S., for example, should remain resilient and certainly no recession in the cards. The reason I say that is, first of all, there's the overall intensity of the economy, which is oil intensity, which is 63% lower than it was in the 70s. I also don't think the Fed is going to respond to the higher oil prices with rate hikes, which is a really key differentiator. And then when you look at the consumer, which, yes, you do have higher, 37% higher gasoline prices, but at the same time, energy represents 5 or 6% of the CPI basket. It represents something like 2% of actual household spending. So for all those reasons, and the fact that we do have, by and large, energy independence in the U.S., I think that's why we can remain resilient.
What does the energy independence do for us, considering the price of crude is set globally, right? So it doesn't matter how much West Texas Intermediate we're pulling out of the ground. Everyone who's a consumer of that has to pay the same that people in Asia or people in Europe are paying for West Texas Intermediate.
Well, I would say it does a couple of things. First of all, it prevents physical shortages. If you are in China or if you're in parts of Asia, you might have to think about actual physical shortages. And that's why in China and parts of Europe, we have seen demand restrictions. We have not seen that in the U.S. So yes, prices are higher, but we don't have physical shortages. The second thing is there's the oil side of things, but there's the natural gas side of things too. And if you look at natural gas prices, and I haven't looked at it this morning, but nat gas prices a couple of weeks ago were below where they were before the war. So that's what energy independence does for it. Make sure that all those things we're trying to fund, whether it's to power data centers or prevent physical shortages, that's critical.
One of the things that was flagged to me by Steve Hove, our quant team here at Bloomberg, was this index he put together that's basically unprofitable companies, but their trajectory is one in such that it looks like they will be profitable. They're getting less unprofitable. And it's trading at all-time highs. This is the index right here. This seems like a really bullish contour of the market because it's not just unprofitable tech, but it's the fact, or unprofitable companies, but unprofitable companies that are improving. What is it about this economy, despite the fact that oil prices are higher, that sentiment's really low, that you can have something like this, that unprofitable companies are outperforming and reaching new time highs?
Yeah, I mean, economy broadly first, and then maybe more specific to the index. The economy broadly, I mentioned the consumer becoming or being resilient, but also you do have a pickup in corporate CapEx. We talked about hyperscaler CapEx, but if you look at CapEx broadly, it has picked up substantially this year. You also have a shifting of capital expenditures from software to hardware, and so all of a sudden you have this manufacturing and industrial engine that's also working for the economy. You also have profitability for large corporations, which is at a record high. First of all, we are outperforming in terms of the earnings season. 88% of companies are beating estimates by something like 10 or 15%. And you have a record profit margin at 13.2%. So it's not representative of the entire economy, but I think it's representative of large drivers of the economy. The index in particular, of course, I'm curious to see what the composition is, but it is also a good sign. And by the way, it's natural, whether it's in private markets or public markets, is you start with an unprofitable company, but if it does have the right secular trajectory and the economic tailwinds, it can move into profitability.
I remember so many people saying that in 1999. I mean, I know this is different, right? But
I can give you several examples of companies that have done that.
The constituents of the index, and to be fair, it's completely different things. It's Bloom Energy, it's Micron. I think I saw Wayfair, Warner Brothers is in here, so it feels really diverse in the type of companies. There's a lot of tech. I mean, CrowdStrike's in there, but it seems like a wide breadth of industries that's kind of succeeding in this way.
That's right, but I think it does tell you that something is working in the U.S. economy, and some of it is cyclical, but some of it is secular. I think what's working in the U.S. economy, we're in actually still the first wave of a three-wave transformation of artificial intelligence, and that's going to produce a lot of beneficiaries, for example, in data centers, in the power sector, and even in the software sector as well. Then back to kind of, I noticed Bloom Energy was in there, back to the energy conversation. Look, a month or two ago, a lot of people would have told you the Strait of Hormuz is never going to shut down, or it's not going to stay shut for more than a week or 2 weeks.
Or
and
it would be
here
catastrophic if it did.
Right, and here we are. But I think the memory is not going to be short on this one. And I think a lot of investors will think, what do we need to invest in going forward, which is resilient, likely domestic energy infrastructure that's diversified and that's powered by multiple sources to produce electricity.
Not wind, though.
Depending on where you are.
Just kidding.
Depending on where you are.
Anastasia, great having you here.
Great to
Thank
see
you
you.
so much. You bring us great intel all the time and
Thank you.
fantastic numbers. Anastasia Amoroso there from Partners Group. Let's get a check on the stock market right now. We're looking at gains once again, up 0.5%, right? 72.47, the level on the S&P 500. I'll walk over here and check out the move screen because the breadth is always interesting to look at. It's strong to the upside, while 3 to 2 gainers to losers right now. So that's a good. Apple continues to rise, up 3.33% after beating expectations yesterday. And you've got Microsoft and NVIDIA on the upside as well before you get out of tech and into drugs. Google on the downside right now, but not by too much, down by about 1%. Amgen is off, also about 4.5%. Qualcomm, Western Digital down. Let's take a look at the industrial breakdown of this on the GRR screen right now. And you can see IT is doing well, which is interesting because the NASDAQ not doing quite as well as the S&P 500. The reason for that is communication services down here. And the energy index is down, the biggest loser of the group after beating earnings. We always used to say at Tucker Anthony, buy the rumor, sell the news, and maybe that's what's happening today, Danny.
It also looks like there's a really good day for software. IGV is up more than 3%. Atlassian had earnings, and that has a lot of short interest, so maybe there's a nice little short squeeze going on in software.
And you had a great software conversation yesterday with the guy who owns a lot of software companies.
Orlando
or
Bravo.
lends money to them, yes.
Yes, the biggest investor of private software companies, and as you'd imagine, is very bullish. Kind of has to be, but he made some good points. Anyway, coming up, Mag 7 earnings show AI demand and spending isn't letting up as it powers the S&P 500 to all-time highs. Mandeep Singh of Bloomberg Intelligence joins next. This is Bloomberg Open Interest.
My old mentor, Roger Staubach, who told me when I transitioned, football will never leave you, but you need to leave it.
Wow.
Everyone has a dream, and a lot of dreams are, my dream is to play football and play professional football, and you get the dream comes true, but it is going to end. And the day it ends, the day before it ends, you're one of the best in the world. Great. The next day you wake up, that's gone. What are you great at? And the truth is, nothing, right? I'm not great at anything else.
I talk about it all the time, Steve, is this whole idea of it's not from penthouse to penthouse. And what I mean by that is you played for 15, 20 years and you're in the penthouse. That doesn't mean that you come to the business world and you're going to be in the penthouse. Now, you don't start in the third floor or the lobby. You actually have to start in the basement.
Tune in to Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm Stephen Engel at Japan's Akasaka Palace in Tokyo, and this is Bloomberg.
The countdown is on. Everything you need to get the edge at the end of the market day. Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything. Middle East tensions are high.
Both sides willing to go back to the battlefield.
The narrative changes moment to moment.
Is there a ceasefire? Is there not a ceasefire? Markets are up, markets are down.
Count on Bloomberg for up-to-the-minute reporting.
Breaking news this morning.
Breaking news in the last few minutes.
On-the-ground perspective.
Talking to you from the bomb shelter.
This White House still pushing.
And the analysis you need to make informed decisions fast.
Clearly, nothing is final until it's well and truly final.
The really important question is whether we'll get second-round effects.
Nobody covers geopolitics like Bloomberg.
Let's get you some top calls. Some of the analyst action we're watching this morning. First up, Hershey gets an upgrade at TD Cowen after beating expectations. The chocolate company says that Ozempic users are driving growth in its mint and gum brands thanks to side effects like dry mouth and bad breath. But there's no way that offsets like lower sales for chocolate because of GLP-1s.
What's the dry mouth is a side effect of GLP-1s.
Yes, and bad breath. So they're like more people are buying.
I got it.
People are burping
I wonder
more.
if they got, like, because of weed, if that's also. Anyway, Morgan Stanley is out with a big upgrade on Caterpillar as it more than doubles its price target on the company, saying that rising demand from data centers is driving strong growth. Who would have thought? Caterpillar's an AI company, but we actually have been talking about it for a while. The firm admits that it underestimated construction demand.
And then finally, there's the Apple earnings. Wall Street is weighing in. Baird, Wedbush, and Evercore say that iPhone demand and solid margins show that Apple is handling cost pressures better than expected.
Staying with tech, Danny caught up with Citadel Securities strategist Scott Rubner about recent market volatility, and he had this to say.
So I think when there is a sell-off, right now it's a buying opportunity, especially in the U.S. mega-cap tech stocks.
Let's bring in Bloomberg Intelligence senior analyst Anurag Rana. And Anurag, I don't know if you saw that yesterday. We had a fantastic day at the Bloomberg House in Miami. Danny and I beating the drum to the race, but then leaving town before the race started. I don't know how that happened. What's your take on tech stocks, on software stocks, on a day when we have, finished a blowout week in earnings for the biggest hyperscalers and Mag 7 companies?
Yeah, I emailed Danny and said, you should tell Thoma to go out and buy some companies because that would really help the sector at this point. So obviously on the software side, Atlassian did well, and that's really helping it. But frankly speaking, when you look at the other cloud providers and even Apple, I mean, you can see the big divergence between what they are doing versus what the rest of the economy is doing. When we look at technology companies that are not these 4 or 5 cloud providers, they are seeing pressure on IT spending, whether that's ServiceNow and, going forward, it could be Salesforce and Workday and so forth. But these cloud providers, because of their AI infrastructure play, are seeing a massive boost to both the growth rates, and they're doing a phenomenal job of managing expenses, which is showing up on margins. So it's a great place to be in terms of a secular growth story, which is all these cloud providers.
Yeah, Atlassian earnings, punishing all the short sellers this morning. Anurag, you mentioned that conversation with Orlando Bravo. You did message me afterwards, so I knew you were listening. So I want to get your take on it. Here's a bit of what he had to say in terms of the strategy of AI versus software, and maybe the lines are getting more blurred. Take a listen.
At the end of the day, many industries are becoming software companies. And now with AI, they're becoming intelligent software companies. And when you invest in these spaces, you kind of move with the industry itself. I think what people are missing is the beauty about software and AI, and they will come together. They will be no difference between either in the next probably couple of years.
So Anurag, one of his big arguments was essentially that for the big foundational models, they need FDEs, they need engineers who can embed with companies. They're incredibly expensive. They take a lot of time and a lot of effort. And so instead, you have these software companies that act as sort of the AI layer for corporations going forward. Is that a fair argument? Is that maybe the future we're looking at for software?
So the point is well taken, and that has been one of our bigger, reasons for still saying the big enterprise software companies will be fine. assuming they can embed the models themselves. The thing is, they are right now accelerating their AI investments to make sure that their products are also intelligent. If they are not, then it's not going to be easy for them to maintain their market share, let alone, show growth down the road.
The 35,000-foot view, I think, from all these earnings, and especially Apple yesterday, is that there's huge demand, whether it be for AI or the highest tech, highest level products, but they have cost pressures from chips across the industry, and they're supply constrained across the industry. To me, that says prices have to rise. Is that your takeaway too?
So, we think Apple needs to raise prices, but at this point, what they're doing is not raising prices and gaining market share. When was the last time you saw 3 consecutive quarters of double-digit growth? They've already done 2, and they've already guided to the next quarter being double digits. It doesn't happen. They grew so much in China, and I think part of that is because they're not raising prices as some of their competitors are. Now, in the case of cloud providers, they have no choice. I mean, it's the incoming, you could say servers are so large in terms of quantity that they cannot manage it and their costs are going up. Apple's managed it well, but in the case of their new product launches, we think the price increases is going to come at the highest end model. So whether it's the iPhone 18 Pro Max or the foldable, I think that's where you will see some of the price increases.
What about at OpenAI? What about at Claude, so widely used by consumers and now starting to see real enterprise usage? What about for Gemini and Grok? I mean, like the consumer price is $20 a month. Does that have to go up? The enterprise price is like $200. Does that have to go up?
See, luckily for both OpenAI and Anthropic, they are private right now. They don't really need to worry about it. As long as they get funding, it's not an issue. Gemini, it's free. In fact, the free Gemini app right now is phenomenal in our view. They have a massive search business and a cloud business to subsidize it. So I don't think that needs to go up. They need wider adoption right now. They need people to use it more in order to make sure that everybody is comfortable with using AI tools in their daily workflow.
Yeah, Anurag, thank you so much for joining us. That's Bloomberg Intelligence Senior Analyst Anurag Rana. Enjoy the rest of your Friday and your weekend. Coming up, Wall Street moves into election betting with the first prediction market ETFs. That's coming up next on ETF Friday. You're watching Bloomberg Open Interest.
Your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
The trading day is about to start.
And you're already looking for that edge.
The Opening Trade brings you everything you need to know as markets open across Europe.
I'm Guy Johnson.
I'm Anna Edwards.
And I'm Tom McKenzie.
This is your Opening Trade.
Only on Bloomberg.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacqua, and this is The Pulse, every weekday only on Bloomberg.
Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate.
More than what you need to know, it's what you need to think about.
This is Bloomberg Open Interest. I'm Matt Miller. Let's take a look at the new highs we're reaching in stocks right now. 72.50 is the level on the S&P 500, a gain of 0.5% after locking in a new closing high yesterday. The NASDAQ up 0.75%. So now the NASDAQ doing better than the S&P. 27,660, the level there. So just continues to fly higher as corporate earnings and especially earnings from tech power this market higher. In terms of crude, actually down 1.2%, so that's good news, I guess, for equity indexes, for equities, not for Exxon and Chevron, which are now both trading unch, but NVIDIA's trading unchanged as well, so not a drag. Apple up 5%. Offering some upside there. And we see Ares right now down 1.1%, even though they've taken in a huge haul, continue to. Moderna off 3% as well. And we're going to hear from the CEO of Moderna, I should point out on the close. Stefan Bonsell is going to come on and be interviewed by Romaine and Katie, so I'm looking forward to that.
As am I. And Matt, it's also Friday, which means it's ETF Friday, and Wall Street is taking election betting mainstream with plans for the first ETFs tied to political outcomes. Joining us now is James Seffer, ETF analyst for Bloomberg Intelligence. James, great to have you in studio. Great to see you.
Thanks for having me.
So what, some of these are coming next week. How do these vehicles even work? What are they essentially betting on and buying and selling?
So the first ones that are coming to market, one, they're from 3 issuers. So Round Hills looks like they're going to be the first out, but Bitwise has filed, and so is Granite Shares. And they're essentially going to be bets on political outcomes. So are the Democrats or Republicans going to win the House or the Senate or the 2028 presidential election? So, and it's just going to be like prediction markets. Either it's going to go to 100 or it's going to go to functionally 0. And you're going to be able to do that through an ETF rather than going to something like Kalshi or Polymarket or other.
It's hard to understand how it works, especially if it goes to 0. I mean, how does that circle get squared?
I'm sure that's what they've been dealing with the SEC for the last few months since they filed it. So if you look in these documents, there's like in all caps, if your market doesn't win, it will go to like substantially, you'll lose substantially all of your money. It won't go fully to 0 because they're going to keep these ETFs around. So after, say, the midterm elections in 2026, if Republicans win, it will go basically to 100, right? And the Democrats will go to theoretically 0 on whatever it may be. And what will happen is it will go into treasuries after that election happens. So once one wins, so it will give you time to get out of the fund, and it's going to reset to the next election, because if you're putting all this time and money to launch a ticker, build up liquidity, build up branding around a ticker, you don't want to just give it up. So I think what all these are going to do is they're going to stick around and just sit in treasuries for a bit for people to either hold on to it or trade out of it.
There's been a lot of scrutiny on betting markets, on insider trading, and weird things have happened. I mean, to be fair, all markets, like it happened in oil markets. But if you're now doing this in an ETF wrapper, does that change the regulatory profile of this? Because ETFs are more regulated than kind of the Wild West of prediction markets.
Yeah, I mean, if you look at Kalshi and Polymarket are all figuring out about exactly what insider trading is. There's been some high-profile cases of people getting caught insider trading on these markets. The SEC is going to be on top of this, I'm sure. I'm sure this is something that they've been discussing heavily with these issuers. But they're working in partnership with the SEC and CFTC. I mean, on the other regulatory thing, like I don't think we're going to see like sports betting prediction markets come into an ETF, but we're going to see this category grow.
Well, why not? You don't think that's going to happen?
Why not? Why would we have like election ones and not sports betting?
Because that's not as controversial. I mean, maybe we will. I mean, I can tell you ETF issuers are probably going to try, because they will throw spaghetti at the wall and see whatever they can get, and they will push the limits.
We get like a weird like 3 times levered inverse like Nick's ETF or something like that.
Yeah, I mean, it could be out there. I mean, obviously you have the CFTC chairman that is very much on the prediction market side of this thing when it comes to states versus betting markets and things like that. But at least for now, all these things that have been filed are tied to financial markets, economics, things along those lines. You can make a very hard argument that like what's happening in these elections is impacting
the world's become
markets.
A casino.
Yeah.
It is what it is, right? As the president says. James, thanks so much for joining us. James Seyfert there of Bloomberg Intelligence. Tune in to ETF IQ, by the way, and watch Eric Balchunas, Katie Greifeld, Scarlett Fu take you through the asset class in an hour starting Mondays at noon. Coming up the next hour, Emily Rowland says mid-caps are growing attractive. Plus, we'll talk surging fuel prices with the boat maker.
anytime you have an industry that grows like that, there will be pockets where things are more difficult. So if they're smaller companies, it's harder to deal with tariffs, it's harder to deal with labor and with rising interest rates. So there you may see some poor performance. That doesn't necessarily mean that lenders will lose money, but it may be more difficult. And then pockets of software, everybody's been worried about how will that play out. I think there was a lot of capital that was put in from very smart private equity and very smart institutional investors into software really in the 21-22 vintage that was pretty highly priced. And that, as that works its way through the system now 4 or 5 years in, you may see pockets there. But I also think that the need for income, people want income in their portfolio, and they can get that in many ways. You can get that from the treasury market, you can get that from a bank, you can get that from high yield right now is pretty good. High yield has very little exposure to software. And then you can get it from private credit where you maybe get more return and a little less liquidity. And so that, I don't see that going away. In fact, I see investors wanting more of that and wanting it from real estate, wanting it from real assets.
Astonishing day for US technology.
Shaping the region's technology ecosystem.
Asia's biggest tech news and innovation.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg.
$4.40. That's the average price for a gallon of gas right now in the U.S. According to Gas Buddy, that makes today the most expensive Friday since 2022 to fill up your car. A new ABC News Ipsos poll shows Americans are feeling bad about their finances, with around half expecting gas prices to increase even more over the next year. Brenda from Texas is retired, but tells ABC News she's had to return to work to try and keep up with all the rising costs.
There's nothing left, even doing cash jobs under the table to supplement my income. There's nothing left to even put into savings. I mean, I run out of money before I run out of money, so.
Today marks 60 days since the start of the war in Iran. Under the 1973 War Powers Act, the president is obligated to go to Congress for authorization of any war effort that lasts longer than that amount of time. But yesterday, Defense Secretary Pete Hegseth said the ongoing ceasefire with Iran pushes back that deadline.
A senior administration official doubling down on what Hegseth said, insisting that the April 7th ceasefire has paused the clock. But our military is conducting a blockade of Iranian oil, and a blockade is considered an act of war under international law.
ABC's Martha Raddatz. After a $375 million judgment returned by a jury in New Mexico, Meta is now threatening to take its ball and go home.
New Mexico's Attorney General Raul Torres says his state's demands of Meta are not unreasonable.
Stop infinite scroll for underage users. Stop autoplay. We know those addictive features are really having a harmful impact on kids.
In a statement, Meta says it's met many of the state's demands. At the same time, quote, we may have no choice but to remove access to our platforms for users in New Mexico entirely. Jim Ryan, ABC News.
You're listening to ABC News. King Charles and Queen Camilla have wrapped up their first official state visit to the U.S. as king and queen. While on the trip, the royals paid their respects at the 9/11 Memorial in New York. They celebrated America's 250th birthday in Virginia. And President Trump also agreed to end the administration's tariff on Scottish whiskey. ABC News Royals contributor Victoria Murphy says it's all being received quite well across the pond.
I think what the palace wanted to get across is that this isn't just about the government of the day. This is about that long-term relationship with all of the American people. And I think really the genius of King Charles's speech to Congress is that it somehow seems to have pleased almost everyone.
President Trump continues to push for regime change in Cuba after cutting off oil shipments to the island earlier this year. ABC's Matt Rivers is in Havana.
No one act from the administration has been more impactful than this ongoing oil embargo. It is essentially choking the Cuban economy of the oil it needs to run everything from cars to buses to even its power plants. Rolling blackouts are the norm. Cuba's famous classic cars that you see take tourists around the city are all but not moving because gas is so expensive.
Last week, Cuba's president vowed to resist any military aggression from the U.S. And in Seoul, South Korea, thousands gathering for annual May Day demonstrations calling for higher wages and improved working conditions. I'm Mike Dubusky, ABC News.
This is Bloomberg Intelligence with Scarlett Fu and Paul Sweeney.
How do you think the Fed is looking at tariffs, the uncertainty of tariffs?
Let's take a look at the sectors and how they performed.
A lot of investors getting whipsawed every day by news events.
Breaking market headlines and corporate news from across the globe.
Could we see a market disruption, a market event?
Are people just too exuberant out there?
You see some so-called low-quality stocks driving this short-term rally.
Bloomberg Intelligence with Scarlett Fu and Paul Sweeney on Bloomberg Radio, Originals and the Bloomberg Business app.
Good Friday morning from the Bloomberg Interactive Broker Studio in New York City to our worldwide audience. We're streaming live on YouTube and on Bloomberg.com/video. That's where you'll find us. Scarlett Fu and Paul Sweeney, we're live here and bringing you the Bloomberg Intelligence program. Coming up, we're going to break down the ISM data came out for manufacturing. I'm going to call it, I don't know, a little bit weaker than expected, maybe even some inflation coming through there. So we'll break that down. Coming up with Susan Spence, ISM Manufacturing PMI Chair. We're also going to check in with Nadia Lavelle, Head of Global Equity Strategy at Global Wealth Management at UBS. Rob Barnett, Bloomberg Intelligence Senior Energy and Commodities Analyst, talk to us about what we should think about looking at global oil. We have oil off today. We've got WTI crude oil off about 4%, sitting right at $100 a barrel. Where do we go from here? And then for me, this is the conversation of the day. Gene Munster, managing partner at Deepwater Asset Management, one of the leading technology analysts on Wall Street for decades. We'll get his thoughts about what we saw from some of the big tech companies this week, including Apple, that reported last night. Apple stock is trading up nicely today, the best since August, up about 4 or 5% here. So, but right now, let's go to that ISM data, the headline data point. ISM Manufacturing came in at 52.7. Scarlett, 53.2 was the consensus, 52.7 last period. Susan Spence joins us here, ISM Manufacturing PMI Chair. Susan, what do you make of this data for PMIs?
Good morning, Paul and Scarlett. Appreciate you having me on. We are indeed a little bit under consensus at 52.7. We are holding steady with last month. Right now we want to remember we're in the fourth month of an expansion trend. And new orders did have about a 0.5 point gain. The big news to me, besides pricing, which we'll get to in a minute, even though we're still in expansion and backlog and new orders, some of the demand indicators, that rise has slowed down a bit as compared to the last month or so. My concern is that we still have the uncertainty of the Iran war. A number of our panelists have talked about that. But we also have a price index that's up to 84.6. That's the highest in 4 years. And if you add up the price index just since the beginning of the year, we're up 25.9 points. 2 months of that, or let's just say 6 weeks of that, was pre-war. So the concerns are with inflation. My concern is that on top of all that data, the employment index is stubborn. It is not rising above 50. In fact, it lost 2.3 points this month. It's down to 46.4. So the concern I have is that the last few months of expansion are at risk. Prices is just the latest one, but we don't see folks making a big move to reverse the non-hiring trend. We're still in a low hire environment. So I'm a little worried that that could erode the expansion we have seen.
Okay, so there's definitely a fly in the ointment here. When it comes to prices paid, and you pointed out how it's climbed for a fourth straight month to a 4-year high, does that tend to have any predictive quality for the manufacturing index overall? Does higher prices tend to lead to a slowdown in manufacturing?
I don't believe it does in and of itself, but when you couple it with the lower employment still in contraction, when you couple it with almost a 12-month, history of, declining orders, that worries me in total. I believe that if we had not been in the war situation, that we might have started to see the effects of the tariff, especially with the Supreme Court ruling, start to mute a bit. And indeed, not as many panelists are citing that as issues. And there was some optimism in our December forecast with about a 4% revenue pop. We'll see. We're about a week away from publishing the mid-year. So I think it's the factors on top of everything else, and almost like a perfect storm. So we aren't panicking for sure. We're just really would love to see the expansion continue, even if it's a whole lot above 50.
All right, Susan, really appreciate your joining us. Susan Spence is chair for ISM Manufacturing PMI, joining us, of course, from the Institute for Supply Management. Let's get over now to John Tucker for our Bloomberg Business Flash.
Right now, we are higher. 6 of the 11 major industry groups in the S&P 500 up right now in the early going. On track for another record close. The month of April, the S&P 500, a 10% pop, just passing our month of April. Information technology, best performing major industry group right now in the S&P 500. That is home to, you guessed it, Apple, up over 4.5% after their earnings report, and we'll take a deeper dive into that in just a minute. Clorox actually is the worst performing individual stock of the S&P 500. It was down close to 10% for Clorox, the household products company, cutting the adjusted earnings per share guidance for the full year. A lower guidance missed the average analyst estimate, too. And then best performing individual stock in the S&P 500, you have CBOE. This is the financial exchanges operator. They are cutting 20% of this. I love these stories. They're cutting a huge portion of their staff, and the stock goes up. Investors love it. It posted a higher revenue, also raising its full-year sales outlook. S&P 500 up 56 points. Intraday record here, up 0.8%, 72.65 of the index. The Dow up 271 points. NASDAQ Composite Index 276 points higher right now. That's a rise of 1.1%. Oil lower right now. Brent down 2.6%, 107.52. WTI, American crude, down 4.5%, still above 100, 100.25 for WTI. Diageo betting bid on canned cocktails. The new CEO betting big on canned cocktails. Really? All part of the strategy to revive growth. Now, single-serve cocktails have soared in popularity, appealing to younger folks. My interpretation is young people are so lame that they don't know how to don't know how to mix cocktails like professionals like Paul and I.
I was a bartender for many, many years.
Yeah.
That's how you roll. And you have to start with the ice. And I hate when bartenders will mix a drink and then put ice in. Like, where were you trained?
Yeah, no, you don't do that.
Who raised you?
In the Mad Men days, Sally Draper would make the cocktails for her parents.
Well, that's...
exactly.
Yeah.
While wearing the cellophane thing from the dry cleaner.
Yeah. See, we give you practical advice here. Yes. I give you stocks. All right, so what? How to mix a drink. We check the markets for you all day long. Right here on Bloomberg Radio. I'm John Tucker. That's your Bloomberg Business Flash. Happy Friday, Scarlett and
Yeah,
Paul.
we're talking about making drinks.
We're all in a Friday mood.
Yeah, exactly. And John Tucker did not get the memo about wearing the Bloomberg Intelligence quarter zip.
No, I have. Well, this is the Bloomberg
the media.
Yeah. Okay, all right.
You can get more specific,
Okay.
And the zipper's been broken for months. I tried to get a new one. Apparently, they're out.
All right, I know a guy. I'll make a phone call there.
All
John
right.
Tucker, thank you so much. Appreciate that. As John was just reporting, we got green on the screen here, but let's take a look at what's happening with some individual stocks. We do that with Avalon Purnell, equities reporter for Bloomberg News. Avalon, what are you looking at today?
Well, we have to start with Apple. That's ticker AAPL. Currently up
5.6%, most intraday since August. And that's after the tech company reported second quarter results that were way above expectations practically across the board. It also delivered a pretty surprisingly strong revenue forecast for the third quarter. That's despite warning that memory chips are continuing to increase in cost and that Mac shortages could linger. JP Morgan's writing that Apple cleared the margin hurdle again as product momentum and supply management continues to drive robust shares gains.
My favorite stat from the earnings is the fact that Apple's going to buy back up to $100 billion of its own stock. I mean, the numbers are just, they boggle the mind. They boggle the mind. All right, next up.
Roblox. So definitely not as positive of a story here. It's sinking 18% to hit the lowest intraday level since 2024. That's after the firm reported daily active users for the first quarter that fell very far below expectations. It also slashed its full year bookings forecast and issued second quarter guidance that fell below expectations. That's all coming after Roblox implemented several safety features that are restricting how kids can use the platform. They faced a lot of scrutiny in the past couple of months and years over those child safety issues and have even reached some settlements, but Jefferies is writing that while expectations were already very low going into the print, the forecast miss will continue to fuel the bear case for the stock.
All right, I'm going to throw the old guy card on the table. I'll do it for John Tucker as well. I don't know what Reddit is. Can you explain what Reddit is? And then tell me about the stock.
I mean, Reddit is an online forum, so that's ticker RDDT. So
Online
basically,
forum.
you can go onto any question that you could ask.
What's a thing you like to read about or you wonder about?
I'm not a
There's
deep
not
guy.
much anymore.
I kind of know everything I need to know.
I know everything, Paul Sweeney says.
Our brains are maxed out at this point.
So much bandwidth I have. But it's okay, so it's a thing, it's a forum, it's a stock as well. What's going on?
It is a stock. It is currently gaining 9.5%. That's after the firm beat sales expectations again on continued ads growth, and that continues a really long streak of revenue growth for the company. It also issued a sales forecast that outpaced estimates. Evercore writing that Reddit's revenue growth continues to be hard to beat. And also worth noting that Bloomberg had a great interview with Reddit's COO that said it's still in active discussions with Google and OpenAI about next steps related to its current licensing agreements. So that's also potentially could lead to some upside.
31 billion market cap, so it's a real...
It's a real business. I mean, okay,
so what do I do with... How do you use Reddit? What do you do?
During the TSA shutdown or the time that they weren't paying TSA, I would go on Reddit because I knew I had to take a flight, and they would point out how long the lines were, and they would take pictures of like Terminal 5. Other Reddit users,
And they're all
Redditors.
generally anonymous.
Redditors?
Yes.
John?
Yeah, no, it's similar to the traffic app that I use, like the Wazers.
No, it's
like
not.
the
It's
Wazers
not.
all over the place.
It's
and
not.
like,
It's
not. Okay.
It's really not.
All right. I was trying to make a connection here. I was trying to be hip. I guess I'm not.
So is there a Reddit
Forget
app?
it.
Yeah, there's a Reddit app, and there's all these subreddits, these threads, and any topic you're interested in, I guarantee you someone has written about it extensively, and they
But
do
who are
deep
these-
dives.
Do I believe these people?
You don't have to, but you can.
Okay.
I mean, do you believe anything you read on social media?
True. That's why, yeah, all right.
I mean, some of the people who are posting on there, they're not going to be posting about the lines at JFK with great detail about their own experience unless they did it themselves. No one is that
Avalon,
bored.
how often do you interact with Reddit on it?
Well, my siblings are really into Reddit. I don't go on as often, but like sometimes when I'm just looking for restaurants in New York, they have some really good reviews.
But what's the advantage of me like posting on Reddit about the
Okay,
line
I'll
is
give you
too
an
long?
example. When I was trying to apply for my Taiwan citizenship, I went on Reddit, and everyone has all these best practices and like tips on how to do it, and that was really, really helpful. No one else
what's
will
in it
publish
for
that.
them?
No, they went through the experience, so they're sharing what they learned. It's been super helpful on that front.
Okay.
So it's
John
almost a
doesn't wanna share.
substitute for Google search? It's another way to get information?
Yeah, it's another way
Just
to
from
get
other people,
information.
crowdsource information?
Crowdsourcing, yes.
Okay.
But like very narrow topics.
Okay, very good. And it's a stock, or as Tom Keene would say, it's a podcast. So there you go. Avalon, thank you so much. We appreciate it. We learn something new every day. John, we got to be open to new ideas, John. And so when someone like,
You could
Avalon
go on
comes
Reddit
in,
and look for Dutch doors. I
Oh,
guarantee you there's a
man,
subreddit
It's
for that.
already installed. It's already painted. It's already
lost
up. I don't
interest.
care anymore.
He's moved
No,
on.
if I'm going to give you information, valuable information, I want to get paid. I want to be compensated for this.
See?
Don't you want the love
And
from the
fucking
community?
Reddit's benefiting from my information that I give them?
Yes.
And you can benefit
No.
from the rest of the Redditors.
Then they should share stock with me or something.
All right, Avalon Purnell, you can leave. You're dismissed. You're excused. You get out of here. Why? You possibly can, Avalon Purnell, equities reporter for Bloomberg News. Looking at the markets here, we've got green across the stream, pretty much across the board here. Really rallying here in the cash market. The S&P up 58 points, 0.8%, and the Nasdaq doing even better, up about 275 points, 1.1%. It's a pretty solid moves for a Friday. This is Bloomberg. Good morning.
Markets, headlines, and breaking news 24 hours a day at Bloomberg.com, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
And I'm John Tucker in the Bloomberg Newsroom with this Bloomberg Business Flash. We're being brought to you by IBKR. Trade, election, climate, and economic outcomes with IBKR prediction markets right alongside your stocks and options. Earn interest on your position. Receive $1 per contract if you're right. Learn more at ibkr.com/predictions. Well, we're adding to the records for the S&P 500, 62 points higher right now, up about 0.9%, 72.71 on the index. The NASDAQ, 303 points higher, a rise of 1.2%. And the Dow Jones Industrial Average, 307 points higher. That is up right now 0.6%. Some of the movers right now, shares of Apple, that's helping lift the indexes right now 5% higher after the earnings report they delivered after the close of regular trading. That's actually the best one-day performance since last summer for Apple stock. Then you move right along to the earnings from ExxonMobil and Chevron. They did have cited some production problems from the war with Iran, but made up for that in other places. But the shares are lower. ExxonMobil down 1%, Chevron down 1% as well. Roblox lowering the forecast for full-year bookings, and they attribute the change to the aggressive push to enhance safety, as they put it, like it's a problem. They projected another quarter of user declines. Roblox right now down 17%. And the Institute for Supply Management's gauge of prices paid for manufacturing inputs climbing for a fourth straight month. This is a 4-year high. The inflation pressures may eventually lead the manufacturers to hike prices that you pay. We check the markets for you all day long right here on Bloomberg Radio. I'm John Tucker. That's your Bloomberg Business Flash. Paul and Scarlett.
All right, thank you so much, John Tucker, with our Bloomberg Business Flash. So stocks are at a record high. It's the start of a new month, and we have earnings to thank for a lot of that. Nadia Laval is head of Global Equity Strategy, Global Wealth Management at UBS, and she joins us now for more on this. It feels like geopolitics has kind of gone out the window in terms of a driver in the market. Sometimes you get good news, like the fact that Iran has delivered a new proposal to the U.S. for ceasefire talks, and then it moves the market. And when there is bad news, it doesn't seem to move the market. Is the focus now entirely on earnings and geopolitics are now by the wayside?
I would say I would agree with that to some extent. Like the ongoing earnings season is going better than even our above expectation numbers. You know, we were looking for 17% EPS growth for the quarter. We're coming in above that. And so that's re-underwriting the strength of the U.S. economy and the strength of corporations in the U.S., and that's why you see the market continues to rally. But that said, you know, we do think that there's more upside to this market, but our base case is now more top to grind higher. It's not necessarily going to be as much of a straight line up from here. We do still think the S&P 500 can get to 7,500 later this year, supported by that strong earnings. But as you noted, there is still this looming in the background around oil-driven headline risk, and that could cap the upside near term, and as well as a Fed that remains on hold. So I would expect to see some volatility pick up around these headlines, especially after the earnings season gets behind us, and the fact that you also have a fairly concentrated performance in terms of quality growth and AI links. So still constructive on the market, but the rally could lose some steam the longer we see the flow of energy gets disrupted. But right now, the market focus is on earnings, but in a couple of weeks, we could see that shift.
Nadia, this week we had on Wednesday afternoon, big four tech companies report results, the Microsofts and the Amazons of the world and all that type of stuff. We had some winners, such in Google, and we had a loser in Meta. And that kind of goes to how investors are thinking about AI as an investable strategy. How are you guys at UBS approaching it these days?
Yes, you know, we are very much positive on the AI, and I think the earnings season sort of re-underwrite that, but selectivity still remains key. As you noted, there's differentiation among some of the players. We are seeing, and I think some of the differentiation is coming through from, you know, are you starting to see monetization and return on some of those investment in those companies that are doing that? You are seeing the market applaud that and strong performance from the stock. So you're seeing momentum in cloud growth and companies that are continuing to point to that demand is outstripping supply. And then, so that gives us confidence in the AI story. You have a company like Google where backlog nearly doubled. And so that's helping to encourage that CapEx budgets moving higher. And so the markets will reward CapEx budget moving higher. If there's a link to monetization, you're seeing, you know, the hyperscalers expected to spend over $700 billion this year in CapEx. And how we're thinking about positioning in AI at UBS is really we're focused on those that are beneficiaries of the CapEx, so the enabling companies, so think about the semiconductors, the storage companies, the networking, and all of those that are involved in the data center build-out, as well as supplying the power. And then in areas as well as those platform and application companies that are starting to see the monetization. I think this is the key distinction here.
It's clear that earnings are the driver here. You've made that point, but we have gone past the big tech earnings. We've gone past the big bank earnings, and it'll be a couple of weeks before we get a readout from the retailers. So what's the next trigger? What's the next catalyst if we're still looking for stocks to maintain these highs to send us even higher?
I really think that it has to be, the sort of some clarity around the Strait of Hormuz and the reopening of that. I think that could, it's the cleanest path to pushing this market up higher. But even so, even though we don't get the retail earnings, the bulk of them until later in the earnings season, you are getting some consumer earnings, right? And so far what you've seen is the consumer being resilient, despite the fact that you have high energy prices. You're seeing it from some of the retailers that have started to report, the restaurant companies, the staple companies, generally steady traffic and comps, and managements aren't really seeing any sort of broad-based slowdown. I think, though, like, the debate is going to be around the cost side, and so if we're starting to see margins get squeezed, I think companies right now are struggling with the fact that you have higher energy prices and potentially higher input costs, whether that's freights, packaging, or petrochemical, and of course, those tariff-related costs. At what point do those need to be passed along? And so we'll be watching margins very closely. But I think that the cleanest way for a more upside to this market will be through the energy sectors in terms of the easing of the disruption of the flow of energy in the Strait of Hormuz.
Nadia, thank you so much for joining us. We always appreciate getting a few minutes of your time. Nadia Lavelle, head of Global Equity Strategy in the Global Wealth Management Group at UBS. Full disclosure, I'm a client of UBS. I was a client of Credit Suisse, and then they made the genius decision to get out of wealth management in the U.S. the same week that Morgan Stanley doubled down on that strategy. Doesn't that show you the difference between Morgan Stanley and Credit Suisse?
And look at where Morgan Stanley's wealth management is now.
Exactly. So I've been happy over there at UBS. Let's get back to the energy story, the oil story. It's front and center. We've got oil pulling back today. WTI crude oil is down about $4.30. That's over 4%, sitting right around $100 a barrel. And just put it into context, folks, if you remember back to right before the war, it was like $60, maybe even a little bit below 60. We traded there for a while. So that's the kind of the war premium, $40 that's in there. Rob Barnett joins us here, Senior Energy and Commodities Analyst for Bloomberg Intelligence. He's down there in the Miami office. Absolutely the best hair in the global energy space for sure. Rob, what's your view here of kind of where we go for oil? Let's just say over the weekend, cooler heads prevail. Somebody says, okay, we'll agree to a ceasefire here. What would oil do then? To what extent would it come back down to maybe more pre-war levels?
Well, I love the idea that we get a ceasefire. That's good, would be good news for everyone. But reopening Hormuz is not going to be the same as normalization. I think even assuming we do get a ceasefire, I think there's going to be reticence from insurance companies, ship owners to move through the strait. So normalization and reopening aren't the same thing. And so I do think you have to think about a higher floor. You mentioned being at $60 a barrel, prior to the conflict at the start of this year. We generally see kind of $80 to $100 range as being where we're likely to be this year. Now, of course, if we stay with the status quo, where the strait remains sort of mostly closed, occasionally open, we could be in the $100 to $130 a barrel range. And if we see an escalation, prices could go significantly higher from where we are today.
Yeah, I think it's notable that even Chevron and Exxon really weren't able to give any forecasts with precision because they have no idea what's going to happen with the Strait of Hormuz. Rob, we also got an announcement this week by the United Arab Emirates to leave OPEC. Does that have any impact on the price of oil?
Not in the near term, right? It's all well and good to have this idea that if UAE gets some normalization and can actually access the strait, I think their intention is clear. They want to produce more than the OPEC quotas would have allowed them. They potentially could add something like an additional 1 million barrels per day to the market. But I think you have to think about that in more of an equilibrium context, well beyond the next few months, probably into next year. So ultimately, it is an increase in supply that you could see coming from that country, helping to sort of pad the supply-demand balance. But I wouldn't put too much stock in that coming anytime soon.
Hey, Rob, I think most folks feel like, all right, eventually the strait's going to be open and the oil will begin flowing again. But I guess one of the things we don't really know is how much of the energy infrastructure, the refining infrastructure in that region was damaged during the various attacks. What do we know? What are your sources telling you?
Yeah, it's a really good point. I think, and this comes back to this idea that even once, assuming with ceasefire holds, we get traffic flowing through the strait, it is going to take time to get the barrels flowing again, and especially on the gas side. We've got more visibility there. We know Qatar's main export facility was damaged, something like 15–17% of the output could be constrained for the next few years. I think they gave a 3 to 5 year estimate. We do believe it'll come back faster than that, but that's not the only damage. So I don't think, even if you had the magic wand, you got a peace deal, these things don't snap back overnight. And I would just say it's not just the oil and gas infrastructure in the region. You're seeing a big reordering of capital. If you're looking at Chinese exports of solar panels, hey, you're seeing those tick up. Where are they headed? To Europe. They're trying to insulate themselves from this gas price spike that they've seen over there.
Yeah, it's definitely much more urgent for those in Europe and those in the rest of Asia. Rob, always a pleasure speaking with you. Rob Barnett, he is our go-to guy, senior energy and commodities analyst on here at Bloomberg Intelligence. He too is in Miami. How come all our oil guys are in Miami?
His desk is in another part of Florida, but he's down there with Mike McGlone every once in a while, creating all kinds of trouble in the energy markets.
Confab there.
Yes. So, but he knows what he's doing.
Bloomberg Intelligence as a whole, the radio show, we need to go somewhere warm.
We do, and I'll put a ticket in for that and see what we can do here. But
see if anyone listens.
Exactly. All right, looking at the markets here, we have gains on the screen here today. The S&P 500 is up 46 points. That's 0.6%. The Dow's up 220 points. That's about 0.5%. And the Nasdaq leading the way. It's up 200 points, about 0.8%. The VIX solidly below 17, that Tom Keene quote there. 10-year Treasury yields 4.35%. Bitcoin, it's up a couple of percent, 78,000. How about that?
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, Bloomberg Television, and the Bloomberg Business app. This is the Bloomberg Business Flash.
And I'm John Tucker in the Bloomberg Newsroom with this Bloomberg Business Flash. So let's start with Apple. Biggest intraday gain since August for these shares. They delivered a pretty strong revenue forecast for the third quarter. Surprised a lot of people who cover the stock. Right as pullback paired some of the earlier gains, up right now 4.2% for shares of Apple. John Turner is going to take the reins from Tim Cook September 1st. He appeared briefly on the conference call last night saying he's going to maintain Cook's thoughtfulness, deliberations, and discipline. Energy, worst performing major industry group in the S&P 500. As oil declines today, there are reports Iran delivered a new proposal to the U.S. We have Brent down 2%, 108.15. WTI down 3.5%, still above 100, 101.32 for Brent. And Reddit climbing after projecting sales in the current period that surpassed estimates. Estee Lauder planning to cut as many as 3,000 more jobs and generate a further $200 million of savings. They're trying to boost their turnaround plans. And then you have Moderna, the first quarter sales, though, beating expectations. The vaccine maker, they faced all sorts of resistance from the Trump administration. They have found new growth actually outside the U.S. S&P 500 up 40. Up 0.6%. That's an intraday record, 72.49. Same thing for the NASDAQ. NASDAQ Composite Index, 192 points higher. That is up 0.7%. From the March low, NDX?
Yep.
That's a 20% pop.
Nice.
So, we'll take it. All of April for the S&P 500, that was 10 points. 10% rather. Dow Jones Industrial Average up 143. That is a rise of 0.3%. I haven't been here for more than a few days. I've been doing our WBBM in Chicago.
Yes.
Their affiliates, so the business reports for them. Mm-hmm. So naturally, I become a commodities expert.
Of course.
The most popular crop is
soybeans.
No,
corn.
It's corn. And because of the fertilizer price increases and diesel, all impacting farmers, they're actually turning more to soybeans because apparently somebody like me, I could grow soybeans. They're much easier. They require a lot less work.
Are you growing soybeans?
I'm not growing, but I can give you a soybean quote. Soybeans, which are priced unchanged right now. Yep. Corn is up 2 3/4
Wait, so
cents.
if there's less corn being grown, does that mean that gas prices will go up because a lot of the corn is used for ethanol, which
But I don't know
needs to go into
because
gas.
the story we had earlier was that a lot of farmers aren't sharing data with the USDA.
Oh, wonderful.
because
So
they
we're
don't
all
trust
flying
them.
blind.
Yep. Okay. Very good.
So, anyway, I'm full of good news. Anyway, I'm going to leave now.
Yep.
We check the markets for you all day long, right here on Bloomberg Radio. I'm John Tucker. That's your Bloomberg Business Flash. Have a great weekend.
All right, John Tucker.
Take care. Have a good weekend.
We got Scarlett Phil and Paul Sweeney. We're live here in our Bloomberg Interactive Broker Studio, streaming live on YouTube. This is the conversation of the day for me. Gene Munster, managing partner, Deepwater Asset Management, joins us here because it was a big, big week for some of the leading technology companies. Remember Friday afternoon, we had the Amazons, the Facebooks, the Metas, all that kind of stuff, Microsoft report numbers, and then last night, Apple. Gene, you saw a lot of the big names, a lot of the headline names report earnings here today. It seems like the market really is trying to identify winners, maybe a Google, losers, at least in the short term, maybe a Meta, given its stock price performance yesterday. What was your takeaway from all these numbers?
Well, I tend to look at beyond the quarter, beyond the guidance, and try to think about what we've learned about whatever the kind of the investment curve that we're on. Of course, we know what the A topic is. What inning are we in AI? And what I learned is, I would say it's probably consensus from the takeaways. So it's that we're still early, probably earlier than what we had thought maybe 6 months or a year ago. And specifically, if we look at kind of one benchmark, which is the hyperscalers CapEx spend for this year and for next year, we saw a measurable bump up for calendar 26, calendar 27. So 3 of the 4, with the exception of Amazon, the other 3, Google, Microsoft, and Meta, all increased their growth rates meaningfully again, off of numbers that were hard to imagine them going higher. That's been kind of a well-traveled. So, Paul, to answer your question is, I think we are still very early, second inning in all of this. And I think there's part of just being a human thinking that this just can't last. I mean, we're entering year 3 of this incredible growth. Like the numbers just keep getting bigger and the comps get more difficult and they just keep crushing through it. Eventually it has to slow down. We're just not seeing that. And I would just put one other piece that we've learned. Google and Meta both have shown that they can leverage AI at scale. Those companies have seen some remarkable accelerations in their growth. Google search going from, call it 10, 11% a year or so ago to 19% in the March quarter. Meta was growing at 16%, their ad business, in the March 25 quarter. They grew at 33% a year later and guided to 28% for the June quarter. So we have seen these two companies are great examples of the benefit, this nagging question about, is there actually utility in AI? Right. These companies have showed that. But beyond those, the world really hasn't seen it. And I think that's the opportunity.
So if we're in the second inning of the AI cycle, as you put it, does that mean Apple, which really has not done very much with AI, is really not that far behind and can make up whatever lost ground people seem to think it has? Or is Apple's interaction with AI just fundamentally different than the hyperscalers and the rest of big tech?
Well, Apple is both behind, but not far enough behind that they can't catch up, to your point. And I would just look at very simply is, you'd know there's a problem if there was some other competing AI consumer device that was capturing people's attention. We haven't seen that yet. That's an example of a problem. Another example that we'd know there's a problem if somehow like the base was starting to drift away for whatever reason. And they've essentially continued to strengthen their underlying base. And, you know, the numbers are quite remarkable. And I think that part of the reason why we've seen this surge over the last 3 quarters, so iPhone on average has grown at 20% over the last 3 quarters. The previous basically 4 years, it grew at an average of just over 1%. So we've seen this big jump up. That's called a super cycle. That's what I would call a super cycle. Super cycles don't last, but the fact that they're able to deliver a super cycle in the face of not having any compelling AI, I think speaks to how they've just become the fabric of consumers' lives. So Scarlett, to kind of bring it all together, I think that you know, they're not so far behind that they can't capitalize on this. And I mean, that's the real question here. Shares of Apple right now up 4%-ish. On what was some spectacular guidance, really underscores that investors are essentially looking past this great guidance in the June quarter. They're already thinking about next year where that growth slows, back down, iPhone growth back to 5% versus 20% over the past few quarters. And that's kind of the central question here. You're getting at the real question is, like, ultimately, can they take AI and create growth, outsized growth, outside of the super cycle? And that's what investors essentially don't believe right now, but that's what kind of where the lines are laying down.
Gene, if we're in the second inning, does that suggest we got many quarters and maybe years of this elevated level of CapEx to look forward to? And if so, would that become increasingly a headwind for the stocks?
Well, the CapEx impact is different for different companies. And so the best that I can see is that if you're a hyperscaler and you're spending more on CapEx, if you have a cloud business, then your investors are generally okay with that spending. On the Google call, they announced that they're going to be basically gave a suggestion that they'll grow CapEx next year between 20 and 30%. The street was at 10%. This is for calendar 27 now. Mm-hmm. And the stock it went down and then it kind of came right back up on that. It basically shrugged it off. Meta does the same thing, talks about 26, a step up in 26, the stock's down 7%. And so the difference between those and Microsoft talked about a step up in spending and the stock wasn't bothered by it. I think the issue here is, like, CapEx in itself is not negative. What's the issue is, I think, for many investors, is that they just don't see the path between CapEx. One last thing, it's a mystery to me, because I don't understand why investors don't give Meta credit, because they've shown that they can deliver CapEx on faster revenue growth.
Yeah. Hey, Gene, thank you very much for your time. You know, it's critical to kind of hear what you have to say. Gene Munster, folks, it's just one of the best, the leading voices in all things technology. We appreciate getting a few minutes of his time. Managing partner, Deepwater Asset Management, decades of experience in tech. S&P up 45 points.
This is Bloomberg Intelligence with Scarlett Fu and Paul Sweeney on Bloomberg Radio.
Good morning. Bloomberg Intelligence here with Paul Sweeney and Scarlett Fu, and we are looking at gains in the equity market, and these are gains with conviction, Paul. We finished a banner week of earnings. Big tech names all reported, topped off by Apple yesterday. We have NVIDIA to come, but that's not for another couple of weeks. So really the bulk of the heavy part of the earnings season is now, slowing down.
Yep, absolutely. So one of the big stories in the world of sports and in the world of golf is Live Golf. It's been really in the news the past couple of weeks. It looks like Saudi Arabia's public investment fund, they announced that it will stop funding the league after this season, which I think the season for Live ends in August of this year. So now if you Live Golf, I think they're out there looking for other sources of capital. But for a business that loses billions, and I think cumulatively the Saudi Arabian Public Investment Fund has spent or invested $5 billion into Live over just a handful of years, I would think that would be a tough nut to crack.
Totally. I mean, how do you fill those shoes? And you'd have to find a number of investors. You can't just find one investor to kind of take over for the Saudi Arabian Sovereign Wealth Fund. What happens to the golfers that moved away from the PGA Tour and went over to Live Golf? That's another big question.
It really is. And if I had to guess based upon what I've been reading from various sources that are really close to the business of golf is the path for like the real big stars like Bryson DeChambeau, John Rahm, those type of people might be easier than for everybody else. But let's talk to somebody who knows this stuff. Randall Williams, U.S. sports business reporter for Bloomberg News. He's down there in Miami. I can only guess why. Fast cars. Randall, thanks so much for joining us here. What's the latest on Live?
They're going to be looking for new investors. As we all know, the Saudis are going to be pulling their funding soon. I mean, we're hearing it is going to come before the end of the year. And so Live, they've actually had a relatively good business season thus far, but when you're $5 billion in the hole and, your profit is up and coming, but again, you lose $5 billion, and some of this predates the current leadership, it's hard for the Saudis with everything going on in the world to continue to greenlight that.
So right now, do they even have plans for next season? Do they have enough money in place to move on with the next season, or everything's kind of up in limbo?
They're in talks. They're in talks with a number of investors, none of which they'll tell me, but a number of investors, a number of banks, a number of things like that to look for funding. I think as far as plans go, if you ask them, they'll tell you that things are full speed ahead.
So do we know whether the players are getting paid?
We don't. There's been a lot of different reporting around players and who's being paid and who isn't. And I think that's a bit unconfirmed right now. I think the team managers have heard a lot from Live leadership, and we haven't heard any big names depart just yet. Now, that could change over time, but I don't think we're there just yet.
Randall, you're down in Miami. Talk to us about the F1 race down there. We heard from Matt Miller earlier in the week about what a big event it is.
Matt tends to focus on different things.
He focuses on different things. You focus on the business of sports. So talk to us about the business of F1 in Miami.
Yeah, it's been growing. I mean, I think Miami was the first time or the first race here that had a real celebrity effect, where you had people walking around and actually wanting to be here. And I think it's penetrated culture. And that's a big thing for F1. Of course, we have all of the media properties and Drive to Survive and the F1 Apple movie. But when you have something like this that is going to continue to attract big names, big investors, I'm standing outside the Auto Business Exchange right now, things like that, it's important. And I think them in Vegas are going blow for blow to see who can be bigger.
Right. I mean, Miami and F1, that's a relationship that'll continue to build, right? They kind of want to make them synonymous.
I think so. And I think Miami is the signature race in America right now. Of course, Austin laid the groundwork for this to happen, and Vegas is on the come up as well. But just the sheer energy around it, I was walking in, and you just see so many fans who are laid out in the grass just waiting for this. And mind you, today is Friday, the race is on Sunday, and people are just dying to get into this thing. So it's incredible.
And it's big for brands, because I've seen a lot of reporting. I'm just if you're a brand that has any aspirations to reach that kind of audience, you have to be at F1, don't you?
Right. I think they have a long list of sponsors. They have investors that want to buy into some of their teams, some of which have happened, some of which haven't. Because if you ask, team principals and CEOs of some of these companies that are around, the Formula One teams, they want to maximize their value the same way that an NFL, an NBA, and an MLB team and club do. And so I think that we'll see more of that at some point, but I think everyone right now is just having a good time.
Randall, before we let you go, very quickly, what's the update on expansion teams for the NBA?
Sure. I mean, I think Vegas, as I said, has had a lot of interest, It's very robust in Vegas. I've heard that there are multiple groups in Seattle as well. The names that we're hearing in Vegas are Magic Johnson. He's part of I imagine, a consortium. We've heard Bill Foley, who's told me far and away that there are people in his ownership group that can buy him 10 times over. And then we have Samantha Holloway in Seattle. And so, and don't let me forget Mark Lazary in Vegas as well. But Samantha Holloway has the rights to the Climate Pledge Arena in Seattle. And so we'll see who shows up to compete against her, because I think Bill Foley and Samantha Holloway, just because they have the arenas in their cities right now, are in the lead.
And they have the NHL teams, too, for those respective cities.
Absolutely. Absolutely. But it's still very early on in the process. So no, let me track back and say no one's in the lead, but they have their favorites.
Interesting. And it'll be big money, as we know. Randall Williams, U.S. sports business reporter for Bloomberg News from Miami, Florida. The place, if you're like a cool person, you're in Miami this weekend.
Why don't we go to Miami?
I don't know.
Bloomberg Intelligence.
I'm going to the Jersey Shore. That's all I can handle. For our listeners in the U.S., a reminder, you can listen to us via satellite radio on Sirius XM Channel 121. Access the world's only global audio business network, coast to coast, 24 hours a day. Bloomberg Radio on Sirius XM Channel 121 is presented by Golden Crest Metals. Stay tuned for the latest market news and industry research. The next hour of Bloomberg Intelligence starts in just a moment with a market moving higher. The S&P up 44 points, the Dow up 130, the NASDAQ up 245 points. That's 1%. How about that? Oil lower today.
This is Bloomberg Intelligence with Scarlett Fu and Paul Sweeney.
Concern about rising prices spooking investors.
What does renewables investment look like in the U.S.?
More tariff talk coming out of this administration.
Breaking market headlines and corporate news from across the globe.
The president wants lower interest rates. He wants a rate cut cycle.
How do you broaden out the AI play?
Are people just looking for something to worry about when it comes to China?
Bloomberg Intelligence with Scarlett Fu and Paul Sweeney on Bloomberg Radio, Originals, and the Bloomberg Business app.
Good Friday morning. This is Bloomberg Intelligence with Paul Sweeney, Scarlett Fu, and Charlie Pellet. We are live at the Bloomberg Interactive Broker Studio in Midtown Manhattan. We are also streaming live on YouTube and available on Bloomberg.com//video. A lot coming up this hour of Bloomberg Intelligence. We're going to check in with Mandeep Singh. He is our global tech research head here at Bloomberg Intelligence to give us all the latest headlines on tech, including OpenAI's CFO seeing a vertical wall of demand for products. Our previous guest was just telling us we're only the second inning of this AI build-out. We're also going to check in with our luxury goods analyst on Estee Lauder. Estee Lauder, the cosmetics company, is cutting 3,000 more jobs. This is as the turnaround plan continues to evolve under the new-ish CFO. It is Friday, so that means munis are in focus. We're going to check in with Craig Brandon. He is co-head of municipals at Morgan Stanley Investment Management on Paul Sweeney's favorite part of the market. And Catherine Chiglinski, she is our U.S. finance team leader. We'll talk to us about Jane Street. Not a whole lot of people know about this firm, but boy, they're profitable.
Amazing.
Okay, their pay pool actually more than doubled to almost $10 billion last year. So a lot to discuss there. But first, let's go to Charlie Pellet for a Bloomberg Business Flash.
Hi, thank you very much, Scarlett. We do have a developing business story right now. Headline on the Bloomberg Professional Service: Spirit Airlines preparing to shut down. This is a rescue deal falls apart. Again, this according to the Wall Street Journal. But the headline right now, we are following the story. Spirit Airlines preparing to shut down as that rescue deal falls apart. We've got airline stocks advancing today. Yes, the price of oil is down, but airlines ripping higher right now. Case in point, former partner JetBlue, former merger partner JetBlue, up by 4.6%. UAL up 2.5%. American up 2% right now. Delta is rallying 2%. But again, the headline right now on the Bloomberg: Spirit Airlines preparing to shut down, according to the Wall Street Journal. The Dow, the S&P, NASDAQ all advancing. We got the S&P, NASDAQ 100 index right now trading at another record. 72.45 where we stand on the S&P, up 36, gain there of 0.5%. Dow up 107, up 0.2. NASDAQ at a record up 196, up 0.8%. NASDAQ 100 index up now by 202 points, up 0.7%. All of this with the VIX below 17, the 10-year at 4.37%. Gold up $8 the ounce, up by about 0.2%. And a retreat for crude below $102 on WTI right now, lower by just about 3%. Apple rallying after earnings. Apple shares gaining now by just about 3.9%. Again, recapping, stocks higher, S&P up 38 right now, up 0.5%. Do want to hit the Spirit headline one more time. Spirit Airlines preparing to shut down as the rescue deal falls apart. That according to the Wall Street Journal. I'm Charlie Pellet. That is a Bloomberg Business Flash.
Thank you so much, Charlie. And just to stay on that Spirit Airlines headline, you mentioned, rightfully so, that JetBlue, Frontier, they're all surging right now as the departure of Spirit would mean less competition for those carriers. The Wall Street Journal reporting that Spirit has not been able to get sufficient support between certain bondholders and the government to get the funding it needs to keep in business. So a preparation to cease operations is now taking place.
Which just once again calls into question, why didn't they let JetBlue and Spirit merge? I would be like leading them to each other.
That was a different administration.
Helping them merge.
Yeah.
It was just like, geez.
Different time.
I mean, and we all knew at the time that one, maybe both would not survive.
Well, now we've come to this point.
Now we've come. All right, very good. All right, Scarlett Fu and Paul Sweeney, we're live with you in our Bloomberg Interactive Broker Studio, streaming live on YouTube as well. As Charlie was just reporting, stocks moving higher today. Let's take a look at some of the stocks on the move today. We can do that with Vildana Heinrich, cross-asset reporter for Bloomberg News. She joins us here in studio. Vildana, what are you looking at?
I'm taking a look at Estée Lauder, ticker EL. Shares are up about 6% right now, up as much as 13% earlier. And that's after the company said it plans to cut as many as 3,000 more jobs and generate a further $200 million of savings to help boost its turnaround plan. This is a company that's behind a lot of various brands, including La Mer and The Ordinary, which I didn't know until today. I'm a big user of The Ordinary, actually. Yeah.
Excellent. Well, what Alex Steele once explained to me is you have to invest in your face.
Yes, you
absolutely do.
Did not know
SPF.
that. Mandeep did not know that. So I'm just saying right away. Here we go.
You guys are on camera. You absolutely need to be doing that.
All right, all right.
You need SPF, every day.
Well, I'm Irish. I live at the beach, so I got no choice.
What's next?
What else you got?
Taking a look at shares of Reddit, that's ticker RDDT. Shares are higher after projected sales in the current period that surpass Wall Street estimates, and it's the company's continuing a streak of strong revenue growth. A lot of that is powered by its surging advertising business. So revenue in the second quarter will be $715 million to $725 million, whereas analysts had projected $714 million.
Are you a Reddit
I
user?
am. This is why I chose this one, because I go on Reddit for skincare.
See, you can go on Reddit for skincare, for credit cards,
right, so
for advice on applying for citizenship.
I am downloading the app as we speak. I'm going to get into it.
Okay, and based on what you look at, that's how they're going to line up what things to serve to you. And
all right,
we'll check in next week to see which.
I look up everything skincare related. Is so many good tips. Yes.
All right.
Yeah, any cream you're about to use, just type in the name and then Reddit. You'll get a million comments.
People who aren't interested in it won't post on it.
Okay.
Yeah.
Okay. All right.
It's so useful.
That's what the kids are doing.
And last one, I'm a big user. Shares of Clorox CLX are lower after it cut its fiscal year.
This is Vildana's personal portfolio of companies that she interacts with.
Not companies I own, but outright. But I'm a big user. Fiscal year 2026 earnings guidance. It was citing weaker consumer sentiment, higher energy costs, and the financial effects of its acquisition of the Purell maker. But this one is interesting to me for a couple reasons besides my own use. I have a toddler. I have to have a lot of Clorox wipes, so hence the own use. But it's interesting to me because I love to sort of get a viewpoint into how companies are being affected by higher costs, oil, etc.
I'm logging on. Choose your interest. You would choose beauty.
Skincare, yeah.
Okay.
Are you choosing skincare?
I'm not at the moment, but maybe I will.
Beauty is different. Beauty is like you might get makeup tips, but skincare is like, what do I do for,
All right. I'm learning, guys. I'm working on it. I downloaded all the AI apps the other day. Now I'm doing Reddit. So I'm getting there.
All right, we're going to check in with Paul Sweeney on Monday. He'll be a brand new Paul Sweeney.
Yep.
Thank you so much, Vildana. Vildana Heinrich, of course, one of our cross-asset reporters. She's the team leader, in fact, of our cross-asset coverage here at Bloomberg News. And for more conversations like this, be sure to subscribe to our Stock Movers Reports, where we offer you 5-minute audio reports on the biggest winners and losers in the stock market. Subscribe to Stock Movers on Apple Podcasts, Spotify, or anywhere you listen. I feel like we're done with big tech earnings, right? I mean, NVIDIA's around the corner at some point.
2 months from now.
2 months from now,
no idea
yeah.
when they
But
do it.
I mean, the Mag 7 names are pretty much done with the exception of NVIDIA. So we need to bring in Mandeep Singh. Mandeep Singh is our global tech research head here at Bloomberg Intelligence. Mandeep, did you learn anything new from the big tech earnings?
Well, clearly, I think CapEx efficiency will become a bigger theme as we go along. So even though these companies are talking about raising CapEx, which most of them did, I think the reason why Google did far better than everyone else is everyone realizes they are showing a higher ROI on that CapEx spend, whereas in the case of others, you're still trying to figure out how that ROI will manifest in top-line growth. And look, I think if you were doubting AI spend, this earnings season shows that all these hyperscalers are seeing a lift to their top-line growth. Even with their large bases, they are growing, 20% plus, and they will probably keep compounding. So we are talking about accelerating top-line growth going into the second half.
Do I have to participate, or can I just do my Reddit stuff?
He's obsessed with Reddit now, so go do your Reddit stuff. We also, of course, are keeping our eye on these AI startups, the ones that are that the hyperscalers are working so closely with, like an OpenAI, like an Anthropic. The CFO of OpenAI, Sarah Fryer, said that the company is meeting objectives and sees a vertical wall of demand. What's going on at that company? Because we also got reporting that indicated that they're not quite executing on what a lot of people had hoped.
I mean, right now, I feel there is so much buzz around Mythos and what Anthropic has done with that model release, even though it's not a full-fledged release, companies are looking at it. But there is a leap that they have taken in terms of, the model capabilities that OpenAI doesn't have. And, OpenAI just raised $120 billion. So their investors are asking them in terms of, where they fall in terms of the next version of the model. And right now, the CFO has to do a lot of, answering in terms of how that capital, which they raise, is being allocated. But there's no doubt that, Anthropic right now has the lead when it comes to the LLM capabilities and where they are versus the rest of the pack. And I think OpenAI is the one who had that clear lead, so now they have to catch up.
So are we going to get these AI companies public anytime soon? Because, boy, that could... I mean, if no other reason, just to see the financials, it would be worth the price of admission.
Yeah, and that could be a big catalyst if you think about, everyone being convinced on this AI super cycle. Well, what if, and again, it's a big if, the financials look really bad in terms of the gross margin profile of these businesses, and suddenly you start to think, why are we funding businesses with sub 20% gross margins, and how long will that persist? So from that perspective, I think the cash burn would be a big focus when these companies file their S1 prospect. And look, I think OpenAI and Anthropic both want to go public based on whatever rumors we have heard so far.
Oh, yeah. I'm almost like, if I'm in one of these companies, I'm like, I'm good, guys. I'm raising capital, hand over fist, great valuations. There's ways for my employees to get liquidity. I'm not going public and deal with all those knuckleheads.
Well, I mean, look at Anthropic. Now we are talking about $900 billion valuation. Yeah. So they are close to that $1 trillion mark. And if, like back in the day, the private companies used to go public much earlier. We beat up on Uber for such a long time for, delaying their IPO. Look at these companies.
Yeah, they've done just fine staying private.
Yep.
Yeah.
All right, Mandeep, thank you so much. Appreciate that. Mandeep Singh, Global Tech Research Head for Bloomberg Intelligence. Boy, I mean, we could have some just amazing gajillion-dollar IPOs if some of these, like SpaceX and all these AI companies.
We've been talking about this, and we'll see if the macro conditions cooperate and this actually happens. But it's fascinating because once you do have companies do this, investors are going to have to free up some space in their portfolios, and they're going to have to dump some I mean, my guess is they're going to have to make room and perhaps trim their holdings in other big tech stocks.
We used to have a little rule when I was at, where was that, Credit Suisse, when the VIX had to move down. It didn't matter from what, but when the VIX moved down over a couple of days from like 18 to 16 or 24 to 20, pick up the phone and start calling your companies that are thinking about going public. That was our thing. It doesn't matter necessarily where the stock market was.
Right.
It was kind
Here's
of
your window.
How are people feeling? Yeah, that was our window. So let's switch gears to, we've been talking about luxury, Estee Lauder. And you want to talk luxury, there's only one person to talk to, and that's Deb Aiken, Bloomberg Intelligence luxury goods analyst. She is based in London. She spends most of her time on the various high streets around the world at the high luxury dealers there. Deb, what did you learn from Estee Lauder this reporting period?
Well, it's quite a mixed bag, actually. The share price was off heavily into results year to date. But what we learned is that the PRGP, the profit saving program, the way they're adding innovation and flexibility is starting to work for them. So they've returned to growth on the top line. Couple of percent constant currency sales growth. And then they got a 3% Forex benefit. So that will help them to really be able to, to invest more and add to what they're doing on the savings side. But when we look at the underlying growth, it's all fragrances and other. So skincare, hair care, in particular, skincare is an issue for them because it's their biggest division. All those numbers are flat year on year. So it's 10% growth in fragrances, not much growth elsewhere. So still a lot to do. And what that makes me wonder is how quickly these the potential for combining with Puig, how quickly that might go ahead, or whether it may be delayed, or whether it may be off the table. So there's quite a lot behind these numbers to me when I dig deep.
So I'm so glad you bring up Puig because there's that proposed merger with Puig Brands, and the company did not give very many details in the earnings call about how that's going or how those conversations are going. Is that a reason to be concerned about whether this will actually happen?
No, not at all. So we had Puig as well reporting a couple of days ago. They were okay as well in what they were doing in their improvements from what we saw from the prior quarters. But actually, because there's no agreement in place, it's just we've just been informed from both parties that they're in talks. It's usual if they don't break earnings because something is about to happen, or certainly Puig has delayed a capital market day, but it goes ahead with an AGM on the 29th of May. But it is usual that these companies would come out and say, this is about earnings and we're not going to give any comment on what we're doing behind any potential talks.
Deb, what's the current feel out there in the investor community about luxury these days? Is what's the driver right here in terms of sentiment?
What we're seeing actually, so we picked up on it the last couple of quarters. We did some work where we were starting to see in China the shift from red towards neutral, and then the last couple of quarters towards green, and we've seen that continue. So it's slow progress, but we now have the beauty companies also, including Estee Lauder, coming through with 6% organic growth in China. So some repair in travel retail and repair in the premium end in China coming through. And that's very much across those premium beauty brands and also the high end of luxury. That would be the one thing. The second thing, we don't quite see it here, though it is in some of Estee Lauder's brands and not others. Americas, particularly the US, has proven very robust. And we're getting decent growth rates coming through on the luxury side. And I would in fact say that for 2026, given that China is against a decline still versus 25, it's actually Americas and particularly the US that is driving the growth rate in luxury goods. So we're kind of looking at this market and the beauty market coming through at around 4 to 5% growth. And what we're finding so far is that the Middle East is about 100 basis points impact on that growth rate.
Gotcha. All right, Deb, really appreciate your joining us this Friday. Deb Aiken is our luxury goods analyst on Estee Lauder earnings. Worth mentioning here as well, Paul, that Estee Lauder is also cutting more jobs as part of that ongoing turnaround effort. It's now up to 10,000 versus the previous target of 7,000.
Every time I see job cuts now, I think AI. I'm not sure if that's accurate or not, or that.
I mean, this goes hand in hand with a bigger restructuring effort, but yeah, you wonder how much AI is in there, especially if we're talking about office jobs. This is Bloomberg.
Markets, headlines, and breaking news 24 hours a day at Bloomberg.com, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
It's 11:21 on Wall Street. We do check markets all day long here at Bloomberg, and this Bloomberg Business Flash is brought to you by gold and Crest Metals. Inflation, tariffs, and volatility have some investors turning to gold for stability. To get a free gold and silver info guide and learn how to add metals to your IRA or 401k, tax and penalty free. Go to goldencrestmetals.com/guide, goldencrestmetals.com/guide. We're looking at an update here for the Dow, the S&P, and NASDAQ. Any advance today on the S&P, NASDAQ, and NASDAQ 100 index will be a new record. The Dow up 85 right now, still below 50,000, 49,737 on the Dow, up now by about 0.2%. S&P off session highs up 46, up 0.6. We've got the NASDAQ, the composite index, up 1.1%. NASDAQ 100 index up now by 1%. The VIX below 17 with a 10-year at 4.37%. Gold up $20 the ounce, up 0.4%. And West Texas Intermediate crude down 3.1%, 101.82 a barrel. Barrel of Brent down by 1.6%, 108.61. After earnings, ExxonMobil down now by 0.7%. After earnings, Chevron down by 1.1%. In the aviation industry, Spirit Airlines shares plunging down 71% right now after the Wall Street Journal reported the firm is preparing to cease operations. Shares of peers, including JetBlue and Frontier Group, both surging on the news. JetBlue up now by 10.9%. Frontier, which uses the ticker ULCC as an ultra low-cost carrier, up by 12.4%. We'll have a whole lot more coming up with Sid Phillip just about 7 minutes from now. I'm Charlie Pellet. That is a Bloomberg Business Flash.
Now on Bloomberg Intelligence, Munis in Focus.
All right, today's Focus on Munis is brought to you by BAM Mutual. Put America's strength to work in your portfolio with BAM insured municipal bonds. Protect your investments with an added layer of security and guaranteed income. Invest with strength. Build a stronger tomorrow with BAM Mutual. Let's talk munis because why not? It's Friday, and that's what we do here. Craig Brandon joins us, co-head of municipals at Morgan Stanley Investment Management up there in Boston, the former Eaton Vance shop, one of the best, I think, best franchises up there in Boston. Eaton Vance been there forever. Craig, talk to us about the municipal bond market. How's the year unfolded for municipal investors?
Yeah, volatile year so far, like other fixed income. We were sort of plugging away in January and February. March hit and the war hit, and we traded off, as did a lot of other asset classes, and we got a lot of it back in April. So we're sitting here up about 100 basis points on the year, slightly outperforming some of the other fixed income asset classes that are either flat or down slightly, but really almost nothing to write home about it at this time if you look at being up 100 basis points year to date.
In general, Craig, where are we in terms of seasonal factors? I know that for the muni market, there's a lot of periods where there's demand coming in or supply really takes a dive. Where are we in the seasonal factors that we need to pay attention to?
Yeah, so we're almost pedal to the metal on both sides of technicals, right? So supply side, very strong, $173 billion year to date on the tax exempt side, and that's up 16% over last year, which was an issuance record, right? But at the same time, we have $29 billion into the market year to date of new money, plus coupons and things like that. So year to date, we're setting a record on inflows between mutual funds and ETFs that doesn't even count separately managed accounts, which is balancing the record supply that we're seeing. So, technicals, I would say, are balanced and they're very strong on both sides. So the key this year is we think that issuance will continue to be strong. We continue to need to see the money come in to balance that out for the rest of the year. So far it's been fine, and flows still appear to be strong. So we're hoping that dynamic continues.
Craig, talk to us about credit quality. It's really been quiet on that front. Thankfully, we haven't really had any big credit concerns. Just give us a sense of what the current situation's like.
Yeah, so states really drive the show on a lot of stuff, right? States give assistance to locals and municipalities. The economy's been stable, as we've seen, right? So states came into this with a lot of cash. Municipalities are pretty flush. Remember, in munis, we are different than treasuries. Pursuant to state constitutions, municipalities have to have a balanced budget every year. You might not like how they get to a balanced budget, which is when people talk about the gimmicks, about the one-time, financing things that municipalities do. But they do that because they can't deficit finance. So every year, the states and municipalities come into the year with a clean slate and a balanced book, you can't deficit finance. So, credit remains strong. There's some sectors that we're watching, right? Some of the smaller colleges and universities, Bloomberg has reported many times on some of the small independent colleges that have been shutting down. And we're watching some of the smaller, more rural hospitals with all of the Medicaid cuts from the One Big Beautiful Bill Act that could be impacting them. So, really, those are the things that we're looking at. But, the big colleges and universities are still very stable. The bigger hospital systems are very stable. So you just sort of need to pick your spots and watch out for a few things. But, overall, muni credit is pretty strong.
Within higher ed, schools of all stripes are looking to raise money, but are the big schools that, have a big endowment, are they just as likely to need to go tap the muni market as the schools that maybe face some of the demographic issues?
They are. I would say one thing to remember, tax exempts, you can't issue bonds just to put on your balance sheet, right? They have to have a specific capital purpose. You need to itemize the capital purposes for construction, basically. The taxable market, right? There's about an $800 billion sleeve of munis that are taxable that primarily international investors buy. Think of Japan, Korea, Europe. That's where they can issue bonds. So what we're seeing is, yes, the big universities. Listen, the big, strong universities are still an arms race. You want to have the nicest dorm facilities. You want to have the nicest research facilities, right? So from the tax-exempt side, there's definitely an arms race where the strong are getting stronger. On the taxable side, yes, we're definitely seeing universities come in issuing bonds to just put on their balance sheet to just remain strong. But, the strong are getting stronger and almost the weak are getting weaker in colleges and universities. And that's demographic driven, as, again, Bloomberg's reported a number of times. On the decreased amount of high school graduates every year right now.
Yeah, kind of like the economy and the other industries as well. Craig, where do you want to be on the curve?
Listen, 15 to 20 is a real sweet spot right now, even out to 22. So if you go from 15 to 20 years, you're picking up almost 11 basis points every year you go out, which is a steep curve, right? And then when you go out from 22 to 30, you're only picking up 18 basis points to go all the way from 22 to 30. So, 15 to 22, you almost want to be in that like 20 to 22 range because that's the steepest spot. That's the most attractive spot. And it's, significantly steeper than the Treasury curve for, market dynamics where separately managed accounts and ETFs, which are seeing a lot of flows right now, they generally don't really buy past that 15-year spot. So that makes 15 to 20 really, really attractive.
Craig, thanks so much for joining us. Really appreciate it. Craig Brandon, he's co-head of municipals at Morgan Stanley Investment Management up there in Boston. Again, crossing the tape earlier this morning, Spirit Airlines plunges as the Wall Street Journal says it is preparing to end operations. Let's get some latest reporting on that. We do that with Sid Phillip, Bloomberg chief correspondent for global aviation. Sid, Spirit Airlines preparing to end operations. What happened to the potential deal with the U.S. government?
So from what we understand, Spirit Airlines couldn't reach a deal with its creditors. And so the creditors were a roadblock. Bloomberg earlier reported that creditors were a roadblock in agreeing to any deal with the government. And that was primarily because of concerns about what basically liabilities and what their recoveries would look like post the government deal. I mean, remember the government was proposing them superseding other lenders. And so that's turned into a bit of the creditors weren't sort of happy with that deal. And so we understand because of that, the government deal can't go forward. And that's really forcing Spirit Airlines to consider bankruptcy and shutting down, essentially.
Okay, so a shutdown, what would that look like for an airline? How long does that take?
Shutdowns usually take it could take a matter of a couple of days, or it could be a day, and it would sort of cause considerable discomfort and considerable sort of pain to various people. So on one hand, you have the passengers who would then be stranded without options in terms of being able to fly. I mean, we may see some of the other airlines and their competitors offering rescue flights or other sort of alternatives. But as far as the consumers are concerned, they would be sort of looking for a way to get out of like their flights and see where they could go to. And the other concern is one for the staff and essentially what happens with them, and then also the assets of the airline and what happens with the aircraft and other sort of assets that the airline has. So there's multi-facets to that thing, and we are still looking to see what the rollout's going to be if there is, in fact, no chance of saving this.
Yeah, I'm just looking at the DES screen for Spirit Airlines. It shows it has about almost 10,000 employees. So that's the human side of it. Is there any chance, Sid, that another airline could come in here? I see that JetBlue stock is down more than 4%. Maybe people speculating that they might come in and try to buy this thing.
There could be speculation that the assets could go up for the assets could be available to other airlines to get them. There's also a possibility that the creditors and the government reach some sort of agreement just in the sort of final hours. So it's still not yet over, but we will be watching the story to see what happens next.
Looking at JetBlue Airways right now, the stock's actually trading up. I correct myself, the stock's trading up a little bit, but I wonder, the government blocked them before, so I'm not sure they would proceed again here.
That's a good question. I mean, Sid, do you think the government might try to pivot and not force consolidation, but encourage an airline to pick up Spirit?
The government would try, but again, the stumbling block would be what price those are paid and essentially what the creditors sort of want from this. So it is hard to see how an airline could come in and get a merger done, especially given that Spirit's been running out of cash and there's no real, they're in their second bankruptcy. I mean, they were meant to exit their second bankruptcy.
Good point.
And so it's hard to see how that could happen so quickly in terms of giving them a lifeline to actually keep going.
All right, Sid, thank you so much. Really appreciate it. Sid Phillip, Deputy Team Leader for Global Aviation, Bloomberg News, joining us on the news that the Wall Street Journal's reporting that the Spirit Airlines is preparing to end operations. And so you think about, obviously, the 10,000 employees at Spirit Airlines. You think about the consumers who have booked flights on this airline, and they're going to have to scramble to find out.
I mean, we're kind of right back to where we started because they were already looking at perhaps a wind down liquidation when there were reports that they had gone to the government to see if there's any kind of rescue plan in the works. President Trump said, yeah, sure, let's take a look at this. And now it turns out that they can't get anything done. Creditors won't get on board. So we're right back to where we started.
Yeah, and I guess if I'm a creditor, I'm just thinking about it. I guess, I got my collateral are the jets themselves, the planes themselves. I kind of know what they're worth.
Right.
And
there's a lot of demand for that.
Right. It might not be 100 cents on the dollar or anything close to it, but I kind of know what it is. If the government comes in here, I'm not sure how I would be treated. That might be part of their thinking there. So that collateral could be some pretty good collateral here. S&P up 47 points, the Dow up 46 points, and the NASDAQ up 273 points. This is Bloomberg Morning.
markets, headlines, and breaking news 24 hours a day at Bloomberg.com, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
It's 11:40 on Wall Street. We do check markets all day long here at Bloomberg. Oil lower, stocks higher. This Bloomberg Business Flash is brought to you by Chapter. The average couple spends over $300,000 on healthcare in retirement. Want to know how much of that you could keep? Find out today in under 20 minutes with one free call to Chapter. Go to askchapter.org to get started. Do want to begin with the latest on Spirit Airlines. We have got Spirit plunging. Right now, Spirit Airlines shares sinking by 61.4%. This after a report from the Wall Street Journal that the firm is preparing to cease operations. Shares of peers, including JetBlue and Frontier, are surging on that report. Shares of Frontier Group Holdings right now up by 12.5%. JetBlue is up by 9%. Other airlines gaining as well. UAL up by 4.2%. American right now up by 3.1%. Delta up by 3.5%. We are looking at stocks at records with the S&P, NASDAQ building on yesterday's gains. S&P up 52, now up 0.7%. Dow up by 0.1%. NASDAQ up by 1.2%. Should point out that Apple shares are gaining after earnings, up now by 4.8%. The VIX below 17 with a 10-year 4.37%. Spot gold up 0.6%. And again, West Texas Intermediate crude down 3.4%, 101.55 a barrel. I'm Charlie Pellet. That is a Bloomberg Business Flash.
All right, Charlie Pellet, thank you so much. We appreciate that. Scarlett Fu and Paul Sweeney live here in our Bloomberg Interactive Broker Studio, streaming live on YouTube and at Bloomberg.com as well. ExxonMobil and Chevron, they exceeded profit expectations due to higher oil and gas prices outweighing production outages from the Iran war. Let's get the latest here. Their stocks are trading down a little bit today, but let's be honest, they've had a nice rip here this year. Chevron up 25%, ExxonMobil up 27% year to date. Vincent Piazza joins us. He's a senior equity research analyst following all this oil and gas stuff. He's here in our Bloomberg Interactive Broker Studio. Vince, what'd you learn from Exxon and Chevron today?
Well, like you said, price trumps volume, number one. Yep. Number two, the rest of the world got punched and Exxon and Chevron got pinched.
Okay.
And I think, when you think about the integrated model during times of stress, that's when it works. And I think you'll see similar for 2Q as well, because, 1Q, we only had 1 month of that price inflation. Yep. We're coming into the second month of inflated prices here. So, from an upstream perspective, net benefit to both, even though the production outages are probably more sustained into 2Q, but overall prices are higher and price trumps volume. So for the most part, we're moving toward an environment for them where at least the upstream component will do well.
And upstream, of course, is exploration and production. Downstream is refining. What was notable to me in looking at the results is that ExxonMobil is just as challenged as everyone else in giving guidance because no one knows how long the Strait of Hormuz will be closed for. And they really couldn't pinpoint anything.
Can't pinpoint anything. And if you look at prices along the curve, I'm not really sure the traders really appreciate it as well, because, we're here and we see that $100 per barrel. But if you look at the November and December contracts, they're somewhere in the high 70s, low 80s. And so, interestingly, by the time we get into election season, those contracts will be the spot contracts. So it'll be very interesting to see what happens at that point. But for the most part, if you think about not only Exxon and Chevron, but also the other majors across the globe, you're seeing the same kind of results where price is trumping volume for the most part.
Just lastly, Vince, before we let you go, why don't I just go down to Texas and drill a hole? What are rig counts doing? Are the landmans, the wildcatters of the world, are they taking advantage of $100 oil?
They are still being disciplined because, as I mentioned to you, the prices out on the longer end of the curve are still somewhat subdued. And so they're not really incentivizing you to drop a lot of capital into the ground. But more importantly, guys like you, investors overall, telling the space, I don't want the additional molecules. What I want is distributions, and that's the process with shareholder engagement, giving them dividends and the stock buybacks that they need.
All right,
it's no fun.
Vincent, you just kind of killed Paul's dream there. He was ready to take off to Texas tomorrow. Vince Piazza is our senior equity research analyst covering oil and gas, giving us the take here on Chevron and Exxon's latest results. We want to talk about a firm, a financial firm that everyone on Wall Street knows, but we don't have a lot of information about because it's not publicly traded. Catherine Chiglinski is here, and she's our team leader for finance coverage at Bloomberg. And that firm, Catherine, is Jane Street. There's a lot of reporting on Jane Street of late, partially because it's extremely profitable.
Extremely profitable, and it's really risen to prominence. I mean, you think about it now, it's a big competitor to Wall Street broadly. They pulled in $39.6 billion of trading revenue last year, and that does include stakes in companies like Anthropic, but that's a huge amount. I mean, that outpaces any of the big Wall Street banks. And so, yeah, they've been paying their employees quite well.
I mean, as Butch Cassidy would say, who are these guys? And like when I was out there trading, there was no Jane Street Capital. Now these guys are just monsters out there. And the Citadel Securities, another type situation. Where do these guys come from?
Well, we've seen them really expand in recent years, and part of it is just sort of the dominance in the retail space. Yeah. But we've seen, and reporter Catherine Doherty did a great story about this deep dive into Citadel Securities and how they're really expanding into high-touch trading. And that's the high-touch equities business is a key business that Wall Street has long dominated. You know, maybe they ceded some on the retail front to these market makers in recent years, but that's been a big space for the banks. And so yeah, we're seeing Jane Street really like move in on some of the bank's turf.
We kind of describe Jane Street as a market maker. Is being a market maker that profitable?
Well, I think, especially with Jane Street, you think about, I mean, they particularly tend to hire very, very smart individuals, like
serious geeks.
Yes, and people who really know like AI and technology and all that stuff. And I think I think this has been true of any industry, is if you have that, that cutting edge technology, if you have people who are pushing the envelope there, I think that like ends up being, it makes it a formidable competitor, especially to these long established institutions.
I know some young folks that work there, and they're all engineers or computer scientists, or mathematicians, and like we've seen since the beginning of time, that's where they're going. Jane Street is the holy grail. It's not Goldman Sachs per se. It's not BlackRock. It's Jane Street.
And do those guys, the engineers, the computer scientists, do they get paid as much as the bankers at a Goldman Sachs or JP Morgan get paid?
Well, like they're getting paid pretty well, honestly. Like So their compensation pool last year was $9.4 billion for every employee. If you did that equally, which obviously that's not exactly how pay happens, it would be $2.68 million per employee. That's more than nearly 7 times what it equates to for Goldman Sachs compensation per employee.
Okay, look at this. Here's the stuff I like. Jane Street's members' equity. That's the firepower the company uses to support its trading operations without having to tap outside capital, has swelled nearly 2,000% since 2016 to $45 billion, according to sources. That's just capital they can put right. I mean, you think about the capital allocation that Morgan Stanley or Goldman Sachs may give to their market making trading operation. It's just monstrous numbers. Is there any reason to think this doesn't continue for these guys? I mean, it seems like their flow, their market share has been just steadily climbing.
Steadily climbing. They're investing in companies. I mean, we just had news out on Anthropic that they're receiving funding offers, like valuing the company at nearly $900 billion. So like, yeah, I think in terms of their competitive edge, I think, that will remain a real sticking point for Wall Street. But then I think you also have, the bets they've made on these privately traded companies that I think we'll definitely be keeping an eye on.
I mean, here's the great chart. I like pictures. It's easier than words for me. Jane Street's total revenue, $39.6 billion for last year. Number 2, JP Morgan, 35. Number 3, Goldman Sachs, 31. Number 4, Citi, 22. So it's just monster. Citadel's down there at 12.2 as well. So outpacing the big rivals. Again, they didn't exist back in the day, but
it's not just the U.S. either. It's not just New York. Jane Street is set to double its footprint in a London office move as well. So this is it's on the march globally. Catherine, Thank you so much. Catherine Chiglinski, she is our team leader for U.S. finance coverage here at Bloomberg News, and that is our bread and butter, so we talk to her often, giving us the latest on Jane Street. Like you said, Paul, did not exist a couple decades ago, and now, you know, maybe it's the place that all the young engineers and computer scientists and traders want to go to.
Yeah, we see it. It's kind of like, it's just been a real source of growth for global Wall Street. You can trade away from some of the traditional investment banks and get liquidity and get good pricing. This is Bloomberg.
This is Bloomberg Intelligence with Scarlett Fu and Paul Sweeney on Bloomberg Radio.
Scarlett Fu and Paul Sweeney. We're live here in our Bloomberg Interactive Broker Studio in New York City. We're streaming live on YouTube and at Bloomberg.com/video. That's where you'll find us. Red headline crossing the Bloomberg terminal. Trump says increasing tariff on EU autos to 25%. So we'll have more reporting on that. But more tariff news. Remember, you can't forget about the tariffs. Are still there. It's not just the war and earnings and the Fed. The tariffs are still out there for companies and consumers to deal with. Big take story. You know, we love these big take stories because they are deeply, deeply researched, deeply reported, deeply sourced. Got some great graphics and pictures that kind of make them kind of just come out and jump out at you. And this is a good one, particularly for those that are interested in the healthcare business. The J&J's ketamine-derived treatment for severe depression got off to a sluggish start after winning approval, but starting to pick up here, and it's the $1.7 billion trip. Madison Muller, one of the reporters on this deal, she's a healthcare reporter for Bloomberg News. Talk to us about Johnson & Johnson and ketamine-derived treatment.
Yeah, so this drug is called Spravato, and it's actually a nasal spray. So you take a couple of sprays in your nostrils, and you sort of lean back and have these, not necessarily hallucinogenic, but dream-like effects, sort of like you'd be tripping, but not exactly like that. And it's for patients who have treatment-resistant depression, so people who have tried and failed, traditional oral antidepressants, and who have struggled with depression for a long time, and who need something else. And Spravato, for a lot of these people, has really been life-changing. And so we outlined that in this story. The drug was sort of, sluggish when it first took off. It launched during the pandemic when, all the in-person care was really not happening. And this is a drug that needs to be administered in a clinic, and then there's a monitoring period after. So it was a bit of a rough go at first, but now this drug has really taken off and has become one of J&J's key products.
So how is this administered? So it's administered in a clinic. How long does it last for a patient?
Yeah, so a patient goes in and they take a couple of spritzes of this drug in their nostrils, and then there's a 2-hour monitoring period after that that's required by U.S. regulators just to make sure that there's no negative side effects. Obviously, they don't want patients going and driving a car after taking a drug like this. And so physicians will monitor their vital signs, their pulse ox, their heart rate, just to make sure everything's okay. Also, a lot of times people have a emotional reaction to taking these drugs. I mean, some people just will color in a coloring book, others sort of drift off, others will, be really, really emotional. So they want to make sure that there is that support and that monitoring afterward. And then they come back every week after that. And then you get to the point where it's every 2 weeks. And so it's a once a week or every other week treatment, and patients, it seems to be very effective for them.
I was going to say, how do they measure the efficacy of this thing? Are you
Yeah, I
happy,
mean-
or you're not happy? Are you depressed? Not depressed?
Right. I mean, there's all these metrics that doctors use, sort of like a questionnaire of depression symptoms, and this is something that they really think, depression symptoms go into remission from, and that's sort of the goal here, especially for people who have struggled for a really long time and who might have not seen good efficacy on other medications. So that's sort of how, psychiatrists and how physicians look at that.
Do we know how big this? It seems like it could be a really big market. What does J&J say about that?
Yeah, I mean, the mental health market, depression treatments is always been pretty big. I mean, if we look back at Prozac, that was a huge drug, huge blockbuster for Eli Lilly. But back then it was all about the SSRIs. And this is, the reason why this drug is different is because it's derived from ketamine. It's not exactly the same, but it works differently than the traditional SSRI medications.
What's SSRI?
Serotonin, something reuptake inhibitors. Yeah, it's like the traditional Prozacs that you would think of when you think about antidepressant drugs. And so this works a little bit differently, and that's why they think it works for people with treatment-resistant depression. But this is sort of the only drug out there right now that's like this. There are a lot of other companies that are working on psychedelic adjacent treatments for mental health disorders. None of those other ones are approved yet, but they are getting there. And Trump actually had an executive order earlier in April to expand access to some of these psychedelic treatments. So the thought is that it's really going to sort of usher in this new era of mental health and depression treatments, and this market could be pretty enormous.
Is this covered by
the end of the
health
decade.
insurance? That's a big issue.
Yeah, so I mean, that's one of the things that this, Spravato drug, that's one of the things that helped it really take off. Once it got FDA approval, that then allowed insurers to cover it. But at first, since this was such a different type of drug, I mean, usually people with depression are used to taking a pill at home. This is something that they had to go into the clinic for, and then there's this monitoring period. Insurers didn't really know how to bill for this at first. They were treating it like a traditional 30, 40-minute office visit, where people were actually staying there for several hours. And so they, J&J, the company, worked with clinics, worked with insurers, and they figured out the billing situation, figured out how to reimburse for this. So that made it possible for more and more clinics, more and more doctors to offer it to patients.
All right, cool, very cool. This is a great story, folks. Check it out. You can read this story and all the other big take stories on the Bloomberg Terminal and at Bloomberg.com/big take. Some really, really good stories. Good reporting, great, cool, fun graphics to kind of bring it to life. Madison Muller, health reporter for Bloomberg News, joining us live here in our Bloomberg Interactive Broker Studio with that cool story and good news for those folks suffering from depression. Looking at the markets here, we got holding on to some green here off the highs of the day, but still positive here pretty much across the board with the S&P up 48 points, 0.6%. NASDAQ is up 290 points, 1.1%. So keep an eye on that. Oil down $4 on WTI crude oil to $101 per barrel. For our listeners in the U.S., a reminder, you can listen to us via satellite radio on Sirius XM channel 121. Access the world's only global audio business network coast to coast 24 hours a day. Bloomberg Radio on Sirius XM channel 121 is presented by Golden Crest Metal. Stay tuned for the latest market news and industry research. Your top stories and global business headlines are coming up in just a minute. 10-year Treasury yields right around 4.37%, pretty steady on the day. This is Bloomberg.
Markets, headlines, and breaking news 24 hours a day at Bloomberg.com, Bloomberg Television, and the Bloomberg Business app. This is a Bloomberg Business Flash.
From Bloomberg World Headquarters, I'm Charlie Pellet. We have got the Dow, the S&P, NASDAQ all advancing. This is oil retreats, the VIX below 17. Two developing stories. President Trump moments ago saying he is raising tariffs on cars and trucks from the EU to 25%, claiming that the bloc had failed to fully comply with a trade agreement negotiated with the United States. In the airline industry, we're looking at shares of Spirit Airlines plunging right now by 60%. This after the Wall Street Journal reported that the airline is preparing to cease operations. Shares of peers, including JetBlue and Frontier Group Holdings, jumping on the news. Frontier shares, they're up by 9.1%. JetBlue up by 6%. Other airlines also gaining right now. We do have UAL up by 3.5%. American up by 1.7%. Delta is up by 3%. Bottom line here, stocks are pushing higher. We are off session highs, but for the S&P, NASDAQ 100 index, we are looking at records. S&P up 48, higher by 0.7%. NASDAQ up 298, gain there of 1.2%. The VIX, as I mentioned, below 17 with a 10-year 4.37%. Gold up $26 the ounce, 46.44, up 0.6%. West Texas Intermediate crude still above $100 a barrel, $100.80 now. It is down, however, 4.1%. Barrel of Brent down 2.6%. Brent crude 107.44 for a barrel of Brent crude. Iran has delivered a new proposal to the U.S. via Pakistan as the two sides pursue behind-the-scenes diplomacy to turn a fragile ceasefire into a lasting peace.
Business News Live. We're going to have the latest on the standoff in the Strait coming up here with Adam Fair, and I guess we may as well do that right now. Let's get you the latest on Iran. On this 60th day of the war. It depends who you're talking to about this, though, and this does remain a question here in Washington, with the president notifying Congress that the war began 60 days ago. But the administration is projecting a different take on this, suggesting the ceasefire either stop the clock or reset the clock. We're going to have more on this coming up. We're told that the president's going to be talking soon. I don't think we have a 2-minute warning yet, but I guess we'll hang out and wait for him to start here. With Adam Farrer joining us from Bloomberg Economics, and our eyes on oil prices here today. They are lower yet, despite the fact that the standoff in the Strait continues. Adam has been a very valuable voice in this whole conversation so far and joins us once again to top things off here on this Friday. It's great to see you, sir. Thank you.
Yeah, great to be here.
I guess the sort of obvious question, without turning you into a stock strategist today, is how can we be in such a good mood on Wall Street, oil prices lower, stocks rallying, when unless you could tell me otherwise, nothing's really changed.
It is the question that continues to, perplex many of us as we look at the current situation. There's no doubt that markets continue to see a more optimistic trend line moving forward. And, part of that is driven by, earnings that we saw in the past, 48 hours that is kind of propelling stocks forward. But they're not seeing the headwinds that I think many of us on the geopolitical risk side are as we look at a continued stalemate in the Strait of Hormuz and a lack of real movement in between the two sides on finding a sustainable path towards de-escalation. The market seemed to have moved a lot this morning just on the idea that Iran had responded to a U.S. Offer on restarting peace talks, but we don't have any of the details. We don't know if Iran has moved closer to any of the positions the United States has taken, particularly on not sequencing the conversation, right? Reports earlier this week were that Iran offered to have a conversation to reopen the Strait of Hormuz, to reach a ceasefire, but push off nuclear negotiations. But the White House rejected that. So the question now is, did they move closer to that? But even if they do, there are still huge gaps in what they see as an outcome that is sustainable on those issues as well.
Really interesting to wait for the latest proposal from Iran. We've been back and forth with this counter proposal, and the latest position to Washington via Pakistan has been delivered. It is unclear what is in this proposal, but everything we have heard so far from Iran would bring us back to where we were before the war started, with no guarantee on nuclear enrichment or the status of the nuclear program. Do we have any reason to believe that could be different here?
So it's always important to know that in the public domain, everyone is posturing, right? And certainly the Iranian regime is very well known for that. But, both sides are doing this. So just because we heard a lot of chest thumping this week from Iran on maintaining control of the Strait and its own determination of its technological control of its ballistic missiles and its nuclear program, that doesn't mean that what they're talking about in the back rooms with the United States is not more flexible. But nonetheless, from the failure of the talks we've seen so far, it's clear that they haven't been able to move closer to the U.S. position, or at least not where the Trump administration wants to see it. And while markets are moving forward, in a very positive environment today, it's worth noting that we're hearing from major oil producers their own concerns about supply shortages, from ConocoPhillips, from Chevron, just in the past 24 hours, with C-suites highlighting their deep concerns about supply shortages, particularly in the most import-dependent economies.
I'm glad you point that out. Chevron and Exxon shares are trading lower today, despite this idea, the sort of halo effect around what's happening. They're printing money, the prices are through the roof, and they might keep going higher. But the idea of this disruption making business more difficult, the CEO at Exxon suggesting today it would be a good 2 months, he said, to get flows through the Strait going again after it is reopened. So if this ended today, we're deep into summer before the oil market is rationalized. Is that right?
I mean, certainly that's what they're seeing. And I think most folks looking at this both from an oil side and just a shipping logistics side would say that looks likely, right? We're looking at a lot of friction and uncertainty permeating through the market, even if we do reach some sort of ceasefire. And the question then becomes, does the market and do shippers feel that any such deal is sustainable enough to actually move their ships back in, right? Because they know that if their ships leave the Strait, leave the Gulf, that's great. But if they go back in, they could be locked in for another 6 months if a war breaks out.
We may be hearing from the president at some point here. He's expected to talk before he leaves town. He's going to be going down to a little bit of a garden party in the Villages down in Florida. But we have no indication that he's about to come out. It's a good thing we started the show early here. What questions are you going to be asking going into the weekend? The president was presented a series of military options yesterday. So there's a feeling, despite the optimism on Wall Street, at least for now, that there could be a resumption of strikes. Are you running odds on this, or do you have a gut check on whether that's the next step?
It certainly feels like it's a fool's errand to be sure of where we're going
sure,
here,
right?
But there does appear to be a distinct risk that the president is calculating the need to re-escalate, whether that is widespread strikes or more limited targeted actions related to the Strait of Hormuz. We don't know, but there is a real chance that he sees this current stalemate as, not abiding by his own interests, and that there is a need to break through and try and pressure and increase the pressure on Tehran. He did comment that he sees the blockade arguably as more effective in increasing that pressure. But even if that is true, the timeline is significantly longer on how much pressure is actually building in Tehran, and also the reality that for the Iranian regime, this remains an existential question. And while the pain will grow in the economy and there are real risks for them, that doesn't mean they're willing to just back away from their demands. And so with that in mind, there is a risk the president may decide to escalate here in the short term as he looks to find a way to end this crisis.
Do we have a sense of what kind of options he's looking at? Is it what we've already heard? Is it seizing Karg Island, for instance? Is it laying troops on the shores of the Strait? Or have we progressed beyond those initial ideas and we need something more creative? The president has talked about infrastructure, civilian shared infrastructure, even in his post as recently as yesterday.
So the president continues to talk about going after new targets, right? Kind of dual use infrastructure, whether that be logistics, transportation, or energy, which is really what he's focused in on. And that's certainly possible. What's likely is that U.S. CENTCOM and the Department of War put in front of him a series of options from low, medium, and high, looking at, again, just going after targets in and around the Strait of Hormuz that may limit or allow Iran to continue to pressure ships that are transiting through. We've seen these small boat tactics continue to come up with ships remaining in the Iranian Navy that are capable of harassing and seizing shipping. But that also could expand to targets in and around Tehran and around the country as they look to go after both those new targets, infrastructure, but also Iran's effort to reconstitute its ballistic missiles and any of the related targets that it's either brought out of storage or found more.
What do you make of this state? I don't know if you saw this on X from Iran's parliament speaker, Ghalibaf. Good luck blockading a country with those borders, referring to his country's very large size. We know that, for instance, they were talking about putting oil on trains to China. What's he getting at?
So I think, he continues to be in a back and forth Twitter war with the U.S.
Would that suggest, though, that there are avenues other than the Strait to export oil?
So there absolutely are, right? And there are overland options for Iran to move goods. But the reality is there's a reason that they haven't been doing that for the decades before, right? It's inefficient, and it is not an effective way for Iran to move particularly oil out of the country. And so while there's certainly mechanisms by which they can import some goods and export it, those are not efficient, and Iran certainly would not be in a good position.
So this is really not a realistic kind of thing to boast
It is
about.
not, right? I mean, I think the reality is there's a reason all of Iranian oil transits via large tanker through the Strait of Hormuz.
Fascinating. We've got a lot of forces over there, and this is now the 60th day, if you're playing along on your home game of the war. And that might sound weird because we've been at this for more than 60 days, but it's been 60 since the president notified Congress, right? That's how it works under the War Powers Act. Typically, at this point, you would need some approval from Congress to continue the operation, although the president also can request an additional 30 days. And that's under the guise, if you read the War Powers, and everyone's becoming an armchair expert on this, under the guise of the War Powers Act that the president is taking issue with. Even if he gets to 90 here without a request, there's a question about whether Congress is going to step up. But the White House says, no, you got the count wrong. Because we have a ceasefire, that stops the clock. That's what Pete Hegseth said yesterday in his hearing. The administration telling the New York Times it resets the clock, which says to me that we're back to zero. How is the war allowing all of this? The law, I should say, allowing this.
So there is, as you said, a clear difference in opinion between many legal scholars and the White House on the War Powers Act and the requirements that are put on the executive and Congress to act. And that is being worked back and forth vociferously right now. What's interesting, though, is that even if one were to look at the ceasefire, coming into place in early April, the U.S. has now imposed a blockade on Iran, which by most measures is considered an act of war. So that raises further questions about what qualifies as a military action against another country. And the sad reality is that this issue is unlikely to be adjudicated from a nonpartisan perspective. I think we're going to hear distinct interpretations from the Democratic and Republican sides with their vision of which way this should be going. Clearly, with the Democrats pushing for some sort of action from Congress that they feel is legally required, while Republicans, as we've seen throughout the President Trump's term, are unlikely to push back significantly.
Interesting. We've got a poll out. We talked to our panel about this, President Trump's war in Iran. is rather unpopular among Americans, and specifically younger Americans, to the point where we haven't seen numbers like this since the Vietnam War in the early 1970s. And this is beyond your remit, but I wonder if it does bring us back to the idea of wrapping this up quickly, which the market likes to. Any time there's a sense of this in the air, the market starts to rally. And maybe that's what we're doing here today. The fact that we're at least talking about talking seems to be driving the news.
Again, I think there's no question that President Trump is looking for an off-ramp from this crisis. The question is whether he feels he can find one where he can claim enough of a victory to walk away. And that is what's outstanding here. And Iran has not seemed interested in giving those aspects in negotiations that would be required for that. And so the war is certainly deeply unpopular. You know, we've seen oil prices, or excuse me, gas prices in the United States go up significantly this week, just day on day. And all of that is going to keep driving worse and worse polls on Americans' perception of this conflict. But while there is this narrative that Trump could choose to walk away from it, right, declare victory and walk away despite the remaining issues, I think the reality is that the Iranian control of the Strait of Hormuz is increasingly restricting his ability to do that, because it will continue to drive energy prices higher. And, you know, we had some distinct quotes this week from Secretary Rubio and others declaring that Iran's control of the Strait is unacceptable. And while certainly, you know, the administration could change its position, it does seem that if the Secretary is willing to come out so strongly there, that is becoming, or is, a red line for the U.S. So, you know, the ability to back away despite all of this pressure is diminishing.
Fascinating, as always, Adam. Thank you for a great talk. This weekend could be interesting. We'll find out together. Adam Fair, Bloomberg Economics, one of our geoeconomics analysts who has been indispensable here with our Iran coverage. As I look down with more on this poll, again, this is the Washington Post and Ipsos working together. 61% of Americans say using military force against Iran was a mistake, with fewer than 2 in 10 Americans believing that the U.S. actions in Iran have been successful. 4 in 10 say it's been unsuccessful. Another 4 in 10 say too soon to tell. I mentioned young people. There's pretty remarkable numbers here. And independents who lean toward the Republican Party roughly split, with 52% saying it was the right decision, 46% saying it was a mistake. Those are the numbers we're going to be looking at real closely during the midterm election cycle, of course. Thanks for joining us here on the Friday edition of Balance of Power. We're staying live here for the president. Is that what's going on? Okay. I guess that's, well, we'll see if he comes out at some point soon here. Some of the other stories that we're following. The president says he's raising tariffs on cars and trucks from the European Union to 25%, claiming the bloc had failed to fully comply with a trade agreement negotiated with the U.S. What are we doing here with this, guys? I think we're going to talk. Craig Trudell is with us in New York. Craig, can you tell us a little more about this story and the impact it might have?
Yeah, I mean, this is quite a bomb throw in the middle of the afternoon on a Friday, and it happens to be May Day in Europe. So I'm sure a lot of folks in Brussels and elsewhere around the bloc are absolutely thrown for a loop here. This isn't, of course, a huge shock in that we've known for many years that Donald Trump has had strong views about the number of cars flowing into the U.S., particularly from Germany. I remember just on the campaign trail the first time around he was going for the White House, talking about all the Mercedes and BMWs that he sees on Fifth Avenue around his building and how unhappy he was about that. This is, sort of a go-to thing for him to rail about whenever and when he is often talking about trade issues with Europe, that cars in particular are front of mind.
The new levies would not apply to automobiles built in U.S. facilities, according to the president. Says there will be no tariff if they produce cars and trucks in USA plants. Are we seeing anybody retool to start actually moving operations here?
I think part of what makes this storyline so fascinating is the fact that BMW and Mercedes do have plants, big plants down in the South. BMW's factory in Spartanburg, South Carolina, is its largest in the world. And for years now, BMW has consistently bragged about how they are the biggest exporter of vehicles from the U.S. By value year after year. this is a major source of production for those manufacturers of SUVs that will insulate them somewhat from this. But you think about just the sort of breadth of these companies' lineups. They have a lot of sedans and models that are brought over from Europe. You also think about particular brands that don't have any manufacturing whatsoever, not just in the U.S., but in North America. You think about Porsche comes to mind, of course. And you also have some companies that are have significant American presence, like Stellantis immediately comes to mind, where, Alfa Romeo, Fiat, Maserati, these are all brands of vehicles where, they're producing in Italy. They will be hit as well. So, while we don't have any trading for European manufacturers like Mercedes or BMW or Volkswagen, we are seeing Stellantis get hit pretty hard this afternoon as a result of this announcement from the president.
Interesting. Will there be anything reciprocal, do we understand, from overseas countries in light of this, or is it too soon to tell?
I think it's difficult for Europe to hit back, at least in automotive trade, because to the president's point, this is a one-sided situation with the automotive industry, where GM in particular just out and out pulled out from Europe years ago. Ford does have a presence in Europe, but it's primarily the case that vehicles that they manufacture locally are what they sell over there. There's not a whole lot of appetite for big F-150 pickups in Europe. They don't fit in on a lot of the roads in places like London or Berlin, and so there's not a whole lot that Europe can hit back on, at least in automotive trade. But in terms of ways for Europe to retaliate, it would likely have to be a matter of targeting sectors other than automotive, to retaliate in this case.
Got it. Craig, thank you for jumping on this. Craig Trudell, Bloomberg News Global Autos editor, with us live from New York. I'm Joe Matthew in Washington, ever waiting for the president. Let's check the markets right now while we have an opportunity. Charlie Pellet has that from New York.
Thank you very much, and here's what's going on. Let's recap and reset on the tariff story. President Trump saying that he is raising tariffs on cars and trucks from the EU to 25%, claiming that the bloc has failed to fully comply with the trade agreement negotiated with the United States. Now, on an up day for U.S. equity markets, we are looking at the automakers declining. A case in point, Stellantis right now down 1.7%. We do have Ford shares lower now by 2%. General Motors trading lower now. We've got GM down by just about 1.2%. Dow higher, S&P, NASDAQ as well, also advancing. S&P and NASDAQ, by the way, they are advancing. S&P 500 index up 45. That is a gain of 0.6%. We've got the Dow Industrials up 17. Now, little change there, up under 0.1%. On NASDAQ, higher by 280 points. A record for the NASDAQ Composite Index, up now by 1.1%. We did hear from Apple last night. Apple shares, they are surging now, up by 4.8%. And the Bloomberg Mag 7 Index, it's advancing as well. Right now, the Mag 7 Index up by 1.5%. All of this comes with the VIX below 17, the 10-year 4.36%, with the 2-year 3.86%. Spot gold up $31 the ounce, up 0.7%. And West Texas Intermediate crude, $101 the barrel, down now by 3.8%. Major developing story at this hour in the airline industry. Sources tell Bloomberg Spirit Aviation Holdings is laying the groundwork to shutter its operations as it runs increasingly low on cash. Now, Spirit, you'll recall, had been in talks with the U.S. government on a rescue financing mission, but those conversations hit an impasse in recent days. Sources say the airline is making preparation to wind down as its liquidity position worsened. Right now, we've got JetBlue down by 62.7%. Recapping, S&P up 46, up 0.6. I'm Charlie Pellet. That is a Bloomberg Business Flash.
All right, Charlie, thank you. Charlie Pellet will have more on the markets a bit later on this hour as we wait to hear from the president. Thanks for being with us here on the Friday edition of Balance of Power. President Trump has just left the Oval Office. If you're with us on YouTube, you can see him. He's walking over to the press pool assembled in the driveway on the south side of the White House ahead of his trip to Florida. We are hoping to get some answers to questions on a lot of issues, including the tariffs we just discussed, the war in Iran. Let's listen live now on Bloomberg.
So they want to make a deal, but I'm not satisfied with it, so we'll see what happens. Iran wants to make a deal because they have no military left, essentially, and they want to make a deal, but I'm not satisfied with it.
Mr. President, why are you not seeking congressional approval to extend it?
Because it's never been sought before. There's been many times, and nobody's ever gotten it before. They consider it totally unconstitutional. But we're always in touch with Congress. But nobody's ever sought it before. Nobody's ever asked for it before. It's never been used before. Why should we be different? We have great respect for Pakistan and Islamabad and tremendous respect for the Prime Minister and the Field Marshal. And they're working with us. They continue to work with us. But the trip is a very long one, and we're doing everything in terms of negotiating right now, in terms of the negotiation telephonically. They've made strides, but I'm not sure if they ever get there. There's tremendous discord. They're having a tremendous problem getting along with each other in Iran. The leadership is very disjointed. It's got 2 to 3 groups, maybe 4, and it's a very disjointed leadership. And with that being said, they all want to make a deal, but they're all messed up. I spoke with the winner, a very good man. As you know, I was very strongly in favor of him in Iraq. And we had a long conversation yesterday. I congratulated him. He won, and with our help, he won, and we want him to do very well. And I told him that the United States is with him all the way. It was a great victory. The new head of Iraq is somebody that we support very strongly.
Pakistan, Pakistan has opened the land route with Iran. Did they consult you before opening it up to Iran? And are you aware of it?
That was a vicious bee. I know everything about it. Yeah, I have great respect. Are you from Pakistan?
No, I'm not from Pakistan.
I have great respect for Pakistan and for the Field Marshal and for the Prime Minister. Yeah, I know that.
On the European Union yesterday, you talked about Italy and the withdrawal of troops from Europe, from Italy and Spain. Can you clarify with your words?
Well, I'm not happy with Italy and I'm not happy with Spain. And they feel it's okay for Iran to have a nuclear weapon. Anybody that feels it's okay for Iran to have a nuclear weapon is not very smart. And it'll be a terrible thing in the future. If they were ever allowed to have a nuclear weapon, you would have problems the likes of which the world has never seen before, and it's not going to happen. And aside from that, right now they have no Navy. It's been wiped out. No Air Force. It's been wiped out. They have no anything. They have no anti-aircraft. They have no radar. They have no leaders because, frankly, their leaders are very disjointed. They have a lot of problems right now. They're not getting along with each other. Their leaders are not getting along with each other. So. We raised the tariffs on cars coming in from the European Union because the European Union was not adhering to the trade deal we have. So based on that, now, when they build their plants, of which they're spending over $100 billion, all countries, not just the Union. When those plants open, there won't be any tariffs. But we raised the tariffs because they were not, as usual, they were not adhering to the agreement that we have. We have a trade deal with the European Union. They were not adhering to it. So I raised the tariffs on cars and trucks to 25%. That's billions of dollars coming into the United States, and it forces them to move their factory production much faster. We have right now in the United States over $100 billion of car plants being built. It's a record. We've never had anything like it from all countries, Japan, South Korea, by the way, Canada, Mexico, they're all building plants in the United States. But the European Union was not adhering to the deal that we made. To each other. They're not getting along. They're very, very confused by what's happened because essentially most of their military has been wiped out. But we just had a conversation with Iran. Let's see what happens. But I would say that I am not happy. Their leadership is very disjointed, very argumentative with each other. They come back, one says one thing, one says another. They're very confused. Obviously, their country has been, frankly, decimated. Their Navy is gone, their Air Force is gone. Many of their soldiers, unfortunately, are gone. They've got to come up with the right deal. At this moment, I'm not satisfied with what they're doing.
Did you decide against bailing out Spirit Airlines?
Well, I guess we're looking at it. If we could do it, we'd do it, but only if it's a good deal.
Claiming that they're preparing to shut down this weekend because they haven't gotten a deal.
Well, we're looking at it, but if we can't make a good deal, no institution's been able to do it. I said, I'd like to save the jobs, but we'll have an announcement sometime today. We gave them a final proposal.
Excuse me. Mr. President, it's day 60. Are you going to seek congressional authorization for...
Well, no other country has ever done it. It's never been, as you know, most people consider it totally unconstitutional. Also, we had a ceasefire, so that gives you additional time. But no other country's done it. We're in the midst of a big victory. This is a victory like we haven't had since Venezuela, okay, to be honest with you. We haven't had, but, you know, we have a country that lost its way. It really lost its way. That's our country in terms of the military. Now we have a great military. We're on our way to another victory, a big victory, and I don't think that it's constitutional what they're asking for. These are not patriotic people that are asking. You know, when they say, even the losers, even the ones that say all the wrong things, admit that it's been amazing what we've done. The Strait is totally shut down. It's flawless. It's totally 100% shut down. Now, we've been dealing with Iran. They want to make a deal. They're not there. They're not with it. They're sort of, they get close, and then a new group of people come in. They don't know who their leaders are. They have no idea who their leaders are, but they're very confused, and that's because of the success we've had militarily. They essentially have no military. Let me just tell you, the war powers. So many presidents, as you know, have gone and exceeded it. It's never been used. It's never been adhered to, and every other president considered it totally unconstitutional, and we agree with that.
Will Iran affect your China trip given the blockade?
No, the China, it's going to be amazing. The visit with China and Chairman Xi, that's going to be great. We have the trip with China coming up. And I think it'll be an amazing event.
Mr. President, if you can't get a deal on Iran, what next? What will you do?
Well, right now we have negotiations going on. They're not getting there. They are very disjointed. They're extremely disjointed. They're not able to get along with each other as leaders. They don't know who the leader is. Their military has been defeated. If we left right now, it would take them 20 years to build back that country, but we're not satisfied at this moment.
Are you considering new strikes on Iran?
Why would I tell you that?
Spirit Airlines, what has been the holdup on a deal? Are they balking?
We're looking at trying to help them, something we're not looking to get involved with, but if we can, it's 14,000 jobs. We are, I would say we're driving a tough deal, but it's one of those things that we'll do it or we won't. We'll have something for you today or tomorrow.
It seems like the other lenders are balking. They think they'll get bumped down in priority.
Well, they will, you know. We come first. Hey, you know what it is? USA first, America first. That's my point. Including with airlines, including with Intel. You know, we made an Intel deal. You know that, right? We made about $40 billion on that. And someday Fox and Peter is going to talk about it. But we helped out Intel, and we ended up making $40 billion. So we're looking at Spirit different kind of a thing. But we're looking at Spirit, and we can help them, we will. But we have to come first. We're first. It's America first.
The CEO of Anthropic came to meet Susie Wiles a week or two ago. What is the latest on your position on that company?
Well, only that they had a very good meeting.
You had the CENTCOM commander come in here yesterday. Was he briefing you on a different approach, options? What kind of options? How would it look different?
Well, there are options. I mean, do we want to go and just blast the hell out of them and finish him forever, or do we want to try and make a deal? I mean, those are the options.
Do you want to go blast the hell out of him?
I'd prefer not. On a human basis, I'd prefer not, but that's the option. Do we want to go in there heavy and just blast them away, or do we want to do something? They're a very disjointed unitship, as you can understand, Peter, very disjointed. I mean, they're not getting along with each other, and it puts us in a bad position. One group wants to make a certain deal, the other group wants to make a certain deal, including the hardliners. The hardliners want to make a deal too. Why wouldn't they? They have no Navy, they have no Air Force, they have no anti-aircraft, they have no nothing.
There were some reports this week that because of all the firepower required for Epic Fury, that there are people in the White House who are starting to worry about our inventory of bombs and missiles. Are you worried?
No, we have more than we've ever had, actually. Because all over the world we have inventory, and we can take that if we need it. But all over the world we have tremendous amounts of inventory, the best. For instance, we're stocked and locked and loaded. Right now, we have more than double what we had when this started. But, you know, we're all over the world. We're in many, many different countries, many different places, all packed up. Now, what happened is Biden came in like a stupid fool, and he gave a lot of what we had to Ukraine. Right. And the $350 billion they spent, we don't do that. Everybody has to pay. The European Union pays us, but Biden didn't get money. He got nothing. But he gave a lot of the inventory away. Now, relatively speaking, it's not that, but it was a lot of inventory. He gave it to Ukraine. We built it up, but we have inventory from all over the world.
Are you going to go to the G7? The G7 is in France in June. Will you go to it?
Probably.
Mr. President, will the Lebanese and Israeli leaders be meeting here soon? Mr. President? President NATO.
What about NATO?
Did the king change your mind? King Charles?
No. The king and I had a great, he's just a great person. He's a high-quality person. I love the job he did in Congress. He actually got the Democrats to stand. He's a wonderful person. She's a wonderful lady, a wonderful queen, and we had a good time.
Mr. President, will the Lebanese and Israeli leaders be meeting here soon at the White House?
Yeah, they're going to be coming.
And President Trump, when you go to this is going to be your first big public event since somebody tried to kill you on Saturday. Do you feel safe going to something like this today?
I don't even think about it, Peter.
You still support a pardon for Pete Rose, sir?
Oh, I think Pete Rose was great. I think Pete Rose should have been in the Baseball Hall of Fame a long time ago. A long time ago before his death. I think baseball did a great disservice by not respecting his achievements on the field. He was a great player. I knew him.
Mr. President, sir.
He was a great player.
Will you pardon him?
It
seems like it would have to be your blockade, and you don't have to restart the war, or you don't have to make a deal. Is that correct? Are you happy with the blockade?
The blockade has been unbelievable. Powerful, 100%. It's been actually unbelievable. If we left right now, we had a great victory, but we're not doing that. We're negotiating with them. Their teams are unbelievably disjointed, but we are negotiating.
Mr. President, the NASDAQ and the S&P 500 posted their biggest monthly gain since your first term, sir. Can you talk about what this means to you, the stock market performance, and do you believe that this is going to continue throughout the rest of your term?
Thank you. The stock market is hitting record numbers. We have more people working in the USA today than we've ever had working, as you know. It's in many ways. Now, when this war ends, gasoline and oil and everything is going to come tumbling down. But right now, as of this moment, the stock market has hit record highs. We have more people, again, working in the United States today than at any time in the history of our country. We are really doing well. Now, gasoline's high. Other prices are way down, but gasoline's high. But when this is over, you'll have a world without a nuclear weapon with Iran. If you allow Iran to have a nuclear weapon, the world would be in great jeopardy. So it's not going to happen. As soon as the war ends, the gasoline prices will
You're going down to the villages. You're going to be talking to our seniors. You've delivered for seniors, no tax on Social Security, most favored nations. Can you talk about everything that you've done to help our senior population, sir?
Will be well. No tax on tips. We have the largest tax cuts in the history of our country also, and regulation cuts, and it's one of the reasons we're doing so well. So we have no tax on tips, no tax on Social Security for our seniors. We have no tax on overtime. And you know, something that nobody talks about, if you buy a car, if it's American-made, you get a deduction on interest for income tax purposes.
But Mr. President,
and by the way, very importantly, right over there, the greatest, you're going to have the greatest ballroom ever built. It's on time, on budget, and it's doing great.
Mr. President, you're going to be hosting the first ever UFC fight at the White House in 45 days, sir. Can you preview the event? Can you talk about the card and what this will mean?
They have some of the greatest champions in the world. The arena, they're going to start building it over the next week. It's right here. It'll be about 5,000 seats. They'll have 100,000 people down by the ellipse with screens, and it's all free. It's going to be great. I got to go. Well, it was just announced we have more people working in the United States today than ever before in history. Outside of the gasoline, prices are way down. Prices have come down. I inherited that. We inherited the highest inflation in the history of our country, 48 years. But in the history of our country. And prices are down. When the war ends, which shouldn't be too long, they want to make a deal so badly, but they're not there yet. They're not there, in my opinion, they're not there. When the war ends, gasoline prices are going to tumble because there is so much right now on the seas already loaded into tankers that can't escape the strait. There is so much, like record-setting. But when the war ends, gasoline prices will go down to below what they were. I think it's very important. The stock market just hit an all-time high. And again, more people working today than at any time ever. And we just got the largest tax cut in history with the no tax.
Mr. President, you, Mr. Kurdish here.
You like him?
This guy?
Yeah. Go ahead.
Mr. Kurdish. I love you, Mr. President. Mr. President, thank you, Mr. President. Mr. President, you said you sent weapons to help Iranian demonstrators. Some sources claim these weapons are in Suleimania, in Iraqi Kurdistan. Do you confirm that? And as you said, they will pay a big price?
I'm not happy with the delivery of the weapons. I'm not thrilled with it. But a small amount of weapons were sent, and we'll see who has them. But I'm not happy with what happened with the Kurds. The Kurds did not deliver the weapons. Like
Exxon and Chevron are refusing to increase oil production. Exxon and Chevron, what do you say about that?
We're doing great production. We're producing more oil right now. That's the other thing. We have more oil production right now than any time in history. And if you take a look at the ships, they're all coming up to Texas, Louisiana, Alaska. Did you see the line? What do they call it? The Tango. But that is some line of ships. They're all coming up. They're loading up. The biggest ships in the world are coming up to Louisiana, Texas, and to Alaska. And they're loading up. And I don't want to say it, but our country is getting stronger and stronger. This has been amazing. The amount of oil and gas that we're selling now is at a level that nobody's ever seen before.
Would you consider Ron DeSantis for a cabinet position?
Well, I like him a lot, so nobody's asked. I like him a lot.
You're not satisfied. Mr. Ron, can you tell us, you said you're not satisfied with the plan right now. Can you tell us what specifically you're not satisfied with?
They're asking for things that I can't agree to.
All right, there you have President Trump wrapping Q&A with reporters there in the driveway, making his way over to some folks on the rope line. Those are not reporters if you're watching us on YouTube. Sometimes he just likes to greet onlookers who happen to be on the campus before he gets on Marine One, and that's the next move here. Get on the chopper, which you heard whirring in the background, on the way to Florida. The president's headed to the Villages, where he's a rather popular guy. No word on whether the boat parade is waiting for him there, but he will have a very friendly and receptive crowd when he talks to those folks a little bit later on today. I'm Joe Matthew in Washington. Thanks for being with us here on the Friday edition of Balance of Power. Really interesting conversation there from the president. He did make some news. When it comes to the war in Iran, he said they're working with us and they continue to work with us, as he likes to say, telephonically. They're on the phone. He says the trip's a long one, and we're doing everything in terms of negotiating right now. When it comes to the 60-day congressional authority, he was asked directly about this. This is, on this May Day, day 60, since the president notified Congress about this action, not necessarily when the first bombs were dropped. Knowing that the White House is projecting opposition to this idea, the War Powers Act that the president now calls unconstitutional, suggesting that the ceasefire in place either stop the clock or reset the clock on that 60 days. He says no other country has ever done it. It's never been done. Most people consider it totally unconstitutional. Also, we had a ceasefire, so that gives you additional time. He says many presidents have gone and exceeded it, that 60-day threshold, when it comes to war powers. Speaking also quickly to tariffs on cars coming in from the European Union, he says because the European Union was not adhering to the trade deal we have, the 25% he just announced today, and on Spirit Airlines, the idea of bailing out Spirit. Stock's been plummeting here as the company says it's going to shut down, according to a report without a deal with the White House. He says, I guess we're looking at it, but if we can't make a good deal, no institution's been able to do it. He said, I'd like to save the jobs, but we'll have an announcement sometime today. The sell-off in Spirit, we're going to hear about this from Charlie, pairing some losses but still deep in the red. Let's update the markets now before we assemble our political panel. Charlie Pellet at the helm right now at World Headquarters in New York. Hey, Charlie.
A lot's going on, Joe Matthew. We got you covered. Let us begin with Spirit Airlines. You mentioned the stock selling off, down now by 27%. At one point just an hour ago, we had shares down by roughly 70%. President saying he will have an announcement later on today. In the meantime, other airlines are advancing. We've got shares of Frontier Group Holdings, ULCC, ultra low-cost carrier on the ticker, up now by 6.3%. JetBlue shares, they're gaining 4.3%. JetBlue, of course, trying to acquire Spirit. Among some of the other major carriers, they're gaining as well. UAL, United, up 2.7%. American shares right now up 1.3%. Delta is gaining by 2%. The other big story, President Trump just talking about it, he is raising tariffs on cars and trucks from the European Union to 25%, claiming that the bloc could fail to fully comply with the trade agreement negotiated with the United States. Now, the automakers lower. Stellantis shares down 0.2%. Ford down by 0.2%. GM down by 1.2%. Dow Industrials, they have given up earlier gains, down now by 48 points, down 0.1%. Any advance today for the S&P will be a record, up 32 points, up by about 0.4%. NASDAQ up 222 for NASDAQ. That is a record, a gain now of 0.9%. NASDAQ NASDAQ 100 index also up by 0.8%. We've got the VIX trading below 17, the 10-year 4.36%, spot gold up $21 the ounce, 0.5%, and West Texas Intermediate crude, we are seeing a retreat. WTI down now by 3%, 101.98 a barrel. As the spread to Brent comes in, we have got Brent trading 108.25, down now by 2%. I'm Charlie Pellet. That is a Bloomberg Business Flash.
Charlie Pellet live in New York. I'm Joe Matthew in Washington, and we want to connect before our panel quickly with Tyler Kendall, who's made her way to the North Lawn as the president just took off on his way to Florida. Our Washington correspondent, Tyler, the president made some news here, and he does seem intent on making a deal with Iran, having been asked directly if he wants to resume strikes, and he says he doesn't want to, or at least he hopes not to do that. Are we getting any signal from the administration on what's next?
Well, Joe, at this point, it appears evident that President Trump feels that maybe there is some path forward when it comes to diplomacy. You can probably hear Marine One is still taking off right behind me. But the president said that strides are being made. But at the moment, he's not satisfied with the latest proposal put forward by Iran, saying that there are things that he just cannot agree to. And as you all know, this comes after earlier today, Iranian state media confirmed that Iran had sent via Pakistani mediators an updated proposal. The thing is, we didn't get any indication on exactly what was in that fresh proposal. We just know what the U.S. didn't like from the previous proposals, including that Iran had suggested that there could be a postponing in dialogue when it comes to its nuclear program. And instead, the first stage of this could be a reopening of the Strait of Hormuz in exchange for that naval blockade being lifted. But Joe, as you heard the president there, seems like no indications this White House is going to let up when it comes to the Strait.
You might have to duck there, Tyler, with Marine One going right overhead. Tyler, thank you. She'll be back at the top of the next hour to recap everything that we heard. The president also speaking to Spirit Airlines, speaking to tariffs on European cars. Let's assemble our panel for a quick swing at this. Both have been very patient in waiting for us to get through that whole conversation. Bloomberg Politics contributor Jeannie Shanzano is with us, our Democratic strategist and democracy visiting fellow at Harvard Kennedy School's Ash Center, and Rosemary Becky, Republican strategist, partner of Brownstein Hyatt. Great to see you both. Jeannie, what are you reading into here when it comes to this White House? It does sound like a president who would much rather make a deal than go back to war. How about you?
He absolutely would, and he's right on that. There is only a negotiated settlement possible here, and it is good news to hear the president talking like that. You know, some of what is coming out of the White House, and quite frankly, other aspects of D.C. and elsewhere, this idea that there's nobody in Iran to negotiate with, really has to be reconsidered. You listen to scholars like Vali Nasser at SIZE, and he talks about the fact that the supreme leader is well in place. We heard from him for the first time yesterday. It was an audio, not a video, but he is in place. He has a team in place. And when you listen to that audio tape from yesterday, he is very clear. They will retain control of the Strait, and they are demanding to retain their nuclear program. And I say that because that's what makes the president's insistence on negotiation, which again I agree with, so difficult, is the two sides remain so far apart. And while the Iranians can hold on to that for a while, it's difficult for the president as we look at the most recent polls.
Hey, Rosemary, and we can talk about that new poll in a minute from Washington Post and Ipsos. It's not good for the president or for Republicans. Rosemary, what do you make about this debate over war powers? President's calling the War Powers Act unconstitutional. They claim the clock has been stopped here because of the ceasefire, that there is no 60-day mark that we've arrived at. Is this going to be the new debate in Washington?
It certainly seems to be the debate at the moment, and likely will drag out here for a little bit. As you know, Congress is gone. They're not back till May 11th. So it'll continue to be debated. And I frankly think, you know, the president's just going to continue to negotiate and try to find some kind of settlement. And, I think we all agree that is the right strategy here. Obviously tensions are very high and both sides are, locked in. But I think, it's all you can do is try to negotiate something here and reach a settlement. Americans are anxious, right? Our gas prices are so high right now. And people are feeling it. And so, the faster we get to a resolution of this conflict, the better it is for Americans.
I mentioned the poll out from the Washington Post and Ipsos. Jeannie, 61% of Americans say using military force against Iran was a mistake. Fewer than 2 in 10 believe U.S. actions in Iran have been successful. Does that speak to the spirit of this mission or the lack of a credible sales pitch from this White House?
I think it speaks to both. And I think that's where the administration has erred repeatedly. I'm smirking a little bit because Donald Trump is not the first president to be frustrated by the War Powers Act. We know that.
Well, that's right.
But of course, what is happening with this poll today is that we know that the war is as unpopular as the war in Vietnam and as the war in Iraq. And that's got to be devastating for a president who repeatedly pushes back on any comparison to the 70s, to Jimmy Carter. I mean, that's what Donald Trump remembers. So you almost feel for him listening to how unpopular this is. And of course, they have themselves to blame. 2 days on Capitol Hill, Pete Hegseth, and he did not explain to the American public why we are there. It is a missed opportunity over and over with this White House.
Well, just to put a cap on that, Republican support remains high in this poll. 79% say it was the right decision. Independents are split. 52% right call, 46% a mistake. We've got a good panel today. Rosemary Becky and Jeannie Shanzano will be back in our second hour as we roll into the 1 o'clock hour on the East Coast and welcome our global television audience to the conversation. We'll get back to the White House for the latest on all of this right here on Bloomberg.
from Washington, D.C., this is Balance of Power with Joe Matthew and Kaylee Lines.
President Trump says the hardliners want to make a deal too. Welcome to the Friday edition as markets rally again on hopes of a peace deal with Iran. But the Strait of Hormuz remains closed on this 60th day of conflict. I'm Joe Matthew alongside Kaylee Lines in Washington. Kaylee, depends who you ask about that timeline. The president suggesting the War Powers Act is unconstitutional.
Yeah, and that's, of course, after cabinet secretaries like the Defense Secretary Pete Hegseth in congressional testimony this week suggested because we are currently in a ceasefire, that 60-day clock is no longer actively running. Clearly a matter of dispute. All that said, when it comes to active conflict or the potential return of it, it may be on the horizon if no deal is made, obviously. And the president, in comments to reporters just a few moments ago, suggested that while strides have been made, he's not sure a deal will ever get there, suggesting Iran has proposed things that he can just not agree to.
He says their leaders don't get along, they're confused, they talk to one person, then it's the next thing. But the war powers issue is an interesting one. The administration, according to the New York Times, saying that this resets the clock, not just stops it. So I don't know if we're at zero or if we stop somewhere in the middle of all of this. Lawmakers might not agree, Kaylee. We've heard from even some Republicans who want an authorization for the use of military force by the time we get to that extended 90-day mark. It's just unclear exactly when we're going to say that happens.
Yeah, and we'll speak with one Republican congressman this hour. Mike Herodopoulos will be joining us with us. He is, of course, representing Florida, which has had some domestic political moves this week as well with a new congressional map that is going to be enforced ahead of the midterm. So there's a lot to get into with the congressman. There's just a lot going on today. It's not just the Iran stuff. The president also says he's raising the tariff on EU cars to 25%.
That's right. And may still save Spirit Airlines because there was a report the company was shutting down operations. The president seems to be keeping hope alive, but the stock is still deep in the red. I'm sure Charlie will hit all of that too.
Yeah, President Trump says they're still looking at Spirit, which is maybe why Spirit is off the lows, as Joe alludes to. But let's get a check on that stock and everything else moving in this Friday trade as we turn to Charlie Pellet in New York. Hey, Charlie.
Hi, thank you very much, Kaylee. You and Joe absolutely right. Lots going on. We got you covered. Oil lower, stocks mixed, the VIX below 17. And let us begin with the tariff developments. President Trump says he's raising tariffs on cars and trucks from the EU to 25%, claiming that the bloc has failed to fully comply with the trade agreement negotiated with the U.S. We're seeing automakers sell off. Ford shares down now by just about 2%. We got GM down 1.3%. Stellantis, parent of Jeep and Chrysler, that is down now by 1.8%. In the airline industry, you heard the president live on Bloomberg Radio and television. President Trump says the federal government still looking at a rescue plan for Spirit Airlines and will offer a final proposal. Trump says the administration will have an announcement sometime today, but right now we're looking at shares of Spirit Aviation Holdings, FLYYQ on the ticker, down now by 17.9%. At one point, the stock was down 70%. Frontier up 8.2%. Other discounters also advancing. JetBlue up by 4.2%. And among the legacy carriers, United up 3.1%, Delta up 2.1%, American up by 1.5%. Equities now trading mixed. The Dow down 0.4%. S&P, NASDAQ both at records. S&P up 36, up 0.5%. NASDAQ up by 1%. NASDAQ 100 index also at a record, up by 1%. The VIX below 17, the 10-year 4.37%. Gold up 0.5%, 46.41 the ounce. And crude keeping an eye on WTI just above $101 a barrel now, down 3.3%. Barrel of Brent at 108, down now by 2.2%. Joe and Kaylee, lots going on, and that is a Bloomberg Business Flash.
All right, lots going on indeed. Charlie Pellet checking on the Friday trade for us. Thank you so much. Of course, there's lots going on in the mind of President Trump, and he just gave us some insight into that as he was fielding a number of questions from reporters before departing the White House en route to Florida. Well, he will be speaking at the Villages later on today. That event obviously likely to focus a lot in part on healthcare policy and tax policy, but it was more questions around foreign policy that the president was focused on just a few moments ago, including the ongoing war with Iran and talks to end it. I don't even know if we're still calling it an ongoing war. He and the administration is arguing that because we're in a ceasefire, it's no longer a war. Don't keep going on the clock countdown for the War Powers Act consideration. All that said, he doesn't seem super satisfied with what he's receiving from Iran in terms of talks to potentially reach some kind of agreement. He said, and this is a quote, "They want to make a deal, but I'm not satisfied with it." So for more, we go now live to the White House, where we find Bloomberg Washington correspondent Tyler Kendall. So Tyler, he talked about strides being made, but didn't sound really overly optimistic that those strides are going to lead us to the desired end result.
Right, Kaylee. I mean, President Trump saying that the reason why he's not too optimistic about this is because Iran has made demands that he just cannot agree to. Now, with this said, he also said that he doesn't want to take that path of escalation to resume military operations if he doesn't have to. But these comments do come on the heels of Iranian state media confirming earlier today that Iran had sent an updated proposal to Pakistani mediators. Now, we still don't have the details on exactly what this fresh plan entails, but we do know that the U.S. wasn't too happy with the plan that was previously put on the table that would have postponed any dialogue around Iran's nuclear program, but would have seen an interim deal where potentially the Strait of Hormuz could be reopened if the U.S. lifts its naval blockade. But you heard from President Trump just moments ago reiterating that that blockade is not going anywhere. He said that it is, quote, incredible, again echoing the statements that we heard yesterday in the Oval Office. He also thanked Pakistan for being the mediator in these talks and says that the U.S. is still trying to pursue this diplomatic route. But as of now, Joe and Kaylee, those talks are only happening on the phone.
Interesting. Kaylee, it's the president's on his way down to the villages. Of course, in Florida, the Marine One helicopter just took off over Tyler a second ago, and the president just boarding Air Force One, Tyler. The headline at the BBC, pickleball and protest, Trump visits world's largest retirement community. Known as the Disney without the roller coasters. This is a friendly crowd for Donald Trump, right? We remember the boat parades during the campaign and so forth. Tyler, why is he going to the villages? What's the message today?
Well, Joe, this is a message around affordability. We're expecting President Trump to tout the new tax cuts under the One Big Beautiful Bill and also to talk about accessibility improvements at the Social Security Administration. But you're right, this is going to be a friendly crowd for the president. He has repeatedly won this area in the elections. But the broader backdrop here, of course, is that Florida is often considered to be a battleground political state as we head into the midterm elections. He did make a brief remark there applauding the governor Ron DeSantis, since we know that there is going to be that tight gubernatorial race in the state. But of course, this comes on the heels and the backdrop that American consumers right now are dealing with those higher gas prices, and that is going to be a liability for Republicans as we get closer to November. Now, this administration has repeatedly maintained that the disruption is going to be in the short term. You heard President Trump make that case to the reporters just there, but it is raising some questions about what more the administration can do in the meantime to help to lower gas prices. And Joe and Kaylee, the NEC director, Kevin Hassett, was on Bloomberg Television just yesterday, and he didn't really outline that the administration is looking at anything new. He seemed to rule out the idea of an export ban and instead touted actions that the administration has already taken, such as extending that waiver for the Jones Act or working to improve those regulations to get higher content ethanol gasoline on the market in time for the summer driving season.
Well, and Tyler, when we think about higher gas prices, we also could be facing down here in the U.S. higher prices of some of the vehicles that gas is going into. At least if the president stays true to what he's saying today, he's going to raise the tariff on European-made cars to 25%.
So this is definitely a move of escalation by the White House, Kaylee, because as you well know, the agreement that had been reached between the U.S. and the EU when it came to the trade deal was that more preferential 15% tariff rate that was going towards most EU imports is instead was supposed to also filter down to autos. That was a really critical part of that trade agreement. You remember there was an investment pledge in order for them to secure that lower rate for those sector-specific tariffs. Now, it's not necessarily surprising because we knew that tensions had been brewing between the U.S. and the EU when it came to implementation on the deal, not necessarily related to the auto tariffs, but related to metal tariffs after the administration had moved to expand the list that 50% metal tariff would extend to. Now, there's been a lot of back and forth. We don't need to get into the wonkiness of it, but at the end of the day, it doesn't appear that the two sides are too happy with the agreement that ended up being reached. In fact, Bloomberg News reported earlier this week that some of the EU's biggest economies, including Germany and France, were starting to really make their concerns known when it came to that deal regarding the metal tariffs. We can say that we've heard from at least one EU Parliament member who said earlier within the last hour that President Trump's behavior is, quote, unacceptable.
Tyler, thank you so much. Day to mow the lawn, it seems, at the White House. Bloomberg's Tyler Kendall with the latest on a number of stories here. And we want to focus on the latest with Iran. The president talking to reporters again just before he left the White House, saying they want to make a deal, but I'm not satisfied with it. He says, we just had a conversation with Iran. Let's see what happens. But I would say that I am not happy, knowing that Iran delivered a new proposal to the U.S. It is still not immediately clear whether the president was referring to that proposal or exactly what is in it. But we are going into a weekend here with the Strait still closed, even as oil prices tick lower, which has been a curious part of this story the last couple of days. Real hope, real optimism in this market for a deal as opposed to the resumption of military strikes. Mona Yakubian is with us now, Director and Senior Advisor of the Middle East Program at CSIS, the Center for Strategic and International Studies. Mona, it's great to have you back. Your thought here with this back and forth. The president says there's no reason to get on a plane right now because there's no evidence of a breakthrough. Do we roll through the weekend with the standoff in place?
Hard to know, Joe. I mean, it's clear that we are at a diplomatic stalemate. No peace, no war. As you note, the strait remains closed, and it seems as though we're witnessing a battle of wills. But that being said, we also know that the president did receive military options from CENTCOM yesterday, and there is some discussion as to whether the president may choose to go with some fierce but limited military strikes in the hope of breaking this diplomatic stalemate and getting Iran to the table. Big question as to whether that would work or not. But I think that is something that's at least is under consideration.
Well, so Mona, what do you think is most likely to get the will of Iran to bend or break at this point? Because we saw weeks and weeks of kinetic military action, of targeted strikes across a lot of their military infrastructure and the like. Didn't seem to do much. Now we see this blockade, and U.S. Central Command just says 45 commercial vessels have been redirected at the Strait of Hormuz. President Trump has talked about Iran as being on almost at a state of economic collapse. Is that what is more likely to make them bend, or are they relatively willing to withstand both types of pain, frankly?
Unfortunately, Kaylee, I think what we've seen is that Iran's pain threshold is pretty high. And yes, their economy is on the verge of collapse. The rial is at an all-time low. They've had significant damage done. And of course, now their oil exports are also being impeded. So it's not as though they are not experiencing pain, but they are signaling defiance. The Supreme Leader, Mujtaba Khamenei, just issued a statement basically saying Iran is not going to relinquish control over the Strait of Hormuz, nor is it going to deal on the nuclear issue at this time. And so I think this is a question of who can endure pain the longest? And of course, caught in the middle of all of this are global markets and countries in Asia, in Europe, that are feeling this pain much more directly even than we are here in the United States.
We've got a new debate surrounding the War Powers Act, Mona. As I'm sure you've heard, the White House is suggesting that we are not at war right now. Therefore, the 60 days that would be marked today under the War Powers Act and requiring some action by Congress to let the president move forward simply does not apply. Pete Hegseth, the defense secretary, said in a congressional testimony yesterday that the days of ceasefire count against the 60-day mark. Other reporting by the New York Times, quoting officials at the White House, saying that the ceasefire resets the clock. I asked Leon Panetta about this last evening. Of course, among his many roles, he was a defense secretary in the Obama administration. Here's what he said about it.
I understand that the president's trying to
raise the threat threshold to try to move Iran. But I don't think that's what's going to do it. The president does have the power to extend the War Powers Act for an additional 30 days if he can show that it's part of an effort to wind down the war. If that were part of it, then perhaps that could be an approach. But I think in and of itself, I'm not sure that it does.
What do you make of this, Mona? The president says that the War Powers Act is totally unconstitutional. Those are the words he used this morning. Are we going to just blow right through these deadlines?
Well, it's hard to know. This is a very unpredictable administration. And beyond Secretary Panetta, there are former officials in Republican administrations who also take issue with the administration's interpretation of a ceasefire, allowing a pause on the clock. But, regardless, I think the issues really are around the tolerance for this war continuing. We've talked about higher prices at the gas pump. The administration itself says the war has cost $25 billion so far. Many believe that the number is much higher, maybe 2 or 3 times higher. So beyond the legal and constitutional issues of the War Powers Resolution, which indeed does come into effect today as we hit the 60-day mark, there are the bigger questions of America's tolerance for this war and, frankly, a lack of understanding of exactly what the objectives are and what the president's plan is for an off-ramp.
So as we consider domestic tolerance for this, Mona, do you think that there may be merit in Iran potentially thinking that it can just wait out President Trump on this one due to those domestic political pressures?
I think the Iranians very likely feel that time is on their side, that they don't have these kinds of domestic pressures, right? This is a very brutal regime with little regard for its people. They are keenly aware of the pressures that the president is feeling at home, including that this is an election year. And so it may well be, as I said earlier, that this is a battle of wills. And Iran believes it's in a position that it can win that battle of wills, that it can outlast the United States.
So it sounds like we kind of know where this is going then. And if Iran is not going to negotiate around its nuclear capabilities, what is there to talk about?
Well, I mean, what there is to talk about is getting the strait back open and having traffic resume. We are seeing this incredible price that is being paid in global markets, and we haven't even begun to see.
Can you have one without the other? Can we reopen the strait without a guarantee?
Well, I think, unfortunately, I think that's what the Iranians are banking on. That is certainly what they've been proposing. Let's deal with the strait first, and of course, open the strait. What does that mean? Does Iran have some sort of administrative control over the strait? That's the complexity of the conflict as it stands right now. And I think, again, it really comes down to how much, frankly, the world can endure the strait essentially remaining closed. We're 60 days into this conflict. It's already exacted an enormous cost. And we also know that this war has a very long tail, that even if the strait were to open tomorrow, we're talking months before things get back to something that appears close to what it was before, some sort of normal.
Yeah, the timeline may be longer than market pricing currently reflects. Mona Yacoubian, thank you as always for joining us, Director and Senior Advisor of the Middle East Program at the Center for Strategic and International Studies. Thank you so much. And that is a question we've continually been asking, Joe. Is this market too overly optimistic about the prospect not just of a deal, but of relatively quick normalization if and when a deal is made and the strait is back open?
Especially on the day the CEO of ExxonMobil says it will be 2 months after the strait reopens to get flows through Hormuz back to where they were before. This is not going to happen overnight.
No, we'll have another check on those markets for you in just a minute and be joined by our political panel here on Bloomberg.
It's 121 on Wall Street. We do check markets all day long here at Bloomberg. S&P 500 index on track for another week of gains. Right now on the week, we're up by 1.2%. If we do have a weekly gain, it would be the 5th in a row. U.S. stocks on this first trading day of the brand new month, trading mixed. The Dow down 27 right now, have been higher for much of the morning, lower now by under 0.1%. We've got the S&P 500 index up 42, trading at a record 72.51, up by about 0.6%. NASDAQ Composite Index up almost 300 points for NASDAQ. That is a gain right now of 1.2%. Record there, record also for the NASDAQ 100 Index. The VIX below 17 with a 10-year 4.37%. Gold is up $19 the ounce to $46.37, up by about 0.4%. West Texas Intermediate crude oil down 3.3%, still above 101 a barrel. Brent 108.15, drop there of 2%. President Trump says the federal government is still looking at a rescue plan for Spirit Airlines and will offer a final proposal. Trump says the administration will have an announcement sometime today. President also raising tariffs on cars and trucks from the European Union to 25%. After earnings, ExxonMobil down 1.4%. Chevron after earnings down 1.8%. Balance of power continues now. Back we go to Washington. Once again, your hosts, Joe Matthew and Kaylee Lyons.
All right, Charlie, thank you so much, Charlie Pellet. Live from World Headquarters in New York, welcome to the Friday edition of Balance of Power here on Bloomberg TV and radio. Just had a long conversation with an expert in Rosemary Becky about the way forward here with Iran. And Kaylee, it's a difficult moment because it's hard to tell what is bluster from both sides in this case. And the proposal that we have from Iran today doesn't seem to have changed anything. President Trump, though, says he is still hoping to strike a deal. At the same time, this is the 1st of May. Happy May Day. That's 60 days since he notified Congress, which is amazing that we're in the month of May. But there are questions about whether we're going to enter a whole debate around the constitutionality of the War Powers Act. It seems like the White House would like us to.
Yeah, that certainly seems to be the messaging, as President Trump argues that the War Powers Act, which has been law for, more than 50 years, is
Vietnam.
Unconstitutional. You had the Defense Secretary, Pete Hegseth, saying even if it is constitutional, the 60-day clock shouldn't have been running so long as the ceasefire has been in place, as it has been for weeks now. All that said, Congress is on the May recess, as it is the month of May now. They won't be back until May 11th to even consider whether or not they want to flex some congressional authority muscle over war powers in the first place. So where that leaves us, I'm not quite sure.
This is going to be a grand debate, I'm sure, remembering that the president can get an additional 30 days, bring you to 90, at which point there would need to be an authorization for the use of military force.
So let's get into this now with our political panel. Rosemary Becky is with us, partner at Brownstein, Hyatt, Farber & Schreck, and Republican strategist, alongside Bloomberg Politics contributor Jeannie Shanzino, our Democratic analyst and democracy visiting fellow at Harvard Kennedy School's Ash Center. Welcome to you both. Rosemary, when we consider the questions around the legality or the reading of the law in the War Powers Act, whether it's 60 days or 90 days, knowing that additional 30 days is supposed to be requested specifically, at least it could be read as specifically for the withdrawing of troops from a conflict zone. Do you expect that today is a real marker for a Republican-controlled Congress who, to this point, has been unwilling to check the president when it comes to this conflict in particular?
I don't think today is a real marker for the Republicans. I think that this debate regarding the war powers is going to continue. And just as you pointed out, their Congress is out until May 11th. And so when they return, there will certainly be some rhetoric and discussion around it. But I don't think that Republicans are looking to challenge the president on this at this moment.
You wonder if that changes in another 30 days, Jeannie. What do Democrats do with this? They're clearly rejecting this argument.
Yeah, absolutely. And I also wonder, Joe, does it change after these members go home? As Rosemary was just talking about, they are heading home. They come back on May 11th. And what are they going to hear when they go home? Because, of course, what the polls are telling us is that the war is widely unpopular. Fewer than 2 in 10 Americans think the action has been successful, and yet we are paying for it. We're paying for it at the gas pump. We're paying for it with our groceries. And so for these members, I just got to imagine they want to be on the campaign trail talking about affordability. The president is out today, wants to talk about this issue involving Social Security. They want to talk about no tax on tips. And yet any savings people are feeling from those initiatives, they're putting back into their gas pump. They're putting back into the grocery store. And so you wonder, is there going to be pressure? Just yesterday or the day before, we saw Susan Collins under pressure in Maine. She reversed course on the war. And so I'm curious, what does this time away and this time at home do to these members as they hear from constituents who are still asking basic questions like, why are we there? What is the point? And when are we going to be done?
Well, and Susan Collins might be a character you would expect to, or one of the more likely characters to break with this administration, Rosemary, but you're starting to see others as well. Todd Young of Indiana, for example, says he would expect to need an authorization for use of continued military force if the president were to choose to go back to kinetic action. And I wonder if you think the chorus could get louder, even if it doesn't become an outright majority of Republicans who disagree, if you would be surprised to see more names added to that list.
I don't think I would be surprised to see more names added to that list. I wholeheartedly agree with Ginny that when they go home here for this work period, they're going to hear a lot of discussion around affordability. And this is a factor in all of that, right? I mean, while, Americans got on average an extra $1,000 in their tax refund, they're spending a lot of that money on gas. And the question becomes, how much longer does that linger? I mean, there are a lot of American families out there that are struggling with energy costs, healthcare costs. And so, they're going to hear all that when they're at home. And so in all likelihood, there's going to be extra pressure to speak up about it and demand, some more action and stuff. I think that's also why the White House is working as fast as they can and as quickly as they can to kind of try to resolve this. But as several of your guests has pointed out today, it'll take time, right? Like even if we have some kind of ceasefire settlement in the coming days, it's going to be a matter of time before, you start to truly see gas prices come down and that impact to the economy overall.
Rosemary reminds us May 11th is when lawmakers will be back in town. And Jeannie, they're going to have to deal with a lot more than this. We should note a lot got done before everyone left yesterday. Some things that we were told could never happen. FISA Section 702 reauthorized for 45 days. DHS reopened after a 75-day, that's a record partial shutdown. They even passed the Farm Bill in the House, realizing that may not take place in the Senate. But there are questions, Jeannie, about how Speaker Johnson pulled this off at the last minute and what last-minute deals were struck that might impact future debates or even need to be undone. In the case of the Farm Bill, he had to renege on an agreement with a group of Republicans from the Midwest that tied year-round sales of an ethanol fuel blend, E15, to the bill. They're going to have to undo that now. What else are we going to learn about? This brings us back to the old Kevin McCarthy days. What did you promise and when, Jeannie?
Yeah, I just love to have an ear on what's happening in this room as the vote is open on the floor with Mike Johnson for hours, and he's moving these people in back and forth from his office. And to your point, Joe, what promises and what deals are being struck? We will likely learn a lot more when we see these bills in writing. Give him credit. He did push this through. I mean, we were looking at this as at least I was, a really tough week. Now, I would go back and say, we also know that there was another person driving this forward, and that was the president. The White House really did get involved here to get these things over the line. But some of this, of course, is just kicking the can. You look at what deals were struck with the Farm Bill. You look at FISA. This has been going on for years over the warrant requirements. So all of those things have yet to be worked out. And when they come back, we are that much closer to primary voting and voting in the midterm election, which of course usually brings everything in DC to a halt and makes passing anything that much more difficult. And of course, they also want to do reconciliation 2 and I think 3 in the midst of all of this, which is, I'm hard pressed to imagine.
Yeah, 2.0 and then 3.0 does seem to be the plan that at least some conservatives are pushing for. But as we think ahead, look back on the week that was, thinking ahead on what's to come as we get closer to the midterms, here is how the speaker himself, Mike Johnson, characterized things yesterday.
Sometimes the process around here is cumbersome. That's the way this works. But in spite of our razor-thin, historically small majority, House Republicans continue to deliver for the American people. We will continue to do that for the remainder of the year. And that is a large reason why we are going to win the midterms so that the grown-ups can stay in charge here.
He's speaking of House Republicans specifically, Rosemary, but it's also a Senate Republican majority, and the two majorities, or at least the leadership of them, don't seem like they're necessarily in lockstep here. What is your read on the reported kind of breakdown in relations between Majority Leader John Thune in the Senate and the Speaker of the House?
So the negotiations between the House and Senate have always historically been, tough conversations and stuff. And I do think, for the most part, that relationship has worked well, but it has been tough. And right now it's a very strained relationships between the two houses. And so, there's a lot of work to be done when they get back. A lot of things, that we've kicked the can a little bit here on some things. We've got a reconciliation 2.0 that absolutely needs to get over the goal line. Whether or not we get to a reconciliation 3.0 is another issue, but you've got Farm Bill, you've got surface transportation, you've got so many other things that need to get done. And so both houses and both leaders are going to have to come back together and kind of iron out their differences and move the process forward.
Jeannie, we've only got about a minute left. I'm going to come out of left field for you on this one because it's what no one is talking about, and that's the nation's debt. Did you see this? The U.S. national debt now exceeds 100% of gross national product. This was said to be unthinkable. But as of March 31, the country's publicly held debt, Jeannie, was over $31 trillion, 100.2%. If Democrats win the House and the Senate potentially, will they make debt and deficits a priority, or is this the kind of thing that only the minority finds religion in?
Well, I certainly hope they do. I don't think we've seen that yet, unfortunately, in what we've heard on the campaign trail. But to your point, Joe, this should be the headline for all Americans. This is a marker that is unsustainable and, to your words, unthinkable at some points. And it should be front and center, not just for Democrats, but Republicans and all Americans. And as opposed to that, out of both parties, it's a pox on both their houses. They have just talked about continued spending, and we can't keep this up. That's why the 1.4 trillion on the military is unthinkable in my mind.
Jeannie Shanzano, Rosemary Becky, thank you for a great panel. Just went red on the terminal, President Trump issuing broad sanctions on Cuban officials and businesses. We'll have much more straight ahead here on Balance of Power, only on Bloomberg.
It's 1:40 on Wall Street. We do check markets all day long here at Bloomberg. President Trump has signed an executive order imposing new sanctions on Cuba. This, according to a White House fact sheet. The document does not name sanctioned individuals, but the fact sheet says the order imposes new sanctions on, quote, entities, persons, or affiliates that support the Cuban regime's security apparatus. The Dow just turning positive once again, up 15 right now to 49,668. That is a gain of under 0.1%. A record-breaking run is driving stocks toward their longest weekly rally since 2024, amid hopes for a deal to end the Iran war. S&P pushing higher at 72.52, looking at another record there, up 43 points, gain of 0.6%. NASDAQ and the NASDAQ 100 index, both trading at records. Both are higher now by 1.1%. All of this with a VIX below 17 and a 10-year at 4.37%. Gold, 46.30 the ounce, up by about 0.3%. West Texas Intermediate crude, 101.85 a barrel, down now by 3.1%. Barrel of Brent, 108.06, down now by 2.1%. President Trump says the federal government still looking at a rescue plan for Spirit Airlines, and the administration will have an announcement later on today. Estee Lauder planning to cut as many as 3,000 more jobs. That news sending the stock higher. Estee Lauder up now by 3.5%. Again, recapping, stocks higher. S&P at a record up 0.6%. Joe and Kaylee, that is a Bloomberg Business Flash.
All right, Charlie Pellet, thank you so much. Charlie mentioning one of the stories we're following from here in Washington around Spirit Airlines. I guess nothing is over till it's over, and President Trump is signaling that perhaps the potential rescue of Spirit is not something that can be declared over yet, despite earlier reporting that we had seen that Spirit was getting ready to wind things down in the absence of a deal with the federal government. The president says, we're looking at it, but Joe, he says, if we can't make a good deal, no institutions have been able to do it. I'd like to save the jobs, he said. We gave them a final proposal.
Also said we'll have an announcement sometime today. So now traders are on the hook for some news here. We saw the stock lift off its lows, Kaylee. It's still sharply lower.
Yeah, so we want to get some analysis on this entire situation as we turn to one of Bloomberg Intelligence's best. George Ferguson is with us. We're over at BI. He's Senior Aerospace Defense and Airline Analyst. George, welcome back to Balance of Power. How long, realistically, does Spirit have here for this to come together? If the president doesn't have something to announce today or tomorrow, will it be too late?
Yeah, my guess is that they have very little time. My guess is you're talking a matter of days, if that, right? You get to this point where the credit card companies don't want to release cash to the airline. The creditors want their money back. They've got to execute. And so I think we're at that point. And so I think very little time.
This is a stock, George, that's trading over the counter here at just over $1. A year ago, it was just under $9. If a deal was announced this afternoon, does it crawl back up to that level?
To $9? I don't think so. We haven't seen financials in Spirit in a while, so I can't give you, sort of an absolute sense on what the valuation ought to be. But look, I think that Spirit was having problems before fuel spiked because of the Iran war. We saw it as just too much capacity in the U.S. airline industry, and especially on the low-cost side of that business. And so I think, fares were soft. They were difficult to get moving. And that's why Spirit's having its problems. So if Spirit gets bailed out, I think that the healing that the market is trying to do, which is to take capacity out of it, gets truncated, and you've got the same problem again. And actually, it's sort of bad news for the other low-cost carriers, for like JetBlue, Frontier, because it means Spirit it stays in the marketplace and pushes down fares for them. Both those companies are having problems being profitable.
Well, so obviously there's potential ripple effects here, George. So when we consider the notion, as President Trump is talking about wanting to make a good deal, in your mind, is there a good deal to be had here for the federal government if they want to get these warrants?
No, so the way I laid it out, like I said, I think if they survive, the market stays too competitive, has too much capacity. Again, it's not one of these temporary issues where if you just get them past the Iran war, fuel spike, that I think that you've got a healthier market ahead of you. And I feel like the government's had some wins. They had a win with Intel, right? And I feel like there may be some areas of the government where they feel like, hey, this is another, it's another Intel, it's another opportunity to make some money here. Again, I think that the market just has too much capacity, and this is a correct reaction to that too much capacity.
Hey, George, we need to get to Congressman Herodopoulos, but I'm just curious, if Spirit goes out of business, do JetBlue and Southwest raise their fares, or does that create a new fare war between the two of the remaining discount carriers and fares go lower?
Well, I think there's less of a fare war if Spirit goes out of business, right? And I think Southwest is less of a benefactor in this one. I think really it's Frontier and it's JetBlue, especially JetBlue. Of course, okay. They both fight for, they're both the biggest sort of JetBlue and Spirit are the biggest down in Fort Lauderdale, nice market, South Florida market. I would expect that fares would rise a bit. We still think capacity needs to come out of the market, even if Spirit leaves. So besides Spirit's capacity, it looks like there's too much capacity in the marketplace, especially given the higher fuel prices now. We think more has to come out.
Hey, George, it's great to have you. George Ferguson pulled back in on a breaking news day. Bloomberg Intelligence senior aerospace, defense, and airline analyst with news apparently looming on Spirit. Now, this isn't where we'd be thought we'd be starting with the congressman, but of course, Mike Herodopoulos represents Florida's 8th congressional district, and that's right next door to where Spirit Airlines is based. Congressman, it's great to have you back on Bloomberg TV and radio. Happy Friday. And I'm just wondering if you have thoughts on this. I know it's not right in your district, but just south of where you are, just south of Fort Lauderdale, is the home base of Spirit Airlines. And I suspect the administration's been in touch with the delegation when it comes to jobs in your part of the state. Is this a deal that could still be struck?
Well, it's only if it's a good deal for the taxpayer. I mean, I believe in the free market. We're all optimistic you can keep more of those low-cost carriers in place. But we need to look at the numbers, because in the end, if we bail out, we're actually helping, we're always helping people in the long run. And so there are a lot of competitive forces out there, as your previous guest mentioned before. So if it works for the taxpayer, that's a good thing. But if it's something that is not, I think this is the reality of the free market.
Well, I guess we'll have to see what the president is ready to announce in the next day or two on this particular issue. Congressman, he didn't seem as excited about the prospect or optimistic about the prospect that he'd have something to announce when it comes to a deal with Iran. When he spoke to reporters earlier, he suggested he's not sure that negotiations will ever get there. He said Iran has proposed things that he simply can't agree to. What is your degree of optimism about a potential diplomatic path forward, or would you be surprised if the president made the decision to return to kinetic military action? And if he does so, would that take a vote from you and your colleagues?
Well, the president is going to make the right call for the American public. He has given up a lot to be our president, and he strongly believes that Iran is a long-term threat to not just the Middle East, but the entire world, as they evidenced by their ability to fire missiles down multiple thousands of miles. And remember, every president, Democrat and Republican alike, have recognized the threat of Iran. We have them on their heels at this point. If the Iranians continue to be not only bombastic, but to kill their own citizens, I think that you might see a return to kinetic activities because we need to eliminate this threat once and for all. We're all paying for it at the gas pumps right now, but we want to make sure that the lives are no longer lost, because remember, since 1979, thousands of Americans have lost their lives, and hopefully this will be our last engagement with this corrupt, evil regime.
Yeah, $4.39 nationally today. It looks like you're just below that mark in Florida, Congressman. You're doing better, $4.28 on average in the state of Florida. But just to put a finer point on, the president said today before he got on the plane to go down to your neck of the woods, he's going to be in the Villages in just a short while, talking about some of the initiatives that he has pursued for retirees. He says that the War Powers Act is unconstitutional. Do you agree?
Well, every president says that. Since 1973, the president, the prerogative has always been the War Powers Act is unconstitutional.
I don't know. I remember George W. Bush going to Congress to make the case for an AUMF, right?
So it's one of the realities of it all. But as you know, the Congress will have a say. And they are, of course, working close with the administration. But most common sense people recognize that this problem in Iran is a real one. Fortunately, there's not been a huge death toll, but 13 is still too much. But we're challenged by a situation where you're dealing with madmen. Again, I can't stress this enough. Their own citizens are being killed by their government to the tune of 30,000, if not more. And so you're dealing with an evil regime here, and we're trying to deal with people who are absolutely irrational. And so we're going to try to bring this in for a landing, but if we need to continue the forces, we're going to need to do so. And the only way I would be okay with giving them any resources is if they turn over the nuclear materials that they've accumulated through the years.
Well, and Iran right now maintains that that's something they aren't willing to do. Just to continue the conversation around the War Powers Act for a moment longer, whether or not it's constitutional, when you're reading the law, Congressman, if you're assuming that indeed that law, which has been in place for decades now, is constitutional, and we have reached the 60-day mark since the president notified you and your colleagues that he was launching these combat operations, is the clock still ticking in your mind? The Defense Secretary Pete Hegseth suggested because we're in a ceasefire, it's not. But last I checked, we are still actively maintaining a U.S. naval blockade with military assets and military personnel involved.
Well, as you've seen already, there's been a few different votes on the war situation in Iran. We are conducting, I think, a thoughtful way in which to conduct the war in order to save American lives and to reduce the threat in the region, let alone the world. I've given the president a lot of leeway because, again, every president before him recognized the threat but chose different paths. If you remember, not too long ago, President Obama attempted to give the Iranians a lot of money and a lot of opportunity to get into the world economy. And instead, they use these dollars to continue their terrorist activities. And so President Trump has said enough is enough. At this point, I'm giving him the benefit of the doubt. Should the speaker bring this up for a vote, I would gladly vote one way or the other, depending on the facts. But it's something where I think I support the effort in Iran because in the long term, we think it'll be beneficial for not just the region, but also the United States. And let's also not forget that even though we are struggling with higher gas prices, there's some relativity here. If you look at the Obama or Biden years during their presidency, adjusted for inflation today, they'd be $150 a barrel during parts of their presidency. So nothing new there. The second part of that is we're bringing on more oil here in the United States. We're being more self-sufficient. It's too bad we don't have the Keystone Pipeline, of course, that Joe Biden killed. And it's also a fact that we have, of course, going to have new oil coming out of Venezuela, which will also help offset some of the higher prices we're all struggling with. But this is something I'd love to end quickly. But good policy is good politics, meaning the right thing to do here is to eliminate the threat from Iran, take away their nuclear capability, because we recognize, unfortunately, now they have the missile capability to shoot a rocket and potentially a nuclear weapon over 2,000 miles.
Yeah, I haven't heard the Keystone invoked in a minute, Congressman. I want to ask you, since right out that window behind you is the Space Coast, about the president's plans for NASA. And this is always important to our audience. We cover every launch here at Bloomberg, as you well know. We saw the budget proposal, and I realize this is the skinny proposal from the White House, but it shows a 23% cut to NASA. The president has pledged his support to the Artemis program and to NASA as a whole. He's taking credit for helping to rejuvenate the agency. Is that a real proposal? Will that become law, or is this up for debate?
Well, I would just say this. First of all, the president loves space. He, of course, created the Space Force. He's created a really opportunity for my community on the Space Coast. And he's put Jared Isaacman there, who really loves the country, giving up so much to really rejuvenate NASA. And we saw this amazing, of course, 10-day mission around the moon for the first time since 1972 in a successful splashdown in the Pacific. These are heady days for us on the Space Coast, so we're excited about that. Last year was much the same as far as budget proposals, but as you know, when we brought it in for a landing, not only did we fully fund NASA, but we put almost $10 billion additional dollars in to help make sure we win this space race. And I think under the leadership of Jared Isaacman at NASA, and of course Ted Cruz here, and Dr. Babin, who's our House leader on space, we're going to win this space race, and we're going to put the resources necessary. And when you actually look at space flight operations, that's actually, the spending is going up. Some of the science capabilities we're going to look more closely at and make sure we get the most bang for the buck. But I think you're going to see that gap diminish because we want to win the space race.
All right, we'll leave it there. Congressman Mike Herodopoulos, the Republican representing Florida's 8th District and the Space Coast. Thank you so much for joining us on Balance of Power. A lot of news covered this hour, and there will be more later on when we reconvene at 5 p.m. Eastern Time. So we'll see you then on this Friday, right here on Bloomberg TV and Radio.
This is Bloomberg Business Week Daily, reporting from the magazine that helps global leaders stay ahead, with insight on the people, companies, and trends shaping today's complex economy, plus global business, finance, and tech news as it happens. Bloomberg Business Week Daily with Carol Masser and Tim Stenivek, live on Bloomberg Radio, television, YouTube, and Bloomberg Originals.
And a very good afternoon, everybody, across Bloomberg platforms. Yes, indeed, we are Bloomberg Business Week Daily. It is the first day of May, Friday, May 1st, 2026. Carol Masser, Tim Stenivek, live here at Bloomberg headquarters in New York City. And we've got a couple records on Wall Street.
Yeah, we do. Taking a look at the S&P 500 right now, it is higher by 0.6%. 72.51, Carol Mass. So the NASDAQ 100 also surging today.
Yeah, it's like nothing's going on in the world. I mean,
well, there is something going on. It's called Apple, and it was a good quarter.
You were going to go there.
Yeah, that's where I'm going.
Take it away.
Well,
yeah, it's rallying.
I don't need to take it away.
Why?
Because it is the market today.
It is.
And, we're going to cover that, but I think there's also some geopolitics that's front and center that maybe investors are ignoring.
I think that's safe to say. We've had a slew of headlines. We're in the newsroom like, oh my God. President Trump leaving the White House, getting ready to board Marine One. This was about an hour ago or so. A slew of headlines talking about issuing broad sanctions on Cuban officials and businesses. Still looking at Spirit Aviation, giving them a final proposal, maybe a decision later today or tomorrow. So I don't know. We're going to get federal assistance. And then, talking a lot about Iran as well. And then tariffs, another bunch of tariffs.
Another bunch of tariffs. Brent crude, Carol, down today by 2.6%, but still $107 a barrel. WTI above $100 a barrel at 101.25.
All right, so we're going to get more on the trade in just a moment. But as Tim and I have just kind of said, a lot coming at us again. It's not a quiet Friday, folks. We're going to get the latest on that U.S. war with Iran, more on tariffs, what's going on in terms of Cuba. Could we be getting ready to do something? I don't know. And then that possible White House bailout of airlines.
And that's just one guess.
That's just one.
Okay. We got some other people we're talking to today, including the CEO of Magna International, Swami Kotagiri, stops by. Read on the auto sector, and we'll talk earnings as well.
Yeah, and then also stopping by to talk about life after Buffett. As Berkshire Hathaway hosting its annual shareholder meeting, that's happening tomorrow. We're going to catch up with the CEO of one of Berkshire's subsidiary companies. We're talking about Brooks Running.
Did you wear your running shoes?
Nope. Oh, I was going to show you, but I won't do that. That could get kind of messy.
It is Friday.
It is Friday. Also, Jayati Bardwaj, TD head of FX strategy. She's going to join us too, making her way right here to our studio. In the meantime, let's get a check on the trading day. Let's turn things over to Charlie Bell.
Hi, thank you very much. You mentioned Berkshire. That's stock up right now. The Class A shares up by about 0.2%. All of that coming out tomorrow morning. Right now, though, we have got the Dow, the S&P, NASDAQ pushing higher. Dow on track for a winning week. S&P also on track for another week of gains, up 41 right now, 72.50 where we stand, as Tim mentioned, up by about 0.6%. Yes, record there. Record on NASDAQ, record on the NASDAQ 100 index. We got the Russell 2000 index also in the green, pushing higher. S&P up 40, up 0.6%. The Dow just about flat on the day, still looking at a 13-point gain. We'll call that unchanged. We have got NASDAQ up 273 for NASDAQ. That's an advance now of 1.1%. NASDAQ 100 index also up by 1.1%. The VIX now just below 17 with a 10-year at 4.37%. The 2-year 3.87%. Gold little changed, up 0.1%, 46.24 the ounce, while West Texas Intermediate crude down 3.6%, still above $101 a barrel. Notice the shrinking in the spread between WTI and Brent. Brent right now 107.64. That is down by just about 2.5%. Bottom line here, we're on track for a 5th week of gains on the S&P 500 index. Some of the other headlines that Carol touched on: President Trump says the federal government is still looking at a rescue plan for Spirit Airlines and will offer a final proposal. Trump says the administration will have an announcement sometime today. Right now, looking at Spirit shares, they are trading down 22%. Earlier this morning, we did see them fall by roughly 70%. Frontier, ultra low-cost carrier, ULCC on the ticker, up by 9.5%. JetBlue is higher by 3.9%. And among some of the legacy carriers, United up 2.5%, American up 0.9%, Delta Airlines up now by just about 1.8%. Recapping, stocks higher, S&P at a record up 39, higher by 0.5%. Carol and Tim, that is a Bloomberg Business Flash.
All right. So appreciate it, Charlie. We'll come back to you later on this hour. There's so much going on this hour, as we've been talking about. You've got President Trump signing an executive order imposing new sanctions on Cuba. There's tariffs. We're going to get into that with our Jeff Mason in just a moment. But we want to get a view on the markets. Feel like it's the kind of right week to start there because there has been so much, Tim, coming at investors.
Yeah, it's great to have back with us Jayati Bardwaj, head of FX strategy at TD Securities. She joins us here in the Bloomberg studio.
She does indeed. Welcome, welcome. It's good to have you back.
Thank you so much.
What a week.
Coming back.
I want to talk the dollar, because the dollar wrapping up its worst month since June as the prospect of peace talks to end the war kind of leaving traders to unravel bets on the haven currency. But it does seem like a little bit different perhaps today, looking at a slightly higher dollar index. How are you strategizing around the war here? Do you think we're getting closer to an end?
Unfortunately, that's not an easy question to answer. It does appear we've reached a stalemate. I think the most likely scenario would be given on the nuclear side, both sides are still on very differing and opposing views on what needs to happen. Eventually, you are going to get close enough to midterm elections, oil reserves and capacity hitting very low levels such that oil prices start shooting higher, such that both sides will have to come up with a brokered deal for the very near term, but you cannot be sure if it remains next year. But up until the midterm elections, you can get some sort of a peace deal. Let's not talk about the nuclear part. Let's leave that for a later discussion, but agree on everything else and try to get the Strait of Hormuz open. So some sort of a midterm peace agreement seems the most likely path.
I'm sorry. It just seems like
it worries me when you say that.
It just seems like that goes back to a situation then that was worse for a lot of parties before the war began.
Yeah.
So like you're not getting rid of the nuclear threat, and oil is still higher, and Iran's leadership has been, in the words of the president, decapitated, but it also seems like, the IRGC is running things. So I don't know. We're having a hard time understanding what's going on.
I think that obviously you do need to take out the nuclear threat. The debate is what's the right time to do it. Is it now when midterm elections are approaching, or do you wait for after that? Because you always have the option of troops on the ground. Do you wait for things to die down? Clearly, both sides are alerted to escalation on both sides, and you do it much later when one of the sides is not expecting it. I think that's the trade-off you need to do, and our defense and policy analyst thinks that it could get deferred until after midterm elections, any surprise troops on the ground, or, tackling the nuclear question more heads-on.
I have to say, JT, I do think about this a lot, and I do wonder if at some point or slowly or right now, the administration and President Trump's advisors are saying, and he seems to be, they all remind us, he's the one who's going to decide where this goes next, but that he could potentially be thinking, let's just figure out a way to get to the midterms without upsetting anything more than it already is, right? And open up the strait. That eases gas prices. That matters to voters. We'll figure out stuff later. And then he might be saying, listen, you want to keep it in our, you got to help us with this. To Iran.
You have a good...
You know what I mean? And put it off till next year.
Okay, I'm just going to say, the president said at 12:32, negotiations are not getting there. He said hardliners in Iran want to make a deal. The U.S. is not leaving the Hormuz Strait now.
So I think the Strait of Hormuz will be prioritized. That's the key thing for voters. That's the key thing for global economies across the world. You will potentially get to some sort of a deal where both sides have some sort of vigilance on the Strait of Hormuz, but it allows to slowly go back up to the way it was operating at maybe 70 or 80% of what it was operating at, but both sides would keep an active vigilance on it. That would be the brokered ceasefire. It would not be a full ceasefire, not a complete deal. That would be the intermediary step before you get to the final stages.
Yeah, it's like not committing. You're dating and you don't commit kind of thing. JT, stay with us. I want to just get to some of the headlines. We mentioned President Trump signed an executive order imposing new sanctions on Cuba, imposing new restrictions on entities, persons, or affiliates that support the Cuban regime's security apparatus. This increased pressure coming as President Trump told reporters that the U.S. is not close to a deal to end the war with Iran. He did speak earlier.
So they want to make a deal, but I'm not satisfied with it, so we'll see what happens. Iran wants to make a deal because they have no military left, essentially, and they want to make a deal, but I'm not satisfied with it.
Now, all of that in the same couple of hours that the president also said he was raising tariffs on cars and trucks from the European Union to 25%, claiming that the bloc had failed to fully comply with the trade agreement negotiated by the U.S. We're talking with Jayati Bardwaj, and we also want to bring into the conversation who obviously tracks everything from Washington, usually in the nation's capitals, or in Jeff Mason, Bloomberg News Washington and White House Bureau. White House correspondent. Sorry, I'm rushing.
Close enough.
I heard you were rushing to get here.
She's just so excited that you're here.
I'm excited
Jeff,
too.
We're excited.
So we're just going to round table, you guys.
Let's do it.
It felt like you just did a dump, in terms of covering so many different things, Jeff, as he was headed to Marine One. I know. What is it that we really need to know? Jeff, me, J-A-T, Jeff. What do we need to know out of that?
Well, I would just say, having just heard or read a little bit about what he said about Iran, that what he's been saying about Iran is been more or less the same thing for several weeks now. I mean, the ceasefire has been in place for a while. The president is not indicating an interest in changing that, at least in part because he talks about wanting a deal, but he wants a good deal, and he said that to me in our phone interview a little over a week ago, that he didn't want to be rushed. He said that again in the Oval Office last week when I asked him, and he said, "Don't rush me, Jeff." So we know he doesn't want to be rushed, and yet he also wants a way out of this war. And it sounds like the Iranians have put forward another proposal that went through the Pakistanis. It seems to me from his comments that means he has seen it and just doesn't find it acceptable.
We don't know what they're asking, but what do you know about from the Washington side of this, Jeff, that would indicate where the president would say, okay, that is something that's acceptable to us? Does it have to do with enriching uranium?
Well, based on what he has said consistently, and let's acknowledge that not everything he says has been consistent, but one thing that he has very clearly said over and over again is that he wants this war to ensure that Iran does not end up having a nuclear weapon. So it wouldn't surprise me if uranium at some point is part of the negotiating, or on the list of things that the U.S. would want it to negotiate about. Certainly the Strait of Hormuz has been an absolute thorn in President Trump's side since the start of this war. He's going to want to have at least some clarity about that. That has created a great deal of political risk for him, in large part because Iran wasn't using the leverage it had on the Strait before the war, and now they are, and now they know they can, and it's going to be tricky for President Trump to take that away from them, and so no doubt he's going to want some sort of agreement or some sort of certainty on that, and that's going to be, that's a tough sell to the Iranians when they're the ones against whom this war was started.
I mean, JT, I want to bring you back in. I mean, we've talked about higher gas prices in the United States, but you go through other parts of the world. You see certainly a much tougher impact. They are much more reliant on what comes out in terms of oil out of the Middle East. Asian currencies, we've seen them under some pressure, whether it's the Indonesian rupiah, the Indian rupee, the Philippine peso. I mean, these are three nations' heavy reliance on imported oil. It's an interesting week where King Charles kind of schooled President Trump on cooperation and really thinking about the world at large. Tell us about the impact and the pressure that you're seeing in the currency market.
Clearly, the oil importing regions have been heavily impacted, and you can see that in the performance of the Asian currencies. You could also see that in the Japanese yen, which prompted the BOJ and the MOF to intervene this week, which was a big deal and led to a big move in markets. But the Asian countries and counterparts are clearly taking the brunt of that pain and pressure. They're also the ones who are, don't have as many reserves like China does. So China and Chinese currency have been relatively shielded because they've had a very lengthy amount of reserves to hold on to while the world is dealing with this oil price shock. But the other nations that you mentioned don't have those reserves in place, which is why the higher oil prices are immediately feeding in. In fact, these countries are now also encouraging people to work from home, take public transportation. There was also talk in India at one point of shutting some restaurants down because of the high prices now impacting the economies there.
Yeah, I mean, look at it from the angle of Pakistan and why Pakistan has such a vested interest in ending this war because of the impact of high oil prices. Just for the remainder of the year, where are you optimistic? I kind of like to, we've been talking a lot about challenges to this economy, challenges to this world. Where are you optimistic?
I'm optimistic that this is the midterm election year, so you do need some good news eventually as the approval ratings start becoming stickier. Important primaries are coming up, and you need to eventually shore up support and start building and gearing up towards that.
I'm so glad you went there. Jeff, before you came in, she was talking about this. Well, exactly.
Set me up completely.
But when does do you see any actions by the president that he's really starting to really think about that?
Yeah, because of his travel. I mean, he's starting to do some
political travel, which is what he had intended to do, or what the White House intended for him to do 8 weeks ago before this war started. They were about to unveil a great deal of travel to swing states, to swing districts, to places where important races for Republicans are close. And then that didn't happen because he's been presiding over a war.
Would it actually be a good thing? Do these candidates want him there?
You know, he's still very popular with his base. He's still very popular with
the war
some
is
Republicans.
Not popular.
The war is not popular. You're not wrong to say that. But he is a good fundraiser, and I think at least the White House believes he has a good story to tell, not necessarily related to this war, but related to the economy and where things were before the war. Now, can you tell that story without one, piece of it? That's hard. It's certainly hard when Americans are going to the gas stations and spending more than $4 a gallon on gas.
And to be fair, I mean, going back to when he came into the White House and coming off of Joe Biden, we were talking about American exceptionalism. I mean, was that fair, JT, in terms of what you saw among traders, whether it's currency markets or just kind of the conversation, the narrative about what the U.S. was prior to President Trump taking up his second term?
Yes, the U.S. economy pre-2025 was having a great run for a good amount of 2 years of being exceptionally strong. The labor market is tight. Inflation is strong from a core and demand side of things, not just as a supply side of things, which allowed the Fed to hike interest rates. The dollar was a safe haven back then, but now all of those things are being questioned and debated, which is why the economy, even before the war, was not as strong and resilient heading into it, which is also, I think, a mattress to the voters. We actually did this interesting exercise where we went back and checked all of the midterm election years where the ruling president lost either the House or the Senate. In all of those, most of those years, there was some sort of an economic issue that voters were dealing with, either high inflation, high levels of unemployment, which forced that flip to happen. So definitely voter approval and a sound economic base is very important heading into this.
Is that happening right now with gas prices? Is that enough? It's a supply shock, and we don't know how long it will go.
Yes, when you read of reports that people are now paying $6 a gallon at stations, it's going to feed into them. Already you see that excess savings for U.S. households are negative, which is different from compared to households in Canada, UK, even EU, where people have held on to their post-pandemic savings. The U.S. households have not, which was going to be painful for them.
Interesting. Jeff, say 40 seconds real quick. I mean, what's the most important thing that we got from the White House and the president this week? There was so much.
There was so much. I found the King speech very striking, as we talked about a couple days ago, and that he really made a case for NATO. He made a case for Ukraine. He made a case for norms. The president didn't take that as criticism, but he did respond a little bit with the tariffs on whiskey, and so, who knows if that will have any other ramifications. It's not helping.
Charles likes whiskey, can we assume?
Maybe one could draw that conclusion.
Doesn't. No, I'm just kidding. Got to run. Thank you both so much. JT Bardwaj, head of FX strategy over at TD Securities, and of course our own Jeff Mason, who covers the White House, Bloomberg News, Washington, and White House correspondent. We're back in a moment.
It's 2:21 on Wall Street. We do check markets all day long here at Bloomberg. S&P 500 index pushing higher, on track for another record, on track for a weekly gain. That will be 5 in a row on the week. S&P up by roughly 1%. The Dow was once again turned lower, down 67, now dropped there of 0.1%. And to be sure, the S&P 500 index is at a record, along with NASDAQ and the NASDAQ 100 index. All of this with a VIX just below 17 and a 10-year at 4.37%. Gold at 46.19 the ounce. Spot gold little changed, up under 0.1%. Crude, big story, falling now by 3.1%. Crude dropping amid hopes for a deal to end the Iran war. 101.78 where we stand on WTI. Barrel of Brent 108.33. That is a drop now of 1.9%. Bitcoin 78,580 on Bitcoin, up now by 2.8%. President Trump says he is raising tariffs on cars and trucks from the European Union to 25%, claiming that the bloc has failed to fully comply with a trade agreement negotiated with the U.S. Automakers lower. Ford down 1.9%. General Motors down 1.3%. Stellantis, that is the parent of Jeep and Chrysler, lower now by 1.7%. Recapping, S&P pushes higher at a record, up 0.5%. And right now, Bloomberg Business Week Daily continues. Once again, your hosts, Carol Massar and Tim Stanovic.
We're ready for you, Charlie. Thank you so much, Charlie Pellet there. All right, folks, we wanted to remind you that tomorrow, investors will focus on Berkshire Hathaway's annual meeting with shareholders. It's quite an affair in the past. This year, it will be the first where the highlight is not the man himself, Warren Buffett, having passed the reins now to CEO Greg Abel.
Yeah, Greg Abel in that position. He's facing a problem that seldom confronted his legendary predecessor, and that has to do with a floundering stock price. Shares have lagged the S&P 500 index by more than 37 percentage points over the past 12 months. Carol, that is the worst stretch for 1 year going back to the year 2000.
All right, so a little bit of pressure perhaps. Yeah. It makes this year even more interesting as investors are always consumed by the Berkshire universe, its public holdings as well as its private ones, its subsidiary companies. One of those independent subsidiaries under the Berkshire portfolio is Brooks Running, longtime affiliated with Berkshire Hathaway. Joining us from the floor of the Berkshire Shareholder Conference in Omaha is Dan Sheridan. He's the CEO of Brooks Running. Dan, it is so nice to have you back with Tim and me. Tell us.
It's already busy there.
I know.
Look at that.
What's going on around you? Tell us.
Well, hi, Tim. Hi, Carol. Happy to join you here from Omaha. You can see behind me, we're at the shareholder trade show, and we're packed here in our booth. We're selling product here to all the shareholders and their family, and how fortunate are we to be here this weekend.
What's selling right now? Not just at the shareholder meeting, but all around the country, and especially in China right now.
Yeah. Tim, we just finished our first quarter. We're up 23% as a company globally, and it's a broad-based growth story. All regions for Brooks are growing double-digit. You mentioned China, up 136% for us. We're really resonating with the Chinese runner. But our core business here in the U.S. grew 20%. Our European business grew 30%. And it's just an outcome of this strategy that we've been on for 25 years. Pinnacle premium performance products with great execution and a brand that continues to strengthen in the market. So I think we're just getting started, to be honest with you.
Well, give me some context and perspective, if you would, Dan, when it comes to China specifically. You mentioned sales growing 136% year over year. How much of top line is actually China right now?
Yeah, China is still a very small percentage of our business. We entered the China market in 2022, so we're a new entry into the market. But what we're seeing both online and offline is just great resonance with the Chinese runner. And the running boom that we've talked about the last few times I've been on continues to gain momentum in the China market. And we're seeing that around the world. As I said, Europe for us is just becoming a very strong engine. And it's not just footwear. Our apparel business grew 34% globally too. So we're hitting it on all fronts, and it's a global story for us.
From a marketing perspective in China, and then we'll go more global in a second, but while we're on China, I want to get some details from you on marketing there. What is the strategy, the communication strategy with the Chinese consumer? Because it comes at a time when, America is not necessarily viewed, I think many people would argue, is viewed as an adversary of China right now. So what's the brand positioning and how do you communicate the brand to that consumer?
Yeah, it's really clear for us, Tim. Our brand positioning is simply put as we believe everyone's a runner. And our jobs are to awaken aliveness in every runner through the transformative power of the run. And what we know based on how we've expanded is that resonates with the Chinese consumer. It's matched with incredible performance products that are merchandised and colored in a way where they can wear it off the run and on the run. And our brand seems to resonate really well with that consumer. So the mix of marketing is pretty similar by country. And China is a bit more online than some of our other markets. But ultimately, our brand is expressed the same way, and the consumer is receiving it really well.
I have to say, Dan, I actually bought some sneakers this week. I'm not going to say what sneakers I bought. I'm just going to be a little quiet. But what's interesting is I am not a runner. I do other things, but I've never been a runner. But it's just you go into one of these stores and everybody's buying sneakers. That's what they want to walk around in. That's what they want to live in. That's what they want to wear to work. I see it here. Is that really the growth? I mean, you guys have such a great running shoe, and we know runners love it. But is that continuing to be also a strong dynamic that fuels top and bottom line?
Yeah, I mean, trends come and go, right? Mm-hmm. And right now, performance is a trend that we're rooted in, but also the casualization of the workforce and how we show up to work in casual footwear is benefiting Brooks as well. And that's why design matters matched with this performance angle. And you can see the beauty in our product as well as the technical benefits. So we're benefiting from that trend, Carol, for sure.
I'm just going to tell you, Elizabeth, one of our producers and managers, she says, I have their nylon plated line. So she is a big user.
Well,
we have some.
Hyperion.
But it does speak to loyalty.
Yeah.
Totally. We've talked about this in the past with you, Dan, this idea that once a runner finds a pair of shoes that they like, they stick with it. That's good news and bad news for companies that produce this stuff, because they need to make sure they continue to satisfy that person who wants that brand or model, but you also want to innovate. And when you innovate, you have to get rid of different lines of shoes. How do you make sure that the person who's loyal to a certain shoe will get that next version of the shoe when you innovate on it?
Yeah, Tim, you're on it. This is the puzzle we have to solve every single year. We have to retain customers that love our products, and we have to innovate for new customers to come into our brand. And we've been able to do that. 25 years of 14% compounded annual growth rate. That comes from understanding the biomechanics of human motion and making sure that when you buy a Brooks, that you are in a safe product and a performant product. We do that every single season. And then you have to match it with innovation in materials, both in the upper and the midsole. And right now in our space, we've got 3 styles that are winning around the world: the Glycerin, the Ghost, and the Adrenaline. These are massive styles. They're in the top 10 here in the US and the top 10 in Europe as well. So it's a franchise style model, but it's retention and attaining new customers that is our mission.
Hey, remind us and the audience, Dan, about the supply chain and how that's going. We kicked off our hour talking about the president imposing, I think, 25% tariffs on EU autos. But stuff continues to come out of Washington that certainly impacts things. The war, the cost of things, customers paying more for gasoline here in the United States and around the globe. Any of that kind of a follow through for you guys, and you feeling an impact?
Yeah, I think the last time we spoke, we really felt like we knew where we were heading in terms of tariffs and the impact on our supply chain. Now, obviously, we have some other disruption in the Iran war. And, we're taking the same approach. We're trying to be very thoughtful in how we manage through price increases to the consumer. We've been very thoughtful in that. And, we're hopeful that this will resolve in the next couple months if we can get resolution. We believe the balance of this year will smooth out for us. But, it's another disruption to supply chains, and supply chains hate disruption, as you know.
What if it's not resolved in the next couple of months?
Yeah, so we're working on scenarios right now, Tim. I'd tell you that the framework we have is, we will have cost increases on raw materials in our products. So we're starting to model that out. and we'll probably have cost increases on moving our product from the manufacturing sites to the ports and to the markets. And so it's a dynamic time for us. And, the worst thing again for supply chains is this disruption and unpredictability in what we can plan for. But our team's really good at it. And we've been able to weather some of these disruptions over the last few years.
Well, how do you quantify it? Is it worse than tariffs? Is it worse than COVID disruption? What is it? Where does it fall with what we've seen over the last few years?
I think it's still to be determined, to be honest with you. I think there's just so many unknowns on what the inputs into the raw materials will be at an oil-based level. And so I would say that it's not any better than those two. It's probably on par.
Yeah, that
on par with those disruptions. Those were huge and are huge, I think, for continuing with tariffs.
Any sign of consumer weakness? It sounds like you guys are doing really well, but any signs that the consumer is hesitating or pulling back?
Yeah, not in our category. Here's what we know about the run category historically. It's pretty resilient. It's durable. And if you think about it in comparison to other sports or categories, this is a pretty affordable sport. For $150, you can buy a pair of running shoes, and those will last you for some people up to 6 months. You compare that to golf or skiing or any outdoor sport, it's still a very affordable sport. So our consumers during times of economic disruption are pretty durable and stick with it and may trade out some other things, but they'll buy running shoes and apparel.
Hey, one thing we wanted to dig a little deeper into too is apparel, your collaboration with Disney, Paris Fashion Week. We've got
casualization, Carol.
I know.
That's what he said.
I love it. Just go where you want.
Yeah, look, what we have built this brand on is partnerships. Partnerships with some of the best retailers around the world, partnerships in manufacturing. And on the marketing side, we're really leaning into partnerships where we can attach our brand to some of the most epic brands in the world. Disney is super unique, as you know, and we sponsor their race series. I was in Orlando 2 weeks ago running the 5K Springtime Surprise. It was great. And we also are matching that, pushing into a lifestyle brand, our brand in the lifestyle category. So there's dimensions of your brand as you build your marketing mix. And we think we've got a recipe right now that's going to invite more people into this brand.
Hey, just 20 seconds real quick, Dan. Going to be a little bit of a different meeting this year around.
It really is. I'm excited. First time in 60 years that Warren's not going to be on the stage, and what a time for Greg to step in. I have so much confidence in his leadership and the leadership of the Berkshire board, and we're just thrilled to be here. And as you can see, there's a lot of people behind me that are thrilled to be here.
All right. Well, we were thrilled to have you here, Dan. Good luck this weekend. Have fun. Dan Sheridan, CEO of Brooks Running, joining us from Omaha and that shareholder meeting, the Berkshire meeting.
It's 2:40 on Wall Street. We do check markets all day long. Here at Bloomberg, we have got the Dow Jones Industrial Average now holding at the worst level of the day, down 105, drop there of 0.2%. But a record-breaking run is driving stocks toward their longest weekly rally since 2024. That would be 5 in a row. S&P at a record 72.36. Any advance today will be a new high, up 27 points with a gain of 0.4%. NASDAQ now higher by 234 points. The NASDAQ Composite Index up 0.9%. NASDAQ 100 Index also at a record, up now by just about 0.9%. So bottom line here, we are seeing stocks advance. Oil is falling, all of this amid hopes for a deal to end the Iran war. The VIX right at 17 right now, creeping higher. The 10-year 4.37% with the 2-year 3.87%. Gold flat on the day at 46.18 the ounce. Crude, though, big story, slumping 2.7%, but back at 102.20 on WTI. Brent, the global benchmark, 108.39. Barrel of Brent down by 1.8%. Apple shares rallying after last night's earnings report. Apple higher now by 3.5%. It did deliver a surprisingly strong revenue forecast for the third quarter, even as it warned that memory chip costs will increase. Recapping, S&P at a record, up now by 0.4%. Carol and Tim, that is a Bloomberg Business Flash.
All right, Charlie, thank you so much. We're going to stick with earnings. We've got another conversation from the C-suite, and this has to do with Magna International. It's an auto parts retailer. You know that. Company out with earnings. Stock selling off at one point down nearly 10% at its intraday low today after cutting its sales forecast for the full year. Evercore ISI out, saying that given the run-up of shares into the print, the stock was up nearly 20% prior to today's earnings. Evercore ISI said there was a somewhat elevated bar for Magna and that the stock saw a big first quarter EBIT margin beat that did not flow through to the full year outlook. This according to the analyst over at ISI, Chris McNally. Magna, these are his words, was generally expected to have a solid first quarter and focus was all on the guide, he said.
With more, we're joined by Swami Kotagiri, the CEO of Magna International. He joins us from Troy, Michigan. Swami, it's always good to have you on the program. We're going to get to the quarter into earnings, but I want to just start with some news that we heard from the president. Just a little earlier today, the U.S. is set to hike a tariff rate on EU auto imports to 25%. This coming from the president just a little earlier today. What does that do for Magna International?
Yeah, we've been dealing with trade policies and tariffs over the last 1 year. As you know, Tim and Carol, we have a footprint in Europe and other parts of the world. The important thing is, in most of the places where we are present, we are aligned with the OEM and we produced systems and components and supply to them locally. So really not much travels across ocean for us. So it's going to be how the strategy of the OEM changes, not as much an effect for us. And mostly, in most of the cases, the OEM is the recorder, importer, they're responsible for it.
So, Swami, in this case, this news doesn't, in other words, doesn't have any effect on your company, nothing material?
Not the first order effects, obviously. As vehicles start having a different price point and different hurdles as they come across, there might be an effect on the demand of the vehicles, but not directly to Magna.
One thing I want to ask you, as of early 2026, average transaction price for a new car in the U.S. officially exceeded $50,000, with Bloomberg reporting a record of roughly a little bit above that. And I'm just, we're buying bigger vehicles, EVs are more expensive. How does that at all impact your business?
Yeah, Carol, that's a great question. The DNA of the Magna, especially the auto industry, but more so for Magna, is continuous improvement. We call it operational excellence. We go through this improvement process year over year, and that is the reason why we have been able to post such good results even in the first quarter, where we expanded margins, generated solid cash flow, and reaffirmed our full year outlook. And that is nothing but execution despite the softer production environment. So we have to continue that process and, do little by little. We call it inches make champions. And, we look for every penny everywhere in the organization.
One thing that we're trying to get a good handle on, Swami, and we're going to be speaking to some other CEOs in our 3 and 4 o'clock hour, is what the consumer looks like, not just in the United States, but around the world, and how that behavior has changed with gas prices moving higher. What can you tell us, just what you're hearing from OEMs right now, and really what you're seeing as far as your product moving?
Yeah, I think, as you know, Tim, we have a broad portfolio, so we have the chance to have those strategic discussions with the OEMs. From a consumer perspective, affordability is definitely, top of the list. From a consumer preference, they're looking at different features in terms of safety, comfort, and convenience. That is what is defined as the software-defined vehicle or the smart car, whatever name you want to give it. There is a balance now of how to get all of this into platforms so that you can still get the features that the consumers in the market demands, but in a way that is economical, and that you can get by scale, right? And that is where we at Magna talk about modularity and scalability, so you can engineer once and deploy it many times. And that is the thing, over the last few years, there has been a significant change in trends. It's been EV, it's been autonomous, it's, a whole bunch of things changing, connectivity. So we're seeing the confluence that we've never seen before. Now the question is, how do you prioritize so that you can give the consumer what they want and still keep it affordable?
Yeah, I think about the factors right now, Swami, coming at car buyers, right? Higher gas prices, cars just expensive. You see this flat production environment globally, particularly on the back of those rising gasoline prices. So I'm just curious, you mentioned, really squeezing out costs. Is that the strategy? That's how you guys navigate through all of this to keep the business where you want it to be?
Carol, you bring up a good point. One of the things that you have to remain flexible and be resilient. We work in an industry that has long cycles. It used to be 4 years and 3 years. Now we're talking about 2 years, but still a long cycle. So in other words, what you're producing today has been designed at least 2 or 3 years before, right?
Yeah.
So you have no option but to think of scalable and be resilient so you can react and be agile about it. And from a design perspective, that's where I talk about modularity and scalability. The trends are changing. So you can't say, I designed this and that's all it's going to be. You look at our powertrain, we are addressing EVs, we are addressing hybrids, we are addressing ICE vehicles. As the trend changed, for example, in North America from EVs, pulled back a little, and now we are starting to see a significant trend in hybrids. The portfolio was set in such a way that doesn't matter which way it goes, we can lever up the particular module scale and get back to the market. So on the design aspect, that's how we are looking at it. We have to do the same thing in assembly lines and process. If the volumes go up and down in demand, we have to be able to react to it. Mm-hmm. And on top of that is what I said, you got to look at every penny across the organization. So it's a combination of all of this to stay competitive in the market.
We have about a minute left, Swami. In this environment, we're seeing higher commodity costs with oil still above $100 a barrel. We talk, of course, about higher gas prices, but then the second order derivatives that come from that when it comes to refining and refined products. Just in 30 seconds, how does that affect your business?
Yeah, some of the pressures that we see, obviously, now with what's happening in the Middle East is energy, freight, and certain input costs like resins, right? The playbook is the same. We have, first order is mitigate operationally as much as you can. Then you work through commercial recovery mechanisms that are in place over time. And you need to do this, collaboratively with the customers.
Yeah, it's just such a wacky environment. I just think about, higher gasoline prices. So, your regular combustion engine cars, that feeds into that. Power prices are up, though. So I've heard people say, I've got an EV, but what it costs now to charge. Like, it's just, there's a lot coming at the customer, but also those who are in the auto sector, and it just doesn't end. Swami, you always find time for us. Thank you so much. Tim and I really appreciate it.
Thank you.
That is Swami Kotagiri. He is, of course, the CEO of Magna International, joining us there from Michigan.
Coming up next on Bloomberg Business Week Daily, stocks on the move, where the S&P 500 on a day up 0.4%.